Wall Street extends gains for the second straight session, with S&P 500 and Nasdaq hitting another fresh record high amid expectations of a rate cut from the Federal Reserve in the next policy meet. Dollar weakens further while Treasury yields fall. Asian markets open mixed this morning. Nikkei falls from record highs while Taiwan and Hang Seng continue to rally. The GIFT Nifty is indicating a muted start for the Indian markets. Oil prices fall to over 2-month lows on bearish supply guidance from the US government and the International Energy Agency, while gold prices gain as investors ramp up Fed rate cuts bets. ICICI Bank revises rupees 50,000 minimum balance requirement for new savings account customers to rupees 15,000 following the feedback from customers. The bank says that they have revised the minimum account balance lower to better reflect customer expectations and preferences. US President Donald Trump warns that Russia will face very severe consequences if President Vladimir Putin does not agree to end the war in Ukraine during their meeting on Friday in Alaska. In a meeting with European leaders, the president also believed to have agreed that Ukraine territory should only be negotiated by Ukrainian President Zelensky. Hello, good morning. You've tuned into CNBC-TV18 and you're watching Power Breakfast with me, Vinny Motiwala. An interesting day, a positive day that came in for the Indian markets yesterday, given that we'd seen so much of a handover coming in from the global markets. Asian markets were strong yesterday, but today, what it's looking like is a mixed opening that we're seeing coming in for the Asian markets. Taiwan index, as of now, yes, opened up with some bit of a gain and now has come to the side of the red, down 0.2%. Hang Seng, on the other hand, is managing to hold on to gains of 0.2%. ASX 200, 0.6% of gain is what we're seeing there for the Australian index, while Shanghai also is managing to hold on to gains. Now, Nikkei yesterday, that was doing well, right? In the last couple of trading sessions, Nikkei today has seen some bit of a correction from those record high levels and is down 1.43%. Obviously, a mixed signal that we're seeing coming in from the Asian markets. What is the Nifty implied open indicating for the Indian markets today? A muted start, 21-point decline, side bit of a negative bias as of now is what is indicated that is coming up in terms overall for the Indian market. A lot of cues that we are going to be keeping an eye out on as well, given that as of now the stock futures in the US are seeing a bit of not much of a move. So muted maybe is what we could be watching out for. Indian markets is a truncated week. Today is the last day of trade for the Indian markets as well. So that is something that we will be keeping an eye out on. And obviously, the US markets, we saw that, they managed to see gains coming in the US market as well. So whether you look at the Dow Jones, Nasdaq, S&P 500, all of them managed to close with gains. But, that's the global market action that we have, more like the Asian market handover that we have coming in this morning. How is all this actually going to be impacting our Indian markets? We'll have a team of research joining in with us to set us up for trade, which are the important stocks to watch out for in today's trading session as well. So we have Gaurav to talk to us about the stocks. But before I go to Gaurav, let me take you through what the trade setup is looking like for the Indian markets. So yes, in terms of trade setup, like I mentioned, the handover from US is not bad. We've seen that gains coming in as well. Tech in the US did really well. So AMD, whether you look at Apple, managed to close with very strong gains. We had a lot of commentary that came in from Trump overnight as well, and especially in terms of the meeting that will be held with Putin tomorrow. So on the back of that, we could see some bit of a move coming in for the Indian markets as well. FIIs on that front, FIIs were sellers in the Indian markets again. 3,644 crores approximately is what they sold in the equities, while DIIs continued to be buyers of around 5,600 crores. Important to watch out for in terms of factors today, weekly expiry, do not forget that. We have the WPI inflation data that will come in today, so that is important. Trade data for the Indian markets is important. We have CM that will be releasing the car sales data for the month of July. Keep an eye out on that one. A lot of earnings today, last leg of earnings that is coming in. So Indian Oil Corporation, Vodafone Idea, Patanjali Foods, Ashok Leyland Pharma, we have Glenmark Pharma and Inox Wind also will be reporting their numbers. Some of the moves that we'll be seeing coming in on these companies. Other than that, Saturn Credit will also be in focus fundraising plans there. And do not forget, US Department of Commerce will be reviewing the exemption related to the 90-day tariff exemption that was there for electronics from India. So that will be a key to watch out for, but that will come post-market hours. But that's an important event that we'll keep an eye out on. New debutant on the D Street today, JSW Cement listing happening today. So keep an eye out on that. And Nifty, obviously, yesterday ended on that positive note, reclaimed the 24,600 levels yesterday. Resistance and support that we'll be keeping an eye out on. 24,750 in terms of resistance and around 24,350 is the support that we have for the Nifty today. So keep an eye out on these levels as well. But that's the setup looking like for today's trading session. Which are the important stocks that we should be keeping an eye out on? Gaurav's here to take us through that. Good morning, Gaurav.
Well, good morning. First, let's talk about BPCL. A good set of numbers is what we saw here. Company reported profits of around 6,100 crores, which was actually higher than our expectation. And at the same time, revenue also was higher than what we were estimating. Other than that, Jubilant Foodworks, here also we saw a good set of numbers. In fact, the growth was actually better than the peers. Net profit that came in at around 66.67 crores, while margins, they remained at around 19% versus what it was at 19.2% as estimated. Other than that, Muthoot Finance, now this company actually came up with very good set of numbers. When we look at net interest income, profit, every parameter is what we have seen a beat from the company. Net profit is now at around 2,046 crores. When we look at loan book growth, that was also at around 40% on a year-on-year basis. Now the loan book stands at around 1.2 lakh crores. Other than that, United Spirits, good set of number here as well. Net profit that increased almost to 258 crores, a bit lower than our poll, but at the same time, revenue came in line with what we were estimating. Texmaco Rail, on the other hand, actually reported some decline in profit. That declined almost by 50%. Now the profit stands at just 30 crores versus when we look at the revenue, there also we saw a decline of around 16% on a year-on-year basis. IRCTC, inline set of numbers is what we can say. Net profit that increased almost by 7%, while revenue increased almost by 12% on a year-on-year basis. Other than that, let's also focus on Jain Irrigation. Now company has secured an order worth 135 crores, and this is for solar pumps in Maharashtra. Zydus Life, now this is also in focus, and the reason being that company has got zero observations from the US FDA inspection at one of the facilities at Ahmedabad. And lastly, let's also focus on ICICI Bank. Remember, a few days ago, bank had raised their minimum average balance. Now they have reduced the balance once again. For metro and urban, it has been reduced to 15,000 versus what it was at 50,000. For semi-urban, it has been reduced to 7,500, and for rural location, it has been reduced to 2,500. So definitely, all these stocks are going to be on our radar today.
Okay, Gaurav, thank you so much for that. Keeping an eye out on all those stocks on our radar today. But on that note, we're going to slip into a very short break. Don't go anywhere. We'll be back with more updates after the break. Welcome back and thanks for staying tuned into Power Breakfast on CNBC-TV18. Now, US President Donald Trump has spoke with the European leaders ahead of the meeting that he has with Russian President Vladimir Putin. CNBC's Iman Javers is bringing us a report on what's at stake.
We're told that call between the president and European leaders took place at 9 a.m. this morning. President Zelensky of Ukraine in Berlin today, meeting with European leaders, trying to set some parameters around what he may or may not agree to ahead of this high-stakes meeting between Trump and Putin in Alaska on Friday. The president has been monitoring some of the television coverage, and he's seen some criticism today of this meeting, criticism that simply by meeting with Vladimir Putin on U.S. soil, he's granted the Russian president some kind of a win here. The president taking to social media to express frustration with that idea. Here's what he posted a short time ago. He said, "Very unfair media is at work on my meeting with Putin, constantly quoting fired losers and really dumb people like John Bolton, who just said that even though the meeting is on American soil, Putin has already won. What's that all about? We are winning on everything," all caps, says the President of the United States. The question here is, what agreement can these two countries come to on Friday? The White House has said that Vladimir Zelensky of Ukraine will not be at this session in Alaska. So is there a deal that the U.S. can broker with Russia without Zelensky at the table? The White House Press Secretary Caroline Leavitt saying yesterday that this is more of a listening exercise for President Trump to simply hear out what Vladimir Putin wants and what he might consider in terms of final negotiations. So the expectations here, I think, being tamped down from this White House about whether or not we'll get a final deal here to bring an end to the war in Ukraine. More like a sense of what the Russian position is going into some final negotiations. Whether that war can be brought to a close this year, really up in the air at this point, guys. Back over to you.
Thank you so much for that. Now, when asked about any possible consequences for Russia if President Putin does not agree to stop the war after the meeting, Donald Trump said that there will be severe consequences. Listen in.
Will Russia face any consequences if Vladimir Putin does not agree to stop the war after your meeting on Friday?
Yes, they will. Yeah.
What will the consequences
there will be
be?
consequences.
Sanctions, tariffs?
There will be, I don't have to say, there will be very severe consequences, yes.
Meanwhile, French President Macron says that Trump wants Ukraine involved in territory talks with Russia. Listen in.
The second element that was very clearly expressed by President Trump is that the question of Ukrainian territory can and will only be negotiated by the Ukrainian president. This is the position that we support, and it has been very clearly expressed by President Trump. And so this heralds our meetings in the future.
Let's get more details in terms of the U.S. market, right? Wall Street ended higher. Dow Jones was up around 464 points. S&P 500 added 21 points. And NASDAQ rose 31 points in yesterday's trading session. We have CNBC's Bertha Coombs, who's joining in with us to give us a wrap.
U.S. markets were higher across the major indexes in Wednesday trading as investor hope of lower interest rates ahead continues to fuel a rally on Wall Street. The Dow up 464 points, the S&P 500 adding 21, and the tech-heavy NASDAQ higher by 31 points. The Trump administration is considering 11 candidates now to replace Fed Chair Jerome Powell. CNBC's Steve Leisman reporting Wednesday on 3 of those potential picks who have not been publicly named until now. They are Jefferies chief market strategist David Zervos, former Fed Governor Larry Lindsey, and Rick Reeder, the chief investment officer for global fixed income at BlackRock. And more signs of life in the IPO market as crypto exchange Bullish went public on the New York Stock Exchange Wednesday, more than doubling after pricing above its expected range. Bullish, which is the parent company of crypto news site CoinDesk, priced its IPO at $37, but it started trading at $90 a share before finishing the day at $68, up 84%. That's what's happening here in the U.S. Back over to you in Mumbai.
Thank you so much for that. Now, the Trump administration is actually considering 11 candidates to replace Federal Reserve Chairman Jerome Powell when he retires next year. CNBC's Steve Leisman is joining in with us to give us more details on the process for selecting the next Fed chair.
CNBC has learned the Trump administration currently considering now 11 individuals, including 3 names that have previously not been disclosed, to replace Fed Chair Jay Powell when his term expires in May. According to 2 administration officials, the 3 new names include Jefferies chief market strategist David Zervos, former Fed Governor Larry Lindsey, and Rick Reeder, who is chief investment officer for fixed income at BlackRock. We now join a list of 8 other candidates that CNBC has confirmed are under consideration, including Fed Vice Chair for Supervision Mickey Bowman, Fed Governor Chris Waller, and Fed Vice Chair Philip Jefferson. Add to that NEC Director Kevin Hassett and former Fed Governor Kevin Warsh, mentioned by the president right here on Squawk Box. The officials described, quote, a deliberative process now taking place where Treasury Secretary Scott Bessent will interview each of these candidates, winnow down a list, and then pass it along to the president for a final decision. The size of the list and the process described suggests a decision not imminent. That could take a considerable amount of time, but the officials would not offer a timetable. The longer the process takes, though, the less likely there is to be a so-called shadow Fed chair in place approved by the Senate before Powell departs. Though sharply critical on an almost daily basis of Powell, President Trump has recently backed off suggestions he might replace the Fed chair before the end of his term. While many candidates on this list have advocated reform at the Fed, most have supported its independence, and they would appear to be a list of people with considerable either monetary policy, market, financial, or regulatory experience. Most of them also have advocated for rate cuts.
Okay, that's the update that we have coming in from the US market. But on that note, we're going to slip into a very short break. We'll get you the cues from the world of commodities after the break. Welcome back to Power Breakfast on CNBC-TV18. Now, update coming in on the solar PV front. India has achieved a historic milestone of 100 gigawatt solar PV module manufacturing capacity under the approved list of models as well as manufacturers, which is a remarkable rise from just 2.3 gigawatt in 2014. New and Renewable Energy Minister, that is Prahlad Joshi, wrote on X that India is building a robust, self-resilient solar manufacturing ecosystem, and this achievement strengthens the path towards Atmanirbhar Bharat and the target of 500 gigawatt non-fossil capacity by 2030. Now, Prime Minister Narendra Modi also hailed the milestone towards self-resilience in achieving 100 gigawatt solar PV module manufacturing capacity and efforts towards popularizing clean energy. Okay, now let's get to the latest update that's coming in the world of commodities. We're Manisha joining in with us for that. Good morning, Manisha.
Morning, Vinny. Thank you for that. I'll start with the crude oil prices because we are looking at a 2-month lows, a further 2-month lows really onto this one. The U.S. inventory data that came in yesterday shows that the U.S. inventory is gained up by 3 million barrels, much higher than what the street was anticipating. And then apart from that, IEA has talked about a surplus in 2025 and 26. The U.S. inventories are expected to rise at a record pace to 46-month highs by the mid-2026. All eyes, of course, on 15th of August, and that is when the U.S. and Russia are meeting. Various statements already ahead of that meeting coming in from both camps there, but this is an event you wouldn't want to miss if you are looking at crude oil prices. I also want to talk about the copper prices because we are finally moving on the higher side here. Copper is trading at a 2-week highs. The optimism over global trade has improved. The U.S. and China trade truce extended by another 90 days also has been supportive. Metals in general are doing quite well in this week at this point.
Okay, Manisha, thank you so much for that. But with that, we're absolutely out of time for this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you in different attire than normal, than the tie and the suit. And I think this is much better because it's, of course, the eve of Independence Day. So first up, let me wish all of you a very happy Independence Day. If you're celebrating it early, tomorrow, of course, is a market holiday. We're coming to you, as I said, from the Motilal Oswal CNBC-TV18 studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good morning.
Hi, good morning. You know, this year, when we enter Independence Day, the entire geopolitical environment is a bit challenging. So let's hope we come out, we turn our challenges into opportunities, and India emerges united, strong, and self-reliant. Freedom we've inherited. But now it's time to take it forward.
Well, that's right. You're looking forward to the long weekend, right? I mean, 3-day weekend. And for those children who had a Thursday holiday, well, they've got a longer one. 4 straight days.
It is a holiday?
For some schools, yes. As you're growing up as well, there were some schools. So you long for these kind of long weekends. I'll tell you what.
Told me this is the last long weekend.
Yeah, I think so. I think so.
Yeah.
I think so. And
guys, there's a day to go. So,
and in September, there's no holiday. So, but besides that, talking about the markets and how challenging it is, I think today is the day you remember the big bull, right? Rakesh Jhunjhunwala, death anniversary as well. And he always said, right, in adversity, you know, you look to buy, you look to be invested in India's long-term story. So remembering the great man, may his soul rest in peace.
Absolutely, and I think that's a nice tribute, Nigel. Let's just, as always, take a quick look at where things need to, what you need to know as we start another session, right? You basically have, and I want to start with not what happened yesterday evening, but what's ahead of us. And it's basically 2 things. One is the Trump-Putin meeting, and I'll talk about this in a little bit in greater detail. But equally important now, which was not in the mix a couple of days back, is Prime Minister Modi's Independence Day speech from the Red Fort in Delhi. The second one, PM Modi's speech, especially in the context of where we find ourselves, a bit of a tough spot, back against the wall. And I know it sounds cliched and everything, whether, another wave of reforms, and some have said the 91 moment. Well, don't go that far, but I think another leg of reforms, I think, would be pretty welcome to basically unleash entrepreneurial forces and, of course, help job creators in that sense, because that is the need of the hour. The first one I'll get to in just a bit. But before that, let me just quickly recap overnight action, which is not very much. S&P was up about 1/3%, NASDAQ 0.14% higher. Small caps, by the way, last 2 or 3 days have been doing a little better. So you look at the Russell 2000, it was up 2%. So large cap tech has been outperforming. Small caps have been doing much better. Macro markets, 10-year yield, 5 basis points lower. Dollar index was down about 0.4%, 97.7. I mean, that's a big one, right? And day before yesterday. So this week, actually, we've lost, 1.5% so far on the dollar index. The broader dollar, that's quite consequential. Oil prices, 65, just under $66 a barrel is where we stand. CNBC, in the US, reported that 11 candidates were in the running for the FOMC chair, which is, essentially a replacement to Fed Chair Powell. Remember, Fed Chair Powell's term only ends in, I think, May of next year. So he's got a while to go. President Trump, though, after that report aired on CNBC, came out and said that, the Fed Chair pick was down to 3 or 4. So CNBC said 11, and Trump said that, well, it's down to 3 or 4 picks. Actually, it's not about, who. Of course, it matters who. But I think what matters more at this stage is when. When is the announcement? Because if the announcement is now and somebody's going to do backseat driving, if, say, for example, they announce that so-and-so is going to be the new Fed chair, what happens to all the subsequent meetings where Fed Chair Powell is essentially, will he be able to hold sway? Will he be able to do what he wants to do in terms of policy decisions, etc.? Or somebody essentially else is going to be doing some backseat driving? And that's essentially the concept of the shadow Fed. So it's when more than who at this point in time. So we'll see. The other next point, of course, is the Trump-Putin meeting tomorrow. And here, Trump spoke with European leaders and Ukrainian President Zelensky yesterday. Latest headlines suggest that a good outcome, I mean, a great outcome would be a deal tomorrow, right? I mean, for peace. But if you just parse through the headlines, etc., I think you need to dial back expectations a little bit, because it seems like tomorrow's meeting is being projected now, I think deliberately so, as a bit of a scoping the arena for what is possible. And then the headline suggests that there perhaps is a trilateral meeting between Ukraine, US and Russia towards the end of next week, potentially, possibly, hopefully. So expectations for what can come out tomorrow in terms of an actual signed and delivered deal, I think have to be dialed back, because that is essentially what we're picking up from everything which is out there. So I'll just circle and tie in the levels here. Yesterday, of course, the market came up, but we're still not out of the woods. I mean, the inclination is for the market to go higher than as compared to lower. But you got to clear these resistance levels, right? The first one is 24,702. After that, the 20-day moving, by the way, we didn't clear it yesterday, 24,702, which is the high day before yesterday. If that gets taken out, the next resistance is 24,782, which is the 20-day moving average. And then you got the 40-day exponential, 24,840. All these levels within about 150 odd points in the Nifty is very, very close by. And that's the reason why I'm putting this out. Support for the Nifty, 24,337. Bank Nifty resistance zone is 55,582 to 55,652. And the support here is at the low of 54,905. Gift Nifty gives you a quick sense of where we're likely to start. Absolutely unchanged. 5 or 6 points lower as we go into this long weekend holiday tomorrow. Rima.
Truncated week, long weekend, and plus we've got the Nifty weekly expiry today.
Yeah.
But it's a flat opening for the Gift Nifty. In fact, Asia too is very, very quiet. Nikkei is retreating after hitting record levels yesterday. So the Japanese market is a cut of about over 1%. Hang Seng is up about 0.5%. Taiwan is down. So it's a mixed picture across Asia this morning, but it's been a winning week for Asia broadly. Big gains seen in Hang Seng, 3.5% up so far. You've got the Japanese markets, despite the correction today, rallying more than about 2%. And the Indian markets too, so far, are up close to about 1%. In terms of the other big headlines, Trump has signed an order to ensure resilient supply chain for essential medicines in US. So he's basically signed an executive order for essential medicines by filling the SAPIR, Strategic Active Pharmaceutical Ingredients Reserve, with critical drug components. So it could impact API makers. We'll have to wait by to see on India. But the goal is 6 months supply, of the key drug ingredients to be stored domestically. So pharma will be on our radar. Also for China, interesting news coming out that they have experienced negative net new loan growth for the first time in 20 years. Basically, the amount of loans repaid by the households and businesses exceeded the amount of new loans issued. This hasn't happened in the last 20 years, and it happened in the month of July. So it questions, the confidence that households and businesses have in the domestic economy, that the loans repaid exceed the new loans that they want right now. In terms of flows, the DII's net bought 5,600 crore in the cash market. Yesterday, the FI sold about 3,644 crore. In terms of what to watch, as I said, Nifty weekly expiry today. ICICI Bank has lowered the minimum balance requirement to 15,000. There is that big JSW Cement listing. Subscription was pretty strong. It was a large issue, 8 times plus in terms of an overall subscription. And even electronic makers, because there was this 90-day waiver. Electronic exports from India to the US were not tariffed. There was a 90-day window exemption, and that expires today. So are we going to see an extension of that window of relief? That remains to be seen. And in terms of big earnings to watch, Glenmark, Ashok Leyland and IOC. And earnings reaction we'll get to in our top 10 segment. But Nigel, what are you looking at?
Well, let's keep an eye out on the weekly expiry. The second half of trade will be volatile because today you have the weekly expiry that will play out for the Nifty contracts as well. And we are bracing to break that losing streak. Remember, 6 straight weeks the Nifty has ended in the red. Today we need to defend this mark to break that losing streak and in fact end mildly in the green. So let's hope that does happen from a bullish perspective. The problem in the last 1 month has been the Nifty Bank. So yes, the Nifty has lost close to around 2%, but the Nifty Bank actually after leading has underperformed. It's down close to around 3%. And even yesterday's trade, though we ended higher, the Nifty Bank underperformed, and there are mild shorts that are getting added into the system. And the index that's more shorted actually is the Nifty Bank, because yesterday as well it underperformed, and you did see some addition in terms of open interest. For the market on the whole, well, if you look at what the FIs did, that short covering bounce actually is still awaited. They're holding on to the short positions, very, very meager shorts covered yesterday, 866 contracts, that's hardly anything, and they continue to remain at around 91% net short. So the markets are net short, the FI is aggressively net short, they're holding on to that short position. Well, in fact, if they get caught on the wrong side, that'll be interesting to see how things play out from there. But in yesterday's trade, well, if you look at the puts, there were more puts that written than calls, both for the FIs as well as clients. So that's giving you some hope that maybe the near-term low, or the 200 DAB, at around the 24,100 odd, will hold out. And the options data should come up for you on the screen, because yesterday we saw aggressive writing. 24,600 put, 24,550 put. Now, these put writers, they are looking to eat into this premium. Yesterday, at least, this premium was down by 40 to around 60% in trade. So they are looking to eat into this premium, and they're hoping that the lower levels do get protected. So let's get the levels up for you on the screen. Well, crucial support comes in at around this 24,450 mark. That's the important mark you're looking at on the downside. The resistance comes in at around 24,750, and the 20 DMA as well in that vicinity. So this is the crucial resistance mark, while support comes in at around 24,450. In terms of stocks that I'm looking at, well, let's see whether or not PVR will be the stock in focus, because you have two big releases. We have Rajnikant's movie that will be releasing, as well as you have War 2. And, the pre-booking was pretty okay for both those two names. So we'll keep an eye out on PVR ahead of the long weekend, whether or not people find their way to the cinema halls. And the other one I'm looking at is PNB Housing Finance. I've been making this point that the open interest gradually is coming in lower on PNB Housing Finance. So it had moved into the F&O ban. The total open interest needs to shed by around 2.5%, and then it could possibly come out of the F&O ban. So that's a stock I'll continue to keep on my radar.
All right, Nigel, thanks very much for that. Mark Franklin is Deputy Head of Multi-Asset Solutions Asia at Manulife Investments. He's with us. Mark, good morning. Great to have you with us here. Looking at the headlines, basically out of Russia, Ukraine, and the meeting tomorrow, should we dial back expectations for an announcement tomorrow, Mark? Eventually, something may happen, but out of the first meeting tomorrow, you think we should keep hopes a little lower?
Good morning. The reality is that it's a very complex situation. There are objectives on the Russian side which clearly don't overlap with the objectives on the Ukrainian side. It's not just about striking a deal, even if it's verbally communicated. It's also the nature of the deal and the extent to which all parties feel that it can hold. In general, though, if the musings coming out of the meeting are somewhat positive, it could be in the short term helpful for risk appetite across global markets. And it may actually serve as a bit of a disinflationary tailwind for those types of exposures which people have built into as a geopolitical hedge or an inflation hedge as well. And then the opposite applies if there's no seeming breakthrough from the conversations tomorrow.
The street is hoping for a breakthrough, because then the hope lies that the secondary tariffs on India for procuring Russian crude oil can be lifted. So that additional 25% could go away. So we'll be watching that very closely. But generally, the geopolitical dynamics between US and India have been a bit unfavorable. And the FIs we've seen relentless selling pressure by the FIs. What's the view now on India?
It's a great question. So there was one school of thought saying that India is a very much a domestically driven economy, not as sensitive to global trade dynamics as other markets, and therefore somewhat immune from the tariff regime that we're now moving into. But the other way to look at it, of course, is that the US is very keen for the Indian government to open up domestic market access to foreign players, to imports. And so equity market constituents have perhaps more to lose from that opening up. And that's probably been a bit of a headwind for Indian equity market sentiment in the recent days and weeks.
Hi, Mark. Good to see you. When we chatted last as well, you said you had your neutral stance on India. Now, we have underperformed for the last many months. Do you think you're gradually believing that it's time to get into India? And also, what are you reading in terms of the economic activity here in India? I recall we had chatted about the credit growth not picking up. And that continues to remain a bit of a sticky point. But the hope is that that picks up. So your reading of the Indian economy, and do you think the Indian markets are coming to those levels when you want to gradually shift that neutral stance?
The two factors are somewhat intertwined. You need some kind of macroeconomic catalyst, a re-acceleration to drive flows, both domestic and overseas, into the Indian equity market. We still officially remain neutral on India at Manulife. one of the things that is incredibly helpful for policymakers is both CPI and WPI inflation really moving in the right direction and creating room for policymakers to cut rates. But the RBI, to some extent, rightfully so, points out that a lot of the disinflationary forces are coming from the food sector, and the potential is for that to reverse at any point and without much warning. So they still remain somewhat cautious, but clearly the more they feel able to cut rates aggressively, the more it has a chance to reinvigorate credit demand and then rebuild a new credit cycle in India. But for the time being, loan growth does remain somewhat sluggish by historical standards, not in absolute terms, of course. And that also explains why the Indian banks have somewhat lagged the market in the last month or so.
Absolutely. Mark, we'll leave it there. Thank you very much for joining us. Good speaking with you here on CNBC-TV18. It's a quick word coming in as far as markets are concerned. We'll take a quick commercial break here. We'll come back with our top 10 list of stocks to watch out for in just a bit from now. You'll also have lots of managements joining us. The first at 8:35 will be Sami Hotels, and we'll discuss the quarter gone by. At 9 o'clock, we'll have the management of CSB Bank, which will be with us to talk about their first quarter performance. 9:20, Manishi Chaudhary will be with us to talk about Indian markets. 9:30, Muthoot Finance. There is an upgrade as well. Stock should do well. Max Healthcare will be with us at 9:40 to talk about the hospital's business. Abhay Soi there. NHPC 9:50 on their first quarter performance. And towards the end of the program, Lata discusses with economist Aditi Nair and Bandhan fixed income head Suyash Chaudhary if Indian bonds are crashing because of fiscal deficit fears. Stay tuned.
And we slip into a short break. On the other side, we go full tilt on the top 10 stocks that we're looking at. For the time being, I'll run you through the list. BPCL, United Spirits, Muthoot Finance, Jubilant Foodworks, IRCTC, all of them will be reacting to positive news flow. Add to the list, Endurance Tech, Vishal Mega Mart, and Infosys. While on the flip side, Deepak Nitrite as well as ABFRL will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. Let's talk about stocks. Our research team is standing by with CNBC-TV18's list of top stocks for the day. And let's begin with BPCL and the numbers. Sonal joins in. Hi.
Good morning, Rima. Well, good set of numbers coming in from BPCL. It was a top-down beat. Revenues increased versus an expectation of a decline. EBITDA was up 24%. We saw margins increasing to 8.6%, and profits were higher as well at 6,123 crore rupees versus a poll of 5,500 crore rupees. GRMs, though, lower than what the street was working with, and on a quarter-on-quarter basis. This beat was actually led by the marketing segment, where marketing volumes also increased, and so did the margins. Morgan Stanley has an overweight rate with the target price of 406. They say it was a beat versus the consensus as well, and if they adjust for inventory losses, the earnings were even higher, so they remain positive on the stock.
All right, Sonal, thanks a lot for that. Sonal, where's the smile? It's the end of earnings. I thought you were going to be, end-to-end smile out there finally. But Mangalam's giving us that, and so as well as Gaurav. Yeah, Mangalam, tell us, you're going cheers all the way?
Cheers all the way for United Spirits, Nigel, this time around. The EBITDA has come in at 415 crores. The street was working with a number of 417 crores, so no problems out there. Margins at 16.3%, and thereafter, the net profit as well, mildly below expectations, but that's because of an exceptional loss. In fact, on the operational front as well, there is a one-off. So the company said that excluding the one-off, the EBITDA margins would have been 17.9%. That would provide a bigger kick to, the watchers of the share more than anything else. Even the volumes, Prestige and above, the volumes were up 9%. The street was expecting 5 to 6%. Popular volumes were up nearly 11.5%. The street was working again with a range of 6 to 8%. Total volumes up near double digits. So these are reasons for cheers for United Spirits. What we already knew were the revenues for the company coming in at 2549 crores versus 2352 crores, which the company had revealed in their first quarter update itself. So operationally, it's a strong brew.
Absolutely. Mangalam, thank you very much for that. Muthoot Finance is the next one in focus. Gaurav is here with details. Gaurav, good morning.
Well, yes, when we look at Muthoot Finance, very strong set of numbers and the beat across all the segments. When we look at AUM growth, that was at around 42% on a year-on-year basis. Now it stands at 1.2 lakh crores. When we look at net interest income, that increased almost by 50% on a year-on-year basis. This was higher than the street's expectation, and this was led by 400 crores of extra income, and this was because of the recoveries from NPA and as well as some principal received because of the ARC. Other than that, PPOP that grew almost by 60% on a year-on-year basis, again stronger than the street's expectation, and this was also led by the other income segment. When it comes to profit, now it has increased, it has almost doubled, it has increased almost by 90% on a year-on-year basis. This was again higher than the street's expectation, almost 22% higher than the street's expectation. And when we talk about some ratios now net interest margins, they have expanded almost by 88 basis points on a sequential basis. Now this was because of the 400 crores of extra income, and at the same time credit cost, which defines the asset quality, that has also come down to 0.2% versus what it was at 0.5%. This was also stronger in terms of the expectation. So definitely all in all good set of numbers. We also saw brokerage is actually upgrading. We have got Morgan Stanley who upgraded the target price as well as rating. So definitely positive set of numbers from Muthoot Finance in this quarter.
Indeed, Morgan has upgraded it to an overweight. Their target price stands at 2,920. For CLSA, target price 2,740. We've got the management joining in 9:30 a.m. for their Q1 earnings fine print. Mangalam is back with us. Jubilant Foodworks and IRCTC. How are the numbers?
Well, good performance coming in from Jubilant Foodworks as well. The EBITDA 323 crores. Again, the street was working with the numbers similar to that, and the net profit as well, closer to 66 crores. The expectations were that of 65 crores. So absolutely in line, but the internals are strong. Consolidated revenue growing 17%, standalone revenue growing 18%. This is something that the company had apprised the street of in their first quarter update. But the Domino's India like-for-like growth coming in at 11.6%, led by delivery like-for-like growth of 20%, is something that the street would be positively surprised by. Delivery channel revenue itself grew by 24.5%, which implies that it's actually faster than all the other food aggregators. So they've continued to gain market share, and delivery now accounts for nearly 73% of their sales. And if you're looking beyond pizzas, Popeyes as well, double-digit same-store sales growth in South India is a recent addition to their portfolio with quarter-on-quarter improvement in profitability. So things baking well for Domino's or Jubilant Foodworks. For IRCTC, the reported numbers are soft with a revenue growth of 3.5%, EBITDA growth of 6%, and a net profit growth of 7.5%. But the key, driver of growth for the company is the ticketing business, and there the performance is strong. 9% growth in their revenues and 10% growth in the EBITDA, margin expansion as well. So I'm going with green on IRCTC and Jubilant Foodworks.
All right, Mangalam, and I'm hopefully going with the pizza later today, from Jubilant Foodworks practically. Let's hope, Mangalam, you oblige.
Well, we'll take a call on that.
All right, let's hop across to Sudarshan. He's here to tell us about Endurance Tech. Sudarshan, you're looking like the man who's relieved that this earnings season has come to an end. Looking forward to the long weekend. For the time being, tell us about Endurance.
So another auto ancillary companies after Bellrise Industries and Minda Endurance Tech has come out with a strong set of numbers for Q1 FY26. Operating numbers have seen a double-digit growth with revenue rising 18%. EBITDA too has seen a jump of almost 19% and holding on to margin steady above 13%, at the same level as Q1 of FY25. Now, company continues to see outperformance from the Indian operations, where Indian operations form around 70% of total sales. And in Q1, it has outperformed the industry. Two-wheeler volumes, if you see, it had seen a decline of nearly 2%, while company's standalone revenue has seen a growth of almost 10%. European operations too has seen a growth of 29%. That includes Stoffel acquisition. If you remove that acquisition, the growth is just 1%. Now, going forward, what will be the growth tailwind for the company? It says that recent government's announcement of mandating anti-lock braking system for the two-wheeler companies would be a growth tailwind, and that's the reason it's going to see a further growth. But as far as earnings are concerned, it's a healthy growth that company has seen, and that's the reason I'm going with green.
All right, going with green. So thanks very much for that. Vishal Megamart is next. Mangalam, over to you.
Good performance for Vishal Megamart as well. 21% growth in their revenues, 25% growth in their EBITDA, implying a margin expansion of nearly 50 basis points, and the net profit on the back of that growing by about 37%, also aided by higher other income. Same-store sales growth here as well, similar to Jubilant Foodworks, 11.5%. Gross margins improved because the contribution from their own brands came in from 74% to around 76%, so that's a positive. And store expansion continued as well, so Vishal Megamart is good. Nigel asked for pizzas from Domino's. I wonder if he wants anything from Vishal Megamart now.
No, we'll stick to United Spirits, Mangalam. Thanks a lot for that. But let's go back to Sonal. She's here to tell us about Deepak Nitrite. Sonal, not asking for anything, but I'm hoping to visit your home over the weekend and get some blessings, from Lord Krishna. But tell us about Deepak Nitrite.
Oh, absolutely. You have to be here, Nigel. But talking about Deepak Nitrite, it was a weak set. And this is something which is surprising because other chemical companies have seen an improvement in Q1. Revenues down 13%, EBITDA down 39%, margins lower by 400 basis points, leading to a profit decline of 45%. It was led by the advanced intermediate segment, where the EBIT halved on a YOY basis. Phenolics also saw a decline to come in at 118 crore rupees. The company says pricing pressure continues because oversupply coming in from China and some sectoral pressure as well. So going with red on Deepak Nitrite.
Thank you very much for that. I'm watching Infosys today because the company has approved the acquisition of a 75% acquisition of 75% shareholding in Versant Group, which is an Australian-based company. They will be paying about 233 million Australian dollars. That turns out to be about 150 plus US dollars. The acquired company had revenues of about $210 million, according to analysts. Assuming that they get a 2-quarter benefit of this acquisition, it should add about 0.3% to their top line, and it will strengthen their presence in Australia. In terms of the overall cash balance that they will use, it will just be about 3%. So that's Infosys making inroads in Australia and New Zealand. But let's talk about Aditya Birla Fashion, Vinny. How are the numbers?
A weak set of numbers, Rima, that's coming from the company this time. Overall, missing the estimates of what the analysts were expecting. Now, in terms of revenue, just a 9% growth this time. EBITDA, 24% growth, slight bit of an expansion, 75 basis point expansion in terms of EBITDA. But the company's losses have widened this time. 211 crores is the loss versus 161 crores last year the same time. Now, demand has been very sluggish. That's what the company highlighted. They're saying that pantaloons, which is the main business for the company now, that's seen a decline of 1%, and that was because of the shift that has happened in the festive season and Eid that was a bit later. So that is what impacted the sales. Like-to-like growth for pantaloons, that has been flat on a year-on-year basis. Now, ethnic business, that's where the company saw some growth coming in. 25% growth there. The designer brands that they have, right? Sabyasachi, that's managed to see a very good growth. 56% growth there. Double-digit profitability. But the main business, pantaloon business, that didn't do well. Tomorrow, that is also a brand of the company that delivered a good growth as well. But these are smaller parts of the businesses. So that even such a good growth is not something that is overall improving in terms of the revenue growth for the company. So all in all, we're expecting red for the stock today.
Thank you. Let's do a quick recap then of the top stocks. Stocks with positive news flow are BPCL, United Spirits, Muthoot Finance, Jubilant FoodWorks, IRCTC, Endurance Tech, Vishal Mega Mart and Infosys. Stocks with negative news flow, Deepak Nitrite and Aditya Birla Fashion and Retail. Well, let's talk commodities now. Manisha is now joining in to round up all the news over the last 24 hours. Manisha, what happened when we were all sleeping in your markets?
Well, early morning we're looking at some support coming in for the crude oil prices, but it's still not too far away from the 2-month lows that it has been trading for the last few sessions now. Well, the U.S. inventories have risen by 3 million barrels, way higher than what the street was anticipating. And then whether it has been about the IEA, EIA, OPEC, all these international energy agencies are talking about a surplus in this year and the next as well. The IEA also says that the U.S. inventories are expected to rise at a record pace to a 46-month highs by the time it's mid-June 2026 there. So everybody is working with higher supplies there and an optimism around U.S.-Russia meeting on 15th of August. That is what is keeping the crude prices in check. But what has been doing well has been the metal prices. So whether it's iron ore, steel prices trading at a multi-month highs, copper is finally risen as well. It's trading at a 2-week highs right now. There is optimism over global trade improving, and the U.S.-China trade truce extended by another 90 days really seems to have done well for the metal prices in this week, where almost all metals seem to be heading for a stronger close.
All right, Manisha, thank you very much for that. So that's commodities in focus. We'll come back in just a bit from now and we'll connect with the management of Sami Hotels to discuss the quarter gone by and get an outlook as well. Deepan Mehta, Elixir Equities, also joins in for some fundamental stock conversation. Stay tuned.
Welcome back. Well, let's focus on Sami Hotels. They've delivered their numbers. We're now joined by Ashish Jakhanwala, the MD and CEO at Sami Hotels. Hi, Ashish. Good morning. Good to see you. And I'll tell you what, I was scouting for places to go over this weekend. It's chock-a-block, anywhere. And I'm fearing actually the drive someplace because coming back will be even more difficult. That said, tell us, how has growth been? Actually, we are almost halfway through the second quarter. First quarter looks pretty okay. July and August kept up with the momentum and things get better from here on?
Yeah. Hi, Nigel. Good to have you. Good to have me on the show. We had a very good April and June, and May, of course, because of the known reasons best known to everybody, was slightly flattish. But we've seen the momentum continue through July and August. So we actually remain fairly upbeat about the remainder of the year. As you rightly said, the demand is just not letting up, and I don't expect it to, given where India is headed. So be ready to plan your vacations well in advance, otherwise they'll keep complaining.
The momentum is as strong, you're saying, Ashish?
It's as strong.
Because in Q1, there were a lot of cancellations, obviously, right? I mean, across, not just your chain, but across.
Only in May.
Only in, yes.
Only in May. Yeah.
But you think all that has been made up and it's kind of back on track?
Yeah, so if you see, we have presented a slide in our presentation which says that April numbers were up about 13%. May was at about just 3.5-4% over last year. June went back to about 12% over last year, and we've seen that momentum continue since then. So the recovery was pretty quick after the incidents that happened in May, and we actually therefore remain quite upbeat for the rest of the year.
And bookings for the third quarter, which perhaps is the strongest for you, that is coming along nicely already?
Listen, a little early. The business, unfortunately, is not that long lead for business hotels anymore. You get short lead businesses. But what we call business on books or pace or trends that we are seeing remain to be in double digits for this year over last year.
Is that the kind of growth we should expect? Double digits, mid-teens kind of a revenue growth? Because Ashish, as as the company expands in size, even the absolute revenue growth has been coming down. So while Q1 was about 10%, last year 18% revenue growth, FY24 was a 30% revenue growth. The year before that was more than 100%. I get with size, it's harder to keep growing at the same rate, but what are we looking at for FY26 and FY27? A mid-teens kind of a revenue growth, is that the sustainable run rate?
Yeah, so let me clarify. For an acquisition-led company like ours, the base that we inherit for the previous year always sets the tone for the headline number, right? Therefore, we've always highlighted same-store growth, and our guidance on same-store growth has always been between 9 to 11%. But then we have some new inventory coming online this year, as in some large hotels, and combined impact of same-store and new inventory will help us deliver about a mid-teen total revenue growth.
Mid-teens, okay. Can you tell us a bit about your pipeline expansion for this year and next year?
So we've already launched a few hotels at the beginning of this year, and hotels do take a quarter or two before they start stabilizing. So we have a new hotel in Calcutta which opened a few months back. We've got a hotel in Greater Noida which got rebranded and has reopened, so that's ramping up. Around October, we opened new inventory in Hyatt Regency Pune and Sheraton Hyderabad. Plus, we have a lot of work going on in food and beverage. So we have some ballrooms under renovation. So H2, we expect to really see the impact of all that inventory addition reflect in our financial statements.
Okay, all right, Ashish, couple of quick questions. The debt number has come down post this GIC deal. Current debt and where is it headed for the full year? What kind of finance cost savings would be there?
So that's where I think we are, I like to believe we're delivering ahead of our promise. After we had concluded the JIC transaction, we had indicated that we target coming below 3 times at the end of FY26. Happy to say that we have come down to 3.0 as of today. So the path towards going below 3.0 is really almost there for us now. So I think that's one really good momentum. And I think we've articulated our strategy to recycle capital. People sometimes think it's selling. Actually, it's not selling. We need to make sure that our capital is in assets which give us the highest returns. So we expect to accelerate our journey towards the intended path of 2.5 times net debt to EBITDA. We've always said that because we can access 12 to 15 years financing, 2.5 times net debt to EBITDA is extremely, extremely safe zone. And I think I'm happy to say that we'll be there much sooner than we had expected ourselves to be, both because of good earnings growth, two, because of the capital recycling, both what we did with GIC and also at a single asset level.
Okay, all right. And one of the reasons that the company wasn't getting the multiple was because of the debt in the books. Now you're addressing that, and that's why the stock has perked up. It started outperforming actually in the last few months. That said, any other deal with GIC, any kind of value unlocking that you're looking at? And is there any kind of, any hotel that you've, marked that maybe you want to get rid of it? So any deal with GIC and any hotel that you want to sell?
No, so the intent with GIC is clear, and it's communicated that we want to create that to be a very large upscale platform. We still have a few more upscale hotels which are in, let's call it SAMI. And I think at the right time, we may discuss with GIC, subject to their agreeing, transferring one or two more assets to that joint venture. But that will largely be to really ensure that that platform is well funded for a significant growth in future. So answer is absolutely yes. We will keep evaluating, what other assets we can transfer to the joint venture, recycle our capital. I must say that we are getting some really exciting opportunities for deploying capital. If you see over the last 2 years, we've sold assets. If you look at GIC monetization, about 750 crores, single asset sales about 200 crores. We have monetized about almost 1,000 crores. And at the same time, we've committed about 1,000 crores in new capex. So all we are doing is making sure that, for instance, our asset sales have been at about 20 times EV/EBITDA average. And wherever we're deploying capital is at almost 15-16% NOI yield. So it's a big shift in how the returns will stack up in future.
All right. Wish you all the best, Ashish, and wish you a good season as well. Thanks very much for joining us here. That's Sami Hotels in focus there. Deepan Mehta is with us with quick thoughts on what the market may do. Deepan, good to have you here. Two things tomorrow, right? Even as we go into that long weekend. Prime Minister Modi's speech at the margin, some expectations that maybe, he will outline what he wants to do next because of the situation we find ourselves in. The second, of course, is this meeting in Alaska, where I think if you read the global media, it looks like you've got to dial back expectations of a breakthrough after the first meeting. It was looking pretty big, but I think they've themselves watered it down a little bit. Don't expect too much. So near term, Deepan, what's the market direction looking like to you?
Yeah, good morning, Prashant, and thank you for having me on your show. I think the same trend, sideways movement, because liquidity is not letting the market sink and fundamentals don't justify markets to move up. So that's where we are. And I think largely the market and the corporate India is absorbing and understanding how these tariffs will work out, because it's not just the direct impact of exports to US, but the overall competitiveness of the Indian exporting community, because it may impact even revenues from other geographies, because we are constrained from selling to the US. So there are a lot of moving parts over here. And on the whole, this earnings season also has not been that great for the reasons that we all know. 5.5, 5.6% type of aggregate net profit growth, lowest in last 2 years, is certainly not impressive. But I think that the festive season has started on a good positive note. Even FMCG revenues have picked up, volumes have picked up over there. So we remain hopeful, because the only way this market can go back to its old highs is we have a strong rebound in earnings.
A couple of numbers today are also pretty good. Jubilant FoodWorks is, for Domino's India, like for like, growth is in double digits. For Vishal Mega Mart too, for the 5th straight quarter, it's reported a double-digit same-store sales growth. So some of these numbers too are showing a pickup. Deepan, morning. I think you like Apollo Hospitals. That's a part of your portfolio?
Yes, it is.
Yeah,
It's
big
one of the
move
few
yesterday.
It's one of the few companies which have brought a smile to our faces in this particular quarter. I think exceptionally good numbers. And now they are firing on all cylinders. Losses have been curbed. And most importantly, looking forward to the split which they are doing in the company. I think that will unlock even more value for minority shareholders. Only thing I think that investors should keep in mind is that they are entering into a very aggressive period of expansion of hospital beds. And whenever that has happened in the past, it does tend to impact the profit margins, because the new hospitals are not immediately profitable. And although the management will give the split between the new hospitals and the old hospitals, but nonetheless, I think that we should be entering a period of investment phase for these new hospitals, which may impact the hospital business revenues, not revenues, but at least the operating profit margins. So we need to keep that in mind, that these results are good, but we're in for some curtailment or pressure on the margins as new hospitals go on stream.
Deepan, haven't met you for a while actually, and even Junior Mehta, maybe it's time to grab a drink or maybe a pizza. We'll see how that goes, but we should do that shortly because I haven't met the junior as well. But that said, what's the view? Jubilant Foodworks as well as United Spirits, both of them came out with a set of numbers. Your take?
See, I think United Spirits is now passé because the way the Indian alcobev industry is doing, they are really doing exceptionally well as compared to United Breweries and even United Spirits for that matter. We look at Radico Khaitan, the numbers which came through, Tilak Nagar Industries, Allied Blenders, Associated Breweries. Across the board, I think Indian alcobev industry is really surging. And it's a good place if you want to place a bet on the FMCG side. I would say that these are the kind of new FMCG companies that investors can focus on. So I would avoid United Spirits, go for these local alcobev companies. And Jubilant Foodworks, I mean, from time to time, 1 or 2 quarters do come which are exceptionally strong. But this entire quick service restaurant business doesn't look to be as optimistic as before. There's a lot of competition from the likes of Swiggy and Zomato, which have now placed a whole host of dark restaurants and smaller restaurants at par with the likes of Domino's and other quick service restaurants. So I would prefer to avoid these companies. And in any case, I think they're trading at extremely rich multiples. And now a lot of the revenues for the QSR companies is coming from outside India, where markets may not be as robust and as vibrant as they are in India.
All right. Deepan, we want to discuss one particular name and listen in and come to you. I don't know if you have a view in particular. I'm talking about Merck Electronics, MIRC Electronics. Now, most of us would know this as the Oneida brand. For many of us, it was basically the first piece of television, Oneida, the man with the horns, right? And they've yesterday, by the way, the stock has gone from 15 to 26, 70-75% in 7 or 8 trading sessions now. Nimesh told us a couple of days back that Merck is going to raise money, is going to do a pref issue to some high net worth individuals, etc., an attempt to revitalize the company, and the announcement came through. They're raising 150 odd crores via a pref issue. Nimesh, morning. Congratulations. First up, tell us more.
So Prashant, as you rightly pointed out, very old company, not done much in the last many years. Finally, it looks like they're waking up. They want to make some changes. So first, the big announcement which came last evening, that is a preferential issue to 4 investors. They're raising 150 crores by giving 8.89 crore shares to 4 investors, basically on a pref basis, and they're raising 150 crore rupees. So that's a big announcement which has come over the night. So again, very small company, 750 crore market cap and raising almost 150 crores. So these 4 investors combined will now own close to 24% stake in the company. Of course, it's a pref, so the conversion will take over a period of time, but money will come into the company in months and days and months to come. So that's a big announcement. As you rightly pointed out, Prashant, very old company we've been seeing since our old age, but nothing has happened in the company, right? I mean, if you look at the numbers also, I was just looking briefly on the screener. For the last 10 years, they've not made profit. Only barring one year when they made some 20 odd crores of profit, it's largely been loss making. Again, I think that is a big issue for them, sitting on 500 crores of debt as well. But
it's pretty, they do 750 odd crores in sales, top line.
Yeah, exactly.
And market cap is 750 odd crores.
Correct.
But as you say, they've not been profitable.
So maybe, what investors would have thought is they're getting for less than one-time sales, right? That could be the one big trigger. And also the fact that, now these investors will own close to 24%. Yeah. They can make some calls, make some changes in the board as well. Also, they have a manufacturing facility. So for many years, there was an anticipation that one of those OEMs may look to tie up or acquire and use that facility. So maybe all this could be on the cards going forward. But the fact is that 24% is bought by four market investors, and they're putting in 150 crores in a company which has not done anything in the last 10 years. Just to note that very small company, and also they have a debt issue. So that's something which, again, not only this particular fundraising, I was just looking at the last few announcements. Apart from the pref issue where they've raised 150 crores, only in the last few months, they've done a couple of further fundraising as well. A rights issue, they've done a 4.5 crore shares rights at a price of 10 rupees. So that money is going to come in. And also they did an NCD issue of 60 crores. So they've done some fundraising activity in the last, say 3, 4, 6 months. So they have capital now. Again, allocation would be important. But the fact is that 4 investors have come in and picking 24% stake, putting in money, 150 crores. Need to see how it pans out. But again, it looks like there could be something on the cards as far as reviving this brand and reviving this company is concerned.
And the next thing to watch will be getting new people.
Absolutely.
I mean, who's going to run the
business? Getting a
business?
new team, I think that would be on the cards, right? They will hire some new team. They'll hire people from the industry. Also, as I said, there could be a potential tie-up with one of the OEMs to use the facility as well. So I'm sure if these 4 investors are coming in, they would have something on the sleeves as far as plans to revive this company. So
Absolutely.
We'll have to wait and watch. But yeah, the big announcement is 150 crores raise by Merck Electronics.
I was thinking, Animesh, and this is something you alluded to earlier as well. A completely different context, but in a way, there's a common thread. We reported that Samman Capital thing, right? I mean, a lot of these, it kind of tells you whether beaten down companies, maybe cheap companies, people going in, trying to engineer a bit of a turnaround. I mean, similar kind of thought process. Different businesses, much larger,
Absolutely.
of course, that one.
And that's happening, right? And the other thing is that now a lot of these big investors are having this firepower and money power to go in and revive and look at taking a board seat. And also I'm sure with this 24% there could be board changes, board seat as well, maybe a new CEO or a new team to take this forward. So we'll have to wait and watch, but at least the news is that 150 crores has come in from 4 investors.
Good intent. Let's see whether or not the retail audience does make money, because in the past as well, when the promoters have tried, I remember 2018 when they came to the studio as well, and they promised a lot. Delivery was a little bit short. This time around, they're looking at a fresh leg. Money is coming in and marquee investors. So let's see how that goes. But if you look at it from 2018 onwards, it had gone to 55 rupees and it's still half of that price, though it's had a big run in the last
few
days.
I mean, the other point, which I began by saying, the stock's up 70-75% in the very near term. So,
and also in terms of numbers, it's loss-making. There is nothing in terms of, obviously there is a top line, but
just a FYI for
they're
viewers.
sitting on debt as well. So,
absolutely. Nimesh, thanks very much. But it's an interesting story worth tracking. Deepan is with us. I don't know if Deepan, I can go across to him. Deepan, any thoughts here?
Yeah, while you were just, talking about this company, I just quickly checked up, and the biggest investor amongst the 4 is Artham Investment. It's a listed company owned by Mr. Sanjay Dangi, and they have a very good track record in terms of identifying stocks and multi-bagger stocks, and then nurturing those companies to scale up. And maybe something similar can happen in Merck Electronics. See, there's a lot of interest in this electronic and consumer product outsourcing. And even if 1 or 2 contracts come through to Merck Electronics, then certainly they can scale up the business pretty well. And there are export opportunities as well for such companies. So I'm hopeful that something positive will come out of this particular development.
Yeah, absolutely. We'll take a break here, Deepan. More stocks with you coming up in just a bit. We'll also get our technical experts in, Sudarshan and Mitesh, with what they want you to do. Stay with us. Okay, welcome back. This is what 17-point indicated lower opening right now on the market. Sudarshan and Mitesh are with us with what they want you to do as we go into this 3-day long weekend. Gentlemen, good morning. Great to have both of you here. Mitesh, how are things set up? A follow through today or a bit of a sideways day?
Morning, Prashant. So I would still bet that there is a good chance of follow through happening. One, we're still in that range of 24,350 to about 24,750. But the indicators on the hourly, the 2-hourly charts have started to look up from oversold levels. So while the opening move is slightly soft, I think there's a good chance that we might hit the upper end of the range. As of now, we don't have any signals of a breakout beyond that. But the immediate flow looks like we might head towards 24,750. And if we clear it in this attempt, well and good, we'll look at higher levels. Otherwise, you might have a dip, and then again the market should start to try and test higher levels.
Okay, got it. Sudarshan, coming across to you. What's your view on the Nifty?
Yeah, good morning. Well, the view yesterday was to go and buy a dip. That was yesterday. This market is changing every day. Today, we are into a long weekend and a very big news event. Markets usually go into a huddle just before such a big event. So we could actually end up in a very narrow range today. Narrow range days are not good for intraday traders. And while, Nigel, anything can happen during the day, the anticipation is that we will not move either ways. So intraday trading and swing trading should be out. Don't touch the Nifty or any other index. Focus on stocks. For the next week, I have a trade. We don't know what the markets will do and what the news event will be. So buy a call and buy a put, but buy a strangle. Essentially, anything above 24,700 as a call and 24,400 below that as a put. And then see what happens. That's for next week. Today, avoid.
Okay, all right. Gentlemen, wait with us. We'll slip into a short break. Come back. We'll get the stock picks from both Sudarshan as well as Mitesh. We'll also be joined by the management of CSB Bank.
Welcome back. Let's just waiting for the pre-opening rates to kick in. Let's get in a few trading ideas. Sudarshan and Mitesh are still with us. Sudarshan, morning. What would be your stock calls?
Yeah, good morning. Well, it's still an all-buy list. BPCL is a buy with a stop under 317. Overall Reality is a buy with a stop under 1596. Infotech, I'm not getting the name right, is a buy with a stop under 1094. K Financial Infotech, I think. Bharat Forge is a buy with a stop under 1157.
Mitesh, hi, morning. Your calls?
Yeah, good morning. So I have a few buy calls as well and one sell. On the buying side is Lupin with a stop at 1974 for targets of 2020. DMART is something which I've recommended regularly over the last few days. That's a buy at current levels. Keep a stop at about 4,300. Look for a target of 4,400. Also a buy on NMDC with a stop at 71 for targets of 76. And Suzlon is one sell call. Keep a stop at about 62.25. Look for targets of 56.
Yeah, no, absolutely. Thank you, gentlemen, for joining us, and we'll chat again at about 9:10 or so. Rima, the other talking point, and on Editor's Playbook, we picked this up yesterday, which is direct flight between India and China. And essentially, if you see the momentum of events, the way it's panning out, seems like both sides are taking steps to normalize relations, India and China, right? And that's great news because eventually that may lead, easing of restrictions on those precious rare earth magnets, etc., right? So that's great news, and it's happening after 5 years. But is there a flip side to it, is the question, which, is just food for thought, but something that I wanted to put out for our viewers. And these are the four things first up, right? Will Chinese companies be allowed to operate with much more freedom in India? That's point number one, as these ties normalize. Second, for most of the EMS, FMEG, capital goods companies, etc., China plus one was not really a big factor for why they did well. What actually helped them, and this is point number three, is import substitution, right? Companies here making what you could import earlier, so substituting those imports, helped by schemes like PLI, etc., and restricting import of Chinese brands, OEMs, etc., restrictions on Chinese companies. So it was not China plus one. In a way it was, but not in the, the purest sense of that term, but it was, these other factors which helped. So if restrictions on Chinese companies as normalized, it's not as if China is going to agree to normalize ties if they don't get access to the market, right? They're the largest producer for pretty much everything on out there in the world economy. So they want access. That's essentially what we can offer. So will easing of restrictions on sourcing from China hurt Indian players? That is the question that I'm asking. And, just a couple of areas where this perhaps shows up. And these are all, and the reason why this is important is because these are all, high valuation sectors. Typically between 70 to 100 times earnings is where most of these, a lot of these sectors trade at. EMS, for example, and the names come up on your screen. Power equipment on the generation side, names like BHEL, L&T, Thermax. If you remember 10, 15 years ago, Chinese import of power equipment, quality aside, was a big factor. And when that stopped and restrictions were put in terms of use of local content, etc., these stocks actually reacted quite favorably. So will there be strict regulated entry if it is allowed? We'll have to see. Power equipment on the transmission and distribution side. Well established that China has got huge capacities here, and the companies will come up on your screen. Again, these are all very, very richly priced sectors in that sense. And of course, you've got lots of emerging sectors like motors, EV chargers, solar inverters, smart meters, and so on and so forth. So it's just a question out there, which is, even as ties normalize and as great news, etc., you're not going to be able to immediately, at least till you build up manufacturing capacities, be able to sell into that market. US is the consumer, China is the producer, and that's the reality of it. So we'll see how this is done. I'm sure the government, of course, is very mindful of all of this to protect the local industry with whatever it can do in terms of measures, etc. Deepan is, of course, still with us. Deepan, I don't know if you have any thoughts here on this topic and how it plays out. Deepan, you have to unmute yourself, please.
Sorry.
No, I think it's positive for the entire Indian economy if the ties with China certainly improve. There's a lot of scope for cooperation as well, and there are export opportunities as well. And certainly, I think certain Indian companies also benefit from Chinese technologies or from investments done by Chinese companies into India. So we remain hopeful. But end of the day, we have to focus on domestic-oriented businesses, as I understand. And these things keep on happening with China on and off, and then there's some skirmish, and then ties get worsened, and it does tend to create a lot of volatility if you are basing your investment theme purely on external partners. So that's what my thoughts are.
Okay, let's see how, for now at least, there seems to be some cautious engagement between the two countries. We'll have to see how they forge ties going ahead. But Dipan, hold on. We've got the management of CSB Bank joining in. Came out with numbers yesterday. The street was disappointed with the margin performance. A very sharp 21 basis points contraction in NIMs quarter on quarter. And on a year-on-year basis, margins declined by, close to about 80 basis points. The stock declined in trade. Pralay Mondal, MD and CEO at CSB Bank, is now joining in on the show. Thank you very much, sir, for joining in. This is Rima here. When we spoke last time, you sort of indicated that NIMs have bottomed out in Q4. We've seen further pressure on your net interest margins and now at 3.5%. What led to that? What happened in the quarter? And what's the guidance on margins now?
Good morning, Rima, and good morning to your viewers. You're absolutely right that NIM did decline by around 20 basis points quarter on quarter. And one of the key reasons for this is, the liquidity which was there in the system at that point of time was negative 3 lakh crore in last quarter of last year. And right now there is of course, positivity in terms of liquidity. And we picked up a lot of deposits in the end of the financial year last year, which came in at a slightly higher cost. That effectively had an impact only for 10-15 days last quarter, and this quarter it was for the full quarter. But it is we are seeing that the deposit rates are declining, and hence I think that pressure will ease off quite an extent. And hence Q2 onwards, we should see a more stable NIM. So I think this is a transient kind of a situation. We didn't expect, but I think things are getting better now.
Can you say with confidence that 3.5% is the bottom for margins, and Q2 onwards, the improvement will be visible?
Absolutely. I think this should be the bottom, 3.5, and we should be seeing gradual rise of NIM from here onwards. Our guidance is we should be gradually moving from 3.5 towards 4% over the period of the full year, with an average of around 3.7%.
All right. Hi, Mr. Mondal. Good morning. Good to see you in. Yesterday, the street was a little bit nervous after looking at your numbers because that compression clearly was more than expected. That said, are you seeing signs of credit growth coming back on ground if there was some slowness? You've mentioned in the past, you want to outgrow the industry. So for the year, what kind of loan growth should we be working with? If you could help us out with a rough range. And the ROAs, that's come down to around 1%. But you have mentioned in the past, 1.5% is where it's headed. For this year?
Yes, Nigel. On the ROA part, what I can say is if you look at our trajectory, it always starts low in the first quarter and it gradually picks up. Last year also the same thing happened, and it will happen the same thing this year because our income starts growing in the third and fourth quarter because of the cyclicality of our income, especially on the fees side. So I think we will be able to achieve the guidance of 1.5% for the full year basis. And also the other thing was that we build up our credit book pretty strongly. If you see this quarter, we had grown our wholesale, SME, gold, everything by more than 30%. Retail, of course, we are cautious. And some of the unsecured book is only 3% or lesser of the whole book at this point of time. So from that perspective, obviously, when we grew the wholesale book very strongly, that also was another reason why we had a little bit of a contraction on the NIM, but that is something which we have taken a strategic call to ensure we have a balanced business between all the three businesses. So from that perspective, I think we are stabilizing, and I think our credit growth guidance is very clear. We will be growing at least double the industry at this point of time. And on a specific number, we should be doing somewhere around close to 25% for the year.
Okay. And in that, the loan book guidance, 25% on an aggregate?
Yes, around 25% we'll do it.
And for gold loans, the growth guidance would be?
It should be somewhere around 25 to 30. It will continue to do well as it is, maybe a little higher, but we'll see as it comes.
Okay. Any signs of stress, sir, in the book? As of now, that's the big fear, right? Credit growth is not picking up, and is there gradual stress building in? What is your observation?
No, for us, I don't think stress is a stress anymore at this point of time because this quarter, of course, our NPA went up a little bit because of some slippages on the SME side, which are all secured, and that should come back. We have already recovered at least 25 crores out of that slippage, which happened last quarter in this quarter. Also, what happened is, on your specific question, I think our overall guidance of with GNPA less than 2, NNPA less than 1, and credit cost less than 50, we are still below that. And where we are today, we'll end the year much lower than this on all the 3 parameters. But one specific thing that happened last quarter was we transformed the bank into a completely different trajectory from our tech perspective. So we implemented our core system with 52 surround system around it, and with many other tech transformations. So the team was a little busy on that last quarter. So from an execution perspective, we are focused on building the long-term platform of the bank, and hence some of these things we didn't focus as much as we should have. I think we'll come back strongly in the second quarter.
We don't talk enough about the technology-related investments, but as a business driver, that's a big one. We'll talk, come back mid-quarter, Mr. Mondal, and we can sort of have a chat. Thank you very much for joining us. Just running into market opening, so shorter chat this morning. Appreciate it. So that is CSB Bank with perspective on the results which came through. Sudarshan and Mitesh are with us with their 9-10 call. Sudarshan, what do you have?
That's KFin Technologies. So buy KFin Technologies with a stop under 1,094.
Mitesh, what about you?
I'll go with a buy on NMDC for targets of around 76.
Any thoughts on Muthoot, Mitesh?
Muthoot, see, we have a slightly negative outlook. In fact, disclaimer that, I had some position which I booked profits on the short side yesterday. But the chart still looks weak to me. I think the target which I'm looking at for Muthoot is closer to about 24.30 to about 24.20 on the downside. So some more downside possibly left.
Okay, 8%, 9% higher right now, though. Indicated in the pre-open session, 250,000 shares is the volume. So that's the, looks like at least this morning, the big one. But that's a technical view coming through. But the numbers recap with Gaurav. Gaurav, morning.
Well, yes, Muthoot Finance actually reported very great set of numbers and also was higher than the street's expectation across all the parameters. When we talk about AUM growth, that was at around 42%. Now it stands at around 1.2 lakh crores. When it comes to net interest income, now that has increased almost by 50% on a year-on-year basis. And there we saw an impact of around 400 crores. This was because of the recoveries from NPAs and also because of the recoveries and the principal that they received from ARCs. When we look at the PPOP, which is pre-provisional operating profit, that increased almost by 62% on a year-on-year basis now, and profit that has increased almost by 90% on a year-on-year basis. So very strong set of numbers is what we can say. When it comes to ratios, now net interest margins, they have increased almost by 88 basis points. Remember, management said that the yields have increased almost by 100 basis points because of the 400 crore impact that we just discussed. And at the same time, when it comes to the asset quality, there also we saw a strong set of numbers. Credit cost declined to just 0.15% versus what it was at 0.5%. Now remember, Street was actually penciling in 0.5% of credit cost in this quarter as well. So definitely a very good number in that front as well. As a result, when we look at the brokerages, they are being bullish now. Morgan Stanley, they have upgraded the rating as well as target price. They believe that the company is delivering group leading ROEs and EPS growth, and at the same time negligible asset quality risk is what they are seeing. CLSA also increased their target price to 2,740, and we also have Nuvama who increased their target price to 2,993 because they also believe that the company is actually shining brighter than peers. So definitely bullish call coming up from brokerages as well, and as a result we are keeping a watch on this counter today.
Thank you. We've got the management joining in at 9:30 a.m. George Muthoot will be speaking with us, so stay tuned for that. Let's go across to Manglam now for Jubilant Foodworks. Manglam.
Well, Jubilant Foodworks reported a good set of numbers. Remember, the company had already given us their quarterly update, so we already knew their revenue growth both on a standalone and a consolidated basis, and the Domino's India like-for-like growth at 11.5%. So what was remaining to be seen is how the EBITDA performance is and how the internals are of the company. The EBITDA absolutely in line with street expectations, close to around 19% margins. The street was working with 19.2%. The net profit also around 65-66 crores. Bang in line with street expectations. The internals, they are positive. 11.5% like-for-like growth for Domino's, but that was led by 20% growth in the delivery business and 24% growth in their delivery revenue itself. And that's much higher than all the other aggregators. We had Eternal and Swiggy report their numbers. So it tells you that Domino's in the QSR space is gaining market share, and in the overall food delivery space is also gaining market share. Popeyes also did well for them. Remember, now they have 63 stores. They are targeting 100 stores by the end of this year. So the street likes it. The only fly in the ointment perhaps would be valuations trading upwards of 75 times 1 year forward earnings. But there is long runway for growth. Let's see how the street reacts.
All right. You know, the other one, Mangalam, thanks very much for that, is Vishal Megamart. I think is opening about 6-7% higher. And that will come up on your screen as well. Just a quick look at that before we hit the market open. I think, 6-7% on Vishal Megamart. So, you know, some positive reactions coming through. Big ones. Vishal and Muthoot, of course, seem to be the big ones that we will address. Market open is absolutely flat, 24,640, almost unchanged to where we left off yesterday. I think Nifty Bank is better, about a 0.25% higher. Nifty Bank was, okay, is it? Not really, is it? It's absolutely flat there as well. A bit of a divergent trend on Nifty Bank over the last 2 days as compared to the Nifty. So 55,200 on the Nifty Bank. Midcap index is 190 points in the green, 56,885. And you've got the small cap index, which is also coming up with gains about 0.25%, 37, 38 points, 17,650. 800 up, 400 lower. So that's the market breadth overall in the NSE. But it's just within the first minute of market that we're tracking. And that's the Nifty heat map. Bulk of everything is up in the green. 42 names are higher. One stock is unchanged, opening up just about. The others are low. But overwhelmingly positive, but nothing very large to begin the day. Rima.
Well, there's only one Nifty stock where the reaction is more than 1%. So things are quiet, at least on the large cap screen. Infosys is your top gainer, and that's got a gain of all of 1%. This is on the back of the company acquiring a 75% stake in a company in Australia, forming a joint venture. So it could add about 0.2, 0.3% to the company's top line. The street likes the acquisition. Stock is up nearly 1.25%. Some other IT names are also higher. Gains are not big, but you've got Wipro, Tech Mahindra opening up in the green. Some auto names, like a Maruti Suzuki, have a positive green tick. Eicher Motors, higher in trade. HDFC Life, Adani Enterprises. Throw in a couple of pharma names like Cipla, Sun Pharma. Stocks in the green. On the way down, you've got Reliance Industries retreating a bit, so that's exerting pressure. BEL, ONGC, Eternal are some of the other drags. But again, nothing too big on the way up in terms of a large cap reaction or on the way down. Infosys is the only one which stands out post that acquisition.
Well, that's right, Rima. From the broader markets, actually, there's plenty of action. Yatra, the stock is up 50% in this week. It comes in for some mild profit taking. So that one's up for you on the screen. HPL Engineering, that's up 25% for this week. Well, that's also mildly lower, down closer around 2.5%. Jain Irrigation, it saw a big spurt in the final few minutes of trade. They got an order, I think so, but the street has sold into that. Maybe the size of the order is not as much as what the street sniffed. The other one is HPCL, that as well is down closer around 2.5%. So keep that on your radar. The stock of the morning has to be Muthoot. In a few minutes from now, we'll have the management who will be joining in. And, things looked good out there. I've looked at the yields. They have moved up. The cost of borrowing is down. The growth has been good. Hard to fault those numbers, even X of those, of the one-off that we saw. The other ones that are actually not doing too well, Supriya Life, pull up that stock. I think it had moved close to around 5%. So Supriya Life, I think, is a little bit lower in today's trading session. Yes, it's down close to around 4.5%. Street didn't like those numbers. But there are other result reactions. Everest Kanto, stock is up 10%. Another stock that's been very, very flimsy from an investor perspective. Sometimes good, sometimes not so good. But that one is zooming away on large volumes. MIRC, as Nimesh told us, a couple of large investors coming in there. They are showing the faith. Remember, this is a stock that's half of what it was, if you look at it in the last 7 years or so. But big investors coming in there, they're showing in the money. The street is optimistic that could be a turnaround. So that one's, in fact, higher. And you have Jubilant Food as well as Bellrise, both of them doing rather well in this morning's trading session. So both of them up and about in trade today. A couple of other notable movers, I think so. We should get Genesis. That one has come in for some profit taking. The numbers look pretty okay, but the stock had run up in the last few days. So that's why that's come in for profit taking.
Okay, that's the screen for you right now as we open up trade. Let's invite Manishi Ray Chaudhary, CEO at Emor Capital Partners, joining us on the show. Manishi, thank you very much for joining in. The situation is changing every day, but as we speak, it's about a 50% tariff, which India is slapped with. But there is hope. 15th August speech from Prime Minister Modi. Let's see what happens in Alaska. I mean, what's your sense about the Indian markets, its current positioning right now with investors?
You talked about, first of all, I wish, my best wishes to your viewers and to yourselves for a very happy Independence Day. And, it's a delight to be here. So first of all, you mentioned the tariffs, but I think investors, and particularly the foreign investors, are more concerned about the earnings environment. As I've been saying, that consensus earnings estimates for India have been on a downtrend for almost a year now, since last September, and it's been across almost all sectors. So I think this earnings estimate downtrend has to stop. Earnings estimates have to bottom out and then begin moving. It's difficult to figure out.
Okay, all right. I think we'll try to get Manishi back with us in just a bit. We're just having a bit of a technical snag out there, so we'll get Manishi back with us. Manishi, yes, I believe you're back. Go ahead and make your point.
Right, great, excellent. So, I think the impact of more cash in the hands of urban taxpayers and more money for the government workers, that should perhaps have an impact on on earnings, maybe in the later part of 2025, maybe in the fourth quarter and beyond. But investors would clearly like to see that happen before committing more capital. So, in a sense, India suffers from a relatively pedestrian micro, but at the same time, a great deal of macro stability with low current account and fiscal deficit, and now very low CPI inflation as well.
Manishi, you want to tell us how your Indian portfolio is positioned right now? What would your top bets be? And have you made any changes to your portfolio in the last 3 months?
Absolutely. So in India, so currently in the Asia ex-Japan context, we are currently neutral on India. And within India, there are possibly 3 pockets where we have a strong presence. First, the private sector banks. I've been harping on this theme for quite some time, that these are the banks that are likely to gain market share. Their asset quality is a lot better. Their technological capabilities are a lot better. Second, industrials, and that includes defense, though one has to be a bit selective here as a consequence of the high valuations that are prevailing. And third, consumer discretionaries, which is a combination of the automobiles, particularly four-wheelers, and other areas of discretionary consumption, which would also include healthcare services like, the diagnostics and the hospital chains. So these are the major areas, and 2 sectors that we are avoiding right now are consumer staples, where we think that single-digit growth going forward does not really justify the kind of valuations that they're trading at. And second, IT services, which we have completely taken out of our portfolio just about, I think 3 weeks ago. I think this, the reduction in manpower announcement by TCS is kind of a canary in the coal mine, which basically tells us about the kind of pressures from AI and, the lack of demand from the Western Hemisphere that this sector is likely to face.
Muthoot is locked up, guys, right?
Yeah.
2760 is where, that stock is at. What a move. I mean, that's the thing, right? I mean, stocks can frustrate you for a long time. And I remember this phase, stock did nothing for almost about 2 years, 2021 all the way to about 2024. Actually 2 years, 1400, 1500, 1400, 1500. And very quickly it's doubled. Similar thing with what the name, Nigel, you were mentioning, HBL Power.
Yeah.
6 months, 8 months, nothing, right? I mean, it's made a lot of money for investors from the lows, different sectors. But last 1 week, it's kind of more than made up for the underperformance. 25% very quickly, back at all-time highs. So, it's you got to be willing to sort of sit through phases of underperformance for stocks to work out. Anthem is another one. I don't know if you guys mentioned it. Anthem is up 7%. It's a recent listing from the CDMO space, but 805. Again, one of those names which has done phenomenally well. Anthem Biosciences. Pfizer is coming up with a 7% pop. It's got volumes on it as well. So 5,500 rupees in Pfizer, but it's got super gains. Premier Explosives went away home yesterday, limit up. It's got another 6.5% right now. So that's super, super strong. On the back of Muthoot, Manappuram is up 3.5% as well. So 265 on Manappuram. Bajaj Housing Finance. I think, Nigel, you were talking about this yesterday with a guest, right? 4% higher on Bajaj Housing, 113 on that one. And it's coming up with strong volumes as well. And out of the blue, there is Prime Focus, which is shooting up 8%. Prime Focus, $160. And the only reason I'm mentioning it is because it's got strong volumes behind it. So, 1,500 stocks are higher and about 900 stocks are lower. At this point in time. Vari for the second day running is a top volume-led loser on the NSE. Vari is down about 3%, so keep an eye out on that one. And you've got a couple of other things which did extremely well yesterday, which are coming, seeing some profit booking. JM Financial did extremely well, and I think is down about 2% or so at this stage. Manishi, any thoughts on this entire CDMO or CRDMO, is whatever you want to call it? Contract research development in the pharmaceutical space. Any stocks you like and valuations, risks to the business because of what's happening in the US? Your thoughts?
Right. Now, see, honestly, contract research, contract development, CDMO, these are possibly the themes of the day. And we're seeing this not just in India, but also in China. In fact, in China, it's the reverse. It's the foreign companies, the overseas pharma majors, they're trying to license the drugs developed by the Chinese majors, right? So, I think China, in a sense, has reached this second or the third stage of development. India is possibly about 7 to 10 years behind. But broadly, I would think just like most other research outsourcing trend that we have seen, and we have seen in case of the GCCs, the Global Capability Centers. This is also a trend that's likely to remain alive in the Indian healthcare sector for the foreseeable time horizon. So it is something that the investor would have to keep a focus on, apart from the usual generics that he plays in the Indian pharmaceutical sector. In fact, I would think that contract research, contract development would possibly be less at risk from the tariff and the trade dispute scenario than the generics would be.
Okay, all right. Thanks very much for joining us. Manishi, appreciate your time and happy Independence Day, as you sort of began by telling us. Good speaking with you here on CNBC-TV18. Let's talk about the big story, the big stock, of course, which is making all the headlines, which is Muthoot Finance. Stock is up about 10%, limit up. There's an upgrade coming through as well. Morgan Stanley has upgraded their rating to an overweight call. Price target is now about 2,900 odd rupees. Loan growth is 42% for Muthoot. We have the management joining us now, as always. And we'll ask them if they now, after these results, want to upgrade their own assessment of what growth will be for the year. George Alexander Muthoot, welcome to the program. Thank you very much for joining us. So, we'll ask you what happened and what led to this super strong growth in the quarter. But let me ask you, do you want to, you've always said 15%, but we'll probably better it. You want to put a higher guidance number out now? Mr. Muthoot?
Thank you. Good morning. First of all, happy Independence Day to all of you. So, Prashant, I don't want to change the guidance now. We've always said the 15%. Give us a little time. So usually we change the guidance after second quarter. So give us a little time. But definitely it will be much better than what we said, 15%. There's no doubt about it.
So, yeah, 20% plus, right? More like? And in October you'll do it.
Yeah, 15% plus is what I said. That is not limited to 20%. Can be even better. So we'll discuss on it after the next quarter. Anyway, I'm also here next quarter.
No, I will not push you. But you said it yourself, sir. Could be 20% plus also for the full year, and why not? Looks like it. The numbers are very strong. But you'll do it in the second quarter, along with the second quarter numbers when you report these, right? Yeah. So just a quick word on what happened in the quarter, what led to the very strong growth?
In the last 2-3 quarters, I think quite a few things have actually come into place. One of the things, as I've always been said, has been good demand for gold loan because of the overhang or the difficulty in getting unsecured loans everywhere. So that is one thing. The second was definitely the gold price and also the momentum about gold and about the talk of gold and people having gold and people using that to get. And the third and one of the important things was, again, the regulatory action which came by revised final guidelines. The final guidelines, if you ask me, has been quite good and it is quite gold loan business friendly. When I say gold loan business friendly, it is helping the gold loan business not only for the customer but also for the NBFCs and the banks. So the regulations which came, it gave a boost to the regulatory overhang which was always there, was whether the finance ministry, whether the Reserve Bank is keen to promote the gold loan business. So I think from the regulations which came, the message I get is that the finance ministry and the Reserve Bank is keen to promote gold loan business, of course, in a very structured way. And most of the regulations, other than that, is mainly to give healthy growth to the system and also guidance to especially the new players who are coming into the gold loan sector. So overall, these combination of factors has been helping us in the last 2 quarters and last 2-3 quarters, and this quarter also the same thing helped a little more.
Record highs for the share price today. Mr. George Alexander, this is Rima here. What about your margins, your NIMs or your yields? It expanded by nearly 100 basis points in Q1. What led to that? Is it sustainable, or do you think coming Q2 we will see a decline in your yields?
See, the yield definitely, or yield always has been in the 18.5. The blended yield has always been 18.5. This time it is a little higher. The two things happened. One, we had the NPA write back or NPA decrease was about 700 crores, and the interest which was the accrued interest on that which has been coming into the P&L constitutes about 275 to 280, 300 crores. That is one. And number two, we had done an ARC about a year back, and all the capital has been received earlier. Now, what we received about 100 crores this quarter, just has gone to the P&L. That is the interest part. Probably another 100 crores should come in the next quarters also for the ARC, which is a facility we gave for the customers. Instead of auctioning the gold, we gave them time, and many of them were able to save their gold. That is the biggest advantage. Finally, we got our interest also. So these two factors increase the interest collection. There is a bump only for this year. So it's not that the yield would continue to remain in the 18.5. This quarter, it is 19.5. So that is just because of this extraordinary income which came.
All right. Hi, sir. Good morning. Good to see you in. When you see any kind of regulatory hurdles, it's actually proved to be the best time to go ahead and buy your stock. That's at least what evidence tells us, because that's the way the stock has recovered from the recent low that we saw earlier this year. That said, the numbers look good, and it seems like a blue sky scenario playing out. Yields are improving, cost of borrowing is going down. What are the NIMs we should work with from here on, if you could help us out with that? And we'll wait by to revise the growth guidance. But in terms of your gold and non-gold portfolio, what should the mix look like?
Our spread has always been 9.5, and probably this quarter there's a bump. I think we'll continue to maintain the spread at 9.5. So when you say the cost of fund, the cost of funds really has not started coming down because banks have not reduced their MCLR as yet. Probably this quarter and next quarter, they will be gradually reducing the MCLR, and our cost of funds may come down by 40, 50 basis points. But having said that, if our cost of borrowing is coming down, we certainly will pass it on to the customer and reduce our yields also, but maintaining the spread at 9.5%. Now,
the spread, the mix, sir? Mix? Yeah.
The mix, yeah. So today, if you take out the microfinance portfolio, which is about 7,700 crores today, which was about 10,000 earlier, now it is only 7,700. All other, the personal loans, the home finance loans, etc., together constitute about 5,000 crores. So it's about 5% of the total portfolio, other than the microfinance. So overall, we would like to maintain, including the microfinance, today it's about 12 to 12%, maybe 15% of the portfolio should be in the non-gold sector.
By when, sir? By the end of this year itself?
No, see, it is, if the gold business is growing very fast, our preference or priority will be to support the gold loan. And we are also building our non-gold portfolio, whether it is the home loan business or the personal loan business or the business loan business. So we are building that gradually. But gold loan, we are there always, and we will keep no stone unturned to see that the gold loan business does the best possible.
All right, so what about Belstar?
Belstar,
Now, Belstar has a couple of questions. How do you see the unit functioning going ahead? And I think you know the second part of the question is that the value unlocking, will we see an IPO in FY26 itself?
Yeah, so the Belstar had a portfolio for 10,000 plus. Now it is about 7,000 plus. So in the last 2 quarters, they have been, they have been recalibrating the portfolio. And so the microfinance is coming down there. But it is stabilizing. I should see it's stabilizing after. This is quarter 2. After quarter 3, the business should stabilize. Not only for Belstar, for everybody. But the recent regulations have got a good fillip to it. Is that it said that 40% of the portfolio can be non-microfinance. So non-microfinance we can do, of course, because it is as a promoter's Muthoot Finance. We have certainly started doing gold loan. We opened 10 branches last quarter, and this quarter we plan to open another 50 branches exclusively for gold loan. So we will have a mix of gold loan and the microfinance in the Belstar. So going forward, it will give a little strength to the total balance sheet so that we have some sort of unsecured lending as well as the unsecured lending.
So in microfinance, and I think you said, you did allude to last time we spoke, would you, from your perspective, say the worst is behind microfinance?
Yes, the first is behind because everybody has now started a little more, what should I say, a little more calculated and responsible lending. All the players have started.
But banks are willing to lend to MFIs, sir? Or is that a problem?
All the MFIs have started more responsible lending because everybody has...
No, I'm asking, are banks lending to MFIs to be able to lend?
I think so. For us, we are concerned, our MFI is double A plus rated. So bank funding is not an issue for us. But of course, I also read in the papers that banks are not a little wary about lending to lower rated NBFCs. That I have read in the paper.
What about Belstar IPO, sir? You didn't clear the point on that. This year we're expecting it. You took me a little bit round, but you didn't tell me. Is it going to be in quarter 3, quarter 4? Should we brace for the IPO?
No, I think because now, as I said, the AUM is coming down. The AUM, which was about 10,000, has come down to 7,000. So, in fact, at this point, we don't need any extra funding. Probably it should be quarter 4 or next quarter 1.
Okay, but is it a size, AUM size that you're looking at? Say if it gets back to 10,000 crore.
It will depend on the growth we see in the microfinance. So, as I said, everybody is doing responsible microfinance lending. We also will be doing responsible microfinance lending. And at that point, if we need capital, we'll go to the market. I don't think it is that difficult even at that time to go to the market. So, at the moment, for next 2-3 quarters, I don't think IPO is necessary for Belstar.
Absolutely. Mr. Muthoot, 20% plus. You've given us a hint, a growth for the full year. But next quarter, at the end of the next quarter is when officially you will change the guidance. You're not.
It's not the 20% plus. It's definitely more than 15%. Not necessarily 20%. It can be even higher also. So let us keep it there. Let us not have a guidance.
So what was
Let us keep it there.
What was the industry growth for gold loans, particularly in Q1? Yours was 40%.
If everybody is growing, all the banks are also growing their portfolio. The market is really improving. The total business of banks is about 13 lakh crores. And NBFC is about 3 lakh crores. So banks have a much bigger portfolio.
And what a change it has been, right? We were talking about regulations 2 quarters back, restrictions on gold loans, and government is not too happy and all those kind of things. And it's completely turned on its head in terms of what is required and what needs to be done. There's a policy push as well, as you alluded to.
I think it is mainly because this serves the community well.
Yes, absolutely,
People have realized that it serves the community well. And I've been shouting from the rooftop that this is a small loan.
You have been. You have been. As the oldest player, and I think we've been taking that point on. Yeah, as the oldest player, we've been taking that point on board as well. Thank you very much for joining us. Great speaking with you. Really appreciate it. And good luck, sir. We'll speak again. Just a quick, maybe dip in on the JSW Cement listing. I think we have visuals, and Mr. Sajan Jindal is speaking at the NSE. And maybe for 30 seconds, we can kind of sort of dip in.
Group, and we can't be conservative. We have to be aggressive, and that's what India requires. India needs aggressive companies. India needs growth. So therefore, I hope that's what JSW will do that. And I know that his mother Sangeeta has also always is very supportive and must be very proud. He's very proud to see him carry forward the values and with such strength and dedication. So she has been always a great strength, and so has been Anushri, who has always been on the side of Parth.
Well, I think Parth Jindal earlier spoke, and he said that it's a nice quote, if I want to live with my father, I better take this company to the #2 position. That's JSW Cement. So listing today, and I think we'll have more for you a little later. Nigel.
Well, and Parth is, to be fair, he's earned the position, right? Because when he came into JSW Cement, it was much smaller. Everyone said, father is such a great man, we need to listen to him. But he turned it from a loss-making entity into a profit-making entity, and he scaled it up substantially as well to 20 million tons. And over the last 10 years or so, whenever I've spoken to him, asking, where is it happening? And finally, that moment has arrived. Came in at peak valuation, JSW Cement, but it got lapped up. Investor interest was high. We'll have to see how they go from here. But getting to #2 is not going to be an easy task, because you have the Adani Group that's going to be at around 150 million tons. They're at 20 million tons, going to 40 million tons. And Ultratech is at around 215 million tons.
So they're not even...
So what he told me is that we're the 9th player right now. So we're price takers. But the top 3 are very hard to move right now. They're giants. So our best bet right now, or goal, is to be the 5th player. I mean, that's the spot that we will be looking at. But let's...
Fifth is realistic.
5th is what he's...
I think second will be a little bit tough. And as he said, right, earlier we didn't have, the bandwidth to go ahead and, in fact, bid for some of these assets. But now they're looking on to take on the Adanis as well as the Birlas. Well, let's focus on, we'll keep dipping in there. We'll get you the, I think the premium should be around 6-7 rupees or thereabouts with regard to the listing. So we'll wait by for that. Max Healthcare, that's the next company on radar. Reported actually a steady performance. Occupancy growth was largely flat. Margins came under some pressure. International patient revenue, though, rose by close to around 32% on a year-on-year basis. We have Mr. Abhay Soy, the chairman and managing director, who joins us on the show. Hi, Abhay. Good to have you, and thanks a lot for joining in. Well, occupancy as well as ARPOB, both of them were flattish in the past quarter. Tell us what went on and what's the outlook on both these two parameters?
Well, as you know, we've expanded quite sort of dramatically over the last 15 months, and we've added about more than 30% capacity. In the last year alone, we've added 2 hospitals. One is Dwarka, which was a greenfield project, and which we commissioned in July. And we acquired JP Hospital in Noida. This was in October, November. So this is what I categorize as newer hospitals. So if I see existing hospitals, then you had an increase in EBITDA per bed. You had of about 7%. You had an increase in ARPOB of about 5%. There's been an expansion of margins as well from 25.8 to 26.2. But the two new existing hospitals are operating presently in the first year at about 12.5% EBITDA margins. And, they've sort of, as expected, would drag the overall ARPOB down, at least in the first couple of quarters. And as these ramp up, and that's exactly where the opportunity is, both the margins as well as profitability will expand from here on.
Mr. Soy, so the two new hospitals, Dwarka and Noida, you said margins are 12.5%. As they ramp up, say exit margins for these two hotels, what would it look like by the end of FY26?
Well, by the end of it, it should track at similar levels as the rest of the sort of portfolio that we have, because we only categorize hospitals. We have a fairly aggressive sort of this thing. We categorize only hospitals which are 12 months old as new hospitals. So yeah, by the end of the year, they should be ramping up closer to the rest of the group.
Okay. And international patients growth really picked up for you. Very strong traction seen, up 32% revenue growth from international patients, 9% of your revenues. What led to the pickup and what can you guide here?
Well, we normally don't give a guidance, but if history is anything to go by, I think last few quarters we've been growing at more than 25%. Yes, it's been more than 30% this quarter, but 25 to 30% seems like a decent sort of growth rate that we've been sort of getting in the past, and I don't see any reason for that not to sort of continue.
Abhay, hi, good morning. So as a percentage share, Abhay, you want to leave us with a number? Where do you see it by the end of the year?
Well, it's presently 9% of revenues, and why I stay away from percentage share is because we also dramatically increasing capacity, as you're aware. So, if our capacity goes up is expected to go up by 30% in the next 6 months before the end of the year. And that should actually bring down the total share, because if your capacity is going up by 30%, and let's say if your international business is growing by about 25 to 30%, then it should marginally reduce, go up, or remain the same. But, apples to apples, it would grow otherwise.
Max at Home, which is your home healthcare business, and Max Labs, the diagnostic business. Could you give us an indication of how they're likely to perform in the balance 9 months, and even on margins picking up for Max Lab? I think currently it's about 13%.
Well, we've been investing for growth in these businesses. They've been consistently growing at 20% plus for, I think, many, many quarters now and for many years. And I see that sort of keep expanding. I see the margins, of course, grow in the lab business closer to where the peers are. The home care business gives more than 20% margins, so we're quite sort of healthy margins. These are low return or very high return on capital, because there's hardly any capital required. At least for the labs, we use our own labs at the back end, the spare capacity in our labs and so on. So this should ramp up pretty well. But yes, I think, even whilst the rest of the sort of sector, a couple of years back was kind of dipping, but we've soldiered on. We've seen a similar sort of revenue growth, which is 20% plus.
So for Max Lab, these are the steady state margins, 13%, assuming the 20% revenue run rate continues?
No, so like I mentioned, this should move up. They should move up to 17%, then 20%, and so on. So I see this going up. There's no reason for it to kind of remain at 30. As we sort of keep investing, so long as you keep building critical mass, and when you invest is a smaller component of what you have on the ground, you're going to see margins grow. Because when you set up new points initially, like I mentioned, margins will suppress, but that's investment for growth.
Is there any inorganic growth, Abhay, that you're looking at?
Well, these are very high value, very sophisticated sort of labs that we run. So you must keep in mind that all of the high-end work we do, all the super specialty work that we do at our hospitals, all our senior clinicians rely on the efficacy and efficiency of our labs. And so you have to find sort of similar minded, similar sort of quality labs out there for us to sort of do bolt-on acquisitions. That is something we always look forward to. They tend to be far and few, but of course, when the opportunity arises, we're quite open to it.
Just one last question on the international patients, Abhay. Before 2019, did not just you, but I mean hospitals, were Chinese patients a big did they make a meaningful number of international patients seeking treatment in India, or not really?
No, never. So actually, I don't think that Chinese patients do come to India. They have a fairly robust government hospital sector, which the public hospitals over there, also parts of them do private work. But most Chinese people go to government hospitals. They have a far bigger reliance over there on government hospitals. So China has never really been a source of patients. Having said that, I think, we are seeing now also influx of patients from developed countries. Earlier you were seeing them from the Middle Eastern cluster, the African cluster, the SAARC countries, the Eastern European cluster, where it was self-pay. It's not necessarily patients which were sponsored by the government or by the insurance in their countries. But now, given the huge waiting lists over there, we are seeing some early signs of patients. And India really, I think, being able to tap its comparative advantage as far as healthcare is concerned.
Abhay, we'll leave it there. Thank you very much. Good luck with the business. Appreciate you joining us here, as always, on CNBC-TV18. Thank you. Markets are down. Markets are up 38 points, 40 points, off the highs a little bit, 24,657. I just want to make a mention of 2 or 3 names maybe. CSB Bank is down 8%. That's a large cut coming through, $350 on CSB Bank. Sami Hotels, actually we've spoken with all these companies. Sami is down 4%. It's coming through again with a large cut. There is HPL Electric, which is down 11%. That's a very large cut coming through on HP Electric. And Deepak Nitrite is down about 4% as well. Actually, if you look at the advanced decline, it's kind of flipped, more down than up. If you look at the all NSE list at this point in time, and many more new names into the mix, which we will address in a bit from now. Take a break. NHPC management on the other side with their first quarter performance.
Well, let's focus on NHPC. The stock is a little bit lower, I think, in trade in reaction to its Q1 numbers. The margins disappointed, but revenue saw a growth with the power generation also double-digit growth. We have with us Mr. Goel, the Chairman, Managing Director, and the Director of Finance who joins us on the show. Hi, Mr. Goel. Thanks a lot for joining in. Well, in the first quarter, we saw 11% generation growth. For the year, what kind of a growth are you seeing? And how is the overall demand-supply scenario panning out right now?
Since we have commenced our Power 2 in current year, and there is increase in generation of Power 3 also, and we have already commissioned 214 megawatt of Bikaner solar project. So we are seeing a growth of around 15% in the generation in current financial year, and the similar growth will be in the revenue and PAT also.
Parvati sir, how many units have been commissioned? When do we see the entire, the entire facility, all the units getting commissioned? If you could tell us, and what kind of contribution can it give to your numbers?
We have commissioned 3 units of Power 2 on 1st of April 2055, and balance 1 unit has been commissioned on 16th of April. So all the 4 units with 800 megawatt has already been commissioned, and it is generating very well.
What is the expected contribution, sir, from Parbati for FY26?
For FY26, we are expecting around 500 crore of PAT in current financial year.
Okay. And for Subhanshri, when can we, you've got 3 units which you plan commissioning. When will that happen?
We are ready for commissioning with 3 units as of now. But due to pending clearance from the NDSA, we are likely to commission 4 units in the first week of October 2025, and balance 5th unit will be commissioned in January 26. So during current financial, we will commission 5 units with 1250 megawatt of capacity, and balance 3 units will be commissioned in the coming financial year, one by one.
You know, the National Dam Safety Authority, the NDSA, visited the project to review plans. Have there been any demands, any cost escalations, anything upgrades you need to do here before you commission these?
NDSA visited in the month of May, and they have given certain tasks to be completed before commissioning. So we are working on those items which have negligible cost, but it will be completed in September month itself, and we are expecting visit of NDSA in the month of August itself. So we are very sure to commission this project in the month of October 2025.
No, got that. You know, you established a dedicated, a renewable energy arm, NHPC Renewable Energy Limited, NREL.
Yes, you are right.
What's happening there, and what is the plan? I think you indicated some separate listing as well.
No, there is no plan to list this company, because the capacity is to come in this company. Basically, we are a hydro company, and we are focusing on hydro, particularly after this IWT suspension. So we are doing little bit in solar and wind, but we are doing solar business in NHP itself, holding company itself, and we are doing the work in RIA mode.
Sorry, what is NREL going to do then, sir? Because this is renewable itself, right?
Yes, it is also renewable, but hydro is also very much renewable, and we are focusing on hydro more.
Right. No, so what will NREL do?
NREL will do solar projects in future, depending upon the viability and considering the return on equity at least 12%. Otherwise, we will not do solar project below that 12% return on equity.
Right. Got that. So nothing really firmed up. I mean, it's you'll do it if it's viable, as you said.
Yes.
Okay. Now, capex target for the year stands at about 13,000 crores. It's about 13% higher year on year. Could you give us a sense of how much has been spent?
Yes.
And is there any change to it?
Last year, we incurred 11,600 crore as capex, and for current year, it is 13,000 crore. We have already incurred 3,700 crore up to, and in the first quarter, it remains at lower side because of monsoon. But in the coming period, we are very much hopeful to achieve the target of 30,000 crore.
Have you set a long-term 5-year capex target, sir?
Yes. We have capex target for next 10 years, and it is in the range of 13,000 to 15,000 crore annually. During current year, we are going to float tenders of around 5,500 megawatt capacity in hydro, considering Sawalkot 760 megawatt, Kamla 1620 megawatt, Subansiri Upper again 1800 megawatt. We have already floated tender for Durasti stage 2 and Uri1 stage 2, taking together capacity of these 2 projects 600 megawatt. So our capex is very robust, and the coming decade is for hydro only, because renewable is coming in big way, and to support the grid, hydro is must.
Okay, we leave the conversation here. Thank you very much for joining in. ICICI Bank, by the way, had opened in the red and now is back in the green. It's got a gain of close to about 0.5%. So following the customer feedback, remember they've lowered the minimum account balance to 15,000 rupees. The stock has moved up. Infosys continues to be the top Nifty mover, 1.5% up. Mitesh is now with us. Mitesh, quiet start, but it's got a positive tilt, at least the Nifty and the Sensex.
Yeah, I think, the Bank Nifty is doing well today. And as you were highlighting, I think a couple of IT names have, also supported the index. So in fact, on the trading side as well, I have a buy on LTIM. People stop just below today's low of 5127. So 5125 is what I recommend. I think we could see a reversal here, which could see the stock head towards 5260 plus levels. The other one is again from the IT name, that's HCL Tech. Here I would recommend buying once it starts getting past 1510. We got a high of around 1507 today. So buy about 1510, keep a stop at about 1490, look for targets of around 1515.
Any view on Reliance Industries?
See, Reliance has gone through a big decline, and there is a pivot around these levels of 1360. It's been holding on to that level for last 4 or 5 sessions. If you go back to the last week's price movement, it bounced back around this 1360 level. So as long as that is holding, good chance that we'll see a bounce back to about levels of 1420. Above that, the trend will reverse on the positive side.
Okay, all right. Thanks a lot for that, Mitesh. Well, those are the visuals that are coming in there from the NSE. Mr. Parth Jindal out there, Southern Jindal, the little girl out there, family member as cute as ever. And Mr. Rao is there, Mr. Sheshagri Rao as well, that's been instrumental in building the JSW group as well, has made it, and Mr. Ashish Chavan as well of the NSE. So the bell is rung. The stock lists at a mild premium in comparison to what the IPO price was at around 147. Valuations are not cheap. The street is looking ahead from 20 million tons. Parth wants to take it to around 40 million tons. He wants to be a larger cement player. And he said he'd rather build than buy. That's been the motto. And he's expecting a big turnaround here for the company as well. Debt goes down as well. Interesting to see how things pan out. Not cheap, but for the time being, opens in the green. That little baby out there, that's the one that catches my eye.
That's Parth's daughter there, which is, and I spotted the CEO of the business, JSW Cement, Nilesh Narvekar.
Yeah, he's there.
He's there.
I mean, he's along there with the entire team next to Mr. Rao. So yeah, absolutely, and it's a momentous occasion. One more Jindal group. As far as the listed space is concerned, and one more cement company for Nigel to track. So 154, about 5% higher, and look at the volumes coming up. That's basically photo ops now. More in terms of valuation comparison, etc., through the course of the day as we go along. But for now, we'll take a quick commercial break here. Manisha is going to be with us to run us through the commodity action that she's watching.
Welcome back. Midcaps is slipping a bit. It's down 250 points in the Midcap index, so 0.5% lower. You've got visible cuts coming through in HPL Electric. CSB Bank is under pressure. NMDC is weak. Brigade Enterprises, EIL, Max Healthcare. We just chatted with the management. Yatra Online. These are some of the stocks which are weak in trade. But let's talk about commodities. Manisha is now joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at a data really, Rima, because this is interesting. We all have been talking about on how so many sectors will be impacted with the kind of tariffs that US has put in, and gem and jewelry sector clearly is on the top two there. When you look at the numbers, well, nearly 30 to 35% of our gem and jewelry exports go to US. And interestingly, the data for the month of July has come in, and that shows that the exports from India for various gems and jewelry actually has been surging ahead of those tariff expectations. So when you look at the month of July, we've seen rough diamond exports gain up by 32%. Polished stone was up 22%, and that is a surprise that you have in the last number. 83% of a jump on a month-on-month basis. This is what we've seen in sense of lab-grown diamond exports. These export numbers are to various countries, including US and UK and UAE as well. And we're looking at very strong numbers there. So when you look at the overall exports, those gained up by 15 or 16%, and imports were higher at around 26.5% as well. So very strong numbers in July. August, of course, is a bit of a question mark with 25% tariffs already on, and we're looking at or staring at 50% by the time it's 27th of August. What the street also is looking at very strong numbers in sense of cut and polished diamond. Those exports were up by 18%. You have polished lab-grown diamonds up 27%. Gold jewelry also saw some gains with nearly 17% of a jump up coming in for that. And then you have platinum jewelry, which also gained up by nearly 14%. What did not do so well was colored gemstones, just about a 2% of gain. And silver jewelry exports actually declined 2.5%. So clearly, more people bent towards gold and diamonds with those prices rising, and not so much for silver there. The buyers clearly seem to be stocking ahead of those tariffs is the narrative that comes in from these July numbers. 25% tariffs already on, and we do understand from various exporters within the sector that the trade is quite at standstill because the margins in jewelry are at about 1 or 2 and maximum 4%. 25% is something that they can't absorb, and 50% they tell us is a non-starter. If that comes in, then there is going to be serious trouble coming in for the industry. Also, when you look at the previous financial year, we saw $13.2 billion worth of Indian exports when it comes to cut and polished gems. Out of that, $4.8 billion was just to US. So very strong numbers is what we are looking at. But whether or not August can continue or what is the kind of numbers that we will see, that would come in about in next fortnight or so.
All right. Thanks very much, Manisha, for that. So keep an eye out, and headlines coming out over the next 24 hours will be consequential for commodities, definitely oil in particular, but others as well. Market breadth is now decisively turned. About 1,500 stocks are lower and about 1,100 stocks are higher right now. That's the market breadth. And, NMDC is the #1 volume-led loser. But there is Garden Reach Shipbuilders, which is down 3%. Yatra is down about 3.5%. HPCL is down 3%. KRBL, Deepak Nitrite. It's a whole list of companies there. HPL Electric, I mentioned earlier, it was down 10%. It's down almost 13% at this point. CSB Bank is down 7%. So that's a very sharp cut coming through. SAMI, I mentioned earlier. So many actually names which are coming through. EIL is down 3.5%. Aarti Pharma has had a tough week. This one about 4% lower. SPML Infra, 3.5% down. And all these, by the way, got volumes. Oh dear, look at Surya Roshni. Surya Roshni is down 7.5%. And it's just completely sunk. For the week, it's down about 11%. But from the recent highs, 10 days back, stock was 350 and it's at about 280 rupees now. I'm assuming it's earnings-related reaction. We'll check up and get back. But there's a fair bit of sort of price damage which is happening in mid-caps and small caps out there.
Even where you had good numbers, like Vishal Mega Marts, opened 4-5% higher. Now it's completely flat. Jubilant Foodworks is flat. United Spirits is on the verge of breaking into the red. Well, get into a break on that note. On the other side is our special segment. It's the Economy. Lata discusses with economists Aditi Nair and Bandhan fixed income head Suyash Chaudhary if Indian bonds are crashing because of fiscal deficit fears.
Stay.
Greetings to everyone for Independence Day. I'm going to do some straight talking today for the good of the country. The bond market is broken. Earlier this week, even a small state loan auction struggled to find buyers because banks simply don't want to buy. They're sitting on losses. The 10-year G-Sec yield is at 6.5%, up nearly 35 basis points from, the early June levels. It went to 6.17. It's almost as if there has been a rate hike. The first cause of the bearishness is a feeling that the rate cut cycle has ended. The stance has changed. A second reason is the fear that tax collections are going to be seriously disappointing, and hence there may be fiscal slippage, maybe more bond issuance by the government in the second half. To discuss the plight of the fisc and the plight of the bond markets, I have with me Suyash Chaudhary, the head of fixed income at Bandhan AMC, and Aditi Nair, the chief economist at ICRA, an expert on the fisc. So Aditi and Suyash, thank you very much for joining me, and my greetings for Independence Day. But let me start with you, Suyash, because the bond market is in such a state. What do you think is dragged the bond markets into such a sulk?
So Lata, we think there are two aspects at play. One is that the bond market has taken time to figure out the revised approach of monetary policy. So as you know, monetary policy this year has been very focused on ensuring transmission right away in the most broad-based manner possible. And for that reason, they have upfronted rate cut and liquidity injection. So for the first phase of this period, the bond market's expectations were almost over-delivered by the central bank. And then in order to signal to the market and economic agents generally that monetary policy should not be relied upon as the only game in town, the stance was changed in the June policy, and subsequently the tone of policy has been interpreted as being slightly hawkish. So there has been a bit of an expectation shock to the bond market from perceiving a central bank who was very focused on monetary easing to suddenly a change of stance and communication. Yeah. So in some manner, you can say that the expectation channel of the bond market for the time being has been neutralized. So that is one aspect leading to a belief that, the next move, whenever can potentially be a hike, although our sense is that we are still in the middle of the slowdown cycle, both globally and locally. And any sort of a rate hike is actually miles away. In fact, you cannot even rule out further rate cuts from the central bank. So this is first piece. Second is that, as we know and is well established, duration supply from central government bonds has gone up substantially over the last couple of years. In the first phase, there was pension and insurance demand to absorb this excess duration. But in this phase, that demand has been lacking. And yet the supply calendar has not, at least till date, been tweaked. There is one additional development. For whatever reason, this financial year, the average duration supplied by states also has picked up meaningfully. Oh. So now you're seeing, a market which is somewhat scratching its head with respect to future direction of monetary policy, at the same time being called upon to take on duration supply that it clearly does not want. So the need of the hour is probably a bit more, dynamic reassessment of how much duration can be supplied to the market and in what form.
Got it. Got it. Just a word for our viewers. When Suyash says duration supply, he means longer term bonds. Perhaps state governments and central government should be borrowing more 10-year and below or 15-year and below, and not 40-year as they have been doing. That's the ask of the bond market, as Suyash puts it. But Aditi, let's look at the fisc. I mean, we discussed enough about the rate cuts and rate cycle. We'll come to that if time permitting. But is the fisc going to face a situation where it may have to issue more bonds, or the fiscal deficit has to be higher? Because the tax collections, corporate and income tax, although, the first returns we will know only in August, the date has been extended, but still it is abysmal. Tax collections are flat year on year. And there is an expectation that a package should be given to the exporters who are suffering. So is it a real fear that the fiscal deficit may be higher?
Thanks, Lata. So let me start with a couple of factors that are giving the fisc some amount of buffer this year, and then I'll go into how we are assessing the tax collections. So first of all, we talked a little bit about this earlier this week on the nominal GDP side. I'm going to start with that. That's the denominator. We're going to assume that Government of India is going to try and keep its fiscal deficit at 4.4% of GDP, which is what the budget estimate for this year was. So the nominal GDP itself for last year ended up being higher than what had been penciled into the budget. So that's for FY25. For FY26, we're all now working with nominal GDP growth that's probably going to be just about 8 to 8.5%. But even with such a moderate nominal GDP growth, the nominal GDP denominator or base for FY26 will still be a little bit higher than what the budget for FY26 had penciled in. So a tiny amount of buffer coming in from that, about 15 to 20,000 crore is what we're assuming is the leeway that we have. Secondly, on the non-tax collections, particularly the RBI dividend, that's giving us some more buffer as well. So 50,000 crore, I would say, between the nominal GDP, RBI dividend, and the fact that at least right now, the disinvestment situation is looking much better than what it typically does at this point in time. So at least we're not looking at a slippage the way that we're usually a little worried that there might be a bit of a slippage from disinvestment.
Got it.
I would say that today we're sitting on a better position than that. So 50,000 crore is a buffer to either absorb lower tax revenues or to increase expenditure or a combination thereof.
Aren't taxes much lower than expected?
So Lata, I would reserve my assessment of how bad the situation is at least until we see the September quarter data. The first quarter tends to be the smallest quarter for tax collections normally. And here, if there is a base effect, then the numbers look quite awry very easily. It doesn't take a lot for the numbers to look very strange. There do seem to be a lot of refunds. And of course, the filing deadline is also extended this year. So I do think we'll be in a much better position to actually assess the tax situation by the middle of September. And I'll tell you what Q I'll be looking for. Whether we get a double tranche of tax devolution to the states in September or not. If we do, then I think we should assume that things are okay. If we don't, maybe that will be the first signal that we should be looking at tax collections being weak.
Okay. You know, as it is, the income tax assumption in the budget was about 15% or so. And last year we fell short as of March 31st by a bit. So the lower base makes the tax expectation or assumption even higher, which is, I mean, I'm finding it difficult to believe that we will be able to reach that kind of taxes, in which case the buffer will be absorbed. So Yash, is there a genuine fear of even higher issuance, or is the bond market now only worried about the combination? That is, we don't want more longer term paper, please sell more short term paper. Is that the only worry, or is more issuance itself a worry?
Lata, I think the dominant effect is confusion with respect to the future of monetary policy, as well as the higher duration. And bear in mind, duration is not just the long end, but even, for example, the 15-year segment is starting to show the pressure. So the need of the hour is really to hike, issuances in the 5-year odd segment, where, balance sheets will be more in a position to buy given very low funding rates today. I think, nobody seriously expects any very proactive expansion in the fiscal deficit as a response to a slowdown. Some expansion owing to a shortfall because of nominal growth slowing is, well par for the course. And I think the bond market will accept that. It needn't even translate into more dated GSEC borrowing. It could very well be funded by some amount of treasury or other sources if required. So I won't say, that is a fear that is as yet a big portion of the bond market sell-off.
So let me squeeze in the other problem which I think the bond market is facing, the quality of buyers and sellers. Last year we had good buying by the insurance companies and we had that bond inclusion. So the FPIs were buying. Those two are absent now, and banks are also absent because, there has been a change of rules on how you account for HTM, held to maturity. So do you think three buyers are absent now? FPIs are absent, insurance is not buying much, bankers are not buying much.
Absolutely. In fact, sometimes we joke that it will be a better thing if part of the government borrowing could be done as corporate loans from banks, because everyone is wanting to do more loans. Pricing there is much more aggressive, and yet mark-to-market risk, as you suggest, appetite for that has diminished substantially. There are ways around. It's just that transmission from the bond market also needs to be on the radar of the central bank, because clearly this massive widening in term spreads without a fiscal stress in sight is something that is at least impeding transmission via the bond financing market, and it should be part of what central bank watches, we hope.
I agree with you. And let's see. Insurance companies have also clearly let down the bond market. But Aditi, can there be a reigniting of hope of a rate cut? If not for inflation reasons, because the RBI keeps looking at 12-month forward and saying that it is a 4%. You may squabble whether it is 4.9 or 4.5, but either ways it is above their comfort zone. But can there be a growth reason to cut rates?
Well, as of now, we think the growth reason to cut rates will take quite a bit of time to really manifest. When we spoke earlier this week, we discussed our views on the GDP growth for Q1. We're penciling in a 6.7% GDP expansion in Q1. And we fear that that's going to be the highest quarterly print for this fiscal year, because a lot of the growth impulses have been upfronted in a sense. We've had very high capex from the center in the states. We've had upfronting of exports to some geographies as well. So these drivers of growth are likely to taper off as the year continues. But you will end up with growth prints that are possibly going to be sub 6% by Q3 or Q4. And even the high frequency indicators may only start showing that stress much later in the year. So inflation uptrend is going to give you bad optics for a rate cut, and the growth optics for a rate cut will also be quite back-ended.
Yeah.
My baseline expectation is that we're now in an extended pause scenario. I'm not sure we can count on a rate cut.
Okay. Yeah, by the time you get to know that the third quarter GDP is, sub 6 or maybe just about 6%, it is going to be February. So will we get a December rate cut is a bit of a question mark. February, perhaps we can expect. Suyash, to wind down the conversation, what is your ask? If you have to ask the governor something or the finance minister something, what does the bond market want?
So first is to restore the expectation channel for transmission. See, nobody is really asking for meaningful further rate cuts. It's just that, the slowing economic cycle, both globally and locally, still has some room to run. Whereas, commentary almost suggests that this is the end, or at least that's how the bond market has interpreted it.
Yes.
The first task is to, basically try and restore the expectation channel that we are still in the middle of a particular phase of the economic cycle. And, that obviously will have support from the central bank. To be fair to them, they have been hinting in that direction, but probably the bond market wants a little more clarity. Second is a bit more, active duration management of supply, or, the tenure of bonds that are supplied to the marketplace, given that India doesn't really run any meaningful refinancing risk. Most of what is borrowed locally. We are running a current account deficit, which is 1% of GDP.
Or even less.
So, we don't really have any meaningful refinancing risk. We are a solid macroeconomic story where hopefully structurally bond yields will be lower. And therefore, even, some bit of interest cost saving can happen for the government if duration management of supply is done a little more proactively basis demand from the market.
Got it. Thank you very much for putting it so succinctly, Aditi and Suyash. Have a great year ahead, and let's hope this Independence Day, we will be rewarded in the days and weeks to come with some more clement policy for the bond markets. Thanks so much for joining us. Time for a break. Chartbusters up next.
Shares of Muthoot Finance surged over 10% to a record high on strong June quarter numbers. AUM in gold loans rise 42%. The management tells CNBC-TV18 they won't change their 15% official guidance, but 20% growth is possible in FY26.
And Jubilant FoodWorks delivers a strong set of numbers, industry-leading revenue growth, like-to-like growth in the first quarter. The stock was up close to 3%. However, it's seen some profit-taking in the last few minutes.
Pfizer surges on a strong set of first quarter numbers. Profits grow 25% year on year. Margins expand significantly. The stock higher by 5%.
Deepak Nitrite's first quarter revenue and profit fall, while the margins contract 400 basis points. The stock is lower by nearly around 2.5%.
JSW Cement makes a muted debut on D Street, listing with gains of about 4% to its issue price, currently trading just close to its issue price.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the indices will come up for you very, very shortly. Both those two, the Nifty and the Sensex, trading in the green. The problem today is a little bit on the mid-cap side, but you want to go into that long weekend on a high. So let's see whether or not the bulls can be in top mode. The good news, Mangalam, today is the Nifty bank that's actually been underperforming, and the one that's seen a lot of shots in the system, that's the one, in fact, that's putting in a bit of a fight. So good to see.
Good to see. Two things doing well. We have the Nifty bank, which is doing well, and the other is the IT pack, which also underperformed yesterday. So two heavyweights doing well. So Nifty currently at the higher end of today's trading range. And bulls would like it even if it stays here because, we're up 1% for the week so far. And if we continue to stay here, we will break a 6-week losing streak. But let's get you some ideas for profit. Our colleagues at Money Control Pro join in. Today we have Kanchi joining in with a stock.
So the stock that I've selected for today is Mahindra & Mahindra. So first, let's touch upon its Q1 FY26 performance. So Mahindra's revenue grew by 26%, which was driven by solid performance in its automotive and farm and equipment segment. However, the EBITDA margin contracted by 69 basis points, which was impacted by higher commodity costs, which was particularly from steel and certain precious metals. Mahindra is reinforcing its leadership in multiple segments. So in the passenger vehicle space, the company continues to shine amidst the rising competition in the SUV category. So in the SUV space, the company also strengthened its position and recorded a 27% increase in the SUV revenue market share in the first quarter. Also, M&M's electric portfolio has been gaining momentum. So notably, M&M's EV penetration in the quarter was higher than the industry average also. And it has also maintained its #1 position in the tractor segment, with the market share has been to 45% now. In the light and commercial vehicle category, M&M posted its highest ever market share at 54%. So M&M has outperformed its own target of earnings growth and ROE of 18% in FY24. The management remains quite committed to delivering 15 to 20% EPS growth and 18% ROE. So this ensures sustained profitability and shareholders' value. So we believe that M&M is well positioned to outperform across its core business, fueled by a healthy recovery in rural area and new product launches. As per our SOTP, the stock has an upside potential of 10%. Thus, we advise the customers to accumulate it for the long-term gains.
All right, that is about an idea for profit coming in. Meanwhile, just don't lose sight of the IT pack. We have Wipro, which has moved higher. We have LTI, Mindtree, Infosys has been doing well already. So now the Nifty is up around 50 points, so half century there. But a bunch of numbers on our radar right now. Let's talk about Samvardhana Motherson. Reported a weak June quarter. Profits fell by nearly 49%. Margins contracted as well. All of that could be pinned to tariff-related uncertainties. We're joined by COO Pankaj Mittal and CFO Kunal Manali to break down all these numbers. Thanks a lot, gentlemen, for joining in. Let's come across to you, Pankaj. There is a fair amount of uncertainty. So, instead of asking you about the quarter went by and what is likely ahead, because it's anyone's guess as of now, you've often said that majority of your US sales are USMCA compliant, which will have no tariff impact. And if you could give us a sense on what proportion of your actual sales come in from the US, that's primary. Secondly, what proportion of your sales which are to clients outside of the US through secondary exposure have, US exposure, and what proportion of that is USMCA compliant and what isn't? Just plain numbers.
So, good morning and thank you for having us on the show. as we mentioned earlier, most of our supplies are USMCA compliant, and they remain so. And therefore, there has not been much impact of tariffs on us. Even the exports from India also are mostly, they are just about $10 million in this quarter, and most of them have had no impact because they are all ex-factory. In terms of the small percentage of the part of the supplies which we do in US, which is non-US MCA compliant, the tariffs are being passed on to the customers, and it's impact of a lag because the tariff rates themselves were not decided on what will be applicable on which commodity, how much. So those agreements are in process and they will all be passed on. So mostly we do not expect any impact or any major impact on our business from the tariffs. So that has been a very big strength of the business model of Motherson, that we are local globally. And this quarter shows the resilience and the agility with which we worked to take care of the disruptions in the market, because many of the customers around the world, and especially in Europe, also had to rejig their powertrain model. So we are a powertrain agnostic company, but still we had to also make some structural changes to take care of the new models which are taking shape and to support our customers.
So just let's get a couple of numbers out of the way. What is the exposure to the United States, firstly? And how much of that is imported into the United States? Because, on one end, people will say there's no impact of the tariff, but then there could be demand hurt as well. So tell us that.
We do not see any demand. I mean, if you see the secondary, that will be through the car makers. So if we supply to the car makers in another region, and those cars were being imported into US, we do not have a number to that. But with most of the agreements being done between, say, Europe and America, UK and America, so those impacts will also get, because it's now stable and the car makers can take their decisions. So that stability will come in. So I don't have those numbers to give you as to exactly how much is a secondary import into the market, because that's through the car makers' imports.
All right. And primary of your overall exposure, how much is US? How much of that is USMCA compliant? You say majority. If you could put a number, that would bring a lot more clarity to the street, sir.
So more than 90% of our business is USMCA compliant. I will pass on to Kunal if you have a very specific number, Kunal, to give on that, because our understanding is there are certain parts which we use in our products which are also customer nominated, and therefore those were the ones which were not USMCA compliant. Kunal, I passed on to you.
So 19% of our revenues come from the US. Around about 90%, as Pankaj was mentioning, would be USMCA compliant. Mind you, we do have 25 odd facilities in US as well. So not that entire turnover that we're doing in US is coming as imports into the US. So there's a fair amount of anyway manufacturing that does occur in the US itself. And whatever is getting imported, a lot actually moves from Mexico and hence is USMCA compliant. There are some parts which do come from other parts of the world as part of the overall customer supply chain. And hence those are the set of parts which are to be passed on to the customers as and when the final agreements happen, which is work in progress, because I think there was a lack of clarity at the customs end on what should be the actual tariff on these parts. And as those get clarified, I think it is a matter of time before those will also get passed on to the customers.
All right. A lot of the clients that you cater to, they've cut their guidance for the full year, be it Toyota, Traton, you have Mercedes, Ford, a bunch of them. Kunal, could you give us a sense on what kind of revenue can you grow this year because of all this uncertainty and your clients facing demand challenges? And on margins particularly, would you have any guidance?
So look, on the demand front, as we had highlighted in the last quarter as well, Europe in particular was facing a bit of stress on some of the OEMs which were all focused in EV segment, and that segment was really not the ones which were growing. And they hadn't invested in the ICE and hybrid portfolio. Having seen that, I think we had also highlighted that the OEMs are working towards creating a new set of portfolio for both ICE and hybrids. which is then expected to come out sometime in H2. And hence, we do expect that some of these underperforming OEMs will start showcasing better performance as the new launches happen in H2. In the meanwhile, keeping in mind the changed environment in Europe, we had done transformative measures announced in April, where we had said we would be, going after a cost block of around about 50 odd million euros. Part of this has happened, in which case we have booked a cost of 14 odd million euros in this quarter itself, and this would have a payback of less than a year. So as we move through the quarter into the H2 part of this year, we should be able to see a sharp ramp up on the profitability as well, aided by multiple factors actually. So one, as I just mentioned to you, the transformative measures will start showing some signs in there, though a lot will also come in FY27. In addition, we do expect H2 demand volumes to look much better in some of the traditional OEMs as they bring out new set of vehicles. Three, I think some of the tariff-related pieces for which we have taken the cost until now, those will be passed through to the customers and hence will improve the margins in the latter quarters. Fourth, I think many of the new greenfields, like the large consumer electronics one and the 10 odd that has been implemented last year, those will be ramping up, which will again be aiding profitability, which today would be at pretty much meager profitability as the ramp ups is occurring as we speak now. So again, latter quarters will show that impact. And finally, some of the acquisitions that we have done, the integration of those should also help. And I just want to highlight from a growth perspective, the non-automotive part of the business, irrespective of how the auto does, is growing at a very sharp click. This quarter, we have seen a growth of around about 40% on the non-automotive pieces. And that is where a large chunk of our growth capex is also going.
And how do you expect that mix to shape up, auto and non-auto, even as there are headwinds in the auto space, non-auto growing 40%? I'm sure the contribution increases from here on. And I specifically asked you about this year, largely because, the last time you joined us, you said that FY26 will grow better than FY25. And FY25, you grew upwards of 15%. And you also said margins would expand. First quarter, that hasn't happened. So that puts the pressure on the next 3 quarters for you to perform, which is why I wanted your thoughts on, once again, the overall outlook for the year.
Yeah, absolutely right. We do expect that we should be able to do better than what we did last year. The quantums around it is a function now of multitude of different variables which continue to be at play. Like this quarter, I don't think we had anticipated any geopolitical issues with regards to Iran and Israel, and that had a significant impact on how both our working capital played out, given we had to keep again safety stock to manage it, and how the freight rates went again sky high, which meant we were bearing additional cost, which is all then part of the conversations we need to have with the customers during the year, and hence, again, the latter part of the year should be looking much better.
Okay, all right, gentlemen, thanks a lot for joining in and filling us in with your insights in terms of how business is shaping up. We look forward to chatting up with you all as the quarter progresses. For the time being, though, we'll slip into a short break. Come back, we'll continue to focus on markets and stocks that are bobbing around. Welcome back, Mark. Welcome back. Markets are holding with gains of close to around 40 points. And the good news, as we've been mentioning, is the Nifty Bank is trying to give up its underperformance. Sachidanand Uthekar joins us on the show. Hi, Sachi. Good morning. Good to see you in. It looks like it's going to be a dynamic finish to the week because after 6 straight losing weeks, hopefully there's some green by the time we wind up. And it appears that could be the case because we need to fall 300 points from right now. Now, what is your view on the markets first? Would you take a fresh buy or do you believe this bounce is a selling opportunity and individual stocks as well?
Good morning, Nigel. Clearly, I think the trend has turned. In fact, the way Nifty was behaving for the last couple of weeks, I think that behavior has somewhere changed. We've already seen a kind of an ending diagonal pattern, which has already confirmed its up move. So I think this particular base should remain intact. We are of the opinion that market could see spurts of momentum in the days forward. Even if you look at today's data, there has been a very significant put writing at around 24,500, 550 kind of a zone, and that particular level seems elevated right now at 24,600. So we are not of the opinion that the market could see any slippages during the day. On the contrary, in case if we see the Nifty, scaling towards 24,700, there's a good possibility that we may end this particular week on a very strong note, and we may see a rally, continuing towards 24,740 during the day itself. So I think it's a good, idea to retain your long positions. Even if you see a decline, I think the stop loss can be placed at around 24,510 on closing basis, and one should consider building aggressive long positions here. The first target would be around 24,740, and probably from a couple of days perspective, there's a good chance that the Nifty may again see this particular move extending towards 24,800, 810 as well. So I think the way Bank Nifty is now outperforming, we need that particular leadership to continue. On the Bank Nifty data, I think the significant level would be around 55,670, where its 5-week exponential moving average is placed. So I think there's a good chance that this particular bounce back may continue towards the same. And hence, even on Bank Nifty, we are of the opinion that until unless 55,130 holds, there's a good chance that the rally may continue towards 55,670, 700 kind of levels.
All right, we take that point. Sachi, individual stocks, what do you have on your list?
Good morning, Mangalam. Mangalam, first buy call is on Bharti Airtel. Already we have seen a good low top, low bottom sequence here. But for the last 3 trading sessions, there has been a good amount of confident call writing near that 1860 support, where its 20-week exponential moving average was also placed. If you look at, day before yesterday, we saw inverse hammer formation, which is again a good complementing sign that there is a base which has been established. And from that particular level itself, the stock has been turning up. So we are of the opinion that this particular move can continue or stretch towards 1940 on the higher side. And hence we are recommending building fresh long positions in Bharti Airtel, keeping a stop loss at 1865 on closing basis. The trading target could be somewhere around 1900, but eventually we see this move, heading towards 1940. The other stock on our radar has been Bajaj Finserv, a very similar formation, an ending diagonal on the 60-minute scale. We have already seen, multiple spike formations on its daily scale near its 200-day exponential moving average support, which is placed at around 1900. There is a good chance that this can be the early signs of a double bottom formation in place. And hence, we may see this particular move getting extended towards 1970. So we are of the opinion that momentum can be chased here, keeping a stop loss at 1905 for a trading target of around 1970.
Okay, all right, Sachi, thanks a lot for joining in and filling us in with your take on the markets and individual stocks. We'll slip into a short break, come back, we'll continue to focus on markets and stock-specific action. Don't go anywhere.
Let's tell you some important news. India has achieved a historic milestone of 100 gigawatts solar PV module manufacturing capacity under the approved list of models and manufacturers, which is a remarkable rise from just 2.3 gigawatts in 2014. So that's a big surge in 10 years. New and Renewable Energy Minister Prahlad Joshi wrote on X that India is building a robust, self-reliant solar manufacturing ecosystem, and this achievement strengthens the path towards Atmanirbhar Bharat and the target of 500 gigawatts non-fossil capacity by 2030. Prime Minister Shri Narendra Modi also hailed the milestone towards self-reliance in achieving 100 gigawatt solar PV module manufacturing capacity and efforts towards popularizing clean energy.
All right, let's focus on a couple of stocks, and Ekta joins us to tell us about Pfizer. Ekta?
Well, yes, Pfizer has seen quite an uptick in today's trading session because the overall numbers have actually come in better than at least what the street was anticipating. So 603 crores is what they've recorded this quarter as compared to 585 crores in terms of a poll. The margins have come in at around 34.8% as compared to the street anticipating, an EBITDA of around 180 odd crores. So that's come in better than expectations. And the profit at 191 crores versus 170 crores. Now, the company separately and additionally has received approval for a pneumococcal vaccine just some time ago. And that's important because it is available for adults in the domestic market. The next trigger would be to get approval for children with regards to this particular vaccine. And it is expected to be a very important vaccine in terms of antibacterial protection, for example, meningitis, pneumonia, sepsis, etc. And hence, the street is now waiting for the next trigger, which would be the children's vaccine. This took place a few days ago, but combined with the good numbers that they've come out with, that's an additional boost for Pfizer.
Take that point, Ekta. Thank you so much for that. With that, we take your leave on this edition of Chartbusters. The news that the Nifty manages to hold on to those gains, currently up 35 points, led by the Nifty Bank as well as the IT Index. Stay tuned. Trading Hour comes up next.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Rima. With me, Sonal and Hormus. At 11 o'clock, markets are pretty flat. It's got a positive tilt. The Nifty is at 24,661. It's got a modest gain of about 42 points. Sensex higher by 180. The advanced decline ratio, though, is negative. We've got more stocks declining compared to advancing stocks. The Midcap index is off from the lows, but it's still staring at a cut of close to about 0.2%. IT is shining bright. Infosys has made a small acquisition. About $150 million is what they've spent to acquire a 75% stake. But I think the fact that they are spending, they're showing that aggression to get growth is something the street likes, because the Nifty IT index is up 1.5%. So it's not just Infosys, because this is a tuck-in acquisition. It's not very large, the amount they're spending or the amount of revenues, but just the fact that they're going after growth now. They're trying to expand into Australia and New Zealand, and that's sending a positive signal, especially because Nifty IT has underperformed so much. Year to date, it's down 18%. So given that underperformance, and there's a rub-off impact across the rest of the IT names too.
Some relief that's coming by, because we've been talking about those weak numbers, the layoffs that happened at TCS. So this is something that the street is liking. Rima, as Rima pointed out, Nifty IT is doing well. We do have Nifty Financials and Nifty Bank as well, which are supporting the Nifty. But it's been quite volatile in last couple of minutes itself. We did see that fall from the highs. Then there was a swift recovery from the lows as well. So we'll be tracking that closely. In terms of movers, this hour itself, ITC is one name that should come up for you on your radar. That one is at the day's low. So is Asian Paints. So some of these consumer names should be on your radar as well. But it's a packed show today on Trading Hour. Today's big story features Muthoot Finance, which is surging in trade after a strong Q1 performance. We'll also get you excerpts of our conversation with the management. Later, Real Vision Group's Raul Paul joins us in our special segment Crypto Corner to decode the latest trends in the world of cryptos. At around 11:30 a.m., George Joseph from ASK Investment Managers joins us to discuss market fundamentals. HSBC India's Yogesh Agrawal also joins us to discuss their latest report on India's passenger vehicle industry. And with that, let's go across to Hormus. He's here with us. He puts the spotlight on top movers in the market at this hour. Hormus, tell us more.
Relief for some, not for quite for the others. But look at CSB Bank today. Was down yesterday, down further today. Interestingly, was down a day before the results as well. Came out with results yesterday. It's a slight recovery from the lows of the day. At one point was down well over 8%. And with this, the stock has now declined almost 20% in the last 3 trading sessions. We've had almost 15 lakh shares change hands by this time of the day compared to a 20-day average of around 91,000 shares. And the stock has delivered positive annual returns every year since its listing, barring last year when it was down around 24 to 25%. Newgen Software is the other one on the positive side that snapped a 6-day losing streak today, almost 8% higher on that stock. We've already had 30 lakh shares traded compared to a 20-day average of 5 lakh shares. But despite this up move, the stock has nearly halved this year, and this comes on the back of the stock doubling in 2024 and going up even further, 5x move in almost a 4x move in 2023. Now, HPL Electric is among the top losers in the broader markets today, and this is the biggest single-day drop since February of 2022. This 12.5% fall today. We've already had 10 lakh shares changing hands compared to a 20-day average of 1.5 lakh. And courtesy of this fall today, the stock has turned negative on a year-to-date basis. But between 2020 till date, the stock is up well over 1,200%. At the start of the year of 2020, the stock was around 54 rupees. Now at around 520. And Surya Roshni is the other one on the downside today. It's declined in 7 out of the last 8 trading sessions. Another 7% gone today. 7 lakh shares changing hands. A 20-day average of just 75,000. And it has also turned negative on a year-to-date basis. But unlike HPL Electric, this stock has delivered negative returns in 3 out of the last 4 years. Back to you guys.
Okay, all right. Thank you so much, Hormus. So some interesting names there from the broader markets which are moving around in trade. Quickly, let's take a look at the markets again. So some sell-off from the highs, not a major one, but 40-point uptick on the Nifty is what we are witnessing currently. Mid-caps are the ones which are underperforming. And as Rima pointed out earlier, declining stocks more than the advancing stocks as we speak. But it is our time for a special segment, the big story, where we highlight key stocks or themes and deep dive into their financial and historical performance. Today we have Gaurav joining us on Muthoot Finance. That stock is buzzing in how. Gaurav, how did the numbers look? What worked well for this company this quarter?
Well, when we look at the quarterly numbers, they were definitely better than what the street is expecting. So let me take you through the numbers first. Net interest income that increased almost by 51%, while the pre-provisional operating profit that increased almost by 62% on a year-on-year basis. Now, both these numbers were higher than the street's expectation, and as a result, profit that increased almost by 90% on a year-on-year basis. Now, this is actually 22% higher than the street's expectation. When it comes to AUM growth, it delivered strong AUM growth of around 42%, with gold itself growing at around 40% on a year-on-year basis. Now, what actually went right with the company this quarter is that there are two factors which led to 400 crores of extra income for the company in this quarter. Now, when we look at the breakup, company received 700 crores as recoveries from NPA, and as a result, around 300 crores is what went into the interest income. And second is that they also received 100 crores from the asset restructuring company. As a result, when we look at net interest margins, they have expanded almost by 100 basis points. Companies' yields have expanded almost by 100 basis points. So definitely that was something positive. And even when we look at the asset quality, there also we did not see any concerns. In fact, it has come down to 0.15%, which is actually very great. It is lower, at least in the last 6 quarters. So definitely good set of number is what company has delivered in first quarter.
Gaurav, just coming back to that point, you said that there was this extra income of 400 crore in terms of interest income, which boosted the company's performance in Q1. So does that mean this performance is not sustainable going forward? Because loan growth is very strong, 40%, plus even on the other parameters, it's looking good. I mean, what did you take away from the management when we chatted with them about the sustainability of this kind of a performance going forward?
Well, yes. This 400 crore, this has actually contributed around 100 basis points in terms of yields in this quarter specifically. Now, what management is saying is that in the last few quarters, we have seen yields maintaining at around 18.5% and spreads maintaining at around 9.5%. Going ahead, they believe that spreads and yields will be maintained in the same range. The one-off impact, which resulted into 19.5% of yields, now that won't be there from the next quarter, but definitely they sounded optimistic when it comes to yields and spreads. In fact, what they're also saying is that in coming quarters, the cost of fund is likely to come down almost by 40 to 50 basis points, but this benefit will be passed on to the customers and they will be protecting their spreads to 9.5%. In fact, when it comes to loan book growth also, we have seen management actually guiding for the loan book growth of around 15% even in the last year, but they had fairly delivered well above 40% in this quarter as well. Management's commentary suggested that at least for this quarter, they have maintained the guidance of 15%, but the result and the overall growth will be definitely stronger than the 15% guidance. So there is also optimism. That is what we have seen from the management commentary as well.
Optimism there showing up on the price as well. But Gaurav, there was a lot of talk about Muthoot's numbers. Now, how do they compare in line with their peers for the likes of Manappuram and so on? How do the numbers look like on that front?
Well, from Manappuram, we saw some kind of disappointment in this quarter. In fact, when we look at the loan book growth, AUM growth actually declined almost by 1.5% in this quarter from Manappuram. Although when we talk about the loan book growth, that was strong at around 20-25%. But definitely some kind of pessimistic commentary is what we saw from the company. What they said is that in the coming quarters, the gold yields are expected to come down almost to around 18%. And they also said that the loan book growth for gold will be stronger. But there was some pessimistic commentary on the loan book, the gold yields. And that is the reason why we saw some weak set of numbers. But as compared to the Muthoot Finance, they do not see any kind of worries. In fact, they said that the spreads will be maintained. So that is something which was positive for Muthoot Finance as compared to Manappuram Finance in this quarter.
Okay, so Gaurav, let's wrap it up. Tell us, how did the valuations look? What are the brokerages saying now?
Well, when it comes to valuation, currently, if you look at Muthoot Finance, it is currently trading at around 3.3 times price to book 1 year forward versus its 5-year average of around 2.45. So it is a bit higher than the 5-year average, but definitely currently, if we look at the brokerages, they are being bullish. In fact, 60% of the brokers who cover the stock are maintaining their buy call, and only 16% of them still maintain the sell rating. When we look at the target price, it is as high as 3,000 rupees. In fact, today itself, we have seen brokerages actually increasing the target price. In the likes of Morgan Stanley, they have upgraded the rating and also upped the target price to 2,920. We have CLSA, who increased the target price to 2,740. And in fact, we also have Nuvama, who increased the target price to 2,993. So definitely a bullish call is coming up from brokerages as well. So all in all, when it comes to numbers, they delivered good numbers. When it comes to commentary, they delivered very optimistic commentary, and now brokerages are also being bullish about the stock. In fact, when we look at the stock performance in this year itself, for the last 1 year, it has given returns more than 50%, which is higher than the market. So definitely an impressive performance is what we have seen from the stock so far.
Okay, thank you very much for that. So valuations higher, double of that of its peer at 3 times price to book. Manappuram is at 1.5 times higher than its long-term average, but this is the second consecutive quarter where they've delivered a loan book growth of 40%, and the street likes that. Actually, let's listen in to what George Alexander Muthoot, Managing Director at Muthoot Finance, had to say.
I don't want to change the guidance now. We've always said the 15%. Give us a little time. So usually we change the guidance after second quarter. So give us a little time. But for definitely, it will be definitely much better than what we said, 15%. There's no doubt about it. 15% plus is what I said. That is not limited to 20%. Can be even better. So we will discuss on it after the next quarter. Anyway, I'm also here next quarter. One of the things, as I've always been said, has been good demand for gold loan because of the overhang or the difficulty in getting unsecured loans everywhere. So that is one thing. One of the important things was, again, the regulatory action which came by revised final guidelines. The final guidelines, if you ask me, has been quite good, and it is quite gold loan business friendly. When I say gold loan business friendly, it is helping the gold loan business not only for the customer but also for the NBFCs and the banks. So the regulations which came gave a boost to the regulatory overhang which was always there, was whether the finance ministry, whether the Reserve Bank is keen to promote the gold loan business.
Well, time to take a short break, but just before we do that, the Nifty has come off slightly from the higher levels, now below that 24,650 mark. So Tuesday's high of 24,700 continues to be that bone of contention for the index, which it has not managed to cross. But at least for now, the index does seem poised to end its 6-week losing streak and end this week on a high. Of course, this being a truncated week. Now, take a look at some of the names. Rishabh Instruments is one of them, the top gainer on the small cap index, 16% higher on that stock. Take a short break, and on the other side, putting the spotlight on the crypto market with Real Vision Group's Raul Pal.
normalization. CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back on Crypto Corner. Today we have with us Rahul Pal, who's co-founder and CEO at Real Vision Group. Rahul, hi, thank you so much for joining in. 2025 has turned out to be a very positive year for the crypto markets. Reports suggest that it is the future of finance. What are your thoughts on this?
Well, having been involved in this space since 2012, the idea for me was always that the financial system will move its rails from the old antiquated system onto the crypto rails. And that seems to be happening at scale now all across the world as governments have realized that this is probably a more efficient way to run financial markets. So we're seeing everything from the rise of stable coins to governments issuing bonds on chain to a whole number of different things. So yes, I think it accelerates from here because it's just a more efficient way of doing things.
Rahul, how would you read various geographies when it comes to crypto adoption? Because some countries seem to be doing very well while others are really lagging behind.
What we're seeing is different speeds run by different regions and different countries. You know, the US dragged its heels for a long time. Europe managed to pass its MiCA laws. China and India have been very stop-start in its adoption. The rest of Asia has been quite aggressive in its adoption. The Middle East, too, has been very forward-looking. The US, after the Trump election, has super accelerated. Now, the US is the backbone of the entire world's financial system, and they're now all in on crypto. So what we're seeing is other governments around the world starting to say, okay, if the US approves it, we'll approve it too. So we're seeing an acceleration and proliferation all across the world right now. I think it's been more difficult for India and China because of capital controls. But I think, you know, there is a willingness within both of the countries to start adopting this technology as well.
Rahul, also comment on the crypto prices, that is, because we are looking at prices trading near all-time highs, but there also is a belief that we are very close to maturity. The last 3 years have seen lesser and lesser volatility. Would you say it is because institutions, high net worth individuals now are being part of this? Does that lead more credibility to the market?
I certainly think the credibility is on the rise. We've seen sovereign wealth funds, we've seen asset management firms, family offices for sure, all being involved in the space. And then we're seeing the financial system itself in the space, whether it's launching of new products or building on top of the rails. So we can see that. But really, when we look at the adoption of this technology, this has been the fastest adoption of any technology the world has ever seen, except now for AI. And that adoption curve keeps continuing. We're probably at about 600 million wallets around the world in crypto, and there's 8.5 billion people. So we've got a long way to go. Currently, the space is about a $4 trillion asset class. If you extrapolate the trend rate of adoption and assume it slows a bit as it matures, we still get to about $100 trillion by about 2032. So really, we're 4% of the way there. So it's still all to play for.
Rahul, what also seems to be doing quite well is the real-world asset tokenization. Those numbers seem to be increasing as well. And there are many people who are very bullish on this. What's your sense on this one?
I sense it's somewhat overinflated as a narrative, but in other ways underestimated. So what I'm talking about is things like tokenizing equities. I think that is going to be enormous because the size of the global equity market's at something like $200 trillion. It's a much more efficient way of settlement, transfer, storage, all of that kind of stuff. But I think the idea of putting real estate on chain and a lot of the ideas that people have, I think it's the people who want to sell real estate love it, but I'm not sure that many people actually want to buy it. And those that do buy real estate as a part of an investment portfolio, they tend to be able to buy it physically anyway or via instruments like REITs or whatever. So I think it's a two-speed thing. Definitely over time, anything with a title deed goes on chain, whether it's a driving license or a deed for a house or whatever. Over time, will certainly go on chain because it's much more efficient. But I think real-world assets makes it sound very acceptable for financial system and the newspapers and things like that. The reality is it's the other aspects of crypto that are probably even bigger.
How would you also look at the kind of push that we are seeing in US in sense of legislations, more reforms coming in? Of course, all of them very friendly, especially for the stable coins. What is the next step that you see within the technology, especially from US?
So I think the US, the next thing we will see is the full clarity on crypto regulation. Then we will see what they're going to do with the strategic reserve in Bitcoin. And then I think we have a very clear path forwards. So I think that only accelerates adoption within the US financial system. You know, as we said, we've seen the banks building on stablecoin rails. The stablecoin explosion will only continue because it's a way of financing the US deficits by getting US dollars further out into the global financial system. So I do think we see that, and I think we see the rise of Bitcoin as a reserve asset, and then we'll see a lot more of the financial industry building on crypto rails, but we'll also see Web 2 using crypto rails for things like digital ID, which are going to be desperate in a world of AI.
Rahul, while 2025 is known as the year where we've seen all-time highs in Bitcoin and various friendly legislations and policies as well, but there is another narrative as well. While there is a lot of progress, there's not so much of protection for consumers right now. The year 2025 also is seeing the highest amount of heists and frauds within the segment. What's your sense?
Yeah, I think, look, if you use the phraseology that this is both finance and a new iteration of the internet, you are always going to have this problem. And regulation needs to be there to help protect consumers and buyers and investors. But, you know, the internet itself is still rife with fraud. Every one of us every day gets an email trying to scam or phish us for money at vast scale, vaster than it is in crypto. And then if you think of the global financial economy, particularly the cash economy, it's the same thing. So I think what is interesting here is because we can record where money is moving on chain because it's immutable, it actually is very useful for government agencies to track down frauds and scam artists. But it's certainly there, and we certainly need some regulation to make sure that people are protected without excessive regulation that stops participation in this incredible opportunity for wealth creation.
Rahul, I'll wind down this conversation with one final question and your sense on where do you see Web3, blockchain and cryptocurrencies in the next 5 years?
So as I said, I think we see the market cap as a way of thinking about the scale of this moving from $4 trillion, and maybe within 5 years' time, we get somewhere close to maybe $50 trillion. So that's a huge increase in value. So that's what attracts investors. I also think we see the number of active wallets, so i.e. kind of the number of active users, rise from 600 million today to well north of 1 billion users, maybe 1.5 billion users within 5 years. So it's going to be a very prevalent way that we are going to be using crypto over the next 5 years. We'll see everything from transferring of money, storing of wealth, investing, building on the financial rails, and using the technology for things like smart contracts. So I think it becomes less of an exotic thing and more of a normal, regular thing that becomes part of our everyday lives.
All right, so less of exotic and more of normal in next 5 years is perhaps cryptocurrencies could be in the financial space. Rahul Pal, thank you so much for joining in with that sense on Crypto Corner. That's all the time that we have on this segment. But on the other side of the break, more news and updates follow.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, markets have come up from the highs, so it's a good time to get an F&O check on the market. Sudarshan is bringing us the latest trends from the F&O space. Sudarshan.
So F&O data is indicating that market is likely to trade in a range, with Nifty is currently holding on to levels of 24,600, while underperformance is coming from midcap space, which midcap index is currently in the red. But support, if you talk about the support, banks are today supporting when Nifty IT is up more than 1%. Now, if you take a look at the PCI, it's currently at the same level, that it was yesterday. It's currently at 1.08 versus 1.09. Even there is not much any indication from volatility index, it continues to trade up the level of 12. Now, if you talk about the options data on the call side, two options that continue to see healthy additions those are 24,700 and 24,650, and the put side 24,500 remains very active and 24,600 is active, and that's the reason support for Nifty remains around 24,548, that is 100-day moving average, and resistance, if you talk about, it's around 24,782, that is 20-day moving average. Two stocks that I have taken, one is Muthoot Finance after a strong set of earnings that company has provided for Q1 of FY26, with gold loan AUM rising almost 40%. Stock is seeing fresh longs. And if we talk about fresh shorts, amongst all the downside that you are seeing in metal names, one stock, that is NMDC, is seeing fresh shorts.
Thank you very much for that. Mitesh is now back with us. Mitesh, not changing too much, at least in terms of the index levels. What stocks are you picking up?
On the index, as you rightly said, not much has happened, but on the stock side, we have seen HDFC Life do well, and today I think ICICI Pru Life or ICICI Prudential is breaking out. So buy here with a stop at about 620 for targets of around 650, while HPCL Hind Petro, that's slightly negative with open gap down and then since has clearly turned negative. So in the short term, sell with a stop at 403.5, look for targets of 385.
Thank you, Mitesh, for joining in with your views on the index and on specific stocks as well. Take a short break from the charts. We move to fundamentals. George Thomas of ASK joins in on the other side. Stay tuned. Welcome back. George Joseph from ASK Investment Managers joins us now to talk more on the markets and the road ahead. George, good morning. Thank you for joining in. With the earnings season now coming to an end, where does the next trigger for the market lie? Because the policy is out of the way, earnings are out of the way. What does the market now look forward to for its next leg of up move, if there is a potential for that, that is?
Yeah, so if you look at it, the bond yields have been significantly lower, and that itself means that the equity valuations can inch up. If you look at the way the GDP growth has been very strong, the falling inflation, reduction of monetary policy rates, and also the improvement in the liquidity of the banking system, and the requirement for the central government to borrow in the market also has reduced. All put together, the bond yields have corrected significantly, which is very good from a valuation point of view. So if you look at from Nifty earnings perspective, I was just looking at the 47 odd companies which is reported in earnings. It has been fairly decent and probably better than the estimates. So almost 8-9% EBITDA growth as well as 8-9% PAT growth. So which is very interesting. So from a Nifty valuation perspective, we are very constructive, and we see there is a good amount of cushion in terms of the return potential in the next 2 to 3 years.
Okay, so that's the return potential for Nifty. George, I wanted to understand what's your sectoral bet now? Are there any sectors which are fairly valued? Because that's not something that we are seeing in the markets overall. So any specific theme that you think would work from here on? Because most of the export-oriented companies, they've spoken about what threat they would see if the US tariffs do continue the way it was announced earlier. Do you think domestic themes would work better?
Definitely. If you look at our market commentary, which we have published for the last 2 months, consistently we have been saying that we want to focus more on domestic-oriented businesses. That's where we see the leg up in terms of earnings growth as well as valuation comfort. So it's a decadal shift in the business cycle, which started in 2020, post-COVID. And we see that continuing in the next 3 to 4 years. So domestic-oriented businesses like cement, private banks, which has not worked in the last 5 years, we are quite constructive at this point in time. And that's where the valuation comfort is there. And probably what we are expecting in terms of earnings growth revision in the second half, as well as the GDP growth rebound and the rural economy also picking up, all put together, there is a good leg up in these domestic sectors visible. So export-oriented sectors, we are quite benign in terms of the visibility, and also we are quite light on that.
But domestic-oriented sectors are huge, right? There are so many to choose from. So tell us a little bit more. What are the stocks or themes that you like?
Yeah, stocks, it's difficult to discuss, but at the same time, the themes, what we like is the manufacturing theme, which we have been bullish on. And also, if you look at the infrastructure, capital goods sectors, so all the domestic-oriented sectors, specifically, I believe the valuation comfort is mostly in the private banks. Structurally good companies, balance sheets have been fantastic. And also they have been going through various, integration and, various other issues, because of which, the stocks have not performed. And the big recoveries, which we have seen in the, PSU banks, probably that is the fag end. And, we will see more of the private banks getting related in the coming years.
George, is wires and cable space a part of your domestic themes because of the fact that, of course, there is increasing competition, yes, but most of these incumbents have managed to withstand that, barring that initial knee-jerk reaction that we saw. Does that feature as part of your bullish themes as well, or are elevated valuations a concern?
Yeah, so we have been constructive all along, but the valuations is a concern at this point in time, and we are looking to carefully evaluate these businesses from the case-to-case basis, and also the merit in terms of the exposure towards US and so on and so forth. So we are not as constructive as we used to be earlier, but at the same time, obviously, as you rightly mentioned, the growth is quite strong in this space. So we are not as bullish as we were earlier.
Okay, what about specialty chemicals or agrochemicals, George? We've been getting very mixed commentary. Some of them said that this is the start of some recovery phase. Today, Deepak Nitrite said that maybe pricing pressure is not over. What's your take on some of these names?
We like some of these stocks, especially from the specialty chemical space. If you look at, it's a very diverse set of companies available in that. We need to do a lot of bottom-up research to arrive at that. We have a strong team in place who does these research very diligently. And, that is where we think we can make a differentiation. So looking at the space, in particular, specialty chemicals, we are more constructive there because most of these companies are coming out of a big lull period in 2024. And, 2025 onwards, we are seeing there is a good green shoot developing, and in terms of the valuation comfort also is there. So many names in this space has been beaten down to dust post the big rally which we saw between 2022-24. Therefore, we are constructive there. So if you look at from pharma, generic pharma perspective, as well as specialty chemicals, we are more bullish on the specialty chemicals relative to generic pharma, which is more exposed to US.
Thank you very much, George, for joining in. Need to get into a break. On the other side, we'll talk about autos. Yogesh Agarwal from HSBC India joins in on the other side. Stay tuned. Welcome back. Now, HSBC has written a note yesterday which says that the Indian passenger vehicle industry, and they title it Rise of the Tail. So it basically means that in the last 1 decade, India's passenger vehicle market has consolidated. The top 6 OEMs, which includes your Maruti, Hyundai, Tata Motors, M&M, Kia, etc., they have increased their market share from 80 to 94%. This is over a period of FY15 to FY25. But some of the smaller players like Volkswagen, Skoda, Renault, Nissan, Honda, MG have seen their volumes fall due to uneconomic levels due to poor product pricing and fit. But now HSBC argues that some of these tail OEMs, the smaller ones, the Skodas and the Nissans we spoke about, are planning a comeback. And the next 5 to 10 years could be more favorable than the past. Now, this would have long-term implications for some of the incumbents too. Yogesh Agarwal, the head of research at HSBC India and the author of this note, is joining in on the show. Yogesh, first, just give us the big picture overview of this report that you have written.
Hi, Rima. So, look, Indian passenger vehicle market has consolidated quite a bit over the past 10 years. So 10 years back, they used to be 82% of the market. Today, almost 94% of the market is captured by the top 6 OEMs. And the bottom 8 or 10 are just 6%. So they have seen significant deterioration in the market share. And while it's going to be very tough to come back, but I think the overall backdrop is a little more favorable today than 10 years back for these guys to make a comeback. So that's a broader theme of the report. It's nothing very imminent as well, but something to keep in mind for the investors, for the incumbent OEMs in India.
But what makes you confident now, right? Tell me 2 or 3 reasons that make you believe that some of these tail OEMs will make a comeback.
Yeah, Rima, few reasons. Look, first of all, the cars in India are a lot bigger today. So in the last 10 years, the average ASPs have gone up by almost 100%. Today, the average price of the car is around 11 to 12 lakh rupees. So I think in bigger cars, it's easier for the global OEMs to come and compete and have a much bigger portfolio from just 1 or 2 cars in 1 or 2 segments. Secondly, even the customer evolution has happened. So 10 years back, safety was not the top priority for an Indian customer. Today, they all care for NCAP ratings and overall safety in the car. So those kind of things have also happened. The overall evolution in the taste and the requirements have changed. And thirdly, exports are becoming a lot more big from from India, and therefore, if exports could be a significant part of the overall volumes for any OEM, then it provides economic viability, even if you are relatively smaller in India. And last but not the least, there is just wisdom of hindsight, right? All the mistakes they have done in the past could be rectified in this time.
Okay, Yogesh, have you seen any historical precedents in other auto markets? If you can do a deep dive into that, where fringe players made a stronger comeback, if there are any examples on that, and how comparable is it to India's setup currently?
Well, there are many examples. So, for instance, Hyundai did very well in US over the past few years and gained decent market share. MG Motors did very well in UK. So there are examples where the OEMs can gain market share. However, I would repeat, it's not easy. I mean, look at China, for instance, on a very other extreme. There are probably 100 OEMs, but BYD is still almost 60% of the overall industry profits, right? So while it's easier to come back from a volume perspective, profitability will still be a challenge. But yes, there are examples from West as well as overall globally where OEMs have come back.
Yogesh, in a market as competitive as the Indian market is, and currently which is also going through a bit of a sluggish phase, if you could call it that, when it comes to demand, how difficult is it for any player intending to make a comeback, because the incumbents themselves are facing issues of their own? Does it make it easier for an incumbent to make a comeback if they have a differentiator product, say for example a Tesla in a hypothetical scenario, or is it difficult to get those numbers in a market like this with the situation that the current market finds itself in?
Yeah, look, India is always a tough market, but at least there is some wisdom of hindsight now. I mean, there were mistakes done by global OEMs. They didn't customize products for India. They just tried to they just try to force fit global products in India, right? So at least those mistakes could be rectified. And secondly, um, uh, there is an evolution in powertrain as well, right? From pure petrol and diesel, now we have EVs, we have hybrids, and if EVs do well from here and the penetration improves, I think that is a level playing field for the tail OEMs to come back. We have seen in the recent past as well, right? The MG Windsor just did so well from nowhere, coming from behind. So I think this evolution in powertrains as well is an opportunity for OEMs to come back. But yes, I agree with you. India is always a very, very tough market, and demand is weak. Although there is a little bit of a green shoot in July, and we are hoping for a better festive season. But yes, it's been a very, very tough year.
Just a quick word, out of time. So what are the implications for incumbent players? I know this is long term, nothing imminent right now, but what would be the call? And generally, what is the view on passenger vehicles and the long term picture?
Yeah, Rima, so look, as I said, first quarter was very weak. May, June were pretty weak, and nobody really knows. We saw weakness actually across consumer sentiments, not just passenger vehicle, across other consumer discretionary space as well. July, there is a bit of a green shoot, and we are hoping for a better festive season. But overall, we are still expecting a flat to minor growth this year, and we are coming from a high base from FY15 to 25. The CAGR for the industry was almost 5%, which in our view is the long-term potential for India, and therefore it is likely we will see a muted year. The good thing is new launches are coming, and a large part of the growth comes from new launches every year, and therefore this could revive some demand in the near term. I would also make a point that there is always this narrative that India car penetration is very low, like we have 30 cars per 1,000 people, and therefore it's a very high growth market. We have a different way to look at it. I don't believe that India is low penetration. India is a story of market expansion because everyone who can afford a car already has a car. So it's about growing per capita income, and at later point, affordability improving. We are not low. Our penetration is not low.
Got it. Okay, all right, Yokesh, thank you so much for joining in with your take on what's happening with the automobile sector. That's the word coming in from HSBC, but we'll slip into a short break. We'll get you more on the markets on the other side. Welcome back. Well, we briefly dipped into the red, but we've recovered from that level as well. The pressure is led by IT names, so the likes of Tech Mahindra, Infosys, all of them are off the high. So are the banking names. So the banking index also is underperforming, but still in the green as we speak. It's the mid-caps which are seeing some red right now. But with that, we'll take your leave on this edition of Trading Hour. Stay tuned. The team of Halftime Report comes up next.
Frontline indices see some green, but the market breadth is negative, indicating caution and uncertainty given big events later in the week. IT and financials eke out gains, but metals and energy drag.
Muthoot Finance reports a heady 42% growth in first quarter, upping the likelihood of a significant guidance revision next quarter. The lender says tighter unsecured lending aided growth, while lower NPAs and ARC receipts helped yields. The stock jumps in double digits.
Infosys will pick up a 75% stake in a client Telstra arm Verisent Group for over $150 million. The move is seen strengthening Infosys' presence in Australia with the company's wide relationship team as well as teams of 650 engineers.
JSW Group cement arm JSW Cement lists at a small premium to its offer price of 147, translating into a market cap of over 20,000 crores. The cement maker aims to double its capacity from 20 to 40 million tons before the end of the decade.
Hello and welcome to Halftime Report, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Mangalam Malu as well as Ekta Batra. And you can see at the bottom of your screens, you do have the WPI inflation data that has just come in. Manufactured product inflation data is what you were seeing right now on the screens. The July WPI inflation is seen a deflation actually of 0.58% this time. So yes, that is what we're seeing and watching out for. Primary article inflation is also seeing a deflation actually. That is at 4.95% as well, versus last month was around 3% deflation that we'd seen coming in. So again, we are seeing a deflation. In June also, we've seen a deflation, and that is what we're seeing continuing this time.
Yes, absolutely. In contraction mode, deflation is where we are seeing the WPI data come through. Just watch out for the food inflation. So that's coming at a deflation as well as at a contraction. So that figure should come up for you. It was expected to decline by as much as 5 to 6 odd %. And I think the decline in terms of the food inflation or the deflation has been lesser than what was anticipated. But nonetheless, it's a decline of around 0.5 odd % or a deflation of around 0.5 odd % for the month of July when it comes to WPI, as compared to expectations of around 0.4 to 0.5% in terms of a deflation. So those are a couple of details which have come in. Maybe we can get our guest in.
Yep, we do have Kanika Pastricha who's joined us. She's the Chief Economic Advisor at Union Bank of India. Kanika, CPI was much lower than what the street anticipated, much lower than the RBI's own guidance as well. And for 2 consecutive months, it's the WPI which is lower. The RBI obviously has, front-loaded a lot of the cuts and, the liquidity measures that they've announced. Do you think there's room for more here? And we also got the US jobs data that tells you that maybe the door has slightly opened up for another Fed rate cut as well. If that were to happen, do you think there could be a little more from the RBI side than what is already done and expected?
So Mangalam, first and foremost, thanks for having me on the show. The reason why CPI was tepid at just 1.55 and WPI is in deflation zone for second consecutive month. So within CPI and WPI, food has consistently been in deflation zone, and that's helping. But what's very important to understand is that, apart from the factor that subdued commodity prices, like in your show, you were talking about energy, metals lagging, that's helping WPI more than CPI. But this is where both inflation metrics bottom out in July. So at minus 0.58%, even WPI bottoms out. As the MPC is more focused on CPI, which bottomed out at 1.55, in the coming months, it is likely to trend higher. And by Jan to March next year, it's expected to move towards the 4% mark. So MPC Jan to March is at 4.4, we are at 3.8. April to June next year, they're at 4.9, we are at 4.5. So what becomes very important to watch out for is, yes, some space for rate cuts, maybe that final token 25-50 basis points rate cuts does open up is our view. But it's important to determine that the timing will be determined not by inflation trends now, but more by when growth starts to show fault lines. So yes, inflation numbers, supportive, but very important to watch out for that the space remains very muted now because front loading has already happened and the timing will be growth led. Thanks.
Okay, so you're expecting these two figures to have bottomed out when it comes to WPI as well as the CPI data. So what does that, Kanika, mean in terms of rate cuts? What are you expecting in terms of the October rate cut, October RBI meeting? Are you expecting maybe room for a 25 basis points?
So in our view, we don't see any change as of now. The only reason being that, the August 30th, growth numbers, when they come out for April to June quarter, in our view, they're likely to track around 7%. And that's only because it's not just in India, but around the world. Because of tariff-led uncertainty, everything is front-loaded. US has avoided a recession because there's so much of fiscal stimulus there. Exports are front-loaded. From the domestic perspective as well, government spending is front-loaded. The growth numbers for government spending are very high. So all this is supportive of a strong growth number in the first half and specifically in the first quarter. It's only when clear fault lines start to show, which we are hearing only in terms of anecdotes, that exporters in some sectors, specifically labor-intensive sectors, are suffering. But the data is yet to reflect that. So October, or I would say it's a September 30th policy, status quo is our view. Thanks.
Okay, status quo is your view coming in. And you're saying that now this is the lowest point that we'll be seeing the deflation, right, for WPI. And from here on, maybe we'll see that increase coming in?
Yes.
Okay,
because the base effects taper out, yes.
And what about food inflation as well, right? Because that was something that, we were expecting those prices to rise, but that's not coming even this time.
So what's happened is, if you look at some segments like veggies, we have seen an uptick on a sequential basis in food prices, specifically veggies. The only thing is it's trailing seasonal trends or the sequential uptick seen in similar periods last year or last to last year. So which is why veggies are also in deflation, pulses are in deflation on a YOY basis. These trends are supportive, but just because the base also shifts from a negative number for food WPI, even food CPI in July, we switch to a positive number next month. So a swing likely in inflation numbers, yes.
What is your estimate then, Kanika, quickly, when it comes to growth? Because we do have this tariff uncertainty, which is going to probably play out even more. When do we probably see the impact, and what is your estimate? And what do you think the RBI could possibly do in that case?
Okay, so first and foremost, given there's so much uncertainty, we've kept our forecast unchanged. Anyways, we are below the MPC's number of 6.5. For the year, we are at 6.3. Now, just on a 25% tariff hike, the penalty impact not yet seen. We don't know whether it triggers or not. Just on 25% tariff hike, the estimate we have is 30 basis points. So the number for growth is tracking closer to 6% with a downward bias. But very important to understand, $90 billion is the annual exports to US. After excluding the exemptions, that's pharma, smartphones, etc., the number comes down to $45 billion. Only value-added impact is close to 40. That's around 1% of GDP. So at 25% or even 50% tariffs, if there's a complete stalling of exports, the impact can be significant. The channel of impact is not just exports demand getting hit. It's also the sentiment-led impact on capex, which is why, in our view, the impact is significant. But there are so many moving parts, it's difficult to ascertain an exact number. But yes, 6% with a downward bias is what growth numbers seem to be tracking as of now for FY26.
All right, Kanika, thank you so much for joining in and giving us your quick take on the WPI. 2 straight months of a negative, or rather contraction, coming in from the WPI. Kanika believes that maybe this needs to sustain on both the CPI and the WPI fund for the RBI to take any action, though she believes that maybe there could be a bit of an underperformance on the CPI and WPI front on account of seasonal factors right now as well. Take a short break, come back, get you more on the markets, individual stocks. We do have the management of Supriya Life Sciences joining us. Stay with us.
Welcome back. Well, for the markets, the Midcap index is trending lower. So you can see that the Midcap index is currently down around 0.2%, and the advanced decline ratio is in negative terrain. So that seems to be the key data point in today's trade, where we're just about consolidating, holding on to our gains for the frontline indices, but the broader section of the market is seeing much more pressure. But let's talk about one particular company which is also under pressure in terms of the stock. Supriya Life Sciences is the one that we're talking about. That stock has recovered from the day's low, but nonetheless, it was a weak set of numbers this time. Saloni Wagh, the MD at the company, now joins in to discuss the quarterly performance. Saloni, hi, welcome to the show. Well, what resulted in this steep fall in terms of numbers that we've seen? A 10% decline year on year. Margins also have come in lower.
So we actually introduced one of our largest production blocks a few quarters back, which is our module E. In terms of capacity, it's almost 350 KL. So it's a very large production block for us. And in the month of April, we had to undertake some maintenance activities because we are doing a lot of scale up of some of the new products as well as existing products in this module E. So for the backward integration part, for the intermediate part, the older blocks have to support this particular new block. So a lot of maintenance activity we had taken up in our old module A, B, and C. And that sort of resulted in us losing a few production days. And that's why the revenue also is slightly on the lower side this time. In terms of the margin, we have still maintained at about 36%. Of course, the lower revenue has also translated into the lower absolute EBITDA number. So that was one of the main reasons.
So what does this do to your guidance for the full year? I remember you saying you'll grow 20% or maybe on an absolute basis 900 crore by FY26. Do you think you can make up for the shortfall in the next 3 quarters and that guidance number stays? And on margins as well?
Absolutely. We are very confident that we'll be able to cover up for this. And we still maintain our guidance of 20% plus growth in revenue while maintaining that healthy EBITDA margin of 33 to 35%. A lot of it will come in H2, but from Q2 itself, you will start seeing good numbers from us.
Hi, Saloni. Afternoon. Also, what about this maintenance which happened this quarter? Is it a yearly thing? How does it work about? So we understand when can these expenses come in again, as well as performances that you've seen across your geographies, whether it's Asia, Europe. How has that done for you?
So this is not a yearly thing. This type of maintenance activity typically we do in maybe 2 to 3 years. And like I explained, this was mainly to support our module E because we want to really ramp up some of our existing products as well as the new products. So you will see that this will not happen every year, maybe once every 2 or 3 years. In terms of geography, and if I were to talk about the business, I mean, business is growing. We have done very well in Europe. Europe revenue has actually gone up to 41% as against 34% same quarter last year. Even the North American revenue has gone up slightly. Asia has also done fairly well. In terms of the product basket, anesthetics have really gone up. Antihistamines have gone up. Overall, our export share has also gone up to 85%. So all the right areas for the business to grow are there. And definitely the revenue numbers also you will start seeing from Q2 itself, like I mentioned before.
Okay. Well, Saloni, I wanted an update on a couple of things. One is that you had this exclusive contract for a vitamin product, which you have for the next 10 years odd. And that was expected to provide 60 to 70 crores in FY26 itself. Has that taken off, and how much are you generating from it already? And is this guidance intact?
So the 60-70 crore revenue, what you're saying, it is supposed to give us in FY27, not 26.
Okay.
Because the full opportunity will come in by FY27. By then, we would have completed all the regulatory approvals. In this financial year and Q1, we have already started seeing some revenue come in from this opportunity. It's an exclusive tie-up for vitamin B2 with one of the largest companies globally called DSM Fairmanage. For this financial year, you can expect about 30 to 35 crores of revenue coming in from this particular CMO tie-up.
Okay, so 30 to 35 crores in FY26, and that scales up to 60 to 70 crores in FY27. How long would that continue for in terms of a contract? What's the peak sales that we can expect? And any more such contracts in the pipeline that you can apprise us of?
So you can expect at peak this contract would give us about 75 to 80 crores of revenue. And this is a fixed contract for the next 10 years. So that kind of revenue addition as well as margin addition you can expect from this contract. We already are at a very advanced stage for 2 such contracts. I think once the contracts are through and they are signed, we'll be making some announcements very soon. While these contracts are not as large as the DSM one, but they would definitely get us an entry into the lot of multinational companies. And then you can expect larger opportunities coming in from the multinationals. So I think very soon we'll be announcing 2 such contracts.
All right, we will keep an eye out on those 2 contracts. So, Priya, thank you so much for joining in. The stock notably has recovered from the lows after opening lower on account of the clarifications that you've given. We hope to, speak to you after the second quarter as well. By then, you would have made up for some of the lost ground in the first quarter. Take a short break, come back, get you more on the stocks and markets. Stay with us.
Welcome back. Still tuned into halftime report on CNBC-TV18. Well, for the markets, the Nifty is absolutely flat at this point in time. So just about higher by around 18 odd points, consolidating and waiting and watching, and a bit of caution ahead of what could take place with regards to the Trump and Putin meeting, which takes place tomorrow, and it is a long weekend. But nonetheless, in terms of specific stocks, to watch out for a couple of these IT stocks. Infosys is in focus on account of that acquisition. But separately, we have Wipro, which is up around 2 odd % at this point in time. So do watch out for that. Financials doing well today. So HDFC Bank, ICICI Bank, both of these private banks up around 0.5 odd % at this point. But to give us a list of all of the buzzing stocks at this point in time, let's go across to Vik. He's standing by at the wall to tell us more.
Well, thank you so much for that. Like you mentioned, I'll take a cue from what you just said a couple of minutes ago, on the back of the fact that the Nifty IT index is the one that's doing very well in the session. The entire IT pack, especially the mid-cap IT names, are seeing significant buying interest. So names like LTIM, that particular stock, significantly higher, cooled off a little bit. Wipro, Emphasis, Persistent, all of these stocks doing very well in the session today. Muthoot Finance, clear standout performer both in terms of results and also the number of EPS upgrades that this particular company has seen post the Q1 results, something that's significant. Morgan Stanley also went ahead and upgraded its rating on the stock. United Spirits, very strong volume growth coming in the quarter gone by. That stock, again, has seen significant buying from the lower levels, up almost 2% today. And Aptus Value Housing, one stock from the broader end of the markets, a couple of upgrades coming in as far as rating agencies are concerned. That stock higher by over 3% today. On the other hand, Cohance Life Sciences, margin depression both on a year-on-year as well as on a sequential basis. That stock lower by over 7%. Engineers India, much lower contribution coming in from the joint ventures that the company has this time around. That stock lower by 4%. OMCs, the entire OMC pack under a bit of pressure. But HPCL was one stock, at least a couple of minutes back, was seeing significant selling pressure in trade today. And Max Healthcare, this particular stock going into Q1 was, burst at near record highs, but post results has seen significant profit booking emerge, almost 4% lower as far as Max Healthcare is concerned.
Okay, Vivek, thank you so much for that. Those were the buzzing stocks in today's trading session as of now. But what's happening in the world of F&O? What are the important cues that we should be keeping an eye out on, especially given that the market is so muted? This week, we've seen those ups and downs coming in and seems like we'll close with a gain. But will we close with the gain? Will we sustain in terms of the growth going forward as well for the market? Will we see a bit of a green coming in on the screen? Will be key to watch out for. A lot of movers that are, moving in the world of F&O as well today. So, look at the names that are coming in on the screens. Muthoot, Kalyan, all these are also moving. But for important cues, we have Mangalam joining in with us for that.
Well, a 20-point up move is what we're seeing on the Nifty. But look at some of the sectoral indices. We have the Nifty IT and the Nifty Bank, both of them underperforming in yesterday's trading session. But now they are outperforming and they are supporting the frontline index. Even as the Nifty is up just 20 points today, remember, for the last 3 trading sessions and including this session, the Nifty is up 1% this week. And if the market holds at current levels, it will break a 6-week losing streak. So that would be something that the bulls would like. It would be a significant one to watch out for. The only things that can actually, cause a bit of a dent in that sentiment is one, the broader markets. We have more stocks declining for the number of stocks which are advancing. So those crisscross lines come up for you. The red one is fairly above the green one right now. The second one is the India VIX. Even as the market's consolidating, the India VIX has moved higher. So that's telling you we're still perhaps not out of the woods. So we'll watch out for how that pans out. Do the option writers worry? No. It is weekly options expiry today. And remember, tomorrow is a holiday, obviously, so not a lot of big moves expected in the second half of trade. A lot of straddles are written. Now, what is a straddle? A call and a put together. So those who are writing the 24,650 straddle, which is a call, has premium of almost 26 rupees. At the 24,650 put has a premium of, similar amount. So it's roughly 50 rupees that you get when you sell both these options. So the option writers are expecting the Nifty weekly options expiry to be between 24,600 to 24,700. Were that range to break on either side, they've gone ahead and protected themselves by buying a 24,700 call and a 24,600 put. So you basically pocket a premium of 60 rupees and pay a premium of around 25-30 rupees to expect the market to expire in the range itself. So 24,700 call and the 24,600 put, both of them come up for you on the screen. And finally, watching out for a bunch of stocks today, we have Nuvama, which is underperforming in an otherwise wobbly market and has seen a lot of open interest build up. So there's a lot of short positions added there. A lot of long positions added on Underperformance Finance. We saw, Muthoot do extremely well in today's trading session, fairly well bid. And on the back of that, we're seeing Underperformance Finance do better as well. It's also seen a lot of long positions being added. And PNB Housing Finance, remember the stock has been in F&O band for the last few trading sessions. Today, the open interest is at 81% of the market-wide position limit. If it falls below that, then maybe the stock exits F&O band. So we'll watch out for that one too.
Okay, all right, Mangalam, thanks for that. So that's on the F&O space. We'll take a short break, but on the other side, Manisha Gupta joins in. She has with her Sashi Singh of All India Rubber Industries Association to take us through that conversation.
Welcome back. Joining us now is Sashi Singh. He's President, All India Rubber Industries Association. Mr. Singh, hi, thank you so much for joining in. As every sector is reading into the impact of those tariffs, 25% right now and 50% if the negotiations do not go through until then. How is the rubber industry, first of all, looking at an impact from this?
This is going to impact this imposition of 50% tariff by US on rubber products, 25% as a tariff and 25% as a penalty. Going to significant, problem for the rubber industries.
As of now, when you look at the overall numbers, Mr. Singh, what is the quantum of exports to US from the sector?
Actually, we are now exporting somewhere around 7,500 crore rupees rubber product. And we are also importing from US around 2,200 crore. So trade surplus is around 5,200 crores, which is going to affect by this unprecedented tariff.
Mr. Singh, the another thing that sectors seem to be doing is approaching governments or their relevant ministries and asking for some assistance or help. What is it that the rubber industry is putting forth for the same?
We also requested government that at least start some export incentive, some extra duty drawbacks, and push on the FTA, which is like recently done in UK. This kind of help, or also government should focus on a domestic development as well on infrastructure, defense, etc. So can be that trade surplus can be get it through that industries.
Mr. Singh, that's about US, of course, which is one of the major markets for you. But when it comes to exports in sense of rubber products, what are the other markets that you are looking at focusing now?
Indian industries now should focus more on the other countries, European countries where demand is more, and also focus on domestic businesses. And we as a industries also should be, always ready for to get something better, development and upliftment in a crisis situation like this.
Mr. Singh, also when you talk about the domestic markets, what really are the numbers here in sense of demand growth?
As I told you, that number for the export is 7,500 crores.
That is the Indian exports to US. But for the domestic markets itself, do you see numbers improving here within the market, within India?
Yeah, of course, there are a number already. We are on an upper trend. All industries is doing good, as automotive is doing good. So rubber industry is directly related to automotive. And there is what I understand, our understanding is that in this tariff, automotive products like passenger car tires or trucks and buses tires are not in that penalty zone. So they are having only 5%. That also a little bit, a safer zone so far.
Well, yes, I understand the point so far there. Mr. Singh, also, when you look at the overall rubber production, since we have you with us, what is it that we are looking at in sense of deficit for the Indian markets for this year? Because we do understand that the deficit has been staying on for many years now. What is the kind of Indian rubber production, imports and overall demand that you're anticipating?
So deficit is still there, somewhere around 5.5 lakh tons. And it is going to remain because it's basically it's a natural product and it takes time, its own time. Of course, northern state are doing good in this, Tripura, Meghalaya and all. But still, we are in a deficit position.
What is your sense on the pricing as well? Because the rubber prices in the international markets have been slightly under pressure, given the fact that we've seen crude oil prices come off and all of this tariff concerns have been keeping rubber prices under pressure. What is your sense from here on?
It will be remain plus minus 4-5% around in a range of 200 only.
Mr. Singh, thank you so much for joining in. Well, that's the kind of information coming in from the All India Rubber Industries Association. The exports to US, of course, could see a lot of hit. And if the industry does not get help from the government in sense of incentives, in sense of otherwise they wouldn't be competitive with their peers like Vietnam and Thailand. So some bit of a concern coming in for the rubber industry as well.
Absolutely a concern coming in there. Everyone is concerned. Each sector we talk about, they are worried that what is finally going to be happening in terms of tariffs will be key to watch out for. Till then, obviously, some bit of an uncertainty is what we're watching out for. But on that note, we're going to actually slip into a very short break, and a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, a premium members only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses and curated lifestyle benefits.
Welcome back. You're watching us here on Halftime Report. The market's doing market things. So, before we go into the long weekend, there's a special segment that we do on Halftime Report. It's called Fund Race, where we speak about, the underlying trends that are playing out in the market right now. We do have with us DSG Consumers Hariharan Prem Kumar, who's obviously the MD and head of India, where they do, make investments in a lot of these D2C consumer brands as well. So, let's talk about the insurgents versus incumbents battle, which is fairly heady in the consumer space right now. And their, Insurgex report itself suggests that over the last few years, insurgent brands, Hari, have actually grown at times 2x, 3x or 4x, and in many categories at multiple times than what the incumbents have grown at. I mean, food and beverage, market grew 1.5 times, the insurgents grew 3 times. Apparel and lifestyle, market grew 1.2 times, the insurgents grew 5 times. What exactly have insurgent brands done right versus traditional consumer companies, and what differentiates a successful one versus the others?
Super. First of all, thank you for having me, Mangalam. And, I think the core of it is that insurgent brands are super plugged in to evolving consumer needs and have product offerings that are best suited to modern day consumer pain points. Examples being like sulfate-free shampoos, you have zero sugar ice creams like a Go Zero taking off in a big way. So that's typically how they, survive and thrive. When it comes to the successful insurgents, there are many things that they do well. I'd recommend the viewers to look at the report. It's on our website. But I think the top 3 factors will be, it starts with the product, a clearly differentiated product that is 10x better than whatever is available out in the market. The second thing is brand. We always say this, that a business becomes a brand when it builds an emotional connect with the customer. So very brand first in everything they do. And the third, and which is also a recurring theme in our report, is capital efficiency. The culture of being capital efficient, frugal growth, not raising unnecessary capital, and getting it to profitability and then scaling on the back of cash flows. So I think these 3 would be the big success drivers of successful insurgents.
Okay. Hari, I wanted to actually drill down on where exactly are they getting market share from, the insurgents. Is it grabbing market share from the incumbents or the existing players, or is there new demand which is being created?
It is, I think it's a mix of both. We sort of are very thematic in our thinking. There's premiumization, which is a theme that we're super bullish on, and as lifestyles improve, purchasing power increases, there are new consumption occasions that come up, in a customer's life. When we backed Epigamia, Greek yogurt was a non-existent category, right? And now it's a brand that literally owns the category. On the other hand, the other theme that's big for us is the unorganized to organized theme. Like if you take Farmly, which is a healthy snacking brand, it's largely unorganized, mainly dry fruits and nuts based products. So that's another theme, right? So I think we're still in the early stages of consumption in India. So it's more market creation, market growth game as opposed to a market share game. What you see in the West.
Hari, like you were mentioning, these are niche products which they enter into, some of them, sulfate-free shampoos. But there are so many such brands now who are coming in, small, newer brands that are coming in. How does one differentiate between each other as well in these brands as well, right? What will make them successful versus maybe someone who's launching with them right now?
No, absolutely. That's a very important question. And, and that's why we sort of think of it as, the positioning statement you can own in the minds of the customer, because there are so many brands screaming the same thing, as you rightly said. But you can just break it down, right? So it can, like for instance, there are many sulfate-free shampoos, but now we're seeing a wave of new insurgents like addressing acne as a problem statement. For example, if you can own the acne positioning in the minds of a customer, in some cases you can really, I always say this to founders, if you can build a brand story around your personality, your story, then that will be unique always, right? And it's a matter of a bit of imagination, storytelling, but the possibilities are infinite.
I just want to interrupt. I think it just reminds me of the nutritional segment, which is the nutritional product segment, which is taking place. And the only thing I could think of was magnesium.
Right now it's magnesium or protein. Or gut health. So
or gut health.
Owning these spaces.
Creatine
is the big one. But I have to ask you this. You said the playbook is here. It's early days, still not a full-fledged bloom that we're seeing in this space itself. But what we know about the incumbents is that they're quick to learn. They might be slow in execution, etc. They might be late entrants to a party, but they ensure that, when they are there, they're the ones who eventually close the house down or be the last ones to leave that party. The case in point is green tea. Lipton wasn't the first one when it joined the green tea market. They were among the last ones to enter. And many years later, Lipton's the largest one here, along with, some of the other incumbent players. So with traditional players now understanding this D2C playbook, is it going to be uphill for newer brands? I say that because you speak about the brand, you speak about the personality. A lot of the Unilevers of the world have come out with niche brands addressing specific needs or going ahead and acquiring some of these guys. So, will it be uphill? Will it be an uphill task for newer brands? That's one part of the question. And the other part is that none of these newer brands have actually gotten big scale offline. So what is the playbook for them to actually get scale offline?
Sure, taking the first question, which is around incumbents doing the playbook, I think it's just good for the entire ecosystem. Historically, in CPG, the best way incumbents have innovated is through acquisition, right? And our report has got amazing traction with the incumbents, and I know that some of them use it actively in analyzing acquisition targets. So I think it's a good thing. And the insurgent brands don't have to be worried about it because the fundamental advantage that the insurgents have will remain, which is speed of decision making, execution speed, and the ability to thrive in niche markets. Incumbents, by definition, find these market opportunities unattractive, too small at the moment, and the execution speed is like far slower, right? So that's that's how I look at it. I think it's in general good for the entire ecosystem. The second question was on, sorry.
The second question was, how do these guys scale beyond the initial?
Yeah, I think, you got to be where the consumer is. We've been investing since 2012, first 9 years. D2C was not even a jargon, right? So I think the digital channels are channels where one can scale rapidly, be it Q-commerce or marketplaces. The offline world is still building the business the old-fashioned way, brick by brick, pin code by pin code, pounding the street, chasing retailers, distributors, and collecting the money. So what I always urge founders is don't copy-paste expectations of digital channels onto the offline world. It's just a game of patience. It's no longer sitting in the corporate office optimizing algorithms. That's hard work, but this is a different kind of hard work. You've got to be with the distributors, retailers, and selling your product.
Okay, all right, Hari, we've run out of time, but an extremely interesting conversation and something which we're going to probably revisit because the dynamics of the industry is going to keep changing. Thanks very much for joining in and speaking with us and taking the time out and coming to our studios. We need to take a short break, but up next, we'll get you more. But before that, remember to tune in to the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. Even as the markets are consolidating, this is our special movers and shakers segment where we track a lot of stocks that are buzzing around in today's trading session, and we tell you the reasons why in quick pace as well. So let's start with our entire team, which is standing for all the stocks which are moving and shaking around. First up is Onmobile. Vinny, what do you have?
So numbers, Q1 numbers that came in for the company. Overall, we are seeing a decent number that came in, especially in terms of revenue muted, but gaming revenue, that's a very good growth of around 31%. Mobile entertainment revenue, that is where the decline came in, 4.9% for the company. Overall gaming subscription, that's seen an improvement as well, 12.04 million subscribers this time versus just 7.6 million subscribers last year. And obviously lower expenses and exceptional item in the previous quarter, something that supported the profitability of the company.
Good performance coming in from an operational standpoint. Ekta, Pfizer, what's next?
Well, yes, good numbers. Revenue up around 7%. The margins expanded to 34.8 versus 31.5%, and a profit which was up around 27%, better than expectations of around 170 odd crores. Separately, a couple of days ago, they did get approval for a pneumococcal vaccine for adults in the domestic market, which is basically to protect against serious infections such as meningitis, pneumonia and sepsis. So the next trigger really would be for them to get approval for the children's or the pediatric market for this particular vaccine. So combined set of news aiding Pfizer today. But CSB Bank, that one is weak today, down around 5 to 6% post the conference call. Let's go across to Gaurav, who has more on CSB. Gaurav.
Well, yes, when we look at the bank, it actually reported very weak set of numbers. When we talk about expectation, those were actually weaker than expected. Yesterday only during the market time, we got the numbers. Net interest income increased just by 5%, while profit that increased just by 5% again on a year-on-year basis. But what was disappointing is net interest margins. Now they declined almost by 20%. And remember, if we look at on a year-on-year basis, it has declined almost by 80 basis point. On a con call, what management has said that this is actually the bottom of net interest margins. After this, we will see some kind of recovery, but the guidance has been revised. The lower end of the guidance has been revised down almost by 25 basis points from 3.75% in the last quarter to 3.5%. Now, this is again something which is discouraging when it comes to CSB Bank because people were not anticipating that. Remember, in Q4 also during the call, management had called out that net interest margins have bottomed out at around 3.75%, but in this quarter, we have seen another fall of 20 basis points. In fact, from here on, when we look at ROAs, they have also come down to 1.03%. Management again has said that ROAs will reach around 1.5% gradually by the end of the year. But definitely on the back of weak set of net interest margins, we are seeing some kind of weakness in share price as well.
Weak NIMs take CSB lower, but weak numbers coming in from Endurance as well. Sudarshan.
So after Minda and Bellrise Industry, another auto ancillary company that is Endurance Technologies, which has reported earnings for Q1 FY26, and those earnings have looked largely better than estimates or say steady set of numbers. All the profit, if you talk about revenue, EBITDA, all these numbers have seen a growth in the range of 10 to 20%. Even margin is hold on to steady. It's about 13%. Currently at 13.4% versus 13.2%, and the earnings continue to be led by India segment, that is the 70% of total sales. And now companies say that it has outperformed the industry. If you talk about two-wheeler sales volume in Q1 FY26, volumes have declined by nearly 2%, while standalone revenue for the company has seen a growth of almost 10%. Even European segment has seen a growth of 29%. That includes Stoffel acquisition. If you remove that acquisition, the growth was just of 1%. Now going forward, what would be the tailwind? Company says that recently government has announced that mandating anti-lock braking system for two-wheelers, that will be the tailwind going forward, and it believes that growth in FY26 is going to be better than FY25.
Okay, all right, Sudarshan, Gaurav, Mangalam, Vinny, as well as myself. Thanks very much for joining
yourself?
in. Yeah.
Wonderful.
Well, and that, bringing us all of the stocks in focus on our movers and shakers segment. And on that note, it's also a wrap on Halftime Report. Business Lunch will take all of the action forward. Stay tuned.
Frontline indices see some green, but the market breadth is negative, indicating caution and uncertainty given the big events later in the week. IT and financials eke out gains, but metals and energy stocks are the big drags. Muthoot Finance reports a healthy 42% growth in the first quarter, upping the likelihood of a significant guidance revision the next time around. The lender says tighter unsecured lending aided growth, while lower NPAs and ARC receipts helped yields. The stock is at a record high. Infosys will pick up a 75% stake in client Telstra's arm Versant Group for over $150 million. This move is seen strengthening Infosys' presence in Australia with Versant's wide relationship and teams of 650 engineers. JSW Group Cement arm JSW Cement lists at a small premium to its offer price of 147, translating into a market cap of over 20,000 crore rupees. The cement maker aims to double its capacity from 20 to 40 million tons before the end of this decade. Counting down to the final few hours of this truncated week. You're watching Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Patakia, and the markets, well, they are exhibiting a typical expiry session. We opened higher and now we gave up some of those gains, briefly slipped into the red, and now we are back towards the highest point of the day. 24,674 is the day's high, trading closer to those levels. But what can be certain as of now, or at least for now, is the fact that the markets will indeed break a 6-week losing streak, considering the fact that we're coming on the back of this longest weekly losing run in 5 years, and we're comfortably higher for the week. 24,360 is that level that we need to close above for a weekly advance, and we are almost 300 points higher on a weekly basis. There are, of course, a lot of stock-specific movers. We just had numbers from Ashok Leyland flashing on your screen. The numbers were absolutely in line with expectations. Margins were supposed to expand as they have, and the stock is trading with gains of around 2.25% as we speak. And the other one is, of course, Alkyl Amines. The numbers just were flashing at the bottom of your screen. That stock too is seeing a bit of a reaction to its numbers that were reported just a few minutes ago. Alkyl Amines there trading with losses of around 1.5%, but there are a lot of other stocks that are moving around in today's session as well. Rhea is joining in with that list. Rhea.
Well, yes, Hormuz, a lot of stocks moving in today's session. The first one is Muthoot Finance, up over 11% after a very strong set of numbers in quarter one. Net profit at around 2,046 crores, well above the estimates that we were working with. Net interest income this time around is at 3,473 crores, and the loan AUM has also increased by around 44% on a year-on-year basis for this one. For United Spirits, that stock is also up over 2% after a good set of numbers. Revenue in line with estimates at around rupees 2,549 crores. The P&A volumes have increased by 9% versus expectations of 5 to 6% growth, and the popular volumes have also seen an increase of around 11.6% versus the expected 6 to 8% growth for United Spirits. Now coming to Texmaco Rail, that stock is down almost 5% after a very weak set of numbers. Net profit has declined by almost 50% compared to the previous year. Margins have also contracted to about 7.79% versus almost 10% in Q1 of last year. The revenue degrowth of around 16% that we've seen in this year has largely been due to the short supply of wagon wheel sets from Indian Railways, but the company says that these issues have largely been resolved at the moment. For Deepak Nitrite, this stock is down around 2.5% today. Revenue declined by around 13% on a year-on-year basis. EBITDA also down by 39%, and net profit has fallen very sharply by 54%. Margins have also come in at around 10% versus about 14.2% in Q1 of last year. So big cuts all around for Deepak Nitrite. The last stock that we're keeping an eye out on is Jubilant Foodworks after reporting its quarter one numbers, down about 0.5%. Net profit has actually been slightly above estimates at 66.7 crores this time around. Margins have also come in at around 19%, largely in line with estimates of 19.2%.
Reha, thank you for that update. More numbers coming in, of course, being the final day of the earnings season. JT India now 4% lower after margins have seen a contraction from last year. But the stock that has done well all through the day is Muthoot Finance. And let us now listen in to what George Alexander Muthoot, the managing director of the company, had to say about their guidance and the demand for gold loans.
I don't want to change the guidance now We've always said the 15%, give us a little time. So usually we change the guidance after second quarter. So give us a little time. But for definitely, it will be definitely much, much better than what we said, 15%. There's no doubt about it. 15% plus is what I said. That is not limited to 20%, can be even better. So we will discuss on it after the next quarter. Anyway, I'm also here next quarter. One of the things is, as I've always been said, has been good demand for gold loan because of the overhang or the difficulty in getting unsecured loans everywhere. So that is one thing. One of the important things was, again, the regulatory action which came by revised final guidelines. The final guidelines, if you ask me, has been quite good, and it is quite gold loan business friendly. When I say gold loan business friendly, it is helping the gold loan business not only for the customer but also for the NBFCs and the banks. So the regulations which came gave a boost to the regulatory overhang which was always there, was whether the finance ministry, whether the Reserve Bank is keen to promote the gold loan business.
Muthoot Finance at a record high in today's session. But of course, there were new entrants on the Lal Street today, two of them, and JSW Cement was the big one. It was a muted listing on the bourses. The stock debuted at a 4% premium, even slipped into the red, currently trading just around 0.75% higher compared to its issue price of 147. Now, prior to the listing, my colleague Reema had spoken to Parth Jindal on the company's capacity outlook. Listen into what he had to say.
Once we get to 40, 41, we will embark upon the journey from 41 to 60, which again should take another 3 to 4 years. So if all goes well, we could get to 60 million tons, sometime in the early part of next decade. And if it goes a little bit worse, then it'll be in the middle part of next decade. I think the top 4 players of the country are well out of reach at the moment. And obviously they also are expanding. I think the 5th spot is up for grabs, and that's the aim, is to try and see how quickly we can get there.
Now, the other big story has been a big talking point as well all through this week. ICICI Bank has revised the 50,000 rupee minimum balance requirement for new savings account customers to 15,000 rupees following feedback from them. Now, Ritu is joining in with the details and the key exemptions in this. Ritu.
That's right. ICICI Bank has made a U-turn on its recent decision to hike the minimum average balance for new savings accounts following widespread customer backlash. Now, on the 1st of August, if you remember, the bank had announced a sharp increase in the minimum average balance required for savings accounts to avoid paying penalties. New savings accounts in metro and urban areas were to maintain a hefty 50,000 rupees, up from 10,000 rupees earlier, and semi-urban and rural customers also faced similar steep hikes. Now, this sudden change had triggered a significant customer uproar, which is quite visible all over social media, especially from the small account holders who found the higher minimum balances difficult to maintain. Now, call it a win for customers or smart damage control, but ICICI Bank has now responded by drastically lowering the minimum balance required for accounts that are opened after the 1st of August. The new minimums now stand at 15,000 rupees for the metro and urban areas and 7,500 rupees for semi-urban areas. Now, these are still higher than the pre-August levels, but it is a massive climb down from the earlier 50,000 and 25,000 kind of levels. For rural locations, the minimum balance required has actually been cut by half compared to pre-August levels, all the way to 2,500 rupees. Now, the bank says it made this decision following feedback from customers aiming to better meet their preferences and expectations. Now, importantly, several categories remain exempt from these requirements, including salary accounts, senior citizen and pensioners accounts, accounts under the PM Jan Dhan Yojana, as well as the no-frills basic savings bank deposit accounts. They're all exempt from any minimum balance requirement. Now, existing accounts that were opened before the 1st of August also remain unaffected by these changes.
Ritu, thanks a lot for that update. Now, cryptocurrencies too are surging today with Bitcoin hitting a record high. Manisha is here to tell us more about the key movers and shakers in this cryptocurrency space. Manisha.
2025 completely belongs to cryptocurrencies. The way we've seen the surge happen here at $4.2 trillion, it is the highest market capital that we have seen for cryptocurrencies ever. The surge clearly continues in cryptocurrencies, in sense of adoption, the friendly legislations that we have seen come in from US as well. Bitcoin is trading at an all-time highs today at $124,000. It has gained 4% on week and 111% on an year-on-year basis. But the hero of the pack clearly has been Ethereum. 22% of gains in the previous 1 week. It is also up by 85% in the past year, and Ethereum is not too far away from its all-time high that it saw in 2011. The other one has been Binance, up by 9% on week, 65% up in the last 1 year. Strong gains continuing for Cardano. That one is up 28% in the previous week. Very strong gains is what we've also seen in sense of Solana. That one is up 19% on a weekly basis. And while Ripple hasn't done much on a week-on-week or a month-on-month basis, but when you look at that chart on an YOY basis, Ripple clearly outperforms with 480% of gains here. The markets will continue to watch out for, of course, the kind of adoption that we have seen happen in case of cryptocurrencies. A lot of experts tell us that this has been the fastest adoption of any technology, the way cryptocurrencies clearly seem to be behaving.
Now, India has achieved the historic milestone of 100 gigawatt solar PV module manufacturing capacity under the approved list of models and manufacturers, which is a remarkable rise from just 2.3 gigawatt in 2014. Now, New and Renewable Energy Minister Prahlad Joshi wrote on X that India is building a robust, self-reliant solar manufacturing ecosystem, and this achievement strengthens the path towards Atmanirbhar Bharat and the target of 500 gigawatt non-fossil fuel capacity by 2030. Prime Minister Narendra Modi also hailed these milestones towards self-reliance in achieving 100 gigawatt solar PV module manufacturing capacity and efforts towards popularizing clean energy. Take a short break. More news on the other side. Stay tuned. Welcome back. Let us now focus on the big global story. US President Donald Trump is all set to meet Russian President Vladimir Putin to discuss how to end the 3.5-year conflict with Ukraine. The meeting is scheduled to take place on the 15th of August at a military base in Alaska. Putin is also the first Russian president to visit the Alaska region across the strait from Russia. Meanwhile, Trump has also threatened severe consequences if Putin does not agree to peace in Ukraine. CNBC's Sylvia Amaro has more details.
The U.S. President Donald Trump has warned of severe consequences if Vladimir Putin does not agree to peace in Ukraine, but again appeared to temper expectations for Friday's summit with the Russian president. Trump also said that the talks will set the table for another meeting, which includes the Ukrainian leader Volodymyr Zelensky. The president's comments followed a meeting with European leaders, which, according to NBC sources, left Kyiv's European allies feeling more positive about Trump's plans for Friday's summit. The sources said that Trump told European leaders he will not discuss possible territorial divisions with Putin on Friday. This despite comments from the U.S. president in recent days suggesting land swapping would need to take place. The leaders also agreed Ukraine must be the one to decide on any territorial concessions it might be willing to make, the sources also said. Now, the French president, Emmanuel Macron, also said that Trump was clear that U.S. intentions for Friday's meetings are to achieve a ceasefire. Yesterday's meeting was hailed by the U.S. president, who was also asked if it was his call not to invite Zelensky to Friday's summit. Listen in.
No, just the opposite. No. We had a very good call. He was on the call. President Zelensky was on the call. I would rate it a 10, very, very friendly. I know the leaders because I was at NATO, as you know. I took it from 2% to 5%, 2% that wasn't paid, 5% that is paid, which is trillions of dollars in defense capability. No, it was always going to be, I was going to meet with President Putin, and then after that, I'm going to call the leaders and President Zelensky. I'm going to call President Zelensky, and then I'll call, probably in that order, the leaders.
Now, Trump also outlined his desire for a trilateral meeting with both Putin and Zelensky, dependent on Friday's success.
There's a very good chance that we're going to have a second meeting, which will be more productive than the first, because the first is I'm going to find out where we are and what we're doing. If the first one goes okay, we'll have a quick second one. I would like to do it almost immediately, and we'll have a quick second meeting between President Putin and President Zelensky and myself, if they'd like to have me there. And that would be a meeting where maybe it could be absolutely work. But the first meeting will not work that out. Certain great things can be gained in the first. It's going to be a very important meeting, but it's setting the table for the second meeting.
Now, Zelensky was in Berlin for the meetings where he spoke alongside the German Chancellor Friedrich Merz afterwards, with both leaders outlining the messages they delivered to the U.S. president.
In Alaska müssen grundlegende europäische und
fundamental European and Ukrainian security interests must be safeguarded in Alaska. That was the message that we, as Europeans, conveyed to US President Donald Trump today. And I can say that we are in broad agreement both in our assessment of the current situation and in the achievable goal for next Friday.
Of course, we discussed the situation on the battlefield today. I told the President of the United States and all our European colleagues, Putin is bluffing. He is trying to put pressure on all fronts of the Ukrainian front ahead of the meeting in Alaska. Russia is trying to portray itself as capable of occupying the whole of Ukraine. This is undoubtedly their desire. Putin is also bluffing, pretending that sanctions are not important to him and that they are not working. In reality, the sanctions are very helpful and are hitting the Russian military economy hard.
All eyes on that all-important meeting tomorrow night. Take a short break. More on the other side. Welcome back. Now, the Supreme Court, hearing a plea seeking the restoration of statehood to Jammu and Kashmir, emphasized that ground realities must be taken into account and said cannot ignore Pahalgam. Ashmit is joining in with more details on the same. Ashmit, tell us more.
Well, just for context, it is with the revocation of Article 370 that the statehood of J&K had also been stripped. Now, it is restoration of that for which a petition has been filed. The Supreme Court today agreed to hear the matter, has directed for the centre to respond. What's interesting, however, is that the centre was present by way of Solicitor General Tushar Mehta, who was here. He pointed out that the situation is peculiar as far as J&K is concerned. In the same breath, the Supreme Court also observed that the ground realities cannot be ignored. Incidents like Pahalgam cannot be ignored, that they all need to be taken into account while considering the question of restoration of statehood. And that is exactly what the PIL, the petition, is essentially arguing. Petition says that the stripping of statehood from J&K is stripping people of their rights, that even the December 2023 judgment had asked for restoration of statehood to J&K at the earliest. So now, all eyes on the centre and its response, which is yet to be filed before the Supreme Court.
Stay on Ashmit, because onto some updates from the Delhi stray dog case in the Supreme Court as well, where the orders have been reserved on plea seeking by NGOs seeking the stay of directions for rounding up of stray dogs. What more do you have on this regard?
Well, a highly emotive issue. Solicitor General Tushar Mehta again appearing for the government of Delhi, saying that this is an order that needs to be implemented, that the dogs need to go, that they're causing a huge security risk for citizens of the capital, and that is something that needs to be addressed on an urgent basis. However, in the same breath, there were also senior advocates, the likes of Kapil Sibal, Abhishek Manu Singhvi. All of them were essentially arguing on behalf of NGOs and on behalf of animal activists that this order is unimplementable. It needs to be stayed. They point out that this order has asked for relocation of dogs to animal shelters. They point out there are no animal shelters. They also raise questions of how, while the situation, the image that has been created is that there's a rabies outbreak, but the government data itself reveals that there's not been a single rabies-related death in the national capital. Also going on to question the role of the MCD, that there have been ABC rules which have been in place, which provide for sterilization, which provide for controlling of population. None of that has happened. There are no control, there are no shelters, there are no animal birth control measures, and for that the onus lies squarely on the shoulders of the municipal body. So after hearing of both the sides, the Supreme Court for now reserving its judgment. So clearly all eyes now on the Supreme Court to give clarity on whether the rounding up of dogs in the national capital will be permitted or if it will be stayed.
Ashmit, thank you for that update. Moving on to some updates from the capital and the NCR. Heavy rain since early morning has caused waterlogging in several parts of Delhi NCR, including Ghaziabad and Gurugram. The heavy downpour has flooded the city, choking traffic in several areas. Several flights and trains have also been delayed. The IMD has issued a red alert, and as per the forecast, the city is expected to receive moderate to heavy rain all through the day. With that, we call time on this edition of Business Lunch. Thank you so much for tuning in. Independence Day greetings to you all. For tomorrow in advance, of course, Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. And this is a show just before that long weekend. It's been a truncated week. And right now, we're seeing some choppiness in the market. We started at that 24,607 mark, saw some uptick from there. But now we've been in a range. So right now, Nifty is absolutely flat with some positive bias. But mid-caps are underperforming.
That's right. Good afternoon, Sonal. That's the story, right? It's been a very choppy trading session. And what's actually transpired in the last hour and a half has been the fact that there has been quite a bit of weakness or deterioration in the advanced decline ratio, especially in the broader end of the markets. So that's something that we'll keep an eye out, especially going into the longer weekend. But we have a lot lined up on the show, an important conversation as well. So let's start off with the top headlines. Frontline indices see some green, but the market breadth is negative, indicating caution and uncertainty given big events later in the week. IT and consumer durables eke out gains, but metals and realty drag. Mid-caps under pressure.
Muthoot Finance reports a heady 42% growth in Q1, upping the likelihood of a significant guidance revision next quarter. The lender says tighter unsecured lending added growth, while lower NPAs and ARC receipts helped yields. The stock jumps.
Tex Macro Rail down almost 5% after reporting the Q1 numbers. Net profit declines near 50%, while revenue falls 16% on a year-on-year basis.
Deepak Nitrite's first quarter revenue and profit fall. Margin contracts over 400 basis points. The stock is lower by 2%. All right, those are the top headlines that we are tracking. Markets, in terms of the Nifty moves, down 10 points. It's a bigger cut that we're seeing in the mid-caps currently. So there, the advanced decline ratio is in favor of the declines. Metals and energy are lower, and that's something which is putting pressure on the Nifty as well. But IT, that's batting for the bulls. Financials too, in the green, lending some support to the Nifty.
Well, that's right. Yesterday we did see significant earnings reactions come about. A name like Insecticides India, we'll have the management later. Yesterday, that stock, post results just around 3 p.m. Fell 12%, and today it's down another 5%. So it's going to be very interesting to hear the management as to what exactly transpired in the quarter gone by, the outlook for Q2 and H2. But this and a whole host of other stocks is what Hormaz has on its radar. This is our special segment, Midcap Movers. Hormaz is going to take us through the midcaps that are moving around in the session.
Final couple of hours for the week to conclude, for the earnings season to conclude as well. The mid-cap index may be at the lows of the day. We'll start off with some of the gainers in the broader markets today. And there are enough and more. There's a spectrum of green and red. Look at Rishabh Instruments now, a 20% upper circuit on the stock. Newgen Software is at the highest point of the day, 7% higher here. Kalyan Jewellers has done well. And Bajaj Housing Finance has sprung up today in the list of gainers, 4% higher on the stock, although significantly lower from its post-listing high. Now, some of the other earnings reactions today, a final few that we are witnessing. Muthoot Finance, of course, a record high, 10% higher here. Pfizer, of course, has a positive earnings reaction. But on the flip side, Brigade and Nava have seen a not so positive reaction to their results, 4% lower on both of these names. Now, some of the others, the metal names are the ones that are not doing well today. Every stock on the metal index is trading with losses. Look at NMDC at the lows of the day, as is SAIL, JSPL, Vedanta, all of them seeing losses of anywhere between 2 to 5% in today's session. Stocks that are doing well on the back of volumes today, and those are some of them that are bucking the trend. Look at Rico Auto at 15% higher, Shivalik Biometals, of course, and Manappuram, in line with what Muthoot has done, is also seeing a sentimental impact, 3% higher on strong volumes. And lastly, some of the other movers in today's session on the losing side, HPL Electric and Surya Roshni, both earnings reactions 15 and 10% lower. And look at Cohance Life and Ganesha Ecosphere, both of them too at the lows of the day, 7% lower on both of these names. Back to you guys.
All right, thank you so much for that list, Hormuz. Those are some mid-cap movers in the day today. Let's welcome Vinay Rajni of HDFC Securities for a technical check on the markets. Vinay, thank you so much for joining in. What's the market anticipating before this long weekend? It's been very choppy in the last couple of trading hours.
Choppy and range-bound movement. Today is a weekly expiry day, and Nifty is not at all moving. 24,600 on the downside and 24,700 on the upside. So IVs are quite low. That is showing that the market should remain range bound for rest of the session. And technically also, if you were to look at last 3-4 days, the gradual improvement can be seen in the technical basis. But we are clearly underperforming the global markets, US market, as well as the other Asian and emerging markets. So yes, till now we have not yet got any bullish reversal sign. But yes, some improvement is there. Today is the last day of the result announcement, so it might happen that broader market will improve in the next week, and some sort of derivative indication which is showing a oversold scenario for the market. So which has been the FI's long to short ratio, which has been more than 92% of the positions on the short side. So we may expect some short covering if anything positive comes out for the Indian markets. So according to us, 24,340, which happens to be the recent swing low, should act as a strong support for the Nifty. On the upside, we are waiting for Nifty to cross a crucial resistance of 50 days exponential average, which is placed around 24,800. Once that is taken out on sustainable basis, then we can expect and we can call it as a reversal. So till then, this 24,400 to 24,800 should be called a range bound market for the Nifty.
Okay, so 24,400 to 24,800 is the range you're expecting the Nifty to move within. Now, in today's trading session, given the choppiness, any individual ideas for our viewers?
Yeah, so some of the auto and auto ancillary stocks have been doing quite well, and one of the stock is Minda, which is looking strong and trading around the 3 months high. So Minda, which is already recommended to our clients yesterday, it is looking quite strong around 1134. One can initiate a trading long. Stop loss I would suggest at 1110, and 1180 should be the short term target, 1180. The second pick I would choose from the hospitality space, Indian Hotel. Indian Hotel looks quite strong. It is finding support near 200 days EMA and bounced back. So Indian Hotel can be bought around 774. I would suggest a stop loss at 755. So 774 is the buying and 755 should be the stop loss. And on the upside, I'm expecting a short term target at 1010.
All right, Vinay, thank you so much for joining in. So those are some technical picks for our viewers. Let's slip into a short break. Management of Insecticides India will join in next to discuss their Q1 numbers and more. Stay tuned. Welcome back. Insecticides India recently reported their Q1 numbers. The revenue saw growth of 5% while EBITDA grew 17% as compared to last year. To discuss this and more, we have Rajesh Agrawal, who's the Managing Director at the company, joining us now. Mr. Agrawal, good afternoon. Thank you so much for joining in. You know, you had guided for a 10% plus growth in FY26. The quarter has started with a 5% growth only. What happened here? It's a low single-digit growth that you've seen. Can you give out the reasons for that? And do you maintain your 10% plus revenue guidance for FY26?
Yeah, this year started with a good monsoon beginning, but June was very dry. So being a dry month, the herbicide sales, particularly in the dry crops, that stopped. So due to that stoppage, we had an impact during the first quarter and the growth was limited to 5%. And then there was a tail cutting strategy along with the premium product strategy. So we have been premiumizing our range. We are bringing the new generation solutions in front of the farmer. Last year, about 1 dozen products were launched into the market. And they, as we got the registration, we launched those products. So the contribution from that product was very limited in the full year. We got about 30 odd crores of sales. But in Q1 itself, these products contributed about 42 crores. And the expectation from this year is very good. Heavy rains at certain places. Dams are full. Situation is good. So I believe that we should be able to make up the top line also. Bottom line growth is already more than 18% on PAT level. And I believe we should be able to maintain that. And top line growth also, we should make a recovery in H1 itself. In the Q2, we should make a recovery.
Okay, so Mr. Agrawal, even though you've underperformed the market as far as Q1 is concerned, you're saying H1 versus H2, you're saying there will be a recovery. Can there be a 10% growth, H1 versus H1 of this year versus H1 of last year?
Yeah, definitely. That is something we are expecting. It should be possible.
And this is along with price realization gains?
Price realization gains are very limited, but yes, it will be along with that.
Mr. Agrawal, can you split the top line in volume growth or volume terms and realization terms as well? What's the outlook on pricing from here on?
There is no major difference. It is just the change in products because we have brought in some premium products. That's why the volume growth is looking little down. But overall, in value terms and volume terms, the prices in the market are not rising. This year, the prices are muted because the international market scenario is quite stable. So that's why we are not able to take the increase in the market, and sentiment in the market is mixed, though there is continued demand. But due to heavy rains in many areas, the sprays are going little slow in many parts of the country, and many parts of the country is asking for different products. So the price increase is not there. So on an average, it will be stable, like the volume and value will go together broadly, you can say.
Okay, so Mr. Agrawal, you've mentioned 2 points. The number one, you mentioned that demand was a little patchy in the quarter gone by, expecting a bit of recovery. You've also spoken about price realization being a little subdued. So now, is this mainly because of the drop in demand, or is there significant competition coming in for the products? And does that mean that going forward, we will have to settle for slightly lower realizations?
No, that is nothing like that. But the international market is very stable. The prices are towards the bottom for many products. So that's why the prices are not gaining in the market. So that is the reason of low prices. Because prices from last 2 years are coming down slowly. So that impact has come. So we are not able to take the price increase. So price rise is which was expected because of the muted June and till middle of July also the rains were a little low. So that has impacted. So the prices are...
Got it. Got it. Mr. Agrawal, you spoke international markets as well. You had indicated you'll enter the US markets. Export is not that big of the overall chunk right now. But USA specifically, with the tariff situation which is emerging, do you think you'll delay your plans to export to the US? What's happening with the facility here with respect to the US?
At the moment, we don't have the exports to US, but yes, there are certain registrations which are on. As we get the registration, definitely we'll try. But what has happened is that our certain consumers who are near to registrations or who have got the registration in South American countries rather, so they are showing very keen interest because the duty from their country to US is little low.
So it may not go directly because of the huge tariff which is there existing today. So it looks that things might move through Europe or through South America to USA. So the other companies can try to move their products, who will be sourcing their technicals from us. So that indirect opportunity is appearing at the moment.
Okay, and tariff impact, if you could quantify for us, that's the first question. And second question, so has, end of Q4, you mentioned that inventory is now almost coming to a bottom. So where do we stand in terms of inventory across players?
Regarding the tariff, it is common for all agrochemical companies like the other things, 25 plus 25. So broadly, it is about 50% at the moment. So it will.
And as a percentage of your total top line, sir?
It's not on us actually, because I'm not exporting anything to USA. So it is zero for me at the moment. So no tariff as such on insecticides India. And regarding the other question was regarding your
inventory levels across the
inventory position is improving because yes, some dry crops like cotton and soybean, their herbicides saw a little muted sales actually. So there are some goods return of that product. Otherwise, everything is going fine. So paddy is good, maize is good, other crops are showing good potential. So overall, the season is in full swing. And it looks like an extended season because the sowing pattern is different. This year, the maize is increasing, paddy is increasing, and the sowing is in a gap of 1.5 months in the entire country. So the season looks extended. So everything looks good as of now.
Okay, so it looks good. You'll be able to achieve your 10% plus growth when it comes to revenues also. Mr. Agarwal, what about margins? What kind of growth will you see there in FY26 considering the pricing impact that you're talking about? Also in terms of exports, will you be able to do the 200 crore mark in terms of revenues this year?
We are keeping our export target as same, 200 crores, though we are not able to achieve it so far. But since we are expecting certain more registrations and some business of technicals is going to start, particularly in South American countries. So once it becomes regular, then definitely this target will not be difficult. And there are chances that we achieve it. We can touch this figure in this year. And regarding the margins, we have grown by about 120 basis points in the Q1. I believe that we should be able to maintain that growth in this fiscal.
So one quick question. Last year you had guided for FY26, we'll have a capex of close to 50 to 60 crore with maintenance capex of close to 15 crore. Is that on track? And secondly, what is the update as far as the product with Bayer is concerned? Has it come on stream?
Okay. So the expansion mode is it's regularly on. So the Dahej plant, we have capitalized the technical synthesis plant. Now we are expanding for the formulation. That also we are expecting to complete by December. And parallelly, there is a new expansion which is going on in Sotanala. So there the major chunk of this money will be going in this year. And the target is to start the formulation facility in Sotanala by April, May, means Kharif season next year. And by the end of the next year, we'll be starting the technical synthesis unit there also. So which will give a big boost to the company because that is going to be the state-of-the-art DCS-operated plant. So which will be good for international markets and for large players because we are looking at the CDMO opportunities from the large companies now.
Okay, all right, Mr. Agarwal, take that point. Thank you so much for joining in. That's the word coming in from Insecticides India. Q1 did see a blip, but the management is confident of achieving their targets for FY26. The stock, though, continues to be under pressure today as well. We'll slip into a short break. When we come back, we'll get you on the markets and stock-specific action on the other side. Stay tuned for that.
Welcome back to Midcap Radar. Well, the market continues to see very choppy moves, but one stock from the broad end of the market, an auto company, Ashok Leyland, is in focus. They just delivered their results. Sudarshan joins in with the fine print.
So normally Q1 for a CV player is a weak quarter, but in this tough quarter, Ashok Leyland has come out with numbers which are in line with our estimates. But if you compare YY, numbers are looking much better. So profit was up 13%, revenue has seen an increase of 2%, EBITDA 2 has jumped by 7%, and margin has come at 11% versus 10.6%, and is in line with our expectation of 11%. So what has helped the company to report the healthy set of earnings? First, so all the companies were talking about an increase in raw material cost, but despite an increase in raw material cost, especially an increase in steel prices, Ashok Leyland has reported an increase of more than 150 basis points in gross margin. It has come at 29.4%. Another positive point is realization, which is improved by 1% YOY versus expectation of 2% increase, and that is because of the recent price hike that company has taken. Also on the volume front, company has outperformed the peers. Total volumes were up 1% YOY. Even MNC volumes have increased by 1%, and the biggest positive on the volume front was export, which has seen an increase of 29% YOY. And in the commentary, its electric mobility segment has turned EBITDA positive in Q1 of FY26. Also, company is redoubling its efforts in international markets and defense business. And amongst the priorities, it says it continues to believe that in the medium term, it will achieve mid-teen EBITDA margin for the overall company. So overall, it's a good set of numbers that Ashok Leyland has reported for Q1 of FY26.
Thank you so much, Sudarshan, for joining us. The company also says that they've gone ahead and gained some market share as far as the CV side of the business also is concerned. That stock has gained a bit after the results update. Well, a few sectors in focus. The entire consumption space has taken a bit of a knock, especially in the last hour. Names like HUL, names like Nestle, names like Dabur, all of these stocks are now trading near the day's lowest points. The other set of stocks that continue to witness selling pressure is the steel pack. So names like SAIL, Tata Steel, JSW, all of them are under significant pressure today. But with that, it's all the time we have on this edition of Midcap Radar Mutual Fund Corner when we return.
Hello, good afternoon and welcome to MF Corner on CNBC-TV18. I'm Vinny Motiwala, with me Sonal Bhutra as well. Sonal, we are wearing the tri-colors today. We are going to be celebrating Independence Day, but equity flows are surely keeping everyone happy as well. Look at the data that's coming from Happy, and that's what we'll be decoding.
We will be. It's definitely financial independence is what we talk about on the show as well. So let's talk about that in greater detail. We'll decode the data with our guests as well. But first up, let's talk about the numbers because it's been a month of records. Let's talk about the equity flows first up. This time around, equity flows came in at 42,672 crore rupees, which is a record number, and it was led by NFOs. But first up, what was the breakup between large caps, mid caps and small caps? Large cap flows increased on a month-on-month basis to come at 2,125 crore rupees. We've seen number higher than that before as well, so it was not largely led by large caps, but mid caps and small caps did well. For mid caps, the inflow was around 5,182 crore rupees, which is at a multi-month high. We do have the small caps doing well, 6,484 crore rupees. So again, that number is also at a multi-month high. So quickly, if we take a snapshot of all these three categories which did well, large cap, small cap and mid caps, so we have seen an improvement on a month-on-month basis as well. Now to the big number, the SIP number has been breaking records every month, and this time was no different. Markets, though they saw the decline, in fact last entire month we saw declines on the Nifty, but still the SIP number kept going. It's the DIIs who have been supporting the markets on the lows, 28,464 crore rupees for the month of July. Now, what has led to this surge in equity flows this time around? If not large caps, if not so much of small caps or mid caps, it's actually the sectoral and thematic funds which have seen some surge this time versus the last month, because there was a sharp dip in the month of June. From those levels, it has seen a sharp surge, 9,426 crore rupees. From that, if we talk about the new fund offers that came by as well, huge number. We've never seen this number ever before. So in terms of new fund offers or NFOs, the total number this month itself, that came in at 30,416 crore rupees. That was due to 30 new NFOs that came by. A lot of it was from Geo BlackRock Asset Management Company as well. They launched 3 liquid funds in the short-term debt category. They actually garnered 17,000 crore rupees from there. So NFOs, while the number was 30, which we've seen before, the absolute amount was huge at 30,416 crore rupees. That's a new record in the industry as well. Hybrid funds continue to do really well, 28,879 crore rupees in hybrid funds. It's up and away for hybrid funds. Balanced advantage funds did well, and so did the multi-asset allocation funds. So these are some categories where we are seeing that investor interest is coming back, because there was so much volatility in pure equity funds or pure debt funds, that these are the categories, multi-asset allocation, hybrid funds, which have seen a big surge over the last couple of months. So to decode the data for us, joining us today are Suranjana Borthakur, the Head of Distribution and Strategic Alliances at Mirae Asset Investment Managers, and Sandeep Bagla, who is the CEO at Trust Mutual Fund. Mr. Bagla and Ms. Borthakur, thank you so much for joining in today. Interesting times for the industry as well. While we're seeing the overall market going down, equity flows are increasing. But NFOs, that continues to be the big talking point. So, lady, let me start with you. NFOs are back again, 30,000 crore rupees inflows. Will this wave continue? And is it prudent to be looking at NFOs when it comes to fresh investments?
Good afternoon, Sonal, and good afternoon to all of your viewers. I think very interesting times to be talking about the NFO numbers. I mean, if you look at the YTD flows in NFOs, what has happened is about 49,000 crores of flows have come through the NFO route into the industry through some 147 schemes. So the proliferation of new schemes has been quite, it's been quite large. I think if you break down the July number, if you look at that 30,000 crore number that you are talking about, actually, as you mentioned, about 19,000 crores out of that is actually in 2 debt schemes. If we leave that out, you can probably see a larger number of NFOs which have come in the equity side, about 10 NFOs that have come in, which have garnered about 9,000 crores. Out of this, about 7 of them were thematic NFOs, which collected about 7,500 crores. Now, the multi-asset is the other category where one NFO actually garnered a decent amount of AUM from the industry. If you look at what is going to happen going forward, I think when it comes to differentiated ideas, there is always an enhanced interest from the investor side. But what is important from the investor point of view is probably, if they can align their long-term goals with the kind of products that they're adding rather than just, chasing the short-term trends in the industry, that will be a very prudent thing to do. And I also think that, unless a fund is really needed in the portfolio, it should not make it to the portfolio. A lot of times we add a fund in the portfolio just because of the fear of missing out of a certain trend, which may not be the best way of looking at it. If you need the fund in the portfolio, definitely look at it. But just because it's trendy may not be the best bet.
Absolutely. Just because it's trending, it's not always the best bet. Sandeep, good afternoon. What's your thought coming in here as well? Do you think this wave of new NFOs, that is something that will continue? And also, apart from that, that surge that we saw in sectorial funds again, do you think that's also a safe space for investor now?
Good afternoon. I don't think that sectoral and thematic funds are something that investors should devote a large chunk of their portfolio into. In a thematic or sectoral fund, the fund tends to be far more volatile and compared to a diversified fund. The onus of entry and exit from a particular sector or a theme then falls upon the investor themselves, and they may not be the best in the best place to time the markets. While experienced fund manager can easily adjust the portfolio compared to in which sector to invest and at what time to reduce the weightages depending on the relative valuations and the prospects of the particular sector. So while this trend is emerging that there are a lot of thematic and sectoral funds, my personal view is that one should allocate only a small part, and one has to be fairly cognizant of the fact that the volatility can be very high. One sector can do very well for a few years and then be completely out of favor because of the changing prospects. So I think diversified funds are a better bet, and one should take probably guidance from a distributor to ensure that you are properly allocating your assets into equity and debt, and within equity into the right kind of funds which meet your financial goals.
Okay, so sectoral funds only a part of your portfolio. That also you have to ensure that your risk-taking capability is as much as this particular category gives you. Coming back to you, Mr. Bagla, because equity inflows led by mid-caps and small caps, not so much by large caps this time. What is the market factoring in right now here?
See, I think I think that investors, by their experience in mutual funds in the last 20 years, have learned something that if you want to capture the growth of India's structural story, then the best way to participate in that growth is through equities and probably through mutual funds, which give you a very well diversified fund with experienced fund managers and at a very nominal cost. So I think that part has been understood, which is probably leading to this higher flows. And on the question of why higher flows in mid caps and small caps, we must understand that the way we have defined our large caps, companies have multiplied in their market cap over the years. And large cap, we have restricted the large cap category to only 100 companies. Now, a lot of companies have become large, but they are still qualified, they're classified and categorized as mid and small caps. A lot of new sectors are opening up, a lot of new companies are getting listed. Most of them are getting listed in the category of small and mid caps. If you look at the indices, then the small and mid cap indices earnings growth for the next 2 years is projected to be in the range of 13 to 15%, while the large cap 100 index earnings growth is likely to be between 6 to 8% as per Bloomberg estimates. So, investors have understood that mid and small caps are the place where the growth is going to be higher than the growth in the large caps. And the immediate past experience of 3 to 5 years has been stellar compared to large caps and mid and small caps. So India being such a diverse economy and so many opportunities which are emerging in the small and mid caps, I think investors are aligning their portfolios more towards mid and small caps. I just hope that they are going to remain invested for a long period of time, so that they are able to tide over any volatility which may arise because of either global uncertainties or any periodic slowdown of growth, and sometimes stretching of the valuations in mid and small caps. So I think one should elongate the holding period and the investment horizon, and try to benefit from the growth in the mid and small caps in a structured way.
Absolutely. So Ranjana, what's your view also coming in on this, right? Mid and small cap, that is what is leading the flow, right? So your thoughts on that, and also in terms of sectoral and thematic funds.
Yeah, I think what has happened if you look at the flows from beginning of this year, from January onwards, what has happened is in the equity category, the largest inflow, about 20% of the flows have happened in the flexi cap category. Followed by small cap, followed by mid cap, and also the large and mid cap category. This is keeping aside the sectoral, which is also second to only the flexi cap category. Now, what is happening is, as Sandeep mentioned, people are looking for the next big growth leaders, and which is where people are exploring more into the mid cap and the small cap space, and also since earnings, visibility is better in the broader market, so which is where probably the conviction is very high. I think within thematic, if you look at it, if you look at the kind of flows that have happened within thematic in the 49,000 crores which have come into NFO YTD from January, about 14,900 have come in thematic, which is actually dispersed in about 23 schemes. So obviously there is a lot of chasing which has happened there also in terms of newer ideas. But what our take is very clear that, when you look at, large, mid and small, while large cap today in terms of valuation may look a little more attractive, but if somebody wants to really create wealth in India, probably having enough allocation in mid and small is absolutely essential, and which is where probably flexi cap and multi cap are great categories to look at from an entry point of view today. But from a pure mid cap and small cap, I would think that probably it's better to go in through the SIP or the staggered route. The only observation is in thematic, probably, that too much of chasing, what Sandeep also mentioned, that if the product remains as a satellite portfolio exposure, great. If you keep on chasing different trends and then they all become core of your portfolio, then the portfolio itself becomes very volatile.
Makes sense, and that's the biggest risk with sectoral as well, right? We did see that big wave coming into sectoral, but then we saw some of them reversing those returns as well. So that's the big takeaway from investing into sectoral funds. It's a very interesting discussion, but we have to get into a quick break. So we'll come back and we'll talk about SIP redemptions and the other categories that have done well as well. So stay tuned for that conversation. Welcome back. You're still tuned into MF Corner. We still have with us Suranjana Borthakur of Mirae Asset Investment Managers and Sandeep Bagla of Trust Mutual Fund. And we are discussing what's the detailed analysis of July mutual fund data as well. Let me start with you this time around, Mr. Bagla. We've been talking about those SIP redemptions number, right? And that has been huge in the last couple of months. Are we seeing an improvement here? Was this number high this time as well? Will we see an improvement in this trend overall?
Yeah, I think the periodic profit booking will happen from time to time. People have been investing for a long period of time, and those things will continue. I think what we need to concentrate on is the fact that the SIP gross numbers are increasing, and which reflects the increasing participation from retail and increasing penetration into the different pin codes in India. So I think the distribution is getting increased and the inflows are more granular in nature, and I think they will be more sticky. So I think that is something that we need to concentrate on. Look at the situation that we are in. You have, Trump tariffs, which are threatening to disrupt the global trade scenario and supply chains. You have growth, which is slightly anemic. And while interest rates have been cut and the government capex is picking up, we are expecting that earnings and will pick up in next 3 to 6 months. But equity market performance has been slightly patchy, and which is why it leads to nervousness, and people who have been investing for a long time are booking profits. But I think the trend is that the core SIP growth, which is probably the cornerstone of mutual fund growth in India, I think that is on the rise. And I think this will continue in the future. I think mutual fund AMFI with mutual fund Sahi Hai campaign, and the very fact that people have made money steadily on a regular basis through SIPs, I think that has led to that growth. And I think today, we are talking about bank deposits and mutual fund investments in the same breath. There was a time when mutual funds were very small. We did not mention mutual funds and banks in the same vein. But I think we are now gaining ground in terms of investor attention. And like in the Western countries, the contribution from mutual funds is far higher. I think we are also headed that way. So I think this growth will continue for quite some time to come.
Okay, expecting this growth to continue for some time to come. That will be interesting to watch out for. So Ranjana, what's your thought coming in overall in terms of obviously the increase that we're seeing for B30 cities, right? So this incremental flow now that we're seeing coming in, is it only B30 cities or even smaller towns and cities are now seeing a higher participation?
Yeah, actually, that's a very interesting trend again, which is evolving. If you see, in terms of B30 is definitely the growth engine for additional flows which have been coming into the industry. But more exciting to see the locations which are beyond the B30 cities. I think a lot of participation from smaller towns which have been coming in. I think, financial inclusion, I think deepening of the MF penetration, awareness of mutual fund as a product, all of these are helping in increasing the share of newer markets. But I also believe that, the digital familiarity, if you look at even from a payments point of view, like using UPI or making a digital payment, all of this is absolutely level playing field it has created for online investing. In fact, a lot of fintech platforms are actually sort of, speaking directly to the client in a language that they understand. So a lot of people are talking jargon-free things, which are, which are making the investor more confident. I feel also the distribution reach, which has expanded in cities which are beyond the B30 and T30, are actually also creating a good reach. In fact, I was just recently talking to a regional ND setup. Very happy to hear from them that their focus for new investors is actually from the cities beyond the B30, and they are actually focusing on the women cohort, where they are seeing a lot more interest for longer term investment and commitment remaining. So very interesting trend there. But if we look at the actual numbers between B30 and T30, I think if you look at the May to June growth, I think the B30, while the T30 growth has been about 3.5% in the AUM, the B30 growth has been actually 3.9%, so a slightly higher percentage growth there. If we look at the YTD growth, July last year to July this year, if we look at the growth, the B30 growth has been around 21%, whereas the T30 growth has been around 19%. So there has actually been an incremental growth in the B30. And also, I think because the underlying of the B30 AUM, if you see, almost 77% of that AUM is actually in equities. So the faster growth there is also leading to better penetration in the equity investments in MF. So I think great trends to be seen there. I feel after 2019, probably the digital penetration, the familiarity, actually having investment knowledge very easily accessible is making investors more empowered, and therefore the reach is increasing.
Take that point. Mr. Bagla, the other category that has done well, and you spoke about it in your initial answer as well, is hybrid funds. They are doing well. Do you think the volatility or the interest out of other categories would keep investor hooked to this one?
Yeah, I think multi-asset funds are getting more popular. See, what is happening is that fixed income rates have come down. Gold has performed really well, and we are, as uncertainty increases, as dollar becomes weaker, as tariffs come into effect. I think the second order effects could be inflationary, while opinion is divided whether it is going to be inflationary in the longer term or it is going to be a one-time effect. My personal take, and which is supported by the long-term bond yields and also the prices of bitcoins and gold, market seems to be weighing in favor that things are going to be far more inflationary than what is being understood by the people in power. So I think it's a good bet to hedge through multi-asset fund, and I hope the fund managers are able to calibrate the exposure in gold to a more significant part than the mandatory 10%. To make the character a little more multi-asset than just another equity fund. But I think multi-asset funds are going to remain here. And I think that in the period to come, I think gold will continue to surprise us on the upside.
Okay, Mr. Bagla, point taken on that note. So thank you so much, Mr. Bagla, as well as Saranjana, for joining us this afternoon and helping our viewers decode that amphi that is coming, as well as the trends that we could expect seen going forward as well. But with that, we're absolutely out of time on this edition of MF Corner on CNBC-TV18. Thank you so much for tuning in. We have the last hour of trade that is still left, and your closing bell up next for that.
go beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng, on the other hand, is managing to hold on to gains of 0.2%.
I don't have to say there will be very severe consequences. Yes.
You got to clear these resistance levels, right? The first one is 24,702, 24,640, almost unchanged to where we left off yesterday.
I think China, in a sense, has reached this second or the third stage of development. India is possibly about 7 to 10 years behind.
They will be gradually reducing the NCLR and the cost of funds may come down by 40, 50 basis points.
Those are the visuals that are coming in there from the NSC. Mr. Parth Jindal out there, Southern Jindal.
Numbers have actually come in better than at least what the street was anticipating.
At 11 o'clock, markets are pretty flat. It's got a positive tilt. The Nifty is at 24,661.
Now we're seeing some choppiness in the market. We started at that 24,607 mark, saw some uptick from there, but now we've been in a range.
Well, that is the day so far. Markets are absolutely flat. I mean, there's about 5-point change in the Nifty. We're at about 24,624. Neither here nor there. No real inclination, no real push or pull either to break out or break down as we head into this long weekend. I'm Prashant. With me, Nigel, and it's the both of us. We're going to get you the last hour of trade today and this week as well.
Well, very, very quiet trading session.
Quieter in the studio as well.
Yeah, without the girls. But the markets are absolutely quiet today. I think if you were to pick up a positive today, will have to be that the Nifty Bank at least is doing a relative outperformance.
Yeah.
And if you pull out a negative, then that's the breadth of the market isn't that great because the Nifty, in fact, is holding mildly in the green. But the breadth of the market is in favor of number stocks declining. But I think there's something to celebrate. I'll tell you what. After 6 weeks, the Nifty is all set to to end in the green unless something really crazy happens, because it means that the Nifty would have to correct by 300 points from here. I don't see that happening at all. So pull through the last 60 minutes, then have a good 3-day break, but keep the sound bites coming because you'll hear plenty from Mr. Trump and our Prime Minister, Mr. Modi as well, will be talking.
Absolutely. Let's just quickly, Nigel, tell our viewers what's lined up here in the next 60 minutes or so. So gold financing companies are in focus. Muthoot is flying away. Manappuram is the other one. So we'll get you analysis on the numbers, valuations, etc. We'll also, of course, get you some sound bites, right? We had the Manappuram management, Muthoot management with us in the morning. Max Health is down about 4.5%, so numbers in focus. Ekta helps us with that. Again, the management also spoke to us earlier. GMR Airports, we'll take stock of what brokerages are saying in a bit on that company as well. That is GMR Airports coming through. So, yeah, I mean, that's the lineup here. And of course, through the course of the show, we'll get you lots of specific sound bites, etc. If anything, I mean, just looking at the price action, the market action, think about a scenario, right? I mean, tomorrow you've got this Russia-Ukraine thing, and that's the big one. I mean, the Prime Minister's speech, of course, is important as well, and we'll see if that speech basically can provide you a directional sense of what the government wants to do. It can't announce specifics, really. But the Russia-Ukraine thing has been built up to this to be this big one. But over the last 24 hours, oh wow, there is the trigger. S&P has upgraded India to a BBB outlook stable. So that is what is coming through straight away at this point in time. And that is breaking news. One of the largest rating agencies upgrading India's sovereign rating to BBB. So that is what is coming through at this point in time. More details. I don't know if there is a press release. We'll try and, of course, get in touch with the S&P spokesperson. But that is what is coming through. Some history, etc. as well. Markets, of course, not really reacting immediately. It's absolutely flat. Maybe we will look at the rupee as well and see what's happening there. One of the things which has happened if you just look at it, right? We've had 2 rate cuts from the Reserve Bank of India. But guess what bond yields have done? Bond yields have actually moved higher. And that has primarily been on account of, government borrowing and some fear at the margin whether there is enough capacity to absorb that bond issuance from the government of India. And, I think at 10:15, Lata did a discussion on this. It's an important topic. So at least in terms of bond markets, and of course for the rupee as well, I think this is important. It's important in any case with regards to ability to borrow at a cheaper rate, and of course, overall standing within sort of a plethora of nations, etc. as well. So it's an important development, important news bit which is coming through. Still waiting to hear in terms of what else is S&P saying, because usually there is a paragraph, rationale, etc., and we'll try and get that for you in just a bit from now. But Nigel, it's pretty flat for now.
Yeah, indeed. We'll have to keep an eye out. We'll try to get you a reaction, maybe try to get you S&P itself. But for the time being, the markets are extremely quiet. The Nifty has not reacted, and the rupee as well has not really reacted as we speak. In fact, the last time I checked, it was at the low point of the day. Now you're seeing a bit of a reaction, but this is definitely a positive point that's coming out there. S&P going ahead and upgrading India's ratings to BBB from BBB-. This is a positive in the larger scheme of things. The market's now moving up a little bit. The Nifty Bank as well is gradually moving to the high point of the day. We'll get back to that. Maybe we'll try to get in an economist or the S&P. For the time being, let's get in Mitesh. Mitesh, a positive trigger coming in the last few minutes. The Nifty, though, as quiet as can be. What do you think? We're leaning towards the positive side, or do you think we want to go ahead and test the recent lows?
Nigel, I think, there's a news flow which Prashant just mentioned, but yet I think, the market hasn't given me a strong signal of an upside reversal. The only good thing is that, and I've been highlighting this since yesterday, that on the 2-hourly and the 3-hourly charts, if you look at the Nifty and the Bank Nifty, the indicators have started to turn up in the oversold level. We haven't got a crossover as yet, but that should suggest that this time, I think, in case we get to about 350, 400 zones, it is unlikely to break below that, and most likely, we should at least test the upper end of the range, which on the Nifty is about 24,750, 775. And once we cross that, we should head towards 24,950, 25,000. So in that sense, the anticipatory move is on the positive side. We are just waiting for some price action to confirm that. On the stock side, Indigo is a buy with a stop below 59.40, targets of 61.30. I think that's making an all-time high, so this should be good. And Laurus Labs is a buy. Keep a stop at about 848, look for targets of 885.
Okay, those are individual specific names coming through. So the previous rating was BBB-, which is the, I think it's the lowest investment grade. So in S&P had kept India at the lowest investment grade in terms of its ratings, and this is a significant improvement which has actually come through. I think May of last year, May of 2024, the outlook was changed. The outlook was the rating was BBB-, but the outlook had been upgraded from stable to positive, and now the rating itself has gone from BBB- to BBB. So that is essentially what has come through. The nomenclature is different from for all rating agencies, but Moody's, for example, has kept us at Baa3, and with the outlook which is stable. From Moody's perspective, it is the lowest investment grade, and I think it remains unchanged since 2020. That is Moody's. If you look at the other big rating agencies, which is Fitch, Fitch, of course, is at BBB- with the outlook which is stable as well. And I think they've had their rating there for a long time as well. So that's the overall some perspective, some context to who's moved and who's not. But S&P seems to be the first big one, which is up their outlook, up their rating. The outlook moved to positive last year, May of last year, and the rating itself has been up to BBB from BBB- at this point in time. So more on this, as I said, we'll try and get you some economist perspective as well, and of course we'll try and have the S&P spokesperson if he can. But that's some information which is coming. So I think on the rupee, Nigel, there is a bit of a move.
There is a move.
The market has also moved. The Nifty is up 16, 17 points. You can see a sharp spike up. Look at that. I think that is what we're talking about. It's a 0.25% move coming in after the move from S&P, which has come through. So that's 17 paise. And I think almost all of it has come through after the rating upgrade from S&P. So that's a pretty decent move. Yeah, Nigel.
Someone said dead economy. No?
Who said?
S&P. I don't know. S&P goes ahead and upgrades India. That's the response out there, you know. So, positive signal coming in there. But let's focus on stocks. We have Gaurav who's joining in to give us a quick comparison between Muthoot as well as Manappuram. Gaurav, for the day, clearly Muthoot is the big outperformer, though Manappuram has some valuation comfort. Please tell us more.
Well, yes, when we look at both the stocks, actually Muthoot actually came up with very good set of numbers, and that is the reason why we are seeing this sharp rally. In fact, when we look at the numbers, net interest income increased almost by 50%. Now, operating profit increased almost by 60%, and when it comes to profit, that has increased almost by 90% on a year-on-year basis, which was higher than street's expectation. In fact, the AUM growth was at around 42%, with loan book itself growing at around 40% on a year-on-year basis, and this is despite having the largest book in terms of loan book for NBFCs in terms of gold loans. When it comes to the overall commentary, that also remained very strong. In fact, net interest margins that expanded almost by 100 basis points, and the reason being that there was 400 crores of impact. But at the same time, commentary also suggested that the gold loan book trajectory is going to stay on. When we look at the management guidance, they've given the guidance of 15%, but they have surpassed the guidance with a very big margin. In fact, they also indicated that in the next quarter, we may see guidance revision somewhere in the tune of 20%, but definitely the number of growth will remain higher than the guided range. They also said that from here on, the outlook looks very strong about gold loan, and this is basically specifically because the unsecured book, there we are seeing some kind of slowdown. So people are moving to gold loan, and at the same time, he also suggested that the finance ministry is also pushing the gold loan book. Now, this is something which is also helping Manappuram Finance today, because when we talk about numbers, Manappuram Finance did a little weak in terms of numbers for the quarter one. In fact, AUM growth was lowered almost by 1%. In gold loan specifically, we saw 20% growth, but overall the commentary was sluggish in terms of margins. But there also they had said that the gold loan book portfolio will grow at a higher pace. In FY25, we have seen the pace of around 19%. They said that in FY26, the pace will be higher. So the commentary around gold loan book is basically pushing both these stocks higher today. For Muthoot, it is more than 10%, and for Manappuram, it is more than 3%.
Okay, all right, Gaurav, thanks a lot for that. Well, let's listen into what George Alexander Muthoot, Managing Director at Muthoot Finance, had to say about their guidance and gold loan demand as well.
I don't want to change the guidance now. We've always said the 15%. Give us a little time. So usually we change the guidance after second quarter. So give us a little time. But for definitely, it will be much better than what we said, 15%. There's no doubt about it. 15% plus is what I said. That is not limited to 20%. Can be even better. So we'll discuss on it after the next quarter. Anyway, I'm also here next quarter. One of the things, as I've always been said, has been good demand for gold loan because of the overhang or the difficulty in getting unsecured loans everywhere. So that is one thing. One of the important things was, again, the regulatory action which came by revised final guidelines. The final guidelines, if you ask me, has been quite good, and it is quite gold loan business friendly. When I say gold loan business friendly, it is helping the gold loan business not only for the customer but also for the NBFCs and the banks. So the regulations which came gave a boost to the regulatory overhang which was always there, was whether the finance ministry, whether the Reserve Bank is keen to promote the gold loan business.
All right. Well, I'll tell you what, I just want to get back before we get Deven's view on both these two stocks. Sudarshan, my colleague, is putting out some flashes on the ticker. And what S&P is mentioning is the effect of the US tariffs on the Indian economy will be manageable. And India is relatively less reliant on trade, and about 60% of its economic growth stems from domestic consumption. So they're stating the obvious, but I think that point with regard to India's story is strong, and we'll be able to combat these tariff issues that are coming out of the United States. That's giving some confidence as well. Well, we're going to be joined by an economist very, very soon, but let's get Deven's take first on these gold finance companies. Deven, I've been observing whenever there is this kind of regulatory overhang on these companies, these gold finance companies, they bounce back even more swiftly. I recall there was an issue earlier this year when you had The same stock, Muthoot, had gone down to 2,000 rupees. And from there, it's given you 30%. Valuations are not cheap, but what do you like between both these two, Muthoot or Manappuram?
So, good afternoon, Nigel. Well, I think in case of Muthoot, I think the opportunity is different versus I think what you have it in Manappuram. The one is basically having the larger footprint in form of I think diversified portfolio. The other one is pure gold focused company. In my viewpoint, I think a pure gold focused company with a long tenure gold loans is something which basically I think makes more sense. Though I think the NPA ratio is not something which I can easily comprehend. In a way, one wants to look at I think this particular business, given the strength of the gold price at this point of time, and I think given the kind of demand that one would have during the festive season, probably the tailwind is in favor of the gold finance business, and that's where probably I think market is also remaining a little bit more steady onto this particular subject. As far as we are concerned, we prefer to go with a diversified consumer finance companies, NBFC companies, the larger ones. We don't like to stay focused onto the asset class like gold pure play. I think as far as I think the investment is concerned. So the likes of Bajaj Finance would remain relatively more better choice. And if one was to go with a dedicated one, then housing finance business also I think remains a little bit more sure bet vis-a-vis the gold as far as I think the safety or downside is concerned.
No, yeah, absolutely. We'll just look at the market for a bit, 10 points, 11 points, and we'll just wait by. Devin, good afternoon. I'll just wait by till I'm told we can go across to Mr. Soumyakanti Ghosh, who's with us, who's joining us in just a bit from now. Market breadth, by the way, is pretty poor, pretty terrible. 1,700 stocks are lower and about 1,100 stocks are higher. So this is actually pretty, negative. It was not this in the morning when we actually looked at things. Things were looking much, much better. HPL Electric started lower, about 6-7%. It was down 10% by about 10:30 in the morning, and it's down 16%. So that's a pretty large cut coming through, and you've got lots of these smaller, 5-6% kind of accidents, and even larger ones, right? I think Surya Roshni is another one which is down sharply. I think we have Kanika Pasricha, Chief Economic Advisor at Union Bank, now joining us, the first voice, and we'll get you more. Ma'am, good to have you with us here. Thanks for joining us. The upgrade from S&P, what do you make of it? And immediately, in practical terms, what does this mean in terms of impact?
So, Prashant, thanks for having me. See, 3 points. First, it's a positive move, and actually it's a surprise move as well. Because recently, when we were speaking to S&P, it was not expected that the move will come in. But I would just say it is very long overdue given our own macro stability dynamics. We are still the fastest growing economy in the world. And the way we have seen improvement in inflation, fiscal, current account dynamics. So all this is playing out. S&P in its report is also mentioning, as you're also flashing it, that they have given due credence to this focus on capex by the government, overall macro stability, and that's a acknowledgement overdue, and we've finally received it. Last but not the least, is typically from market perspective. Recently, the bond market was having a lot of concerns about some fiscal slippage or need for fiscal stimulus or some sort of fiscal related issues in the coming year. But this is likely to give some relief to bond markets. We've already seen yields drop by 4 to 5 basis points. So some positive news on the cost of borrowing, cost of capital coming down as well. Thanks.
Hi, Kanika. Good to see you. Ben, has this come as a surprise, and do you expect other rating agencies also to follow suit? We'll be waiting back to hear from Moody's probably. Your take?
So Moody's typically has a very transparent framework which they work with and display in their reports as well, where they are also stuck on other issues like lower per capita income and maybe slightly higher debt to GDP compared to our EM peers. So let's see if Moody's follows through. It will be a positive acknowledgement. But overall, it looks like yes, it was a surprise. Given we are not heard from them, we are already As I said, it's long overdue. Given for the past 2 to 3 years, typically India has seen a dramatic turnaround
Right.
since COVID in current account dynamics, and of course even fiscal and inflation numbers. Thanks.
Kanika, just hold the line. We have Dr. Soumyakanti Ghosh also joining us. He's Group Chief Economic Advisor at State Bank of India. He's a part-time member of the 16th Finance Commission as well. So good to have you with us here. Your first reaction to the upgrade which has come through, sir, and what do you imagine is the impact in practical terms, sir?
No, I think that's a positive development for the economy as a whole, and you can already see that's been reflected in the cost of borrowing, the GSEC yields, the rupee. And the most important point is that it reaffirms India's commitment to the reforms which we are currently underdoing. And given the fact that I think this last outlook, I think it is coming more than a decade. The S&P outlook, upgrading India is coming more than a decade. I think it's a very positive development. And one of the interesting points which the S&P has mentioned in the press release, which I can gather from the press release we have been putting out, is that it has also talked about the monetary and the fiscal policy coordination. So I think since the pandemic, this policy coordination has been demonstrated in full gusto, and my sense that it's a positive development of the economy amidst all the uncertainty which we have been facing in the last couple of months.
And for the upgrade to come at a moment, particularly like we find ourselves in now, right, which has been a little bit of the US-India thing which is going on, and whether there have been some talk whether this is going to.
I think that this upgrade actually could I don't know. This is possibly could point up to some thaw also in the India-US trade deal, which could actually which may materialize. It seems that there is a possibility of it materializing maybe in the next 1 or 2 months. So the sense is that there has been policy continuity, there has been fiscal coordination, inflation has been under control, robust and governed fiscal deficit. If you remember, the center has brought it down to 4.4% from 9.2% in a span of 4 years. And the state's consolidated fiscal deficit is also around 3% because that's a rule because they can't borrow more than 3% of GDP. And overall consolidated fiscal deficit has also been steadily declining. My sense is that if the things continue like this, I think it will be good for the economy and it will be good for the debt market and the bond market as well.
I think Moody's, Dr. Ghosh, has also got us at the lowest investment grade, like S&P was before this upgrade. Would you expect others, Fitch, for example, is at a stable outlook and a different nomenclature in terms of the ratings. Would you expect others to follow? Typically, should we expect when one large rating agency moves, others sort of look at their own assessments?
Yeah, I think others would follow, but I am glad that S&P, I think, was the one the rating agency which was actually has pushed the rating upgrade to has done this rating upgrade after more than a decade. So from that point of view, I think it's a very positive development. And even if other agencies follow, I think that will be good for all of us. But in terms of the overall rating, I think S&P upgrading India is a very big news for Indian economy as such.
I was saying earlier, Dr. Ghosh, that we've had rate cuts, but bond yields here have moved higher. There have been some concern at the margin whether, government borrowing is going to be, is there going to be any issue at the margin with regards to financing that? I think in terms of government borrowing, bond yields, etc., this perhaps helps in a sustainable way, this upgrade and more if they follow?
Yeah, I think that's a very interesting question, Prashant. My point is that I think ultimately a rating agency has to convince the Indian markets that Indian public finance is actually in quite a good shape. And I don't see any reason why the debt markets, the bond yields have actually reacted so unfavorably after the monetary policy announcement. Maybe it was a market reaction or maybe it was an irrational exuberance or whatever you can call it. But my sense is that after this S&P call, and with an international rating agency ascribing that India's fiscal position and monetary position continues to be sound and favorable, the debt market already has taken a cue from the development and the yields are down. So that is, I think, one of the another positive developments for the economy as such. Because if the cost of borrowing declines in the international market also, that will be also a positive for the market.
Okay, all right. Thanks a lot for joining in, Mr. Ghosh, as well as Kanika, and giving us your take. So, initially we didn't see a big reaction, but now as you look at the intraday chart on the rupee, you'll see the rupee has pulled back a little bit. The yields have softened by around 4 to around 5 basis points. And the Indian stock market itself has suddenly come back to life. We're up close to around 35 to around 40 points after being mildly negative. So the rupee pulls back. The yields as well have cooled off a little bit, and the Indian market spiked to the high point, towards the high point of the day as we speak, and we have an expiry that's playing out. So getting this sort of a news point on weekly expiry could sometimes lead to an outsized reaction. So let's see whether or not those call writers, they suddenly get stumped on the wrong side, because they would be bracing for not a very, very big move, and suddenly you have the Nifty that's moving up. I think around the 24,675 to around 24,700, going by the options data. That's where the bears are looking to defend for today. Let's go back to Deven Choksey. Deven, good news definitely that's coming in there. S&P going ahead and detailing that India is growing well. The consumption story is something that we should be focusing on domestically, and we'll be able to, bear up or withstand any kind of impact of this tariffs. So heartening to hear those words. Your take, any stocks that you've seen today that you would like to talk to us about or recommend it? Because it's the final day of earnings. It hasn't been so bad, actually. Expecting a weakish performance in the first quarter. In the last few days, you've got some earnings surprises, actually. One stock is Asian Paints. It's now moved to the high point of the day. That was a pleasant surprise as well. What's your take?
Yeah, Nigel, I think it's a very positive news going forward. And at the same time, I think the commentary coming in from RBI, I think on the lowest lies inflation. I think they are saying that I think India will now probably focus more on the growth vis-a-vis the inflation. Now, this is extremely positive commentary. That means that I think the regulator is trying to pitch in, and I think put across, I think the growth-oriented policies for the banks. So which promises that I think going forward, you're likely to see the activity increases, I think, as far as the economy and the companies are concerned therein. Overall, I think the first quarter result season is over. And my take is that I think based on various commentaries that we have heard from different companies, my take is that in these subsequent quarters, we are seeing a robust demand scenario emerging. Consumer demand from rural space, I think, is actually, growing better. At the same time, I think cost controls are, quite some in the entire universe in different companies per se, which also promises better profitability along with the growth in the current financial year. So I think some of the immediate ones who could possibly be the beneficiary immediately, autos, I think in particular, would remain relatively more short bet as I see it. The likes of Maruti's, likes of Tata Motors, and for that matter, Mahindra & Mahindra, they remain, I think, relatively more focused stocks as far as the investment outlook is concerned from them. I also believe that I think some of the real estate companies could possibly see relatively larger amount of uptake as far as I think the constructed premises are concerned in subsequent quarters. So we remain distinctly bullish about the discretionary spending in the economy, and probably believe that I think lower cost regime is definitely helping the economy more at this point of time.
Got it. Okay, all right, Deven, it's good to have you on the show as always. Thanks a lot for joining in. It's been a good afternoon, actually, with this kind of pleasant news flow that's come in from the S&P. Wishing you a good weekend ahead, Deven. We chat up in the next week itself. Well, slip into a short break. Continue our focus on markets. We'll have Tushar Pradhan as well, who will be joining in.
Okay, welcome back. Markets up 26, 27 points. It's kind of flattish. Market breadth is a little poor, although both have picked up since that S&P upgrade news came. Tushar Pradhan is with us, Director, Hexagon Partners. Tushar, good to have you with us here. Thanks for joining us. You know, gold is the name of the game. Gold finance, gold jewelry. Look at Senco. Senco is up 7-8% today. Of course, there's Kalyan, which is up about 4%. Muthoot, Manappuram are up 10 and 4-5% respectively. So, you know, prices are going up. Lending is pretty robust. Anything you like in the space?
I think this is part of the overall consumption theme that we keep speaking about. And essentially, when we talk about this 6.5% GDP growth, domestic led, I think one of these sectors, such as gold, etc., are very central to the entire theme. So I think that's playing out. But you have to also remember that all of these stocks have been at much higher levels before they have come to this level now. So we've seen a fair bit of volatility as well. I think from a gold financing business, I think clearly they are in a better position because their net asset values go up while they may have lent a lower amount, which means that the scope for them to lend more without actually prospecting for more clients is very much the case, which means their ability to lend is much higher because of sheerly the cost of the collateral going up. So I think these are all vectors which are pretty positive. But as I said, it's one of the themes that we look at, not something really the main theme at this time.
Tushar, but how do you approach the markets right now? Because there is that caution out there. Domestic data points are still rather soft. Hopefully this upgrade that we've got from S&P, that can help sentiment a little bit. And we are also seeing the money market react, which is telling you that this is quite a big positive. Your take though, Trump's tariffs will keep things uncertain. The hope is the economy recovers in the next 45 days. You believe it will be as much as expected?
No, in fact, I have been bullish for the entire economy for a while now. In fact, I've been a little disappointed with the first quarter results. But I think that there will be catch up, especially if you remember September quarter of last year was particularly bad across a large swath of Indian companies. So when the second quarter numbers post September into October is when we'll see them, they come out. I think we are in for pretty significant surprises on the upside. That's one of the things I continue to believe in. Second is about this S&P upgrade. I think most of these rating agencies have been far behind the curve when it comes to country ratings. And we've been there before, so it's no surprise. But the downgrade by Moody's in the US, for example, which has come after 1 decade after the downgrade from S&P. I mean, it just tells you that, there is not so much of a consensus in terms of, where the direction is, and it takes so long to be able to kind of decide. If you look at the economics, if you look at what is it that decides the rating of any country, I think India has been far ahead of some of the other countries which have much higher rating. So, it defies logic to me. But when you look at it overall, I think after such a long time, if they have acknowledged an increase in the fundamentals of the country, I think that's a very strong positive. And I think it comes at a very interesting time because we've got local inflation, which is lower. We've got a central bank which is fairly positive on growth and allowing for interest rates to slide down. And this, kind of bolsters the case for lower rates. And that is essentially going to be dramatically positive for the economy because we are still on a growth path. We are talking about 6.5% real GDP growth. So it makes for a very interesting time. I think, yes, the Trump situation will keep it volatile, but maybe that's a good news because then you enter at a time when all the positives are not in the price.
No, I got that. The point of rating agencies, I completely take on board. But it is what it is, right? Somehow they matter. I guess the downgrade matters more, right? I mean, more than the upgrade.
Yes, I mean, come to think of it, but you saw the impact of the US sovereign downgrade. It had absolutely no impact on their stock markets. So would you think there are two roads one takes? But yes, for countries which are at the margin, so whether it's a triple B and a triple B minus, a downgrade really hurts a lot. Yes, I think you're right on that.
Yeah. Point taken. Any other ideas, any other themes from a market perspective, Tushar, you focused on?
So I think one of the areas which we have ignored for some time and for various reasons and for, I think, logical reasons as well, is the private lending space, both in the banks as well as the NBFCs. So one of the reasons why we feel confident about is that the quality of book going forward, because of some of the challenges that we faced in the NBFCs lending to microfinance, etc., they seem to have had a cloud over these valuations for some time. And I think they have a reasonably sized book. They have a significant growth path ahead of it, which means the assets will grow, which in effect means that net interest margins are likely to be pretty strong going forward. And if the economy grows, then every part of the economy, including the MSMEs, the small and medium enterprises, they all grow. And I think these are the companies which are right in the path of being prudent, of course. I'm not saying all of them will do well, but if you're a prudent lender to this growing area, I think a year or two will provide us with some great opportunities. So that's one area that we at least at Hexagon look at very positively. The second is capital goods. That's again an area which has kind of come under the cloud because of a softening of ordering, the kind of revenue recognition that we see in the last couple of quarters. It's come off a little bit, and the prices also have come off. But I think if you're talking and believing in the 6.5% GDP growth rate, then I think these things have to do a lot better. In fact, most of these capital good companies are now trading at below their average PEs that we've seen in the last 5 years. So these are the two areas very strongly that we look at from a positive upside perspective.
Okay, all right. Tushar, what we'll do is we'll leave it there. Thank you very much for joining us. Appreciate your time here on CNBC-TV18. Have a good weekend and happy Independence Day to you and your team. Well, time for our segment, D Street Chatter. Nimesh has been working the phones to get us a sense of what he's picking up across dealing rooms. Nimesh, take it away.
Hi, Prashant. So, a bit of softness ahead of the big truncated week. So, that's something to watch out for. We had one good news in terms of the S&P upgrade today. I guess all eyes will be on the US Russia meet, and that could potentially have a big impact of a short covering to a rally as well for the Indian market. So that is something Citi is anticipating and hoping for. So let's see if that comes on Monday morning or not. From a flow perspective, for the second day running, I understand there is buying interest in technology stocks. So again, the IT index is up another 0.5%, and there is delivery buying happening in a lot of the IT names today. So that stands out for me. Technically, 24,350 is a level to watch on the downside. If that gets taken out, you will see a very sharp fall from there on. So that's the level to watch out. And on the upside, 24,950 is a big level to watch as a resistance. So in that range for many weeks now, need to break out on the either side. But I guess all eyes will be on the meet this weekend and potentially hoping for a short covering rally on Monday morning.
Okay, all right. Got that, Nimesh. What about individual stocks? What are you picking up?
So the first stock on my list is Autumn. Again, there was a sharp intraday dip and an equally sharp recovery as well. There was a large block, nearly 50 lakh shares got changed hands. And I understand the promoter native was a seller and some large FI investors were buyers in today's block. So again, disclosures would be quite interesting in Autumn. So that's the first stock. Second stock is Mastech. Well, the stock has been consolidating post earnings. I understand there could be a large block in Mastech very soon. So that's the second name. The third name is SPML Infra. The stock is under pressure today, but the sense is there could be some large order wins for the company very soon. So that's the buzz there. And the last is Patanjali. That's interesting. It's been pretty much on the sideline, sideways for the last many weeks now, consolidating a very narrow range. But now there could be some trigger of potential new hirings. So that is something to track as far as Patanjali is concerned.
New hiring. That's an interesting one, Anish. Usually you will have more on it. It's a very cryptic clue. But basically a senior person joining. Is that what?
That's the buzz that maybe you will see some not one but maybe one or two more senior people joining in Patanjali. So that's the buzz there. So need to see who comes in. A couple of names have been speculated, but nothing official yet. So I leave it there that maybe you will see some big hirings there.
Okay, all right. That's Patanjali for you. There's Mastech and there's one more. So yeah, I mean today's the list with regards to individual names to keep an eye out on. Mitesh is with us with what to buy or sell today for a reverse trade when we come back on Monday. Mitesh, what do you have?
On the short side, we'll take some long positions despite being a weekend which is extended. APL Apollo, after a big decline, was showing first signs of a reversal. BTSC here, the stop at 1595. Look for target of around 1620, 1625, set to bring more. And the other stock which I like, that's Booster. It had a breakout on and in the day, and then gave a pullback for the last 1 hour, it's picking up again. So keep a stop just below levels of 1775 for targets of 18.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's slip into a short break. On the other side, we'll put the focus on some stocks that are moving around. Max Health as well as GMR Airport. Stay tuned.
Okay, welcome back. There's 18 minutes to go for the market closing. Market is up 14 points, not very much at all coming through. Let's quickly get a quick sense on the F&O space. Nigel has walked across to the F&O desk. Nigel, take it away.
Well, unlike what we've seen the last few trading sessions, the good news today is the Nifty Bank has found its form, and that's up close to around 200 points. That always helps the Nifty scores, though you have a couple of large weights that are not participating. So because of the Nifty Bank's outperformance, it explains that the Nifty is holding in the green as well. Now, it's very, very interesting because the next 25 minutes, you'll have this weekly expiry that will expire. And there will be a couple of strikes that are very, very active. So the positioning is such that we don't get past the 24,700 mark. Why is that? 24,650 call. The premium out there has come down drastically. It's almost at zilch right now. At the start of today, it was around 60 rupees. So those call writers, they are factoring in that the 24,700 odd mark does hold out. On the downside as well, it appears right now that the 24,575 level will hold out because the premium on that strike, that's the 24,600 put, that at the start of today was close to around 40 rupees. That's totally got eaten into. So both those two. So as of now, it appears that we won't breach this 24,575 mark on the downside, and on the upside, 24,700 mark. Stocks that are in focus, well, Industars. That's one stock that has come in for some kind of unwinding of positions in today's trading session. The stock as well was lower the last time I checked. But a couple of names like Infosys, good open interest built up, stock still holding with a gain of around 1%. And after many weeks, we are seeing that the Nifty IT index, in fact, has outperformed what the Nifty has done this week. And one of the stocks contributing to those gains is Infosys, which has seen a good amount of long addition. Eternal's the other one out there that's holding strong. Remember, 3 months or so ago, you had $1 billion of selling coming in from, FIs because of the rejig. From there, there's been good amount of open interest build up. Today as well, the stock is holding strong, and there's massive build up on the open interest side, telling you there's long addition on that one. And finally, PNB Housing Finance, there is some skimming down of positions on the, on the option side. I think it has a little bit more to go, but it's very, very close to exiting the F&O ban. As we speak, around 81% of the MWPL is the open interest as a percentage of MWPL is 81%. If it breaches 80% on the downside, that's when the stock comes out of the F&O ban. So there is some shedding, but I think it has to do a little bit more work, maybe another 50,000 shares or thereabouts. Back to you.
All right, Nigel, thanks very much for that quick snapshot view on the F&O side. Max is the one we want to focus on now. Steady performance. Stock, though, is, I think, seeing a bit of a dip. Ekta is here with details. Ekta.
Well, yes, Max Healthcare is under pressure in today's trading session on the back of the margins, which came in lower than what the street had anticipated. Now, the reason why the margins were pressured is because the company's added 2 hospitals in the past 1 year, one in Dwarka, and they acquired JP hospitals last year as well. So these 2 new hospitals are operating in their first year, and the margins are at around 12.5%. So the company did indicate to us that the new hospitals have pressured margins as they are just in the first year of operations. They expect the new hospitals margins to ramp up to the existing hospitals levels soon enough. Now, in terms of the other segments of the business, such as the international revenue, they have grown over 30% this quarter and have indicated that they have in the past been growing at around 25 to 30%, and they expect to continue growing at those similar levels. Max Labs and Max Home, both those segments which the company runs, have been growing consistently as per the company, and for Max Labs, they do expect the margins to probably improve to around 17 to eventually 20% odd levels. They are interested in acquisitions, but as and when the opportunity arises. Possibly the key spanner in the works for the company this time is the 2 new hospitals with their margins possibly pressuring margins on a blended basis.
Absolutely. Ekta, thanks very much for that. Abhay Sohi is Chairman Managing Director at Max. We spoke with him. Just listen in.
In the last year alone, we've added 2 hospitals. One is Dwarka, which was a greenfield project, and which we commissioned in July. And we acquired JP Hospital in Noida. This was in October, November. So this is what I categorize as newer hospitals. So if I see existing hospitals, then you had an increase in EBITDA per bed. You had of about 7%. You had an increase in ARPOB of about 5%. There's been an expansion of margins as well from 25.8 to 26.2. But the 2 new existing hospitals are operating presently in the first year at about 12.5% EBITDA margins. And, they've sort of, as expected, would drag the overall ARPOB down, at least in the first couple of quarters. And as these ramp up, and that's exactly where the opportunity is, both the margins as well as profitability will expand from here on.
Let's hop across to Vivek. He's here to tell us about a Kotak note that's come in on GMR Airport. Vivek?
Well, that's right. A very interesting development as far as GMR Airports is concerned. So the company has gone ahead and refinanced 20% of the consolidated net debt, and this has happened at significantly lower rates. So the company has gone ahead and raised close to 5,900 crore. This is via the NCD route, and this is at a coupon rate of 10.225 to 10.425. Now, this is for a period of 18 to 36 months. The current rate at which the NCDs were being serviced was at close to 14%. So again, significant savings coming in, and what has actually prompted and aided the much lower interest rates, number one is the fact that there have been ratings upgrades that had come in, especially post the tariff revisions. So CRISIL has gone ahead and given an A+ rating as far as GMR Airport is concerned. Now, Kotak Institutional Equity says that this particular move paves the way for much higher value as well as valuations of GAL, that is GMR Airports, and also says that this enables a faster move towards adding assets and thus higher reinvestment value. So now the fair value as per Kotak increases from 101 to 104 rupees a share. Along with that, they are saying that the EBITDA run rate per quarter of GMR Airports has already reached close to 1,000 crore rupees. It came to 1,000 crore rupees in Q1. They see there are prospects of EBITDA actually increasing to 1,400 to 1,500 crore with the addition of the Delhi duty-free operations as well. They are saying they wouldn't be surprised if they see another 100 basis points reduction in interest costs a year from now on. So along with it, they're also saying that there is a possibility of another ratings upgrade that has come in as far as GMR Airports is concerned. On the back of the balance sheet strengthening, Kotak is quite positive as far as GMR Airports is concerned.
All right, Vivek, thank you very much for that. 91 on GMR as things stand right now. Amrish Baliga is with us. Amrish, good afternoon. Good to have you on the program as always. Let's just start with what you like. Uno Minda is the one stock that you've got your eyes on.
Exactly. And this is a global tier 1 manufacturer and supplier of automotive components and systems. Our product portfolio is across 25 categories, mainly automotive switches, lighting, castings, seat and acoustic. And the new segment they have got into is EV-specific products, sensors, controllers, ADAS, and blow molding products. Catering mainly to two-wheelers and passenger car segment, but now they've also shifted focus to CVs, three-wheelers, as well as off-road segment. Mainly supplying to OEMs, but the replacement market also is growing quite fast. Globally, about 75 manufacturing facilities, around 37 R&D centers. The Q1 numbers were better than expected. EBITDA margin was about 12.1%. And growth is actually seen in aftermarket, and they've also benefited from premiumization and increase in content per vehicle. So next 3 years, I'm expecting a revenue CAGR of about 15%, EBITDA CAGR of about 16%. Expected EPS of about, for FY27 is about 23. And with this, my medium-term target, so is the next 4 to 6 months target is about 1265.
Where is it trading at? Valuation, Amrish? Sorry, missed that.
See, the expected EPS is around 23. So my target price, like I said, is 1265.
Okay, all right. Amrish, request you to stay with us. Before we slip into that break, just want to pull up one stock, Hindway Homes. Just pull up, that way it's a massive move is what we're seeing on that particular stock. It's up close to around 13%. So big move on that counter as well. Well, for the time being, slip in a short break, come back. We'll continue a conversation with Amrish. We'll also get, cracking in terms of the market. Stay with us.
action.
Welcome back. Well, Amrish Baliga is still with us. Amrish, what's the view on hotel companies? Because the first quarter was a little bit softish, but every management that's coming on from Mr. Chatwal to the smaller names as well, everyone's saying their occupancy is up, ARs are moving up, and if you go anywhere for this weekend itself, it's totally chock-a-block. Do you think hotels, the best is yet to come?
I think so, because what we are seeing is average room rents, have been going up and they have stayed up. Because in the past, we have normally seen those spikes and then they would come down. But since the last 2 to 3 years, we have been seeing that the average room rents are continuing to move up, and they are in fact consolidating. And again, looking at the number of new rooms or new keys which will be coming into the market over the next at least 1.5 to 2 years, I don't see a huge supply which will actually push these rates down. So I think at least for the next 1.5 to 2 years, I see the margins improving for most of the better brands. So I think it's still time to buy and hold.
Okay, all right. What is your view on these gold finance companies? Because, if MFI loans as well are going to be in pain, the one secured lending that you're looking at is gold finance companies.
Absolutely.
And Muthoot's numbers are blockbuster.
Right.
Manappuram has got a revamp happening. So, between the two, what would you go for? The bigger one, the one that's enjoying good valuations, or the turnaround story? Or do you find some other way of playing it? I don't know, FedFina, or maybe IFL, or a couple of other names, CSB that comes to mind that has some gold portfolio?
I think, the companies, the NBFCs or banks which have a decent gold portfolio but haven't really got the valuations, like the pure gold finance companies have got. So I think one should be looking at such companies. So something like a FedFina surely should be looked at, because again, we have not seen a great performance, at least the stock performance from this NBFC. So I think one should be looking at stocks like those, because that's what I think will play out, at least going ahead. And I've been maintaining that possibly we could see pain in the retail side of lending, but when it comes to gold loans, it's secured. So from that point of view, I think it's much better than a pure retail lending portfolio.
Yeah. Do you track HBL, Amrish?
I don't track it very closely, but yes, I think the earnings were extremely good. So I think that's what is showing up.
Yeah, lots of segments, right? I mean, I think batteries, there's some defense component, industrials, electronics.
Absolutely.
Yeah, I mean,
but like I said, I've not tracked it very closely, so I really can't.
JM Financial is the other big winner. Anything here, Amrish? This week?
JM Financial, I believe it can move up some more from here, but already we've seen a decent performance. So I think the upside could be limited to about 18-20% from here.
PG Electroplast was the big casualty, 17% down this week.
Yeah, but I think this is again an opportunity after the sort of a correction which you have seen. Yes, the valuations were high, but after the sort of a correction which you have seen, I think at these levels, the worst seems to be built in. I think the downside could be about 5 to 8%. If someone can take that risk, I think it's a good time to start buying.
Okay, all right, Amrish, thanks a lot for joining in and giving us your take on the markets. Have a good evening and a rocking weekend ahead as well, a long weekend. Well, time to wind down the markets then. It was that sort of a day when the Nifty went home as flat as can be with a mild positive bias. The good news was the Nifty Bank found its form in today's trade. The Midcap index, though, was a relative underperformer with a lot of stocks actually ending in the red and the number of stocks declining were more than the number of stocks advancing. Let's tell you about some of the top winners, though. Anthem Biosciences, stock up 8%. Good move out there. Muthoot Finance, brilliant set of numbers. There's all probability there's going to be a AUM guidance revision at the end of quarter 2. The management hinted that to us. Stock goes home with gain of around 10%. Everest Kanto, stock up 14%. Rico Auto, stock up 12%. Big move out there. Bajaj Housing Finance as well. A lot of action yesterday in the SLBM market trade. The stock was up close to around 4%. Manappuram as well, their numbers weren't that great, but today it participated on the upside. So good move out there. On the flip side, You had Yatra that came in for some profit taking after seeing a 45% rally in this week itself. NMDC had an element of dividend as well, so it went ex-dividend, 1 rupee adjusted for there, but still the stock goes home with a cut of around 3%. NHPC management sounding confident about the way ahead, but that stock went home with a cut of around 3.5%. And metal sector on the whole was a little bit under the weather, so that index in fact went home with a bit of a cut in today's trading session. From the large cap names though, there were a couple of stocks that were moving on their own terms. You had Wipro that was up, Eternal that was up, and Infosys as well, doing a small ticket acquisition. The street liked it though. So by the time we wound up, the Nifty goes home with some mild gains. It'll be on the basis of averaging. So actually the Nifty will end in the green. As of now, the last tick was in the red, but otherwise it'll end with some minor gains in trade today. I'll tell you what, we'll wrap up on this edition of Closing Bell. Don't go anywhere. Editor's Roundtable waiting for you on the other side. Well, the large street snaps its 6-week losing streak. The Nifty and the Sensex gained nearly 1%, except FMCG, all sectoral indices end some gains. On the Editors Roundtable, we decode the week gone by on the large street. We put the spotlight on the IT index performance, and also we tell you all the big accidents of 2025. I'm Nigel, and with me, the editors, we have Prashant as well as Dimesh who are joining in. And we're also joined by Gautam Chowcharia, Head of Global Markets, UBS Securities, who joins in. Hi, Gautam. Always good to have you in the studio. Thanks a lot for joining in on Editors Roundtable as well. But gentlemen, how are you all feeling about the week? Looking forward to the long weekend?
Looking forward to the long weekend. I think that's the most important thing, right? And of course, the US-Russia meet, that's going to be a big trigger. And actually, if things go right, we just had one good news in terms of S&P upgrading India. And if there is some settlement with Russia and US, we probably will see a big short covering rally. FIs are 92% short.
Well, absolutely.
That's something to watch out for.
1.85 lakh contracts on the short side, 92%, the highest we've seen all the way since March 2023.
Do they know more than what anybody else know, or do they know more than what even Trump is going to do? I'm surprised, before such a big event, to have 92% short in the market when India has underperformed.
Yeah, but it was good to see that S&P upgrade that came about, right?
We should ask Gautam about.
Guys, before that, let me tell you the program tomorrow.
Yes. The calendar. Not for tomorrow, the whole...
No, the calendar for tomorrow. What's happening in Alaska. Okay. Sharad has sent this, right? He says, so they're going to have one-on-one meetings, Trump and Putin. Sensitive matters will be discussed at the summit. Wider meeting with delegations, working breakfast. By the way, this is all happening tomorrow late evening.
Okay.
So it's going to be, whatever, by the time headlines come through one way or the other, it's going to be, I guess, late evening tomorrow our time or Saturday morning. So there's some names who's going to be on the Russian side, it's going to be on the other side. Central topic is the regulation of the Ukraine crisis. There's a news conference at the end. I think that's
joint press conference.
The joint press conference.
Yes.
So, I mean, I think that is essentially why many are of the opinion that if they're going to go up to the podium and say something, I mean, so something should be done, right?
Something will come.
How is it possible that they're going to go up and say, we'll continue talking? So,
you had me there, actually, Prashant. We said, it's going to happen tomorrow. I thought you were going to tell me what you're going to be doing, but it's good you run us through that.
When Sharon sent that message, I was looking for what are they going to have for, I mean, it's such a detailed message.
But Gautam, market's in a bit of a flux right now because domestic economy is a little bit soft and we don't know what Trump is going to do next. But we just concluded the earnings season, which to many weren't as bad or not that great as well, somewhere during the, in the midline. What's your view with regard to the earnings season that went by? Was it satisfactory and you're expecting things to improve from here on?
So look, earnings season, to be frank, disappointed markets and investors at a broad level. There were a mix of positives and negatives as always. But to me, the negative surprise was basically because its economy and earnings are still reflecting the lag effect of the policy environment which we have been seeing.
Yeah.
The easing which happened a few months back from RBI, etc. Typically, monetary easing takes 6 months to play through. Typically,
yeah.
In a good times, maybe 3-4 months. So the June quarter was still premature for the easing to reflect in economic growth and earnings. But I guess markets and analysts got a little bit excited early, looking at the headline announcements, and that's where the disappointment came in. I would be worried if we don't see a pickup in the festive season, for example.
But you're expecting the double-digit earnings growth to come about and, for the year?
The base effect itself from here should make it easy, and therefore we should see double-digit at least for the remaining part of the year. Full year, we'll see where we end up. But the base effect itself makes it easy. But I think
a bit of a near-term question, very, very near-term. Actually, tomorrow morning you'll have the Prime Minister from the Red Fort, and it's a bit of a cliched question. Also, will we hear something in terms of reforms? But you would agree, right? Last few years, momentum on reforms, etc., is kind of slacked off quite a bit.
Yeah.
So, do you expect directionally, and what are the 2 or 3 things which you think, if the government talks about and gives the direction, okay, we're going to do this. It'll make a difference.
Look, when you talk to policymakers in Delhi, including meetings, etc., their stance typically is a lot of the tougher reforms out there is more at the state level rather than the central government level. They do want to or aspire to do stuff around, say, for example, judiciary and bureaucracy, etc. But those are tougher things and you can't put a timeline. Is the current global environment giving them enough of a confidence or excuse to do something more radical? We'll see. Again, we haven't picked up anything beyond what we read in media. But yeah, this is an opportunity for them to act more aggressively. I don't think this will be announced in a 15th August speech. This is more a announcement at a different press conference or a different media rather than a 15th August one.
So, Gautam, one of the anticipation has been that maybe you'll see rationalization of GST rates.
Yeah.
And that will have an impact on a lot of the sectors as well. Post Q1 earnings, in terms of micro sectors, which are the sectors that at a UBS level you guys are bullish on and betting on for the second half?
So I'll talk about the second part later, but from a GST rationalization part, you have to remember that the fiscal space is also limited.
Yeah.
Specifically with we don't know what will happen post-Trump meetings if government needs to support some of the export sectors. So I think near term, will it be in a hurry? We don't know. Again, things might change completely tomorrow or after the US-India talks. Okay. The second half, again, there are pockets which still look very interesting. In general, we are bullish consumption. Okay. And within consumption also, there are pockets which are more interesting, where there's been disruption, but we see clear bottom-up exercise by the company, both in staples as well as retail. Then at a big picture level, you saw big real estate construction activity happening over the last 2-3 years.
Yeah.
Okay. It's kind of slowing a bit, but the second order impact of that is always durables or household improvement sector. And you've seen elements of that in this quarterly season also, where household improvement numbers in select pockets are showing some uptick signs. So that could be the interesting one for the next couple of quarters. The last thing I would say at a big picture thematic, and this is not just for next 6 months, but next 3 to 5 years, in this macro uncertain environment, one of the sectors we are very, very bullish on, and we've done a detailed deep dive, is power equipment sector. Simple maths, India's power capacity addition will be 3x in the next 5 years versus last 5 years. The revenue CAGR for the power equipment sector will be 20% plus. Okay. Earnings for our coverage universe will be 45% for the next 3 years.
I saw that report, and I was very surprised to read a line on BHEL saying that BHEL profit can be 8x in the next 3-4 years. So that was a big headline for me as well, that you are so bullish on, or as a house, you are so much bullish on the power OEM.
And it's across all OEMs. I can't comment on India stocks, but thermal and renewables. And simplistically there, again, what our analyst deep dive suggests is I think market underestimates the execution capability of thermal equipment companies.
Yes.
And also overestimates how easily or quickly the supply can come in solar equipment.
I just had one question related to power, and this is something new. We don't know if your analyst has considered this, but I don't think he would have, because all this is happening now, which is normalization of India and China ties, right? If they're going to normalize and they're going to give us something, then they'd want something from us. One of the things they'd want from us is access to markets to sell their products. It's interesting Nimesh mentioned BHEL, because BHEL back in the day when it used to be Chinese import, Chinese boilers, etc., used to be a big reason for why, I mean, the entire space went south, because price points were so much lower. I don't know if we'll see a repeat of that. A lot of Chinese, especially capital goods, power equipment, etc., makes it to the market here. But is that broadly a concern at all? Have you thought of that?
It will always play at everyone's mind. Tough to predict it. But again, if you look at last 15, 20 years, when it was eased, opened up, and then it was also controlled to make sure the local industry has enough protection and support. The initial opening up also forced the incumbents to become more efficient. So that was also the case. I don't think the case exists today where there's a big efficiency gap as such. The second part is the model which is likely to happen from opening access to China, etc., is likely to be them investing here or taking stakes and providing technology. That's a more likely scenario rather than opening up the markets to imports.
Not a big risk, basically, across the board.
Very unlikely. Very unlikely.
Nigel, you're looking at the IT space?
Yeah, the IT space for this week itself, surprise, it went ahead and actually it outperformed what the Nifty has done. And that's not really been the case. Even if you look at it year to date, you compare the IT index returns, which are actually, it's down close to around 12%. The Nifty is marginally up by close to 4%, and the Nasdaq is up, close to around 20%. So tech has actually underperformed. The bulls on the street, they are saying that, the free cash flow yield is at around 3.5%, 4.5%, depending on, what flows you are factoring in. And in terms of dividend yield as well, it's at around 1.5%. So, downside is protected. But HDFC Securities, they put out this note. They are comparing the valuations of the IT index with the Nasdaq, and they're comparing the IT index with the Nifty. And if they're comparing, the discount that the IT index valuations are trading at in comparison to the Nasdaq, That's widened to around 20%. If you look at it in the last few years, the average has been it trades at a discount of around 15%. Though at its peak in 2023, the discount went as high as around 30%, and from there, tech made a bit of a bottom. So that's one point that they are talking about, that as of now, the discount to the Nasdaq valuations is at around 20%, which is higher than what we've seen on average. The other point they're making is the premium that tech is trading at in comparison to the Nifty, that's come down as well drastically. It's come down to around 15% approximately, which is a sharp discount in comparison to the averages that we have seen of around 23 to around 25%. And that's why they're saying maybe there's some kind of optimism that maybe tech is making a bottom and gradually forming a bottom. What do you make of it, Gautam? You're in that camp, or do you think there are better, fancier sectors to move to? Or do you think that valuation argument where you're looking at the dividend yield, you're looking at the free cash flow yield, you're saying they've already got hammered out of shape, the street already knows that they're not going to grow much. Would you take comfort out there? You're like, no.
So I would argue it's a bit differently. Okay. Those arguments always hold and have always been supportive of IT industry in terms of cash flow yields or relative valuations. And in today's market environment, relative valuation always works rather than absolute, much more than absolute. But for IT in India, I think tactically, our analysts think there is room for select stocks to see positive surprises in terms of order flow versus the expectations which are built in, but select stocks. At a broader sector level, our view is more neutralish.
Neutral.
Yeah.
Okay.
Can I just use the IT question, but slightly differently? In your conversations with global funds, etc., and this is something we were discussing earlier, the lack of core AI kind of stocks in India, does that come up, and maybe is that a reason for a bit of an underperformance here as well? I mean, if this is a technology which is really, I mean, all technologies sound very big and large when they come for the first time, but this apparently is like going to fundamentally alter things in a very basic level.
It absolutely comes up very commonly, and I think the debates around this has only picked up rather than died down. It picked up a couple of years back, and then now in the last 3 to 6 months it's picked up again as to what and how it will impact them. I think the broader view is that in the near term, for the foreseeable future, it may not be that disruptive because they would get more business out of it, because AI, for it to be implemented across all kinds of businesses, will take years, won't happen overnight. And we need IT services companies to drive that implementation. It may not be as labor or employment intensive as the historical model has been, but it still will drive revenues. It will still give business to them.
But we're talking about using it and to make business across industries efficient.
Yeah.
But I'm talking about creating AI technologies, which is where the value...
So look, Indian IT services have never been product companies. Okay. Forget AI.
But now is the time more than any, right?
So to expect or think that they will suddenly overnight become productive companies, like, can they invest, make some acquisitions? Possibly. But to expect them to overnight change their DNA into an AI...
Overnight mat karo, 6-7 saal.
You should ask them. You should ask them. But these discussions have happened, including with the top management of the IT companies and investors. These discussions keep happening.
Okay. All right, Gautam, I'm going to request you to just hold that thought. I'll tell you what, we're going to slip into a short break. You come back. Nimish is going to put together a very, very interesting piece. 2025 has seen accidents in more than 15 companies where stocks have fallen 15 to 30% in a single day. Most of them have struggled to reclaim their previous highs. We get into that piece on the other side.
Well, 2025 has been a tough year so far. The index returns have been just 4%, but we've seen many accidents since the beginning of the year. In fact, there are more than 15 companies which have seen single-day accidents where the stocks have fallen anywhere between 15 to 30%. So that's what a lot of the companies have done in this year. So let me start with the first stock. The first big accident of the recent accident has been PG Electroplast. In a single day on August 8th, the stock fell 20%, and after that, it's fallen another 18%. So that's the kind of fall we've seen in PG Electroplast. And the reason for the fall was the sharp cut in the guidance revenue and the profit guidance by the company. They've cut the revenue guidance growth to 30%, to 17-19% from 30%, and they've cut the profit growth to 3 to 7% versus 39%. And that's the reason why you've seen a very sharp fall. And to add to it, the promoters sold 5.5% stake on May 27th, and after that, you've seen the stock deteriorating. So that is one big accident which very recently happened and had a bit of a concern with the investors as well. So this was one big accident of this year. The second big stock was PNB Housing. On a single day on August 1st, the stock corrected 18%, and after that, it has fallen another 5%. And the reason was that the MD and CEO Girish has announced that he's going to quit the company, and the reason for such a sharp reaction was under his leadership, in the last 3-4 years, the stock had seen a 3.2%, almost 3x returns in terms of stock price. So that is the reason why you saw a very sharp correction in PNB Housing as well. The other big accident of this year was IEX, Indian Energy Exchange. On a single day on July 24th, the stock corrected 30-odd%. I've seen a bit of a recovery, but still the recovery has just been 7% for a stock like IEX. And the reason for the fall was the regulator, CERC, has announced market coupling, and that's been a big disappointment for IEX. In fact, Bernstein gone ahead and has downgraded the stock to an underperform with a target price of 99. So that was again a very big accident of this year. The other big notable name in that list is IDFC First Bank. A single day fall of 27% on March 11th. And after that, while the stock has seen a bit of a recovery, but it actually hit a low as well of 606 intraday after that big thing. And the reason? Well, the reason was very clear. The company announced that they've seen a big accounting lapse and an accounting loss of nearly 1580 crores, and that led to a big fall. There was a change of management as well. Finally, Rajiv Anand has been appointed as a new MD and CEO. So need to see whether we see a bit of a recovery after he joining in. So that's another accident. The other big name, an MNC name like a Whirlpool, saw a single day fall of 20% on Jan 30th. Well, the stock has recovered sharply, but it actually hit a very low of nearly 880 odd levels, and since then it's seen a recovery. Having said that, the stock is still below the Jan 30 level, so it's still not recovered from where it has fallen. The reason for the fall was that the parent company came out and said that they're going to trim their holding in the India subsidiary to 20% from 51%. So they're going to sell 31%, and that's likely before the end of this year. So you will see that large block in that company also. The other big accident was Cyient. Again, Jan 24th, a single day fall of 23%, and after that the stock has fallen another 13%. And here the big reason, again the reason was a sharp cut in the guidance, and then they announced that the MD and CEO of the company, Karthikeyan, is leaving the company as well. So that led to a big re-rating in Cyient as well. So these are the few examples. There are 15 odd companies, but these are a few examples. There is a cliche in the market that never catch a falling knife. If you look at this data, it turns out to be proof that you should never try to catch a falling knife. But 25 has been a challenging year, and we've seen very large, big accidents in individual names falling 15-30%. Gautam, your take, we've seen very sharp corrections in many of the individual names that I pointed out. Typically, a retail investor looks to buy that falling knife. We've seen it in the past, it's been a bad experience. What is your general advice? Should one look into, or is there any opportunity in any of the names that I spoke about?
I can't talk about names, but generally speaking, it boils down to the earnings outlook.
Sure. No, but I know, for example, say like an IndusInd Bank or a PNB Housing, it has fallen below one-time book now. There is a lot of argument that maybe this is the level to go and buy into. But at least data suggests that the pullbacks are very, very, very shallow. I mean, even if they pull back, they just gave up. So
look, if we go by history, the broad experience is when you see such sharp corrections in a day or over a prolonged period, it also takes time to come back.
Yeah.
It doesn't happen overnight. In general, specific individual companies, yeah, but in general, it takes time.
Okay. But within the financials, what's your take now? Because I spoke about a couple of names, but in general, this quarter was more of a disappointment, right, in terms of credit cost. A lot of companies surprised, and we saw very sharp corrections there. But as you said, you could probably will see that RBI effect in the second half. What's the broad call in financials?
So similar. So I think the RBI easing effect should show up in financials. I don't think that view has changed from us for individual stock level or various segments of banking, whether it's the NBFCs or the private banks, the view still remains same. Again, I would say it's been a more mixed bag rather than a broad disappointment. Some of the market leaders did deliver good numbers in both growth as well as in NPL names, while pockets like MFI, etc., still were a mixed bag or more disappointing. But again, the broad view still remains that we will see as the cycle turning second half this year.
And gold financiers, anything out there?
We don't have coverage, but again, you saw the numbers.
Brilliant.
It tells you a lot, yeah.
Nimesh, by the way, if I ask you, out of the list that you put out, which do you think will come back the fastest?
So, it's difficult to say, but Prashant, looking at something like a PNB housing, I mean, fair that, the MD had seen a big rating after rejoining in. But I'm sure they're going to get a new CEO, and that can come very soon. Once there is a credible name which comes in, I mean, at least Koshi has gone on record saying that the books are clean, the balance sheet is fine, there is no big concern about the book as well. So
actually, that's what I was thinking. Two of these names, right, PNB and IndusInd,
it
ties in to another theme which you've done on this show earlier, which is management changes.
Generally, management change generally leads to a re-rating.
So IndusInd Bank has got one, Rajiv Anand, and I think PNB will get
somebody. It's a hope that they will get somebody, right? So,
the others were IEX and...
so IEX was more of a structural story.
Course,
so
yes.
there is no change of guard or anything of that sort. IEX was one. PG Letter Plus was another big thing. But again, even in PG, the feedback that I got is it's one summer. It doesn't. We should not play out like a big theme throughout.
And we spoke with them. I mean, they said by October, November, the inventory should be normalized.
This year is what? It's half, right, from the top.
Yeah, it's half.
And everyone's talking about that. But in the last 5 years,
last 5 years is up
10x.
20x.
Yeah, 10,800%. So people are forgetting that the stock went up 10,000%.
Exactly, and valuations, right?
Yeah.
What you're paying for.
Absolutely.
So, any such auction, you were going to see a disappointment. So that's what.
All right, Gautam. Thanks a lot for coming down on Editors Roundtable. And
thanks very
gentlemen.
much.
Thank you.
Well, on that note, we'll wrap up on this edition of Editors Roundtable. You stay tuned. More news and updates coming up on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Global ratings agency S&P upgrades India's sovereign credit rating to BBB with a stable outlook. S&P says the impact of higher US tariffs will be manageable, expects more fiscal consolidation as it believes growth is well on track. The Sensex and the Nifty snap a 6-week losing streak despite a flat close on Friday. All sectoral indices gained this week, barring FMCG. 38 out of the 50 Nifty stocks end in the green. President Trump warns Russia's President Putin of severe consequences if he does not agree to a ceasefire in Ukraine ahead of the Friday summit in Alaska. Ukraine's Zelensky meets British Prime Minister Keir Starmer in London as EU leaders urge Trump not to cede territory to Russia. India is fully engaged with the US on trade negotiations. Commerce Ministry says talks are on at different levels with less than 2 weeks to go for the 50% tariffs to kick in. India and China speed up efforts to rebuild bilateral ties. Bloomberg reports both nations are in talks to reopen border trade. India's Commerce Ministry says trade development is moving positively with growth in exports and imports. ICICI Bank reduces the minimum balance requirement for savings accounts from 50,000 rupees to 15,000 rupees for urban areas after a backlash. The limits for semi-urban and rural areas also been cut.
If I have to have a bed in my house in where I stay with my father, then I have to dream to be in the top 2, and we all will dream to be in the top 2 and to build this company.
But Jindal reiterates the ambition to climb the pecking order as JSW Cement lists on Dalal Street. Ends the first session with minor cuts. Shares of more than 15 companies have suffered a single-day decline of more than 15% so far in 2025. CNBC-TV18 analyzes a majority of these stocks, including IndusInd Bank and PNB Housing, yet to reclaim lost ground. Election Commission admits 65 lakh names have been removed from the voter list in Bihar. The Supreme Court directs the poll body to publish the names on the website in a searchable format. The Apex Court says citizens should not be at the mercy of block-level officers. At least 12 people feared dead after flash floods in Jammu and Kashmir's Kishtwar district. Heavy rains also lashed Delhi, disrupting road, rail and air traffic. Well, let's go straight to the top story this evening. Global ratings agency S&P has upgraded India's sovereign credit rating to BBB with a stable outlook. The credit ratings agency has said that the impact of higher US tariffs will be, and I quote, manageable. It also expects more fiscal consolidation as it believes growth is on track. Ritu's here with more from S&P. Finally, an upgrade coming in there from S&P. Ritu, take us through the history of how India does and how it compares to Moody's and Fitch when we talk about S&P's outlook.
Well, Shireen, it is a landmark move for India's economic story. S&P upgrading our sovereign credit rating to BBB from BBB minus with a stable outlook. Keep in mind, this is India's first rating upgrade by S&P in nearly 18 years, and it signals a stronger vote of confidence in the nation's economic and fiscal trajectory. Now, for perspective, S&P's new rating is the second lowest investment grade rating. It is just one notch above Fitch's BBB minus and Moody's equivalent Baa3, both of which again sit at the lowest investment grade level. Now, if you look back at India's rating history, S&P first gave India a rating in 1990, that is before the reforms, and that was at BBB. The 1990s, of course, saw some setbacks. The rating slipped to BBB minus in 1991, then again to BB plus the same year, down to BB in 1998. From there, we climbed back all the way to BBB minus by 2007, which is where our rating has now stayed until the long-awaited upgrade today. We're essentially, in a sense, Shireen, back to where we were in 1990. Now, S&P says the upgrade reflects a buoyant economic growth, improved inflation control, and a clear commitment to fiscal consolidation. India, it says, has staged a remarkable comeback from the pandemic, clocking an average 8.8% real GDP growth from FY22 to 24, the fastest in Asia Pacific, and it is now projected to grow around 6.8% annually in the next 3 years. Public investment is a key driver. Central government capex spending is set to hit 3.1% of GDP next year, which is more than 50% higher than a decade ago. And at the same time, fiscal deficit is projected to narrow. Debt to GDP could fall from 83% to 78% by 2029. Now, what does it mean in terms of immediate benefits for India? First and foremost, it is going to bring down our cost of borrowing. That is very important for the country. And of course, it will trickle down, the corporates borrowing overseas as well. It boosts the confidence in our long-term growth story because, this is a long overdue acknowledgement of India's stable macroeconomic fundamentals, whether you look at GDP growth or you look at the fiscal consolidation and even the inflation control. And now we have to see if other rating agencies will follow suit.
Yes, that is the big question. Will the others follow suit? Ritu, thanks very much for joining us. And to take this conversation forward, we're joined by Yifan Vuo, Director, Sovereign and International Public Finance Ratings at S&P Global. Yifan, many thanks for joining us on CNBC-TV18. The very first question to you, it's taken 18 years for India to get this ratings upgrade. Why that long, Yifan?
Hi, Shireen. Thank you for having me today. Yeah, I mean, if you look at India's rating trajectory over the past 18 years, as you mentioned, there's been ups and downs. But I think for us, we really take a much longer term, view to this sort of things. The outlook has changed a couple of times, but I think this time round, if we've been recognizing the strong efforts that the government has put into economic reforms, at the same time driving growth, at the same time also allocating a lot of the spendings towards infrastructure as well. And all this has helped to really boost economic growth in the last few years. And we are starting to see a lot of this economic growth numbers flowing on into credit metrics and helping to paint a much better trajectory going forward. And that's the reason why we have acted on the positive outlook, which we started last year, and acted upon it this year to upgrade India to a BBB flat.
Well, Yifan, you talked about the macroeconomic stability. What is it that you like the most about what India has been able to do in terms of infrastructure spending, in terms of inflation control, and so on and so forth? What about the macros do you find most comfort and confidence in?
Yeah, you have touched on a very important point for us, which is the growth story, right? It's been very stable in terms of growth. India has been through many cycles, up and down, but throughout it all, I think the government has done very well to maneuver the economy, right? I think the sheer size of the economy, the very healthy growth, the strong domestic consumption, all these are factors to overall help to build the story as well. As for infrastructure investment, I think that's very admirable for the government in terms of how they have been, as a share of the budget, allocating less towards subsidies, but putting it towards more productive use like infrastructure investment. And as these infrastructure investments come forth and bear fruit, we do believe that it can actually help to lift India up to an even higher economic trajectory versus what it's seeing right now.
Right. I want to address the issue of the tariffs that the U.S. administration has imposed on India, 25% currently, with the threat of an additional 25% by the 27th of August, if, of course, there is some sort of a middle ground negotiation achieved between both sides. If it were to be 50%, you still believe that that will be manageable, in your words. Can you explain to us what the impact is likely to be and why you believe that India should be able to ride through this?
Yeah, hey, thanks for raising that question. I think for us, if you see India, it's an economy that's not extremely trade oriented, right? If you look at the exports to GDP in terms of exports to the US, it's only about 2 or 2.2% of Indian exports goes to the US. And once you factor the fact that there are sectorial exemptions on certain products like pharmaceuticals and also consumer electronics, ultimately the exposure to the US in terms of GDP of the exports is only about 1.1%. So therefore, even with a 50% tariff, if it was to go to that high, we don't think it will overly impact the growth story. A lot of India's growth is driven by domestic consumption. And it could have some sort of a short-term impact on growth, but that impact we expect it to be small and manageable. But over the longer term, we do think that the long-term economic growth prospects of India remains very, very strong.
Well, Yifan, this is Ritu just stepping in as well. In terms of specific fiscal, milestones or growth numbers you'd look at, what are the, specific steps that India would have to undertake or targets India would have to achieve to consider the next upgrade now to BBB+?
Yeah, I think we've pointed out in our outlook statement of what it would take to get to the next level, right? I think one important thing is further fiscal consolidation, right? That's one of the factors that drove the current upgrade, which is we see a very strong political commitment from the government to consolidate the fiscal balance. I think going forward, the state government finances will be something that we'll be watching out for. We recognize that the central government, the deficit has been declining quite quickly. But if you look at state government deficits, they have not been declining as quick as the central government. And in our rating methodology, when we look at the fiscal deficits, we look at it from a general government's perspective, which is the central plus the states. So I think if the state government is able to consolidate even quicker, I think that could help to bring about further upward rating pressure.
Well, quickly, how should we reconcile S&P's rating upgrade with that of, with India's rating where as far as Fitch and Moody's are concerned? I mean, what is the specific metric you looked at where India stood out? You think, the other rating agencies have not looked at?
Yeah, unfortunately, I won't be able to comment on the rating methodology of other rating agencies. But what I can speak about is to really focus on one of the key strengths that we look at for India, right? I think for us, one of the important strength that India has, which is also a very large weightage in our rating criteria, is actually on the external position. India scores very well in that. Current account deficits has been very small. It's been covered by FDI flows in the past and portfolio equity flows as well. And the central bank has accumulated a high level of reserves. And overall, one important thing also is the government doesn't borrow in foreign currency. So all in, you're looking at an economy with a very high level of net external asset position. So that actually places India very strongly in our external scoring. Fiscal, as you know, the scoring is still quite weak. Monetary assessment is one thing that we also look at as well. I think, as you also mentioned earlier about the inflation coming under control, I think that also signals monetary policy getting better in India, which is more conducive to strengthening transmission mechanism from the RBI. The very high growth that India enjoys is also something that we also take into account into our consideration. If you look at India's high growth numbers, it also signals that it's able to have that strong flow-on impact into debt and also towards fiscal numbers as well. So all this help to moderate the fact that despite still wide deficits, that the GDP is still coming down gradually because of strong nominal growth.
Well, you talked about the factors that have helped in S&P moving as far as India's outlook is concerned, and with that upgrade coming in. If I were to ask you about some of the risks that you foresee, as we talk about the growth story as well, Yifan, what would be some of the key risks that you would watch for?
So I think key risk is, of course, if the government starts to not focus so much on fiscal consolidation. If the government starts to, have decided that they need to spend a lot more, I think that could be something that we will watch out for. But one thing also is the quality of spending of the government. That's something that we've mentioned in our reports quite a few times about how we think that has been improving quite a lot in the last few years as they tilt more and more towards infrastructure investment. So let's say if deficit starts to get even wider, and at the same time the quality of government spending actually reduces. They start to spend less on infrastructure instead to put more into subsidies and things like that. I think that could be a sign that this could be a sign that this could be erosion of political commitment to push through reforms. I think that could be a sign for us potentially to be a downward pressure on the rating.
Well, so far, at least S&P upgrading India's credit rating to BBB from BBB-. It's taken 18 years. We hope it won't take another 18 for the next move, which hopefully will be moving up the investment grade. Thanks very much, Yifan, for joining us here on CNBC-TV18. That's S&P with its outlook on India and why they have upgraded India's credit rating. We will head into a short break, but up next, India is fully engaged with the US on trade negotiations. Commerce Ministry says talks are taking place at different levels with less than 2 weeks to go for the 50% tariffs to kick in. That and more when we return. Well, let's talk about the market action for the day. The Sensex and the Nifty closing flat with financial stocks lending some support. Midcaps underperformed today. The market breath in favour of the declining stocks. For the week, the market snapping its 6-week losing streak. That's the Nifty absolutely flat and the Sensex as well. For the week, the Nifty closing 1% higher. Similar story for the Sensex and the Nifty Bank higher by about 0.5% or so. Remember, it is a truncated week as we are closed for Independence Day tomorrow. The other big story, India's Commerce Ministry says it is fully engaged with the US on trade negotiations. The ministry official said talks are taking place at different levels. Now, this comes with less than 2 weeks to go for the 50% tariffs to kick in. An External Affairs Ministry spokesperson says India is hopeful the partnership with the US will continue to grow based on mutual respect and shared interests.
हमारे दोनों देशों के रिश्ते एक कॉम्प्रिहेंसिव स्ट्रेटेजिक पार्टनरशिप है। जैसा कि आप जानते हैं, ये जो हमारे रिश्ते हैं, द्विपक्षीय रिश्ते, ये आपसी इंटरेस्ट यानी कि शेयर्ड इंटरेस्ट जो हैं दोनों देशों के लोकतांत्रिक मूल्यों और हमारे दोनों देशों के लोगों के बीच में जो परस्पर बहुत मजबूत रिश्ते हैं उन पर आधारित है। ये रिश्ते कई एक ट्रांजिशन और चैलेंजेस को इन्होंने देखा है, उसका सामना किया है। अभी हमारा उद्देश्य है कि हम हमारी जो सब्सटेंटिव एजेंडा है दोनों देशों के बीच में, उस पर हम अपने को केंद्रित रखें और ये हमारा मानना है और आशा है कि ये साझेदारी आने वाले दिनों में म्यूचुअल रिस्पेक्ट और शेयर्ड इंटरेस्ट के बेसिस पे ये आगे बढ़ती रहेगी।
Meanwhile, India and China are in talks to resume border trade after 5 years. As per Bloomberg, both countries have proposed to restart trade via designated points on the shared border. China's Foreign Minister Wang Yi will be travelling to New Delhi next week in a bid to further ease tensions. He's scheduled to hold talks with Foreign Minister S. Jaishankar as well as the NSA Ajit Doval. India's Commerce Ministry has said that trade developments with China are moving positively with growth in both exports and imports. US President Trump has warned Russian President Vladimir Putin of very severe consequences if Russia refuses to agree to a ceasefire with Ukraine. Now, the warning comes ahead of their first meeting in 6 years, which is set to take place in Alaska. Trump made these remarks after conducting a virtual meeting with European leaders, including Ukraine's President Zelensky. European leaders urging President Trump to ensure that any peace agreement does not sideline Kyiv. Take a look.
Will Russia face any consequences if Vladimir Putin does not agree to stop the war after your meeting on Friday?
Yes, they will. Yeah.
What will the consequences
there will be?
Sanctions, tariffs?
There will be, I don't have to say, there will be very severe consequences.
There will be consequences if Russia doesn't agree to a ceasefire. That's President Trump. Remember, there will be a press conference, a joint press conference between President Trump and Vladimir Putin after that meeting that takes place in Alaska. And that'll be sometime late Friday night, early morning. And of course, we'll be tracking those developments right here on CNBC-TV18. The big story from the Supreme Court. The Election Commission has admitted that 65 lakh names have been removed from the voter list in Bihar. The Supreme Court has directed the Election Commission to publish the names on the website in a searchable format. The top court has said that citizens should not be at the mercy of block-level officers. Ashmit joins us now with more details. Ashmit, a breakthrough there for the petitioners, relief coming in for the petitioners. Take us through what the Supreme Court has said and where does this now leave the Election Commission's electoral revision exercise for Bihar?
Well, indeed, an important breakthrough. This was the very relief that a number of petitioners had been asking for, that the exclusions that have been made, at least let's put them on record, let's make them public, let's give the public an opportunity to verify for themselves what their current status is as a voter on the election card, on the electoral rolls. Now, bear in mind, the Election Commission began its arguments today where it clarified that they began with 7.89 crore voters in the state of Bihar. That was whittled down to 7.24 crores, thereby meaning that 65 lakh names were reduced. When being asked as to why these exclusions were made, the Election Commission responded by saying that there were instances like in the case of 22 lakh names that were removed on accounts of deaths that were taken place. Now, petitioners have been arguing at length how there are a number of cases where dead people have been shown to be alive and alive people have been shown to be dead. And this was something that was cited by the Supreme Court as well, which raised questions about the quality of decisions that have been made at the block level, officer level for exclusions that have been made. So to that end, the question that was asked by the Supreme Court is why not have more transparency? Why not have the Election Commission publish the data in a searchable format that will allow the voters of Bihar to search online for themselves to be able to see whether their name is on the list or if it's off the list, and if it's off the list, what needs to be done to bring it back online. So towards that end, the Supreme Court giving a very specific direction that 3 days' time is what the Election Commission has to publish the data of 65 lakhs names that have been excluded To publish that on the website has to be done in a searchable format where you and I, as a voter from Bihar, can search online. Not just that, even the block level officers will be required to put up this data at their respective offices, again giving voters a chance for verification. But that's not all. What's another important aspect as a part of today's hearing is that the Supreme Court, on the third time, they have nudged the Election Commission to go ahead and to accept Aadhaar. Election Commission so far has been refusing to accept Aadhaar as a means of verification. Today, for the third time, the Supreme Court has asked the Election Commission to allow for the use of Aadhaar for verification of electoral rolls.
All right. Many thanks, Ashmit, for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC-TV18. Stay tuned. We're back in a moment.
Hello and welcome. You're watching Global Lens. I'm Parikshit Luthra. These are the top global headlines. India continues negotiations with US lawmakers with 2 weeks to go for the 50% tariff to kick in. India's US ambassador speaks to Democratic senators Richard Blumenthal after speaking with Republican Senator Lindsey Graham. Both had sponsored a legislation proposing higher tariffs on India for buying Russian oil. European leaders hold talks with US President Trump ahead of his summit with Russia's Putin. Ukraine's Zelensky, along with leaders from Britain, France and Germany, make a final diplomatic push to avoid ceding territory to Russia. United States applauds Pakistan on combating terrorism and promises to deepen bilateral cooperation. The joint statement comes nearly 4 months after the deadly terror attack in Pahalgam, which killed 26 people. US President Trump is considering 11 candidates to replace Jerome Powell as Fed chair when his term expires in May next year. These include at least 6 current or former Fed officials, executives at Jefferies, BlackRock, among others. It's green across the screen for markets around the world. Asian markets ended higher, tracking gains on Wall Street. Japan's Nikkei hit fresh record highs. China's Shanghai, Korea's Kospi and Hong Kong's Hang Seng all clocked gains. Nifty and Sensex ended at day's high, with the Nifty reclaiming 24,600, S&P 500 and Nasdaq hitting fresh record highs, adding to its recent momentum as expectations for lower US Federal Reserve rates continue driving the major indexes to all-time highs. European markets also gained. Our top focus: amidst President Trump's trade war, India and China are speeding up efforts to rebuild bilateral ties. China's Foreign Minister Wang Yi is set to visit India next week and hold talks with National Security Advisor Ajit Doval. This will be a meeting of huge geopolitical significance. India and Chinese ties had broken down after the border clashes in Galwan in June 2020. But there is an expectation that from September this year, there will be some stability and predictability in ties. Prime Minister Narendra Modi is set to visit China for the SCO summit in Tianjin from 31st August to 1st of September. This will be Prime Minister's first visit to China in 7 years. Sources say India's objective would be to instill positivity in the relationship. We have also been told by sources that the India-China relationship and the upcoming meeting between Modi and Xi should not be seen through the prism of an India-US relationship. While India and US relations have taken a rough turn recently, India and China have been working on improving ties for the past few years, and more so after October 2024, when Prime Minister Modi met President Xi Jinping on the sidelines of the BRICS summit in Kazan, Russia. Both leaders had agreed to work towards a peaceful and stable India-China relationship, and they had also decided to not allow differences on the boundary issue to disturb peace and tranquility at the LAC. Since then, there have been multiple meetings at the level of foreign secretaries, NSAs, defense ministers and the external affairs minister. Sources say that the consensus reached between Modi and Xi is now being given shape to ahead of the SCO summit in Tianjin. India has restarted issuing visas for Chinese nationals after 5 years. Final timelines for resumption of direct air flights between India and China is expected soon. India and China had earlier agreed in principle to resume direct flights. Reports say China has eased curbs on urea shipments to India, and the Indian industry hopes China will ease supply of specialty fertilizers. China's restrictions on rare earth magnets have created a crisis for the Indian industry, and the automotive industry is hoping that a positive meeting between Modi and Xi will help ease high rare earth magnet exports to India. India has also been clearing Chinese JVs with Indian companies wherever a technology partner is needed for Indian manufacturing. Also, in a first since 2021, an Indian vessel with 496,000 barrels of ultra-low sulfur diesel has been shipped to China. PM Modi is expected to have a one-on-one meeting on the sidelines of the SCO summit. The meeting will definitely set a roadmap for ties for the next few years. So what next now? And will this meeting between PM and President Xi at SCO stabilize the relationship? Joining me now to discuss this further is Sean Rain, founder, China Market Research Group. He's joining us from Texas this evening. Thank you very much, Sean, for joining us. Chinese Foreign Minister Wang Yi is visiting India next week, specifically on the 18th of August. He will be holding talks with the Indian National Security Advisor. I'm guessing this is to lay the groundwork for the SCO summit, where the Prime Minister is going, and he will have a meeting with Xi Jinping on the sidelines. What do you think will be the expectations of China from the meeting between the two leaders?
Well, it's great to be here. I think we're starting to see some green shoots or light at the end of the tunnel, a very dark tunnel over the last 5 years where China and India relations weren't great. So I think Wang Yi is visiting India to make sure that when Modi visits the SCIO summit in Tianjin, that everyone knows we're looking for some deals between China and India. It might be an easing of visas. It might be an easing of direct flights. It might be an easing of export bans on rare earths. Whatever it is, I think Wang Yi and the National Security Advisor for India have to sort of come up with an idea of what is going to be on the agenda so that both Modi and President Xi can announce some wins at the end of August, early September. Now, the last time I was on CNBC-18, I said to my fellow Indian friends, we got to be careful. The United States is going to look to contain India's growth, and India should move closer towards China's economic orbit. I got heavily criticized after our last interview on Indian Twitter. People said, no, we can't trust the Chinese. We have to get closer to the Americans. But look what's happened in the last month. Trump is now threatening 50% tariffs on India. I doubt it'll be that high. But it's clear that Trump does not view Modi and India as a real friend of the United States. I don't think he views any country as a friend right now. He's very almost narcissistic, maybe he is narcissistic, trying to extract the best deal for the US and most importantly for America. So it's key for India is that India needs to fix its geopolitics, get closer to China.
Right. You're saying that India should pursue closer ties with China. Sean, at the same time, India and China have had a difficult and complicated relationship historically. You cannot call this a friendly relationship or even allies. We are neighbors who have been managing their relationship over the past few decades. We are closely interconnected through global value chains and supply chains of critical components. One issue which has been an irritant in ties from the Chinese side is the fact that India has put restrictions on Chinese investments, and all Chinese investments into Indian companies have to be cleared by the Indian government. This has been happening, but on a case-by-case basis. Do you think somewhere Xi Jinping, in this meeting with Prime Minister, may seek more access for Chinese companies, more ease of doing business for Chinese investors?
Yeah, so that's a great point. Chinese companies are hitting a wall, okay? You've got great ones like BYD or Xiaomi or Huawei in the tech space. But because of national security concerns, and I think frankly racism and bigotry, they're running into a lot of barriers to entry in the United States, a lot of barriers to entry in Europe. So for Chinese companies to grow, the best place for them is India. Because as you and I have talked about in the past, India should and will be a global superpower in the coming decades. So the best place for Chinese companies to expand, offset the geopolitical tensions with the Western world is to invest in India. But unfortunately, Modi hasn't made it easy for Chinese companies to invest. Obviously, TikTok has been banned. Other companies like Xiaomi have come under tax investigations. So Chinese companies right now are scared to invest in India, but they want to invest in India. What I hope Modi and Xi can come to is some sort of an agreement where China sends magnets, sends batteries, sends rare earths, and things that are needed by India and gets rid of export controls and barriers. And then on the other hand, India welcomes investment from China. China needs it, and right now, India needs it. Because you're not going to see Apple and other major companies from the United States investing and expanding operations in India anytime soon because they're worried that Trump is going to attack them. The way that Trump has attacked AMD or NVIDIA for investing in China. Right now they have to pay 15% of their revenues in China back to the United States. So a lot of companies are going to be hesitant to expand in India from the United States. Right now, both China have to say, you know what, let's forget some of the tension over the last couple decades. It's stupid. They're fighting over some rocks. I don't really quite understand why there's so much tension between the two countries. Both countries would benefit from more trade because both countries are going to be contained or try to be contained by the United States over the coming decades.
Right. I would also like to ask you about the rare earth magnet issue. China has started easing curbs on rare earth magnet exports for US and Europe, but not for India. There is an expectation in the Indian industry. The government has not said so. We would like to keep the expectations from the meeting between Modi and Xi slightly low. But what do you think could be the trade-off between India and China for letting those rare earth magnets go to India?
So I think that magnets, rare earths from China to India are going to be eased. It might not happen, on September 1st, September 2nd. It might be over the next 3 to 6 months. But it's very clear that we're setting the stage with Wang Yi visiting, that there's going to be an easing of the rare earth and magnet export controls to India. Basically, China hasn't done it yet with India because they're looking to get some leverage and they're looking to get some deals coming out of India. The Chinese have had to do it with the United States because they were worried about having the 100 and whatever % tariffs into the United States. So this was their carrot. They said to Trump, they said to Scotty Bessent, the Treasury Secretary, and Howie Lutnick, that we'll continue to export rare earths, but you need to reduce tariffs. Right now, India doesn't have leverage over China. And that's why China has been waiting to ease the export controls to get a better deal for, again, like you and I just discussed, potential investment for companies like Xiaomi or Huawei into India and make billion-dollar investments.
Right. I would also like to ask you, what would be the larger expectation from China in terms of balancing this partnership? We have a boundary dispute which has not yet been resolved. We've reduced the concentration of troops in certain areas. We're not in an eyeball-to-eyeball confrontation, which we were in 2020 after the border clashes. But still, the relations remain tense. What do you think will be the next steps in stabilizing the relationship? The reason why I asked this, because both leaders set the ball rolling in October last year when they met in Kazan in Russia during the BRICS summit. And there was a consensus to try and re-engage and put the relationship back on track.
Yeah, so they couldn't do it that much after last October, and that's because of the Trump factor. Nobody knew who was going to win the presidency in America, whether it was going to be Biden or Kamala Harris or Trump, and nobody knew how Trump was going to react towards both countries, right? You saw Modi made a beeline towards Washington, D.C., and basically had a love affair with Trump and saying, we're great friends. But it's clear that India and America are not great friends under the Trump administration. So I think, Modi needs to be a little bit more realistic. I've never understood his geopolitics. He doesn't get close to the countries that I think he should get close to. He creates enemies with countries that I don't think he should. I think Modi needs to say, you know what, let's be a lot more pragmatic. If we're going to continue to do oil trade with Russia, if we're still going to be concerned about Pakistan, and Pakistan is getting closer to the United States right now, that India really has no choice but to get closer to China. I would like to see some initial first steps. How ridiculous is it that the two most populous countries in the world that share a border, that are going to be the global superpowers in the future, don't have direct flights? Both countries are shooting themselves in the foot by not saying we need to have direct flights. Now, from the Chinese side, the Chinese feel that they've been asking for direct flights ever since COVID ended, and that the real barrier is Modi. So Modi, in my mind, has to be a little bit more pragmatic and, say, let's be less strongman and let's make an olive branch to China by having those direct flights, ending the tax investigations, and let's stop all the stupid banning of Chinese companies like TikTok and other apps on national security grounds. Because right now, let's be clear, China will benefit from trade with India, but right now, Modi and India needs China more than China needs India.
All right. Thank you very much, Sean Rain, for joining us on the program. Moving on, India has begun an outreach to mitigate trade challenges ahead of the imposition of additional 25% tariffs by the US. A special discussion on the other side. Welcome back. You're watching Global Lens. India has begun an outreach to mitigate trade challenges ahead of the imposition of additional 25% tariffs. India's ambassador to US, Vinay Quatra, spoke to Democrat Senator Richard Blumenthal and shared the country's perspective on securing energy needs. He highlighted the importance of growing India-US energy ties. He has also reached out to Democrat Senator Chris Van Hollen. This comes days after Quatra spoke to Republican Senator Lindsey Graham and discussed the same. This also comes ahead of a meeting between US President Donald Trump and Russian President Vladimir Putin. Blumenthal and Graham were leading co-sponsors of a bipartisan bill to impose additional sanctions on Russia and penalties on countries that buy Russian oil, including India, China and Brazil. Remember, Trump has extended the trade truce with China for another 90 days, but India and Brazil continue to face tariff rates of 50%. India defended its purchases, saying that it started buying Russian oil with the encouragement of US to help stabilize oil prices when the Ukraine war began. India's energy imports from the US have grown by 70% year-on-year between January and June. India has already purchased $7 billion worth of oil and gas in 2025 so far. Its energy purchases from US could jump to over $14 billion by the end of FY26. To take this discussion forward, I'm now joined by Amitendu Palit. He is the Senior Research Fellow and Research Lead of Trade and Economics at the Institute of South Asian Studies at the National University of Singapore. Thank you for joining us. Mr. Palit, how significant is this outreach that the Indian ambassador is leading with top US politicians?
First, for inviting me to your show. Always a pleasure to be with you, and particularly at a point in time when the diplomatic activity is at its peak, not just on part of India, but I'm pretty much sure on part of most other trade partners of the United States. Coming specifically to the meeting that you mentioned, Parikshit, I think there are a couple of important things to be noted here. The first is this is something which, when I say this, I refer to the Russian penalty that has come on India of 25% additional tariffs. This is something which India wasn't really expecting, and you can't really fault India on that ground because a bilateral trade negotiation was going on, and there was enough commitment by India to a successful resolution of a bilateral trade deal. But suddenly on top of that, if something like this comes in without any inkling of the fact that it is going to come in, you're caught by surprise. So to that extent, I think India has every reason to feel let down by this additional 25% tariffs. And the fact that it's only India and Brazil which have been pushed these tariffs make an indication of the fact that for whatever reasons, India and Brazil are being singled out by President Trump in his treatment of countries at this point in time. So for India, it becomes important to engage diplomatically and strategically on three fronts. The first is obviously with the United States. And when it comes to the United States, I think what India has started doing is that it has started engaging with legislators, as well as those people in the United States who have a view on this subject. And that view reportedly is not a very favorable view. So it's important to connect to those people who have this opinion that those countries that are buying energy products from Russia need to be penalized. And the fact that India is one of those topmost countries, and it is doing so on grounds of its own long to medium term strategic interests and security interests, is something which needs to be explained to these group of people. So to that extent, I think it's a very important signal that you have recorded and sent in terms of capturing the details of the meeting. But I'll also take this opportunity, Parikshit, to just add, I think there are two other parallel outreaches which are happening on part of India. The first is, of course, with Russia. And there is the report of the EAM going to visit Russia very soon. But I think the most significant outreach is the news that Prime Minister himself might be traveling to China at the end of the month. And let us not forget, all these are happening around a number of other significant bilateral meetings that are taking place between President Putin and President Trump, and also a meeting between President Xi and President Trump, which is supposed to take place sometime around the end of October when the APEC summit takes place in Korea. So I think we will see a lot of these simultaneous parallel extra actor to extra actor engagements taking place as we see the next phase of the drama unfolding.
Do you also feel, Amitendu Palit, that's very important for India to give a sense of the long-term purchases which are already in the pipeline? For example, our sources tell us that energy imports from US are up 70% on a year-on-year basis. They will cross possibly $14 billion by the end of this fiscal. There will be defense contracts that we will be giving to US industry as well. Do you think it's very important for India to keep making this point to US legislators, US officials, and even to Donald Trump somehow, that there is so much more which is in the pipeline, and don't negate all of it?
Parikshit, I accept your point that this is an important information which needs to be conveyed to the US legislative members, primarily because of the fact that there is so much of noise, so much of internal confusion, even within the United States over the American tariffs, who's getting what rate, who is being paused when, who is being cut to half when. So it's important to make this point that India, indeed, if it is being penalized on the purchase ground, it is important to note this point, and it should be noted by the legislators. But I don't think India should use this as an excuse that we are buying a lot of US energy imports. As a result of that, we should be allowed flexibility on the Russian purchase. I think that's not the point at all. Whether India buys more imports from the United States or not, the fact remains that there are two clear rationales behind India buying more energy from Russia. The first of it is the fact that if India had not been buying Russian crude oil along with a couple of other countries, by this time, since the outbreak of the Ukraine war, Russia would have offloaded that entire bulk of unsold crude oil onto the global markets. The global spot purchases for crude oil would have gone for a toss. And I think India has played a very important role in stabilizing the global crude oil prices. This is a fact which, in fact, the American establishment had endorsed earlier during the Biden administration, that India did play a supporting role so far as stabilizing global crude oil prices are concerned by buying more of Russian oil, number one. Number two, India is a country which imports, an extensive amount of crude oil. It is the world's most populous economy. It is the world's fourth largest economy. And there is no question about the fact that it requires fossil fuels. Now, in that respect, any country, whether it be US, whether it be anybody else, needs to respect India's choice insofar as making an economic decision for sourcing is concerned. It is an economically logical and rational decision for India to look at a variety of options before itself and choose which one and how it will combine in its spot and forward purchase portfolios. You will recall that in the past, India had made mixes of the Brent and the Dubai crude variety in its oil purchase baskets, depending upon the kind of requirements it faced. So I don't see any reason why India should be apologetic in this regard, or even trying to make a mention of this, that look, we are buying more energy from the United States. That's why this is something which needs to be looked at a different perspective.
Absolutely. So we need to convey, and possibly what we are conveying, that India will always take decisions on the basis of our energy security needs, our national security needs. And this is a relationship that we have with Russia, which is very important as well and has to be balanced. But Mr. Palit, my question to you would be, how do you think India will fare in the coming months? Clearly, there are double standards at play. You've got Donald Trump, who is targeting India, but not China. We're being pushed to the wall when it comes to agriculture and dairy. What do you think is the way out? And in case we're not able to arrive at a deal because the demands are so stark and so strong, what will happen to India if we get a 50% tariff?
Richard, let me put this answer to you in a counter perspective. India is one of those very few countries in the world which is yet to reach a deal with the United States. In terms of comparable economies, it is only China from Asia which is yet to reach a deal. and perhaps Brazil or Canada, Mexico in their own separate. But let's look at the countries which have reached a deal with the United States. Nobody knows what the content of those deals are except for what has been put out by President Trump himself on the Truth Social and certain other comments that have been picked up from here and there. There is no official record of any deals that has come out either from the American government or from the other governments on what has been signed till now in the majority of cases. And I can share with you one fact. It is in this game that is coming out. There is a feeling that is growing among all the countries that have signed deals with the United States that no deal with the US is enough. Matters are not going to end here. The fact that you have got a lower rate of reciprocal tariffs brought down from 20% to 15% for a hypothetical country does not mean that its main exports are exempted from the Section 232 tariffs that exist on steel, aluminium, automobile, auto parts, and there are 8 more investigations going on in Section 232. So where is the guarantee that a country which has been spared on the reciprocal tariff with a lower margin will not be slapped with Section 232 tariffs in the later stage, maybe on critical minerals or maybe on pharmaceuticals?
That's an important
And in addition to that, there are transshipment tariffs. Look at a country like Vietnam, whose dependence on the American market for exports is so high that even though it has got a 20% reciprocal tariff and removed practically all barriers on American exports to Vietnam, it's still saddled with a 40% tariff where it is totally at the mercy of the US border and customs protection.
Absolutely.
We decided how much of local content has actually come from Vietnam and actually from Noah. So as a result of which...
Yeah. So, Mr. Palit, I'm running out of time, but you made a very important point that, you know, irrespective of the deals that Donald Trump has already agreed upon, there is never enough for Donald Trump. And that's what probably India also has in mind, that we may give a deal, even if we give a deal to him on his terms, it doesn't really mean that he'll end there. There may be more demands that may come up next year, and global supply chains and global trade will definitely be impacted this year and in the coming years as well. So this is all that India also has to keep in mind. Thank you very much for joining us on the program.
You're welcome.
Hello and welcome to this special show, Charging India's EV Future. I'm Parikshit Luthra. India is racing towards an electric future with an ambitious target of 30% electric vehicle penetration by 2030. However, the road ahead is charged with challenges including inadequate infrastructure, heavy reliance on battery and critical mineral imports, and non-alignment of policies between the centre and the state. The number of public charging stations has grown 5-fold between FY22 and early FY25. As per a report by CareEdge. But the figure is yet to match the scale of EVs. The report says that India has just one public charging station for every 235 vehicles on the road. Over the next half an hour, we will discuss how India can accelerate its readiness when it comes to the charging infrastructure, battery ecosystem, and also align the policy support. Joining us on the program is Siddharth Sikka, co-founder of Battery Smart, Virendra Goyal, Head Business Development and EV Charging at Tata Power, and Akshat Bansal, Founder and CEO, Static. Thank you very much for joining us. Virendra Goyal, if I can begin with you. When it comes to India's electric vehicle adoption, we are roughly over 7% right now. Even the Niti Aayog has noted that, yes, while we have made progress, we are still far off from our 30% electrification goal by 2030. What do you think are the pieces of the puzzle which are lacking as far as the infrastructure is concerned?
Thanks, Parikshit, for having me on the show. If we break down the 7-point-odd percentage penetration, in certain segments, we are doing exceptionally well, like three-wheelers, two-wheeler, where we are seeing very high penetration rate. I think the only segment in which there is a kind of bit of a slowdown is four-wheeler passenger car. But even in that, if we look at the EV car sales of calendar year 24, which was roughly about 98,000 units, and if we look at the car sales happening between January and July this year, we have almost touched the same number. So there is a lot of excitement amongst the buyers. The puzzles which we need to fix is, of course, availability of charging infrastructure comes as one of the critical element. Also, availability of options to the buyers, and which is what, if we see today, why this calendar year we are seeing there is an uptake in passenger vehicle sales. It's because today consumer has many more options. And the price difference between an ICE vehicle and EV is continuously reducing. There are more and more EV vehicles on the road, which is giving a lot more confidence to the new buyers. I think all put together, we will certainly be moving towards 30% penetration target by 2030. There is a beautiful scheme which we recently launched in the form of PME Drive, which covers it is a comprehensive scheme which covers from demand side to EV charging to everything. So I think the puzzles are there. It is just getting fixed.
You know, I would also quickly like to ask you that what would be your target in terms of market share and the number of charging stations you would like to have in the next 3 years? The reason why I'm asking you this, because there was a report recently which said that India needs at least 3.9 million EV charging stations by 2030.
See, we already have about 5,500 public charging points plus about 1,200 bus charging points. Plus, if we look at, we have very high penetration of home chargers in the country, and Tata Power has installed about 150,000 home chargers already. So we are looking at installing about 7.5 lakh home chargers in next 5 years, making these public charging, semi-public charging station to about 10,000, and buses, trucks would go as the penetration happens. I think when we look at public charging numbers, we are not factoring the home charging installations which are being done, and India has seen very high penetration of home charging, which is what is actually enabling the adoption of e-mobility. Various reports from OEMs, they say approximately 90% charging happens at home, and there are many users who never go to a public charging station. So given the ease and the kind of service which we have created for, and it is so seamless. You book a car, we come to your home and we install a home charger. So once you get back in the evening with your car, you can charge. So it's
Mr. Goyal, I'm going to come back to you. Let me also get in. Right. Let me also get in our other panelist, Akshat Bansal. Akshat, Static has been deploying, and they've deployed over 8,000 chargers across 70 plus cities, and you're aiming for 20,000 by 2026. But do you feel that having more fast chargers is the answer? Currently, you've got 30 kilowatt-hour chargers, 60 kilowatt-hour chargers, 150 kilowatt-hour chargers. But what Tesla has shown us in India now, in Delhi and Mumbai, is superchargers, which are 250 kilowatt-hour, and they can charge your car to about 267 kilometers or 270 kilometers in about 15 minutes. Companies like Xiaomi and some of the Chinese car makers are displaying technology that can give you 600 or 700 kilometers of range in about 15 minutes. Do you think that is something that the Indian government must work with industry players to offer to the customer?
Right. No, first of all, thanks a lot, Parikshit, for having me on the show. I wanted to point out, first of all, that we were the ones who helped Tesla build these stations in Delhi. And what we realize, given our experience in this market, is obviously fast charging is the way to go. But then it is also a combination of the OEM being able to support it and the grid that is available. So even though fast charging is the way forward, and as a company, that is what we're looking to build, there are a lot more challenges that needs to be solved for it, majorly in the back-end power infra space, which is not adequate at a lot of locations. And even though charging will be in all the parking, not every parking charger could be a fast charger. So you need to carefully build that out.
Right, that indeed is important. Let me also get in Siddharth Sikka, co-founder of Battery Smart. Now, Siddharth, battery swapping is a model that is popular in several countries. But how important is it from an Indian point of view? And also, we've been toying with the idea of a battery swapping policy and a standardization across the board. How much success have we achieved with that policy, and what kind of a nudge do we need from the government?
Thank you, Parikshit, for having me. When we talk about making electric vehicles mainstream, I think two big barriers always come up. One is the affordability, and then there is uptime. Battery swapping directly solves both of these barriers. When you remove battery ownership from the purchase equation, you bring down the upfront cost of any electric vehicle down by as much as 40%. Now, this is very transformative for a commercial driver, fleet operator, right? Because they have to be on the road 24/7. Swapping actually means that you are never stuck waiting for charging. For 2- and 3-wheelers commercial driver, that would make up to, I think, 80% of all the vehicles sold in India. This is very critical. For them, time is money. This also takes the range anxiety out of the picture entirely. A driver knows whenever their battery is low, the station nearby, they can get a fully charged battery under 2 minutes. So this is uninterrupted operations. At Battery Smart, we have a network of more than 1,600 swapping stations. We have shown that this model works at scale, works in real-world conditions, deployed about 2.5 lakh batteries and doing about 4 million swaps every month. So what we have done is our approach is built for speed. We have collaborated with the local entrepreneurs in a lot of places. We have also collaborated with the local bodies. There is a lot of support from the government as far as battery swapping is concerned. Because there is a lot of talk around policy as well. I can talk about some of the things that government should be doing, could be doing, right, to make this more mainstream. One of that is definitely GST. If you talk about GST, electric vehicles are taxed at 5%. But if you separate the battery, it suddenly becomes 18%. Now that same 18% applies to swapping services as well. And any e-rickshaw driver that's earning like 500, 800 rupees is also paying 18% tax, right, which is prohibitive. So I think if you bring the GST and swapping down to 5%, same as EVs, it will immediately cut costs for drivers and push adoption much faster.
Right. Okay. Virendra Goyal, if I can come to you, I'm just reading out a Goldman Sachs report which has said that global average battery prices declined from $153 per kilowatt hour in 2022 to $149 in 2023. And this is projected by Goldman Sachs to fall to $111 dollars by the close of this year, and 80 kilowatt hours, $80 per kilowatt hour by 2026, which is a 50% drop since 2023, at which level battery electric vehicles would achieve ownership cost parity with gasoline-fueled cars in the US. Now, when it comes to the India scenario, how do you see the battery prices coming down, considering we're importing our cells largely, we're assembling batteries, but if we have to bring the cost of battery down significantly, because this is still the 70% cost of acquiring an EV, how do we bring that down further in the coming years?
See, battery prices are coming down globally, and the same is being seen in India also. And if we look at the price of the vehicle, they are also coming down. Not exactly the rupee value of a car, but if we look at the size of the battery inside the car, that has been constantly going up, which means the range of the vehicle is getting enhanced with every new model. Today we have models which are running to the extent of 500 kilometers in one single charge. So I think globally, as the battery prices keep coming down, in India also the prices will keep reducing. I think it's more of a global dependence which we have, and Government of India is also working on creating local capacities, which we will have to see in years to come.
Right. Now, let me take some final questions with all our panelists. And let me begin with Akshat Bansal, founder and CEO of Statit. Akshat, if I asked you to prioritize one point out of these three, charging infrastructure, battery manufacturing, or policy alignment, what do you think as a country, as an industry and government, we need to focus on?
Actually, that's a very difficult question to answer and prioritize just one. I think all the three are really very, very important. It is very important that there's price parity for EVs with the ICE vehicles, and EV battery manufacturing locally helps with that and creating the whole supply chain around it. So I think price parity is the number one thing. And then comes the charging infra, because it's a chicken and egg problem. If you don't have enough charging stations, fueling stations, people would not buy EVs. So that is the second priority, and obviously all the policies need to come together. Government should be an enabler, which it is already acting as one, and there should be enough financing available for EVs and for the charging infra. So I think all three are very, very important for growing this ecosystem.
Right. Let me ask you one more point, Akshat. When it comes to your company, what specific policy actions could actually help startups like yours scale up faster?
Yeah, no, I think we are in the business of building the infra, and we also build the technology. But the infra build out actually really requires a lot of financing, and that the charges that we build may not be profitable on day one, because EVs are also growing slowly. So great financing options from the leading banks and supported by government schemes could be a game changer for startups like us to grow and build out this infra.
Right. Siddharth, coming to you, lack of interoperability. Now, that is something that would hold back battery swapping. How do we overcome this hurdle? And how do you see the government-industry collaboration on this?
Yeah, I think interoperability is something which, of course, a lot of people are talking about. And I don't see this being a factor in battery swapping adoption as such, right? I think there has been a lot of support from the government as far as policy is concerned. One thing which I want to talk about, of course, is that we are daily very heavily dependent on imports for critical materials even today, lithium, cobalt, nickel. And that makes us very vulnerable to price swings and supply shocks as far as batteries go. I think we need to work towards energy independence, building strategic partnerships, scaling up recycling of batteries, right? And also eventually probably exploring sourcing domestically. So this is something where I think there is an execution gap as well. We have had schemes like advanced cell chemistry under PLI, which was announced, but the speed of disbursement and on-ground action, that does not match the ambition. I think closing the gap there between announcement and execution could be key to keep the momentum going, because the opportunity is huge. We need to really get the supply chain, technology, talent, and policy aligned. India, because won't be able to just meet its own demand, right? We can actually be a major exporter in the next decade. So I think that is one area where we can really focus on.
Right. Virender Goyal, final question to you. When it comes to global supply chains, they are all in disarray right now. There is a rare earth restriction imposed by China. And for charging infrastructure, for battery technology, for EV components, we are largely import dependent right now. What are some of the capabilities that we need to develop and the kind of diversification we need to do in terms of imports to future-proof our EV journey?
So Parikshit, yes, we are largely import dependent today, whether it is battery or the critical components inside the charging infrastructure. And the same needs to be, created, developed in the country. So the question which you had asked, Akshit, on the 3 points, my view is that we need a policy, and we need to first address these import-dependent activities, the dependence which we have today, and all of us are seeing the rare earth dependence, on which would have impact on the vehicle output. So that dependence will have to reduce by local manufacturing, localizations, which is also a part of many subsidy schemes. Yeah.
All right. Thank you so much, Mr. Goyal, Siddharth Sikka, Akshat Bansal for joining us. It's been a great discussion on charging up India's EV journey. We're taking a short break, but don't go anywhere. When we return, we'll get you a special and exclusive conversation with Jayesh Ranjan, Special Chief Secretary, Government of Telangana, on the other side to discuss the EV policy, which aims to attract $4 billion in private investments by 2030. Welcome back. Telangana is one of the states that has its own EV policy, which aims to attract $4 billion in private investments by 2030, create 1 lakh jobs across charging infrastructure, manufacturing, shared mobility. The incentives for the battery ecosystem, including up to 20% capital subsidy, which is capped at 30 crore rupees, as well as full state GST reimbursement. Joining us now to discuss this further is Jayesh Ranjan, Special Chief Secretary, Government of Telangana. Thank you very much for being with us. So, quite a forward-looking policy that has come from the state of Telangana. How do you think states and industry together can accelerate both the high-quality local battery manufacturing and also sustainable recycling in future? Because both have to go together hand in hand.
Thank you, Parikshit. Nice to be talking to you. So I was listening to the previous panel as well and picking a few points from that discussion as well. I feel that three things need to go together. The policy has to be very supportive. It should address all the pain points that investors experience. And some of your panelists spoke actually about the pain points that they face. More than that, we also need to give them very good quality infrastructure. See, I have learned about how battery manufacturing happens in other parts of the world. And we know that a number of those kind of manufacturing units are in China, Japan, Korea, etc. We have to provide matching kind of infrastructure where land is adequate, infrastructure like power, water, transportation is taken care of. Waste discharge is a very big requirement. High quality power is a must. And then this kind of activities do have some element of pollution. So they should be away from habitation. So it's not very easy in our country to find a location which ticks all the boxes. But fortunately in Telangana, we have been able to set up possibly the country's first energy storage park. And the park is full. Actually, 3 clients between them have taken all the space which was there in that park. And now we are developing one more park. So good quality infrastructure is required. And the third and of course, along with the infrastructure, there is also a supply chain issue. How do you
Okay, I will come to that. But, you know, India has a number of policies. We've had a FAME scheme 1, a FAME scheme 2. You've had a PM e-drive scheme. These are the supply side incentives. For example, when you buy an electric vehicle, you get an incentive on that. Then you've had the ACC PLI scheme, which is to incentivize manufacturing of cells in the country. Then you also have PLI schemes for advanced automotive manufacturing, both for components and entire vehicles, which includes cars, 2-wheelers, 3-wheelers, buses, trucks as well. So India has literally brought out a number of schemes to incentivize the entire supply chain when it comes to EVs. Why has cell manufacturing been slow to take off? You've had a number of players in the cell manufacturing space, but at the same time, we've not really seen cell manufacturing taking off in a big way. Now, that will be critical in terms of bringing down electric vehicle prices. Currently, we are big importers of cells from countries like South Korea, countries like China for that matter, even Japan. But we need to have those local partnerships. Yes, there are companies which are striking local partnerships for battery manufacturing. But let me just ask Mr. Jayesh Ranjan about cell manufacturing. Mr. Jayesh Ranjan, would you say that more than battery manufacturing, cell manufacturing is something we need to focus on? And why do you think, despite the fact that we have an ACC PLI scheme, why hasn't cell manufacturing taken off at scale till now?
Apologies, I got disconnected momentarily, but thank you for getting me back. So in my honest opinion, the answer is that the supply chain is not really mature enough. Cell manufacturing requires dependency on a large number of components, many of which are not yet produced in our country. There are compulsorily imports to be relied on. And as we know, it is becoming increasingly difficult to get imports. Some of these import items or some of these components also have elements of critical minerals. And there is a suspicion about dual use. There are restrictions on how to avoid or how to provide a certification that there'll be no dual use, etc., etc. So cell manufacturing definitely is very much required. It also helps the country become self-sufficient, but the kind of supply chain that it requires, very, very refined components, very complicated manufacturing processes, unless we develop expertise in doing all that. So that is one big ask, in my opinion.
Mr. Ranjan, my final question to you, what kind of policy standardization that we need all across the country, be it on infrastructure, be it on charging, be it on battery manufacturing, and even sale of electric vehicles?
So, see, we won't be able to achieve standardization beyond a point. That is the reality. India is a federal country. States compete with each other. Everyone would like to provide some kind of USP. But I have seen something in the semiconductor vertical. So while every state may eventually desire to have semiconductor manufacturing units in their state, but the government of India has felt that 6 to 7 states offer the best value proposition. And then if any overseas investor comes, only these 6 to 7 states are opened up. I guess that is how it is going to happen for both cell and battery and components also. You'll have to identify those 6, 7 states which have the best policies, best infrastructure, skills are available, logistics are easy, supply chain is possible. And then you allow a fair competition between these 6, 7 states. And of course, whatever can be added from the government of India, that will be the icing on the cake.
Right. Thank you very much, Mr. Jayesh Ranjan, for joining us on our special series, Charging Up India's EV Journey. We've run out of time. Thank you for watching. Goodbye.
Well, hello and welcome to Finding Alpha, the show where we zoom out to understand the macro and then deep dive into the micro. All of this to sharpen your stock selection process. Well, today we'll be focusing on a very, very crucial theme. Who stands to gain amid the rate cuts and asset quality concerns? With the RBI shifting to a pro-growth stance and introducing a series of rate cuts, albeit modest, investors are weighing this against tepid credit growth and some signs of emerging stress in asset quality. Well, to unpack this, we're now joined by Digant Haria, founder of Green Edge Wealth, a firm that builds tailored stock and high-yield bond yield portfolios. Digant, by the way, has been tracking India's banking and NBFC space for over 16 years and brings a sharp lens to what matters and what doesn't in this dynamic sector. Well, Digant, thanks a lot for coming down to the studio. And we're looking forward to learning more about, the financial companies, NBFCs, and some HFCs as well. How are you feeling about the sectors right now?
Thanks, Nigel. Pleasure to be here. Pleasure to be on the first show of, the first episode of this new series. So yeah, I think, banks, NBFCs, it's a very large sector. So always there's interest. And the reason for a higher, a higher scrutiny for this sector now for investors is, the RBI started reducing the regulations and they have cut the rates. Yeah. And there's a finance minister who said that NBFCs should not think of themselves as shadow banking and they should now go out and grow. So the government and the regulator wants this sector to grow. Which is the reason why we are all looking very closely where in the large space can we find our growth.
All right, Digant, then let's take that forward and let's focus first on the housing finance companies, because it's more relatable as well. Now, housing finance companies within that, some of them could see some margin expansion, as you said, because of the rate cuts. Lower cost of funds will help them. There's also backed by physical assets, which is good in terms of asset quality. And within housing finance companies, well, we'll break it down into traditional housing finance companies and affordable housing finance companies. First on the traditional lot. And we'll get those graphics up for you on the screen, the likes of LSE, Housing Finance and the likes. Yeah. Anything you like out there? Is there one of those companies that is better placed?
Nigel, I think, traditional housing finance companies, you highlighted a lot of positives. But then, all these positives come with very high competition. All private banks, all PSU banks, all regional banks, everybody wants to do affordable housing. And which is why the margins and growth both will be under pressure for this segment. So this is a segment which is best left for, somebody who's happy with 10% returns, because I don't see, a big upside in any of the stocks in this particular sector. I think if somebody is still very keen, maybe Canfin Homes has a little bit of turnaround story left. But otherwise, I think best to focus on smaller names, niche names where banks cannot really come and compete.
So we'll keep the traditional housing finance. They're not giving you anything to really be very excited about. But let's focus on, the other ones. That's the affordable housing finance companies. And when we talk about real estate companies, their advice is always go with the larger names. But I believe from this space, you are looking actually a smaller name from the affordable housing finance. India Shelter, that's the one that's on your radar. I think it's well placed, though the loan book is the smallest, but the ROA is looking quite good. Tell us more and what's the rationale?
Yeah, so I think, the affordable housing story of India, a lot of times we say there's so much opportunity. Actually, that's not true. The opportunity is limited in affordable housing because all the housing prices have gone up. So in housing finance, we have one rule, Nigel, that you focus on companies which are small in size, because the moment you hit 20-25,000 crores in loan book is the moment where either your growth or your asset quality starts suffering. We have seen that with Gru in 2016, Canfin in 2018. These were also great affordable companies at one point in time and they're struggling later on. We've now seen it with Awas and some extent Aadhar also. So this is a space where I think smaller is beautiful. And I think amongst the small space, there is Aptus and there is India Shelter, which is like less than 10,000. Between the two, I think India Shelter has a better growth focus and better prospects of growing and maintaining their profitability. So I think that can be a business which can do well over next 18 months.
Yeah, and as you said, I think the loan book is less than 10,000 crores out there, but it gives you a good potential to grow. Just wanted you to highlight, what about the LAP exposure for these companies? How much is it?
Okay, so that is slightly, like we say these are housing finance companies, but anywhere between 25 to 40% of their portfolio is in loan against property or LAP, as we say. It's a slightly risky segment, but that is what gives them margins. These players over the years have really done it well, but there's a little bit of risk build-up. So, you always have to be careful and not go overboard because, mind you, Nigel, these are all trading at 3.5 times price to book also. So they need to execute well. I think India Shelter over last 2 years, they have had a new management from Chola and I think they're doing things right. So I think that is where we have the best probability of success. But yeah, we have to be careful about LAP.
Pick up the pack, India Shelter from Digant there. Loan book size relatively smaller, but they've got triggers. And that's why Digant says that they're favorably placed. Digant, I wanted to ask you about the asset quality. On the asset quality side, particularly in various pockets, MSME, 2- and 3-wheeler space, there are suddenly some signs of some pressure. Right. For the sector on the whole, how are you reading it?
Yeah, so see, I think the pressure is in the high-yield lending space. Like if we break down the entire lending space, the pressure is in the high-yield lending space. So you look at microfinance, you look at personal loans, you look at unsecured business loans, and lastly, you look at these 2-wheeler, 3-wheeler loans. So these are all places where you lend at more than 20%. There is a stress. The stress is not come today. It is building up since the last 18 months. Yeah. I think another 6 months and we will find our feet. So it's not something which is alarming to me. I think we have already seen bad patches. We are about to, end those bad patches in coming quarters.
Yeah, that's heartening to hear because let's turn our attention then on the vehicle finance companies itself. From that space, HDB Financial, well, it recently listed. And those that bought in the pre-IPO would be a little bit worried, because the IPO came actually attractively priced. Right. Now, going at the current state of affairs and, the valuations that it trades at, what's your view on this name, HDB Financial? If you compare it with the traditional darling, that was Chola, always got the best in terms of valuations. Right. Out there, between the two, good pedigree, good parentage, what's your pick? How would you approach both these two names?
Yeah, I think, see, Chola, there is very little to complain, but the macro setup is really we were at the best possible scenario for the last 3 years. Good truck prices, good number of trips. So everything was going good. I think after 3 good years, we have a high base and, we are slowly decelerating. So somebody like Chola, who has seen amazing valuation expansion, amazing returns, I think that should rest now. The best days for Chola as a stock, maybe 1 year is a time of consolidation for Chola, maybe even a little bit of correction because it has run ahead in terms of valuations, around 5.5 times price to book. HDB Financial, on the other end, it has struggled over the last 2 years in terms of asset quality and operating costs. But I think if cycle improves, which is our thesis of this show, that, the lending cycle will improve in the next 4 quarters, I think HDB Financial can meaningfully outperform Chola. Not to say that, these are like small caps who can go up a lot and something like that. But between the two, I think the funds may actually end up shifting from Chola to HDB if HDB shows a little bit of execution. All right. So, and HDB is much more cheaper. So
absolutely, as that chart is telling you, HDB is still relatively more attractive priced if you look at it against Chola. So we take that on board. And in the near term, you would say, if someone is looking at a fresh investment, you'd rather pick HDB over Chola for the reasons that you've given. What about Shriram Finance? It was attractive. Then it became even more attractive, made its way into the Nifty, and it's a frontline name. Valuation cushion, but what is your view on the stock?
I think Shriram has also done really well. If you look at last 3 years, it's done better than Chola also, which will come as a surprise to a lot of the observers of this space. But I think, Shriram should also rest. Just like Chola, I think Shriram should also rest for some more time. Their numbers, we are at 3.5% ROA. So, when you are at a high base and the environment is not very favorable, you may not show very strong earnings growth, and stocks typically don't do well. It's a great business model, great company. But I think, you will get better opportunities after 6 months or 9 months.
Okay, let's talk about then. So Shriram, Chola, maybe a bit of a rest. HDB Financial is something that could relatively better place. But let's talk about a stock actually that's done very, very well. L&T Finance, the stock is up, I think, close to 50% in just the last 8 months or so. It's re-rated a fair bit. But since Mr. Sudipta Roy, since the time he took over, there's been a lot of good news that's coming in there. And we just spoke to them actually. They said that they'll grow by 20-25%. That's good. But they only cautioned that the MFI industry, that recovery could be pushed back by a quarter. Your view on the stock, it's already seen some part of re-rating. Is it getting started, or is the best already in the price?
Okay, so yeah, so see, they had this turnaround 3 years back when the new CEO joined. He changed the way credit is done, especially in two-wheelers and tractors. So I think that turnaround will be visible, from say next quarter or Diwali. And microfinance, as we say, is a pain for everyone.
Yes.
But if you look at the comparative charts, the pain for L&T Finance, Ujjivan, and Credit Access, these three companies, it has been the least. So they have been the best three out of the 40 microfinance companies. So I would think that this is one place where you have a large name, comfortable valuations and good potential, combination of all three. So if somebody is looking at the larger blue-blooded names between say Shriram, Chola, Sundaram, Mahindra Finance, L&T, I think L&T is a hands down can be a better performer than the other large names.
But the only point is, after the recent run, it's not that cheap compared to what it was. That said, what would the fair multiple you would give it, for L&T Finance?
So see, L&T Finance, all other diversified large groups, who have corporate backing, they're trading at 3 to 5 times price to book. This guy is at 2 times.
Yeah.
Obviously, it is because the ROEs are at 11-12%. I think as the ROEs re-rate, which they should over next 18 months, I think the valuations also have room to expand. So you have a 20% room to expand in terms of valuations, and then earnings compounding is what people can earn. And in absence of all other ideas, a lot of money can flow. So valuation expansion can be a bigger game as well, which we cannot predict today. But if Sundaram, Shriram, Chola, do not attract money, the money is going to flow somewhere else.
Well, Digant, so that's about the vehicle space, vehicle financing space. But I think the space that gives you some comfort is with the way gold prices have moved up. These gold finance companies actually could be pretty well placed. And also the commentary that's coming from the RBI, particularly in the last, I think, 10 to 12 months, has been favorable. That said, just give us a couple of basic numbers first. What is the size of the opportunity out there? How much of it is unorganized? How much of it is organized? The split between organized and unorganized?
Okay, so see, credit card, people like us, we get credit cards. We can just go and swipe whenever we want. Gold loan is sort of, a credit card for the businessmen and credit card for the poor. Whenever you need emergency loans, you pledge your gold, you get the loans. It is no more a distress loan in India. It's not as if when I don't have anything and there's emergency. So it's like a business loan. So instead of playing a personal loan company or a business loan company, gold loan is a preferred bet. The overall industry is very huge. More than 15 lakh crores is the total industry size. But half of it is controlled by money lenders. Money lenders charge 36 to 40% interest rates. And it is almost criminal. Those rates are so high that, I think these NBFCs charge between 14 to 19%. So they have a very good case. The banks generally charge between 12 to 16%.
Okay.
So that is the spectrum. I think this is an industry which is growing because one, gold price is extremely favorable. Two, the regulator has streamlined the guidelines and the guidelines are actually in favor of the sector growing faster. And three, you have more and more players who are coming in the gold loan industry, like Poonawalla is starting with 400 branches, L&T Finance acquired Paul Merchants, and so on and so forth. So when everybody markets gold loan, the industry itself expands.
Okay.
And when personal loans and microfinance loans are not easy to get, gold loans is something which shines.
And this 15 lakh crore, as you said, it's divided into 50% each of them.
Organized and unorganized.
So for the industry, what kind of growth rate are you working with for the organized sector?
So Nigel, I think these numbers may sound insane, but 20% is a bare minimum growth in gold loan industry, which we can see this year. That is when our credit growth is going to be 9-10%. So it will grow 2x that of the system. And because of all the three factors which I just highlighted before. One factor which every investor has to keep in mind is you have to keep your eye on gold price. If there's a big crash in gold price, then gold loan companies cannot do well for 6 months. That is a patthar ki lakir, or what do you have to say? It's a very big thumb rule.
Okay, all right. Muthoot, that's been the big daddy, right? It's always enjoyed those premium multiples in the space. But that's what could limit the upside. Instead of Muthoot, would you rather play the other ones that can now twinkle? Say a Manappuram that's got new ownership, or an IFL that's coming out of a ban. Yeah. So among these three names, at least, what do you like?
So I think there's a spectrum. Each kind of investor can pick what they want. Muthoot Finance will probably do the best because it is best suited to capture all the growth. But Muthoot Finance probably more for the large funds, for people who are happy with 15-20% kind of returns. For people who want to play a recovery trade, I think IIFL has a wonderful gold loan book. They will show you the sharpest upsurge in growth because they had an RBI ban and so on. And there's one more interesting company called FedFina, which is a subsidiary of Federal Bank. I think that is something which got listed a year back, slightly undiscovered by the market. And, to your surprise, in gold loans, we look at what is your per branch AUM. So Muthoot is number 1 with 21 crores of gold per AUM. Number 2 is FedFina. It is not Manappuram. It is not IIFL. Number 2 is actually FedFina. So, FedFina, IIFL are interesting. Manappuram, the new CEO is about to join. They have some more pain in the microfinance. So, maybe I'll wait for a quarter or so for it to settle and then we can move ahead. But these gold loan companies are really better placed than the personal loans, companies like, say, Bajaj, Poonawalla section, which will come to the next.
All right. So in terms of preference, maybe Muthoot will not shine as much from now on. It could be a compounder, though, from here on. But the delta could come in from companies like FedFina and IIFL, as well as a Manappuram. Well, you spoke about some of those consumer-facing finance companies. I'll tell you what. We'll slip into a short break. We'll come back and we'll continue the discussion. Digant will tell us what's his view on a few of those names as well. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha on CNBC-TV18. Well, we're still in conversation with Digant Haria. Digant, we have discussed a few themes, but as promised, we're going to be moving now to the diversified consumer lenders. Bajaj Finance, that's been the poster boy, right? If you ask anyone in 15 years, where did you make your money? They would say Bajaj Finance. The problem is now that the numbers, even when they're good, people want more. Ye dil mange more, right?
Yeah.
Do you think Bajaj Finance has run its course? Or can it give, I don't know, maybe a mid-teens, double-digit returns from here on?
I think it has run its course. It's very, it's a very harsh statement to make, but I really think that it has run its course. If you look at last 9 years, the stock price CAGR of Muthoot Finance has been higher than Bajaj Finance. A lot of people don't know this, but this is the reality. See, Bajaj was a leader in physical world, buy now, pay later. You go to a shop, buy a TV, buy this. Now shopping has moved online and Bajaj is no more the leader there. So Bajaj, the main reason why Bajaj is struggling is it is no more a leader in any fastest growing segments. So Bajaj has been moving to different segments like gold loan, micro loan, tractor loan, everything which is traditional. Bajaj never did traditional stuff.
Yeah.
But now because they are not able to grow, I think they have reached a size that unless India's middle class and lower middle class does well, Bajaj cannot really outperform. So Bajaj's outperformance is now so much linked to what happens to the entire middle class. It can no more outperform the country in a big way. So I think we can, personal loans, MSME loans, two-wheeler loans, the credit card loans, they're all struggling. And, which is why, apart from Bajaj Finance, we should also be very cautious on companies like, say, SBI Cards or companies like Poonawalla FinCorp, which are talking of very fast growth in such an environment. I think these are places where investors will have to wait a lot before they can see returns.
All right, so Bajaj Finance and Poonawalla FinCorp, for the time being, you would not be, looking to jump into it. But I want to ask you about SBI Cards, because that's the only listed credit card player, right? Credit costs remain elevated. Every time, there is something or the other, and now the best is yet to come, it doesn't come. Even, the past quarters numbers haven't been that impressive. So asset quality is an issue, credit costs go up, growth is not coming about, they're not making any big dent in any market share. What's your view on the stock? Because if you look at rank underperformers, this is one stock that comes to your list.
I'll just give you one line, Nigel, that in credit cards, if you want to make money, you cannot sell credit cards at petrol pumps, at malls, at railway stations. If you do it this way, you invite a customer segment which is not very strong, and which is why your asset quality issues never end. So 2021 to 23, their sourcing strategy itself was, you go much lower down the pyramid. And which is why you see quarter after quarter losses come and management is clueless.
Okay, all right. So that's aside. But JM Financial, that's something that you've liked. What's it? What's happening out here? Does it have more legs?
Yeah, so it's a capital market play. And if you look at this stock, 2008, the price was same as it is today. So it's almost 16 years. The company went through a lot of pain in the NBFC space. They have come out of that pain. So I think good times for the company are just about starting. It will be a very interesting capital market play to track for the next 2 years, because it's like a long 7-8 year of pain which is coming to an end. And capital markets division is doing very well. So instead of a mutual fund stock or a broking stock, we prefer something like a JM Financial where, there is a lot more steam in the business.
And it's got valuation comfort as well, even after this big run. So that's something that you like.
Absolutely.
All right, let's wind this down then by turning our attention to the micro lenders. Companies like Credit Access, Arman, they have 70 to 90% in this space, and they're well placed. Do you like any of these two?
So see, microfinance is always cyclical. No matter what anyone tells you, there is a good cycle, there's a bad cycle. Right now, we are going through the deepest point of the bad cycle. Maybe in a quarter or two, from the deepest point, we'll start the upward journey. So if somebody is interested in playing cyclical stocks, I think this sector offers upsides. The best companies, the best managements are Credit Access and Arman in this space. But, we feel that microfinance, even in the upside, it will be a little slow because that over leveraging was just too much. So in this space, we like something else, which is Northern Arc.
But tell us more about this Northern Arc, because there was a pending large trade. It took place, got cleared out around 200 rupees. From there, that has been one of the biggest outperformers from the broader markets. So at around 260 ballpark, what's your view on this name?
Okay, so...
And what are the key triggers you'll be tracking on this one?
Perfect. So see, Northern Arc is a very unique company. They lend to 300 other NBFCs. That is their first business. Second business is they lend to small LAP, microfinance, just like, a lot of other companies, say SBFC or, 5-Star would do. So they have these two major businesses. One of the business, which is microfinance, had some trouble, and which is why the stock is trading at 1.1, 1.2 times book. I think the base business is so strong that once the microfinance down cycle is over and the up cycle starts, this will also re-rate quite significantly. So in Northern Arc, I see that there is a reasonable room, just like JM Financial or Fed Fina, there is a reasonable room for the business model to outperform in terms of earnings. So that is our business case in Northern Arc.
Northern Arc and JM Financial. But before we wind down, we had a couple of stocks on the screen, SBFC and Five Star Business. They traded around 4 times approximately. What's your view on these two names, or are you going to give us an alternate?
See, I think both are into that very high lending space and they're growing fast. So this is an area which I try to become a little cautious, that high yield and fast growth. There's a chance of mistakes. Valuations are also very rich, so there is no margin of safety. So I think gold loan companies in this environment, investors are better off being in gold loan companies than in these companies. Maybe once the environment improves, we can do a shift trade. But
all right, Digant, it's been a pleasure having you on the show. Thanks a lot for joining in, explaining all of that to us. Just to rewind, India Shelter, something that you like. From the gold finance companies, FedFina, something that you like. And from the other stocks, Northern Arc, JM Financial, they could still look from here on. And that trade you spoke about, maybe it's time for Chola to make way for HDB Financial. It's been a pleasure having you on the show, Digant. We look forward to chatting up with you soon.
I'll just say one thing, that investors need to be patient. This whole cycle, it will take 2 or 3 quarters for the cycle to really turn around. And yeah, be long-term, track the businesses, not the stock price. And whatever we spoke is business analysis. That's it from my side.
Well,
thank you for having me.
Bang on, Digant. On that note, though, we'll wind up on this edition of Finding Alpha. Thanks a lot for joining in. We hope we manage to dissect the entire space for you. More news and updates coming up on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Global ratings agency S&P upgrades India's sovereign credit rating to BBB with a stable outlook. S&P says the impact of higher U.S. tariffs will be manageable, expects more fiscal consolidation as it believes growth is well on track. The Sensex and the Nifty snap a 6-week losing streak despite a flat close on Friday. All sectoral indices gained this week, barring FMCG. 38 out of the 50 Nifty stocks end in the green. President Trump warns Russia's President Putin of severe consequences if he does not agree to a ceasefire in Ukraine ahead of the Friday summit in Alaska. Ukraine's Zelensky meets British Prime Minister Keir Starmer in London as EU leaders urge Trump not to cede territory to Russia. India is fully engaged with the US on trade negotiations. Commerce Ministry says talks are on at different levels with less than 2 weeks to go for the 50% tariffs to kick in. India and China speed up efforts to rebuild bilateral ties. Bloomberg reports both nations are in talks to reopen border trade. India's Commerce Ministry says trade development is moving positively with growth in exports and imports.
If I have to have a bed in my house in where I stay with my father, then I have to dream to be in the top 2, and we all will dream to be in the top 2 and to build this company.
But Jindal reiterates the ambition to climb the pecking order as JSW Cement lists on Dalal Street, ends the first session with minor cuts. Shares of more than 15 companies have suffered a single-day decline of more than 15% so far in 2025. CNBC-TV18 analyzes a majority of these stocks, including IndusInd Bank and PNB Housing, yet to reclaim lost ground. Election Commission admits 65 lakh names have been removed from the voter list in Bihar. The Supreme Court directs the poll body to publish the names on the website in a searchable format. The apex court says citizens should not be at the mercy of block-level officers. At least 12 people feared dead after flash floods in Jammu and Kashmir's Kishtwar district. Heavy rains also lashed Delhi, disrupting road, rail and air traffic. Well, let's go straight to the top story this evening. Global ratings agency S&P has upgraded India's sovereign credit rating to BBB with a stable outlook. The credit ratings agency has said that the impact of higher U.S. tariffs will be, and I quote, manageable. It also expects more fiscal consolidation as it believes growth is on track. Ritu's here with more from S&P. Finally, an upgrade coming in there from S&P. Ritu, take us through the history of how India does and how it compares to Moody's and Fitch when we talk about S&P's outlook.
Well, Shireen, it is a landmark move for India's economic story. S&P upgrading our sovereign credit rating to BBB from BBB minus with a stable outlook. Keep in mind, this is India's first rating upgrade by S&P in nearly 18 years, and it signals a stronger vote of confidence in the nation's economic and fiscal trajectory. Now, for perspective, S&P's new rating is the second lowest investment grade rating. It is just one notch above Fitch's BBB minus and Moody's equivalent Baa3, both of which again sit at the lowest investment grade level. Now, if you look back at India's rating history, S&P first gave India a rating in 1990, that is before the reforms, and that was at BBB. The 1990s, of course, saw some setbacks. The rating slipped to BBB minus in 1991, then again to BB plus the same year, down to BB in 1998. From there, we climbed back all the way to BBB minus by 2007, which is where our rating has now stayed until the long-awaited upgrade today. We're essentially, in a sense, Shireen, back to where we were in 1990. Now, S&P says the upgrade reflects a buoyant economic growth, improved inflation control, and a clear commitment to fiscal consolidation. India, it says, has staged a remarkable comeback from the pandemic, clocking an average 8.8% real GDP growth from FY22 to 24, the fastest in Asia Pacific, and it is now projected to grow around 6.8% annually in the next 3 years. Public investment is a key driver. Central government capex spending is set to hit 3.1% of GDP next year, which is more than 50% higher than a decade ago. And at the same time, fiscal deficit is projected to narrow. Debt to GDP could fall from 83% to 78% by 2029. Now, what does it mean in terms of immediate benefits for India? First and foremost, it is going to bring down our cost of borrowing. That is very important for the country. And of course, it will trickle down, the corporates borrowing overseas as well. It boosts the confidence in our long-term growth story because, this is a long overdue acknowledgement of India's stable macroeconomic fundamentals, whether you look at GDP growth or you look at the fiscal consolidation and even the inflation control. And now we have to see if other rating agencies will follow suit.
Yes, that is the big question. Will the others follow suit? Ritu, thanks very much for joining us. And to take this conversation forward, we're joined by Yifan Vuo, Director, Sovereign and International Public Finance Ratings at S&P Global. Yifan, many thanks for joining us on CNBC-TV18. The very first question to you, it's taken 18 years for India to get this ratings upgrade. Why that long, Yifan?
Hi, Shireen. Thank you for having me today. Yeah, if you look at India's rating trajectory over the past 18 years, as you mentioned, there's been ups and downs. But I think for us, we really take a much longer term, view to this sort of things. The outlook has changed a couple of times, but I think this time round, if we've been recognizing the strong efforts that the government has put in into economic reforms, at the same time driving growth, at the same time also allocating a lot of the spendings towards infrastructure as well. And all this has helped to really boost economic growth in the last few years. And we're starting to see a lot of this economic growth numbers flowing on into credit metrics and helping to paint a much better trajectory going forward. And that's the reason why we have acted on the positive outlook, which we started last year, and acted upon it this year to upgrade India to a BBB flat.
Well, Yifan, you talked about the macroeconomic stability. What is it that you like the most about what India has been able to do in terms of infrastructure spending, in terms of inflation control, and so on and so forth? What about the macros do you find most comfort and confidence in?
Yeah, you have touched on a very important point for us, which is the growth story, right? It's been very stable in terms of growth. India has been through many cycles, up and down, but throughout it all, I think the government has done very well to maneuver the economy, right? I think the sheer size of the economy, the very healthy growth, the strong domestic consumption, all these are factors to overall help to build the story as well. As for infrastructure investment, I think that's very admirable for the government in terms of how they have been, as a share of the budget, allocating less towards subsidies, but putting it towards more productive use like infrastructure investment. And as these infrastructure investments come forth and bear fruit, we do believe that it can actually help to lift India up to an even higher economic trajectory versus what it's seeing right now.
Right. I want to address the issue of the tariffs that the U.S. administration has imposed on India, 25% currently, with the threat of an additional 25% by the 27th of August, if, of course, there is some sort of a middle ground negotiation achieved between both sides. If it were to be 50%, you still believe that that will be manageable, in your words. Can you explain to us what the impact is likely to be and why you believe that India should be able to ride through this?
Yeah, hey, thanks for raising that question. I think for us, if you see India, it's an economy that's not extremely trade-oriented, right? If you look at the exports to GDP, in terms of exports to the US, it's only about 2 or 2.2% of Indian exports goes to the US. And once you factor the fact that there are sectorial exemptions on certain products like pharmaceuticals and also consumer electronics, ultimately, the exposure to the US in terms of GDP of the exports is only about 1.1%. So therefore, even with a 50% tariff, if it was to go to that high, we don't think it will overly impact the growth story. A lot of India's growth is driven by domestic consumption. And it could have some sort of a short-term impact on growth, but that impact we expect it to be small and manageable. But over the longer term, we do think that the long-term economic growth prospects of India remains very, very strong.
Well, Yifan, this is Ritu just stepping in as well. In terms of specific fiscal, milestones or growth numbers you'd look at, what are the, specific steps that India would have to undertake or targets India would have to achieve to consider the next upgrade now to BBB+?
Yeah, I think we've pointed out in our outlook statement of what it would take to get to the next level, right? I think one important thing is further fiscal consolidation, right? That's one of the factors that drove the current upgrade, which is we see a very strong political commitment from the government to consolidate the fiscal balance. I think going forward, the state government finances will be something that we'll be watching out for. We recognize that the central government, the deficit has been declining quite quickly. But if you look at state government deficits, they have not been declining as quick as the central government. And in our rating methodology, when we look at the fiscal deficits, we look at it from a general government's perspective, which is the central plus the states. So I think if the state government is able to consolidate even quicker, I think that could help to bring about further upward rating pressure.
Well, quickly, how should we reconcile S&P's rating upgrade with that of, with India's rating as far as Fitch and Moody's are concerned? I mean, what is the specific metric you looked at where India stood out? You think, the other rating agencies have not looked at?
Yeah, unfortunately, I won't be able to comment on the rating methodology of other rating agencies. But what I can speak about is to really focus on one of the key strengths that we look at for India, right? I think for us, one of the important strengths that India has, which is also a very large weightage in our rating criteria, is actually on the external position. India scores very well in that. Current account deficits has been very small. It's been covered by FDI flows in the past. And portfolio equity flows as well. And the central bank has accumulated a high level of reserves. And overall, one important thing also is the government doesn't borrow in foreign currency. So all in, you're looking at an economy with a very high level of net external asset position. So that actually places India very strongly in our external scoring. Fiscal, as you know, the scoring is still quite weak. Monetary assessment is one thing that we also look at as well. I think, as you also mentioned earlier about the inflation coming under control, I think that also signals monetary policy getting better in India, which is more conducive to strengthening transmission mechanism from the RBI. The very high growth that India enjoys is also something that we also take into account into our consideration. If you look at India's high growth numbers, it also signals that it's able to have that strong flow-on impact into debt and also towards fiscal numbers as well. So all this help to moderate the fact that despite still wide deficits, that the GDP is still coming down gradually because of strong nominal growth.
Well, you talked about the factors that have helped in S&P moving as far as India's outlook is concerned, and with that upgrade coming in. If I were to ask you about some of the risks that you foresee, as we talk about the growth story as well, Yifan, what would be some of the key risks that you would watch for?
So I think key risks is, of course, if the government starts to not focus so much on fiscal consolidation. If the government starts to, have decided that they need to spend a lot more, I think that could be something that we will watch out for. But one thing also is the quality of spending of the government. That's something that we've mentioned in our reports quite a few times about how we think that has been improving quite a lot in the last few years as they tilt more and more towards infrastructure investment. So let's say if deficit starts to get even wider, and at the same time the quality of government spending actually reduces, they start to spend less on infrastructure instead to put more into subsidies and things like that. I think that could be a sign that this could be a sign that this could be erosion of political commitment to push through reforms. I think that could be a sign for us potentially to be a downward pressure on the rating.
Well, so far, at least S&P upgrading India's credit rating to BBB from BBB-. It's taken 18 years. We hope it won't take another 18 for the next move, which hopefully will be moving up the investment grade. Thanks very much, Yifan, for joining us here on CNBC-TV18. That's S&P with its outlook on India and why they have upgraded India's credit rating. We will head into a short break, but up next, India is fully engaged with the US on trade negotiations. Commerce Ministry says talks are taking place at different levels with less than 2 weeks to go for the 50% tariffs to kick in. That and more when we return. Well, let's talk about the market action for the day. The Sensex and the Nifty closing flat with financial stocks lending some support. Midcaps underperformed today. The market breath in favour of the declining stocks. For the week, the market snapping its 6-week losing streak. That's the Nifty absolutely flat and the Sensex as well. For the week, the Nifty closing 1% higher. Similar story for the Sensex and the Nifty Bank higher by about 0.5% or so. Remember, it is a truncated week as we are closed for Independence Day tomorrow. The other big story, India's Commerce Ministry says it is fully engaged with the US on trade negotiations. The ministry official said talks are taking place at different levels. Now, this comes with less than 2 weeks to go for the 50% tariffs to kick in. An External Affairs Ministry spokesperson says India is hopeful the partnership with the US will continue to grow based on mutual respect and shared interests.
हमारे दोनों देशों के रिश्ते एक कॉम्प्रिहेंसिव स्ट्रेटेजिक पार्टनरशिप है। जैसा कि आप जानते हैं, ये जो हमारे रिश्ते हैं, द्विपक्षीय रिश्ते, ये आपसी इंटरेस्ट यानी कि शेयर्ड इंटरेस्ट जो हैं दोनों देशों के लोकतांत्रिक मूल्यों और हमारे दोनों देशों के लोगों के बीच में जो परस्पर बहुत मजबूत रिश्ते हैं उन पर आधारित है। ये रिश्ते कई एक ट्रांजिशन और चैलेंजेस को इन्होंने देखा है, इसका सामना किया है। अभी हमारा उद्देश्य है कि हमारी जो सब्सटेंटिव एजेंडा है दोनों देशों के बीच में, उस पर हम अपने को केंद्रित रखें और ये हमारा मानना है और आशा है कि ये साझेदारी आने वाले दिनों में म्यूचुअल रिस्पेक्ट और शेयर्ड इंटरेस्ट के बेसिस पे ये आगे बढ़ती रहेगी।
Meanwhile, India and China are in talks to resume border trade after 5 years. As per Bloomberg, both countries have proposed to restart trade via designated points on the shared border. China's Foreign Minister Wang Yi will be travelling to New Delhi next week in a bid to further ease tensions. He's scheduled to hold talks with Foreign Minister S. Jaishankar as well as the NSA Ajit Doval. India's Commerce Ministry has said that trade developments with China are moving positively with growth in both exports and imports. US President Trump has warned Russian President Vladimir Putin of very severe consequences if Russia refuses to agree to a ceasefire with Ukraine. Now, the warning comes ahead of their first meeting in 6 years, which is set to take place in Alaska. Trump made these remarks after conducting a virtual meeting with European leaders, including Ukraine's President Zelensky. European leaders urging President Trump to ensure that any peace agreement does not sideline Kyiv. Take a look.
Will Russia face any consequences if Vladimir Putin does not agree to stop the war after your meeting on Friday?
Yes, they will. Yeah.
What will the consequences
There will be
be?
consequences.
Sanctions, tariffs?
There will be, I don't have to say, there will be very severe consequences.
There will be consequences if Russia doesn't agree to a ceasefire. That's President Trump. Remember, there will be a press conference, a joint press conference between President Trump and Vladimir Putin after that meeting that takes place in Alaska. And that'll be sometime late Friday night, early morning. And of course, we'll be tracking those developments right here on CNBC-TV18. The big story from the Supreme Court, the Election Commission has admitted that 65 lakh names have been removed from the voter list in Bihar. The Supreme Court has directed the Election Commission to publish the names on the website in a searchable format. The top court has said that citizens should not be at the mercy of block-level officers. Ashmit joins us now with more details. Ashmit, a breakthrough there for the petitioners, relief coming in for the petitioners. Take us through what the Supreme Court has said and where does this now leave the Election Commission's electoral revision exercise for Bihar?
Well, indeed, an important breakthrough. This was the very relief that a number of petitioners had been asking for, that the exclusions that have been made, at least let's put them on record, let's make them public, let's give the public an opportunity to verify for themselves what their current status is as a voter on the election card, on the electoral rolls. Now, bear in mind, the Election Commission began its arguments today where it clarified that they began with 7.89 crore voters in the state of Bihar. That was whittled down to 7.24 crores, thereby meaning that 65 lakh names were reduced. When being asked as to why these exclusions were made, the Election Commission responded by saying that there were instances like in the case of 22 lakh names that were removed on accounts of deaths that were taken place. Now, petitioners have been arguing at length how there are a number of cases where dead people have been shown to be alive and alive people have been shown to be dead. And this was something that was cited by the Supreme Supreme Court as well, which raised questions about the quality of decisions that have been made at the block level officer level for exclusions that have been made. So to that end, the question that was asked by the Supreme Court is why not have more transparency? Why not have the Election Commission publish the data in a searchable format that will allow the voters of Bihar to search online for themselves to be able to see whether their name is on the list or if it's off the list, and if it's off the list, what needs to be done to bring it back online. So towards that end, the Supreme Court giving a very specific direction that 3 days' time is what the Election Commission has to publish the data of 65 lakhs names that have been excluded. To publish that on the website has to be done in a searchable format where you and I, as a voter from Bihar, can search online. Not just that, even the block level officers will be required to put up this data at their respective offices, again giving voters a chance for verification. But that's not all. What's another important aspect as a part of today's hearing is that the Supreme Court, on the third time, they have nudged the Election Commission to go ahead and to accept Aadhaar. Election Commission so far has been refusing to accept Aadhaar as a means of verification. Today, for the third time, the Supreme Court has asked the Election Commission to allow for the use of Aadhaar for verification of electoral rolls.
All right. Many thanks, Ashmit, for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC-TV18. Stay tuned. We're back in a moment.
was my childhood passion, and I'd been an aero modeler since I was 7. And in many ways, I consider myself to be a child of DRDO and HAL. We have to remember an aircraft and a spacecraft are crafted, and that's why there's craft in the word aircraft. So we find these children of painters, sculptors, weavers, basket makers, and we take these children when they're around 15 or 16, and for 3 years they're trained and certified to become aerospace workers. So in Bangalore you've got entrepreneur, engineer and craftsman. In UK we have materials
and robots,
machinery and money. This is actually taught as a case study at IIM Bangalore and IIM Ahmedabad.
Yeah. Today everybody wants to be a defense manufacturing company. Is it that easy?
The two biggest things you need to bring to this business is patience and passion.
So who came up with the names Cheel and Katil?
Well,
and there's Patang as well.
Patang is persistent. It's a tethered drone, which you can use for surveillance. The Cheel is an eagle, and then you see our Katil, which is an assassin. We also have a few other birds coming which have Sanskrit and Indian names.
Let's talk about the Tejas, which you've been involved with as well.
Right.
I mean, you had the Air Force Chief go on record to say, look, I'm getting frustrated with the pace of delivery.
You can't blame HAL alone. It's the whole system. If somebody wants to go out and buy coffee for the year, give a contract, it'll probably take them more time than in Dynamatic we take to decide on a big machine worth 20 crore rupees.
Hello and welcome to the Young Turks Reloaded podcast. I'm Shireen Bhan. We're coming to you from Bengaluru. We're very close to the Bengaluru airport. So through the course of this podcast, you are probably going to hear aircraft whizzing past us. But that's also important because that's really the story we're going to tell you about here on the podcast today. If you've been reading the news and watching headlines, then you know that Make in India in defense and aerospace is the buzzword. It's the big theme today. We're seeing stock markets rewarding companies in this space. But what's important to note is that this is not an easy business to get into, and it's certainly not a business that can get you a quick buck or two. To really understand where we are in the Make in India story, where we are possibly headed, what the opportunities are, but more importantly, what the constraints are that we need to contend and cope with, is a man who spent the last 4 decades, starting at 20 in this space, joining us today on Young Turks. Toby, many thanks for joining us here on the Young Turks podcast. It's a pleasure to have you back on the show. As I said, 40 years now here at Dynamatic. Everyone's talking about Make in India in defense. Everyone's talking about the aerospace opportunity. I want to understand from you, where are we today? Is this the big breakout moment that you believe we could be sitting on, or do you believe that there's more hype than reality?
Well, when we started, we were Dynamatic Hydraulics Limited was a company that made hydraulic products for tractors, agricultural tractors, bulldozers, drill rigs, cranes. Pretty boring markets, but very high precision products because we were pumping oil at 3,000 to 4,000 pounds per square inch. So very highly engineered safety products. And in the early 90s, in a garage behind the pump plant, we started a little garage with a little board on it saying Dynamatic Aerospace. 2 or 3 things. One is it was my childhood passion and I'd been an aero modeler.
Since the time that you were 7,
Since I was 7. And the second was being in Bangalore, which is home to DRDO, NAL, HAL.
Yeah.
We had a lot of opportunities to develop, to actually co-develop. We were developmental partners for their R&D divisions, where we did prototyping, tool manufacturing, and the design of the manufacturing engineering itself before these things went into series production. And so we were involved in almost every program through the early 90s and early 2000s. At a certain point, HAL started building the Sukhoi 30. Yeah. And roughly 1/6 of the airframe was built by Dynamatic in a plant, and that took us a step up. And in many ways, I consider myself to be a child of DRDO and HAL, which we learned a lot from and we grew. Around 2007, we started working for Airbus, and around 2009, we started working with Boeing Defense. And we rapidly became their global sole source for what we do. So around 850 Airbus aircraft, every A320, 318, 319, 320, 321 and A330, we make the flap track beam assemblies. So we actually have facilities in Bristol and Swindon. Now the wings of all these Airbus aircraft are made in the UK in Broughton. So what we did was we acquired businesses and then grew them, put in complete robotic lines. The raw materials which were sourced in Europe were machined at our facilities with robots. Now, India 15, 18 years ago had interest rates that were 16, 17%. Even now it's 9%. We borrow at 1% there, and we have completely robotic manufacturing of very high precision products at scale. And you're able to continuously run these machines 24 hours, 7 days a week. Now, the beauty of what India offers is very high quality engineers and craftsmen. Yeah. So a lot of people think of an aircraft as a highly engineered product. But we have to remember an aircraft and a spacecraft are crafted. And that's why there's craft in the word aircraft. And so while it's a highly designed, highly engineered product, it's also highly crafted. And across the world right now, you're seeing generations of craftsmen who were there for maybe the last 60, 70 years retiring. So there's a need for fine craftsmen. And as a company, we've been very involved in supporting craft. So we work with craft communities, 55 Gram Sabhas around us. We take the children of actual artisans who've been working with their hands from the time they were 2 years old. So we find these children of painters, sculptors, weavers, basket makers, toy makers. And we, along with the government, manage a government-owned industrial training institute, ITI Devanhalli. And we take these children when they're around 15 or 16, and for 3 years trained and certified to become aerospace workers. These come into the workforce and they're world-class craftsmen. Now, Bangalore is also home to the largest cohort of global engineers. So in Bangalore, you've got entrepreneur, engineer, and craftsman. In UK, we have materials,
and robots,
machinery, and money. Low cost of capital. So what we've done is we've created a global best value model, and this is actually taught as a case study at IIM Bangalore
Ahmedabad and Bangalore as well. Yeah.
So, so that's the story in a way of what we've done. If you look at us today, we are a single source for Boeing Defense for their P-8 and F-15EX. Now, the F-15EX hasn't been sold in India, so this is not an offset. We are winning business based on kabiliyat, capability.
And just for the benefit of people who are watching, let's explain what this offset business is, because a lot of the Indian defense manufacturing came about on account of offset obligations. So you're saying this is not an offset.
If you look at what offset means, it means that India buys, let's say, 30 aircraft from Boeing or 50 aircraft from, any of these companies, Dassault, and they put a burden on the seller saying that you will buy from India a certain volume. You'll see a lot of Indian companies going out and selling offset capability that we will produce stuff so you can fulfill your offset obligation.
The mandatory local requirement as part of these contracts.
Yes. So by the way, if our product or production or export ticks that box, that's fine. But that's not what we ever offer. We offer basic, hardcore engineering, design of the manufacturing process, tooling. If you look around us, all the tooling is actually designed and built in Dynamatic. We have capabilities to create manufacturing processes, digitize erstwhile analog processes, and make it really global best of the best. So that's the Kabiliyat part of it.
I want to pick on this Kabiliyat aspect that you spoke of, because you make it sound easy, and it's not. It's far from that. What does it take to create a company sitting here in India that becomes a tier 1 supplier to the global best? Today, everybody wants to be a defense manufacturing company. Everybody wants to be an aerospace manufacturing company. Is it that easy?
The two biggest things you need to bring to this business is patience and passion. And if you're chasing money, you're not going to build a very good, valuable business. So if you take what we've done is, we are, in our heads, we have just built the foundation for a great future. So 2 years ago, we were awarded Boeing Supplier of the Year. That is the best supplier in the world. 3 years ago, we were awarded Airbus's first Global Sustainability Award. We've been Bell Helicopters Best Global Supplier. So for us, these elements of excellence will drive growth. And I think what we've done is, in the programs we have and the ability to consistently deliver reliably for over a decade, decade and a half, you have the trust of customers to do bigger things here and bigger programs, which will make everything we've done seem insignificant. And if you see this campus, you see it's scaled for the next level of manufacturing.
So give me a sense of what the next level could be.
Next level would be large fuselage sections. So if you look at all these companies, if you see our latest ramp up that we're doing for Airbus, it is all variants of doors for the latest Airbus aircraft, the A220. So it's very interesting, because when we started working for HL, it was a big thing that they were exporting passenger doors to Airbus. We're industrializing right now and will start deliveries soon. The passenger doors, the cargo doors, the overwing exit doors, the service doors, and the emergency escape hatches.
So all doors
all
on
variants
the Airbus.
Of doors for A220. The second thing is, if you look at what we're doing with Dassault, we're developing entire fuselage sections for the world's best business jet, which is the Dassault Falcon 6X. And their volume of production is, for the Falcon, is greater than what they produce, the number of Rafales they produce. And when you look at a Dassault Falcon, you have a 2.5 meter diameter on the tube, on the fuselage, going to 2.8 and 3 meters. A 320, an Airbus 320 and a 737, just 3.5 meters. So once you're reliably delivering Falcon fuselage assemblies, the next step is to go on to commercial.
Let's start by talking about what we're seeing happen globally today. There is a fair amount of flux. Geopolitics is dictating who does business with whom at this point in time. There are all kinds of restrictions being put in place. And the view is that India must now focus much more on its own R&D, on its own sort of design and development from a strategic perspective. Now, as Dynamatics and somebody who's worked closely with HAL and DRDO since your inception, how do you look at that opportunity that's opening up today, the indigenization of the defense industry in India?
That's a great question. If you look at us 30 years ago, we were involved in Indian R&D for India. And then we focused, the volumes just ran away, and it's essentially we're a global business with very little Indian. We're India for the world, make in India for the world.
For the world,
And the government, the government has really recognized that there's a real value in India, make in India for the world. Looking at the technology denial, the raw material shortages that are developing across the world, and the disaggregation or fracturing of the global supply chain, they're looking at Atmanirbharta.
Yes.
So we are now coming back, making a whole U-turn back. If you look at us in terms of, we have my new garage, at 59, a new garage, which is called Dynaton. And it's really something very beautiful because we have deep technology. We have developed our own camera systems, our own gimbals, our own autopilots, our own control laws, 5 million lines of code, down to the PCB level. Even on the cameras, we just buy the lenses, we build the cameras in-house.
Okay.
And based on those subsystems, we develop drones. Now, there must be 500 drone companies in India.
I was just going to say that.
If you go to Bangalore, I can throw a stone. I'll actually blindfold myself, throw a stone, I'll hit a drone company. A stone for a drone. But let me tell
That's a nice
you,
line.
Yeah, new one. But let me tell you, most of these guys just import kits. They're doing stuff in 2025 that I did when I was 7 years old. This is not the way to build drones. And if you look at the very large businesses, a lot of them are going in and tying up with some very large global companies, but it's essentially a rebadged global platform. When you look at Atmanirbharta, it means not just India for Indians, but it should also mean with a very significant amount of Indian brain power.
Yep.
And if you look at our Cheel or our Katil, it's a hunter-killer that we've designed, which is quite unique. We have a bird that's persistent. It flies 8 hours. It captures data. It transfers it electronically to the Katil. The Katil flies in a GPS-denied, radio-denied environment, cannot be jammed. And it flies with a jet engine. So it's flying at 600 kilometers per hour. It's a mini missile.
So these are essentially drones that you have designed, developed, and are manufacturing here at Dynamatics.
In-house, yes.
In-house.
We have roughly 23% is from strategic partners. Okay. For example, we have a very unique engine on the Cheel, which comes from Australia. Now, the platforms are designed so that they can be sold to India and India's allies. So we have 77% indigenous content. Of that 77%, roughly 65% is made in Bangalore within 30 kilometers of us.
So who came up with the names Cheel and Katil?
Well,
and there's Patang as well.
Patang is persistent. It's a tethered drone, which you can use for surveillance. And you don't worry because it's electrical. You've got a Jeep with a generator on board. This thing can be up for hours. And then when you're done with your observation post, pull it down and go to the next location. So put it at the borders, put it for crowd management. It's very versatile. The Cheel is an eagle. And then you see our Katil, which is an assassin. And they all talk to each other. All of them have electronics developed and designed by us. We also have a few other birds coming which have Sanskrit and Indian names.
For these birds in specific now, what's the procurement plan? I know from conversations that I've had with people in government that post-Operation Sindoor particularly, I think one of the aspects that the government does intend to focus much more on is drone. And the world is now, post-Russia, Ukraine, etc., what we've seen is move towards, drone warfare. So what do you see as the future for Cheel and Katil from an India point of view and from a global point of view as well?
We're a Bangalore-based Indian company that's global. Our products are designed for the world. That's said and done. The first customer, the first solution that we want to build is for our country. But the products aren't designed to just be sold here.
To India or for India.
They're world-class products, world-class technologies, which will be sold all over to friendly nations. The second part of it is the question you asked about the global requirement of drones. What recent military operations have shown all over the world is the efficiency, the sheer capability of drones in causing massive damage and the bang for the buck. So drones are a tremendous, their time has come. The second part of it is not just the drones, but the software on it, the AI on the drones. So we actually, when I talked about the Katil, the Cheel will give sighting information, targeting information to the Katil. The Katil then is unstoppable. It's got its own brain. We don't control it.
Let's talk about the Tejas, which you've been involved with as well. I mean, you had the Air Force chief go on record to say, look, I'm getting frustrated with the pace of delivery. What's the problem?
The Tejas is a really good aircraft. The fact that we are in 2025 struggling to deliver volumes, I think it's a serious issue and it needs much deeper thought. What we need is a process where the government reaches into all of us willing, private sector, globally competent companies. And they need to change the game. They have to stop thinking about manufacturing of fighter jets as something that has to be done in a traditional manner the way it has been done. You can't blame HAL alone. It's the whole system. If somebody wants to go out and buy coffee for the year, give a contract, it'll probably take them more time than in Dynamatic we take to decide on a big machine worth 20 crore rupees. I'll give an example. If you looked at Indian cricket, we never had that killer mindset that we have today in the past because everybody was focused on not getting out. So they would protect their wicket. And if everybody's protecting the wicket, you can't win. And then you created IPL and we started getting all these youngsters from all over India. And you have this hard-fought, high-tempo game. And suddenly you see India winning globally because these young Indians from all over, new places, new clubs that you never heard of 30 years back, are hitting and aiming for the fences, and they're not worried about getting out. Because they know in the law of averages, if we swing for the fences and we are skilled and we train enough off the field, and the processes are good, they'll deliver the match and bring the cup home. So I think in that sense, if I could use cricket as a metaphor, we need to do that in defense manufacturing in India.
You know, speaking of developments, global developments that could potentially impact your future as well as the future of the ecosystem that you were just talking about, bilateral trade deals, the UK-India FTA. I mean, you've already been transacting on a zero duty basis for, as you were telling me, for the last 18 years. So it doesn't really impact you. But what does it mean overall for more joint ventures, for more collaboration, for more partnerships, for instance? And we're still, of course, waiting for the India-US deal to happen, but the India-US defense collaboration has deepened.
Yeah, so India-US defense has grown warmer over the last decade and a half. The UK corridor that was established by us first has manufacturing in Swindon and Bristol and manufacturing in Bangalore. We're 1 hour away from Heathrow and we're right next to the Bangalore airport. So we looked at time rather than distance. And we said if we can shorten the amount of time, so we said it's only 10 hours. If we machine out, now you take an aircraft part, you take 100 kilos of raw material. The finished flying part is 8 kilos. Now you're only shipping 8 kilos instead of 100 kilos or 80 kilos instead of a ton. So instead of sending it by sea, we send it by air. So we have shortened the WIP cycle to 9 days. A typical, coming back to HAL or some of these big Indian, the largest Indian companies that ship 1,000 tons by sea, they have to suffer, coming down through the Suez Canal, Somali pirates, monsoon, cyclones, and then ship it back. That's a 90-day WIP cycle. So in our working capital cycle, we removed $25 million just by shortening time. So I think that UK-India corridor that we developed so well with an FTA, with reduction of friction, with reducing rates both ways, with a common intent, can be a massive game changer for not just aerospace, but for everything. And the US already has very strong relationships with India in terms of IT and stuff like that. The question is the tariffs. And that's for them to sort out.
One aspect that I want to talk to you about, because again, this is something that's been capturing mind space and headlines, is safety. I mean, we've had unfortunate incidents, and it's been a tough year for aviation globally as well, and the focus is very squarely on safety.
Yes.
As a supplier, I would imagine that that's the cornerstone for you. I mean, it's a cornerstone for the OEM, but it has to be a cornerstone for a supplier as well. I mean, how have you built for safety, and what does it take to actually do that?
So again, it comes back to process, it comes back to skill, it comes back to the traceability, the continuous, trust but test. So if you look at everything we produce has written documents with signatures and stamps from beginning to end, from the suppliers, through our process, to the customer. And then what we've done is we've also created QR codes continuously. So the process is not only verified by hand in the document that travels with the product, but is also constantly picked up digitally and is monitored. Now, the people are skilled. You have a skill matrix. Over 2,000 people have their skill constantly tested. So we have a lot of sports in our company, and you'll find trophy cases across our factory. Some of them are for cricket, some of them for soccer, volleyball, kabaddi, but also for quality and productivity. And we have 48 teams. So you have a very collegial level all the way down to the ground, where people work in a sportsman-like manner with Corinthian values of a sportsman. So if a worker makes a mistake, they never hide it. They've been given that trusted space where they stop the work and they say, hey, this is what it looks like. And we either take it away or we have a documented plan to use the material, rectify it. So first it starts with the behaviors that you have. So nothing is hidden. That's very important. The second is the process that you apply to it. And the third is the constant skilling that you have for your people.
Well, we hope that you continue to build on the Kabiliyat, and thanks very much for sharing with us a very interesting perspective on where the Make in India story is for defense and aerospace. Toby, we wish you and your team at Dynamatic the very best of luck. Appreciate your time here today on the podcast. Well, with that, it is time for us to wrap up this edition of the Young Turks podcast. If you did enjoy watching this conversation, send us your feedback. If you heard all the planes above us, that's only because we're right next to the Bangalore airport at Dynamatics, bringing you the story of Make in India.
Hello and welcome to News Centre. I'm Parikshit Luthra. The top story we are tracking this evening. Finance Minister Nirmala Sitharaman has introduced a bill in the Lok Sabha for amendments to the Insolvency and Bankruptcy Code. The amendments are aimed at reducing delays under the IBC and will introduce creditor-initiated insolvency resolution process. The government has also proposed an out-of-court initiation mechanism for genuine business failures. The changes are aimed at facilitating faster and more cost-effective insolvency resolution. The government also aims to ease burden on judicial systems, encourage ease of doing business and improve access to credit. Group insolvency framework will also look at efficiently resolving insolvencies that involve complex corporate structures. The new law proposes cross-border insolvency framework to protect interests of domestic and foreign stakeholders. The bill has been referred to a select committee of Parliament. To take this discussion forward, I'm now joined by former Finance Secretary S.C. Garg and Kumar Saurabh Singh, partner at Ketan and Company. Gentlemen, thank you very much for joining us. Mr. Garg, one of the major problems with the IBC, the original intent was clear and was good, but what we were seeing is that the average time taken for admission was almost 434 days. And we're not talking about resolution, we're talking about admission. Do you think this bill will do a great service by fixing a time period for an application to be admitted or not?
See, fixing timetable is the easiest thing to do, but adhering to that is the real test. The IBC has the time sort of table for every process, including the total resolution and all. So how would this one, once it becomes the act, so far it's going to the joint select committee of the parliament, they will take time, and what finally becomes the law, we don't know. But assuming that this becomes the law as it has been introduced in the Lok Sabha, there are good proposals sort of to start counting from the day, specifying timelines for the initial admissions and all. Hopefully that is a step forward. But don't sort of discount the ingenuity of Indian legal system, the lawyers and the people involved to sort of test this out as the time comes.
Right. That's an important point, sir. Saurabh, if I can come to you, what do you think will be the proof for global investors and even domestic investors to trust India's insolvency process even better? All right, we will be joined by Kumar Saurabh Singh in some time. Mr. Garg, if I can put that question to you, going forward, if we want investors to trust India's insolvency and resolution process, what do we need to do in terms of implementation?
Well, the bill has many provisions to sort of address the interest or the concerns of the investors, whether foreign investors or domestic investors, including trying to put together a regime for the cross-border resolution, insolvency resolution. This has been in the works for many years. I remember when I was in the system in 2017-18, we were talking about introducing cross-border insolvency resolution. That has come now, and that has come, by the way, only as a kind of enabling provision. The bill talks about that the government will frame the rules as it when you go through it. So becoming the law and then framing the law is quite far in the future. Likewise, the group insolvency resolution is also a very complicated kind of thing. Remember the ILFS issue or the GenSol, and where multiple companies, subsidiaries exist, and if one has defaulted, the other one has not defaulted. How do you resolve in such kind of group bankruptcy and insolvency cases? Again, there, the bill proposes enabling provision. The government will bring the rules in times to come. So we'll have to watch out what comes into those rules. A good move possibly is, yeah.
All right, you're saying a good move, a good intent, a good message that we're sending to domestic and foreign investors. Let me also go across to Kumar Saurabh Singh. Saurabh, if I were to ask you, do you think this bill will address concerns in the banking sector among investors about what has happened with the Bhushan Steel resolution process? Now, the Supreme Court had quashed JSW Steel's plan for resolution in the case of Bhushan Power and Steel. The banks were asked to return 19,300 crores. There was 34,000 crore of bank exposure, which is at risk. This is at a review stage right now. But do you think this bill and the government's message here will address those concerns?
I think the message is very clear. I think some of the problems of last 3-4 years, if you see the last amendment of law came in 2021, and some of the problems which had crept in the system through various interpretations of courts have sought to be addressed through this amendment. Now, in terms of very specific context of Bhushan Steel, yes, I think the intent seems to be to address, but the messaging is more at the NCLT level, because NCLT is required if in case of non-compliance of the provisions of the plan with the law, to send the plan back to COC and give it a chance to come back. Now, while NCLTs are going to work in that framework, I mean, for the apex court of the country, they have lot wider powers and they have exercised discretion in many situations. So, I mean, that, as Mr. Garg was also mentioning, the interpretation of law is something that will be left to the courts. But I think the intent from government side is quite clear. Some of the issues that the process has faced in the last few years, there is an attempt to address it. Does it completely allay all apprehensions? That only time will tell, and it will depend a lot on how the law is implemented through courts. So it will have to be seen over a period of time. But I think the direction of changes seems to be quite welcome and in the right direction.
All right, let me go back to Mr. Garg. Mr. Garg, when it comes to out-of-court settlement, in the case of genuine business failures, there is a provision for this to encourage out-of-court settlements. This will be an important factor in reducing litigation pendency of cases under the IBC process. Do you think if this bill is passed in this form and implemented, a lot of people in the corporate sector will try and resort to this process?
See, this is a very interesting proposal. So what essentially is that the lenders are being put in charge of the insolvency process instead of the court as part of the corporate resolution process. Now, putting the lenders in charge is efficient, definitely. The lenders can take more and faster decision, and they can do a commercial kind of deal in case there are genuine business failures. But the very same proposal can also be misused completely. What we saw in several cases resolved here, where the haircut was 90% or 95%, you don't know whether that was actual business failure or there was sort of some game going on between the lenders and the corporate debtor. So will in future this provision be sort of used to compel bankers to grant the accommodation to whoever need to be favored, or used for the actual genuine business failure kind of cases, is yet to be seen. So it's a double-edged sword in my judgment.
Right. So you're saying it's a double-edged sword. Let me go back to Kumar Saurabh Singh right now. Kumar Saurabh, when it comes to group insolvency provisions and provisions around cross-border settlements, How important are these amendments that are being suggested by the government?
So again, I mean, if you see the proposal, it is creating enabling framework for government to create rules around cross-border insolvency and group insolvency. The law is not really being set through the proposed bill. So in that sense, it will take some effort before we have, say, particularly cross-border insolvency framework in place, because that will also entail discussions between countries, between governments to create a reciprocal regime, because typically a cross-border regime is, created as an enabling framework on a reciprocal basis. Group insolvency, again, we have had experiences like ILFS, which has taken a fair amount of time to resolve. So in that sense, both the aspects need to be addressed very clearly. I mean, the first round of distress that we have seen, say, from 2015 onwards, a lot of that has got resolved. But now is the time really to look at second generation of insolvency reforms. And I think as part of that, these two are very critical areas, not just ILFS, but if one were to look at Videocon, GenSolve, various other cases where you may have businesses spread across multiple companies, and in distress, you take a corporate debtor specific approach. That can be, say, counterproductive, value degenerating. So in that sense, very, very important to have a framework which is functional and not left to courts to decide.
One very quick. Right, that's an important point. My final question to you would be, how important is it to increase the staffing, increase the infrastructure under the IBC framework if we want these new amendments to succeed, Saurabh?
No, I mean, infrastructure is very, very important. And I would also say that, if you look at, say, infrastructure, while there has been a lot of delays, but a lot of it is also because of the gaps which get created in our law. And sometimes at the level of committee of creditors, the tendency to get adjudication from courts. As long as that tendency remains, you will not see merely amendments leading to minimization of disputes or delays in the process. So it also requires some sort of a attitudinal change, and I think support from regulatory side, that if there is decision making which is done by committee of creditors, accept that and move on, particularly if you see examples like BPSL, reopening the whole case, that in a way shakes the confidence of the entire system. So those aberrations, if they are not there, and you create further improved infrastructure, and with these changes, I think things can get better. But I mean, to the larger question, of course, a lot of it will remain to be seen how we implement and whether all the problems get addressed through this changes or not.
All right, Kumar Saurabh Singh and Mr. Garg, thank you very much for joining us on the program. We're taking a short break, but don't go anywhere. The news continues on the other side. Welcome back. Amidst President Trump's trade war, there is a thaw in the bilateral relationship between India and China. This comes ahead of Prime Minister Modi's scheduled visit to China later this month. The first in the last 7 years. This will be a meeting of huge geopolitical significance. Indian and Chinese ties had broken down after the border clashes in Galwan in June 2020. But there is an expectation that from September this year, there will be some stability and predictability in ties. PM Modi is set to visit China for the SCO summit in Tianjin from 31st August to 1st of September. This will be Prime Minister's first visit to China in 7 years. Sources say India's objective would be to instill positivity in the relationship. We have also been told by sources that the India-China relationship at the upcoming meeting between Modi and Xi should not be seen through the prism of an India-US relationship. While India and US relations have taken a rough turn recently, India and China have been working on improving ties for the past few years, and more so after October 2024. When PM Modi met President Xi Jinping on the sidelines of the BRICS summit in Kazan, Russia. Both leaders had agreed to work towards a peaceful and stable India-China relationship, and they had also decided to not allow differences on the boundary issue to disturb peace and tranquility at the LAC. Since then, there have been multiple meetings at the level of foreign secretaries, NSAs, defense ministers, and the external affairs minister. Sources say the consensus reached between Modi and Xi is now being given shape to ahead of the SCO summit in Tianjin. There are signs of a thaw as well. India has restarted issuing tourist visas for Chinese nationals after 5 years. Final timelines for resumption of direct air flights between India and China is expected soon. India and China had earlier agreed in principle to resume direct flight. Reports say China has eased curbs on urea shipments to India, and the Indian industry hopes China will ease supply of specialty fertilizers. China's restrictions on rare earth magnets have created a crisis for the Indian industry, and the automotive sector is hoping that a positive meeting between Modi and Xi will help ease high rare earth magnet exports to India. India has also been clearing Chinese JVs with Indian companies wherever a technology partner is needed for Indian manufacturing. Also in a first, since 2021, an Indian vessel with 496,000 barrels of ultra-low sulfur diesel has been shipped to China. PM Modi is expected to have a one-on-one meeting on the sidelines of the SCO summit. The meeting will definitely set a roadmap for ties for the next few years. Speaking to CNBC Awaz, Indigo CEO Peter Elbers said that the airline is ready to begin flights to China if a bilateral pact is reached between both countries.
The government is planning to open up to China also. So if they ask you to start, are you prepared for that?
You know, whenever the sort of bilateral arrangements between China and India were to enable flights, Indigo clearly is happy to start operating. Indigo was operating there prior to COVID. Indigo is known for its entrepreneurial spirit and exploring it. So if the governments were to come to an arrangement that the air travel would resume, clearly Indigo would be ready to do so.
Swedish home furnishing brand IKEA has opened its first city store in Delhi. This marks the retail giant's big expansion push in India. Shivani Bazar's caught up with the outgoing CEO Suzanne Palvera and IKEA's India's new CEO Patrick Antony to talk about the company's plans in India. Take a look.
Well, IKEA has a brand new store, a city store they're calling it, in Delhi. We are standing here in the new IKEA in Pacific Mall, Tagore Garden. And to speak more about this and IKEA's future plans, we have the people themselves, Patrick and Suzanne. Thank you so much for joining us here on CNBC TV18. Let me begin by asking you, Suzanne, how do you feel about this? And what is IKEA's strategy basically about these city stores? We saw last year that IKEA made its entry into North India. How has that been going, and what role does this play?
I am immensely proud to open the door with the first store in the Delhi region. And it's a city store, but it's the first in a long row of more stores to come. And as you said, we opened the online business half a year ago, and we have now a good sense of what the Delhiites live. So we can further meet them here, and they can come and physically experience our products and solutions. So we are very happy to be here today.
Two big stores coming up in Delhi NCR. The North India market looks up for IKEA. What is the expectation? Is there an expectation, a ballpark figure for sort of what is the kind of plan when it comes to revenue growth, profits? Is there something that you have in mind?
We can say that Delhi is most likely the biggest home furnishing market in India, and hence the expectations are very, very high over time. We have started in one way, which is the online. We're complementing it with various formats, and we will see a quite rapid growth, I believe. So we have much more capacity to do, so we can meet many more of the Delhiites. We don't have a ballpark number to give you, but it's expected to be by far one of the biggest 1 to 2 markets in India for us.
India is looking to include the global tender inquiry feature in the government's e-marketplace. The move is aimed at providing easier market access for government procurement through existing and potential free trade agreements. Abhimanyu Sharma spoke to Mihir Kumar, Director and CEO of GEM Portal, on this feature and began by asking him about the platform's expansion plans.
Our expansion plan depends on the demand which comes from the buyers and the sellers.
So we are working on, firstly, as I was mentioning, the rate contract is one functionality which we have created, which will help the buyer community. The other thing is the global tender inquiry on which we are working, which will be launching in this financial year. So it's a constant journey, it's a constant interaction based on the requirements which are coming from various stakeholders. We try to align our functionality as per the needs. So that is the way to go forward. Secondly, we are trying to say to the states especially who have not been able to do big business through the portal, that there is a lot of merit on coming to the GEM portal. So that is our other endeavor on which we are working.
So you were also debunking myths about the fact that states are also witnessing contracts from outside the state. So GEM portal is not stopping or forbidding, but rather is facilitating the taking of contracts by contractors from outside the state. Now, as we move ahead, we also have insurance, which is growing on the portal. What kind of expansion plans are you looking at in these domains, and also on the procurement aspect which you spoke about? Now, India is signing FTAs. You have a public procurement aspect in the UK FTA. We are also looking at FTAs with other countries. What kind of things are you looking at as far as harmonizing India's standards with these countries is concerned?
You see, so far as the product development and the services development, like for example, insurance as a service or the other services, it's completely based on the demand which is coming from various buyers and the sellers who are able to offer that kind of service or the catalog. So that is a ongoing process. So that's how we have created more than 343 odd services and product vertical more than 11,000 products. Now coming to the other aspect which you are talking about is the bilateral trade agreement and the market access, which is public procurement space. So obviously that will be through the mode of global tender inquiry, which is otherwise also it's a mode of tendering and mode of procurement which is already in vogue. So we were not having that functionality. We will be creating that functionality. We are working on that.
With that, it's a wrap on this edition of News Center. More news and updates continue right here. Hello and welcome to News Center. I'm Parikshit Luthra. The top story we are tracking this evening. Finance Minister Nirmala Sitharaman has introduced a bill in the Lok Sabha for amendments to the Insolvency and Bankruptcy Code. The amendments are aimed at reducing delays under the IBC and will introduce creditor-initiated insolvency resolution process. The government has also proposed an out-of-court initiation mechanism for genuine business failures. The changes are aimed at facilitating faster and more cost-effective insolvency resolution. The government also aims to ease burden on judicial systems, encourage ease of doing business and improve access to credit. Group insolvency framework will also look at efficiently resolving insolvencies that involve complex corporate structures. The new law proposes cross-border insolvency framework to protect interests of domestic and foreign stakeholders. The bill has been referred to a select committee of Parliament. To take this discussion forward, I'm now joined by former Finance Secretary S.C. Garg and Kumar Saurabh Singh, partner at Ketan and Company. Gentlemen, thank you very much for joining us. Mr. Garg, one of the major problems with the IBC, the original intent was clear and was good, but what we were seeing is that the average time taken for admission was almost 434 days. And we're not talking about resolution, we're talking about admission. Do you think this bill will do a great service by fixing a time period for an application to be admitted or not?
See, fixing timetable is the easiest thing to do, but adhering to that is the real test. The IBC has the time sort of table for every process, including the total resolution and all. So how would this one, once it becomes the act, so far it's going to the select committee of the parliament, they will take time, and what finally becomes the law, we don't know. But assuming that this becomes the law as it has been introduced in the Lok Sabha, there are good proposals sort of to start counting from the day, specifying timelines for the initial admissions and all. Hopefully that is a step forward, but don't discount the ingenuity of Indian legal system, the lawyers, and the people involved to test this out as the time comes.
Right. That's an important point, sir. Saurabh, if I can come to you, what do you think will be the proof for global investors and even domestic investors to trust India's insolvency process even better? All right, we will be joined by Kumar Saurabh Singh in some time. Mr. Garg, if I can put that question to you, going forward, if we want investors to trust India's insolvency and resolution process, what do we need to do in terms